Helen Toner, thank you so much for joining us. You're a director at Georgetown Center for Security and Emerging Technology, and you're also an OpenAI board member. Dan Wang, thank you so much for joining us. You're a visiting scholar at the Tsai China Center at Yale Law School, and you've been studying technology and China for many years now.
And we've just heard from Mustafa Suleyman, and he thinks that China's emerged as one of the biggest contenders in AI. So Helen, I'm just curious to start with, do you think we're overestimating China's capabilities?
It's certainly true that they're a big player. And it's also true that we shouldn't underestimate them and that we have a bit of a history of underestimating China's ability to innovate. I mean, I think 10, 15 years ago, the story, at least in Washington, D.C., where I'm based, was, yeah, China can't innovate. If they're producing things that look like new technology, it's because they've stolen them. I think that's clearly no longer true. At the same time, I think it's also very possible to overestimate them. And sometimes I think I see that as well. So are they a serious competitor? Yes. Are they eating our lunch? No.
So that copycat culture, it's fair to say that most people are thinking we're past that stage. Dan, what do you think of that?
Well, I think it's certainly the case that China focuses on different things. So President Xi Jinping is, I think, a little bit less enamored with the internet platforms, with a lot of the cryptocurrencies, with a lot of the AI businesses that Silicon Valley specializes. He's also a little bit less enamored of Wall Street and financialization and hedge funds. And if I had to think about what Xi's broad views are, it would be much closer to being something like capitalism with German characteristics, which is much more about building cars, building hydraulic pumps, building heavy machinery, the heavier the better, about all sorts of these major industrial projects. And I think China is very much a leader in things that include electric vehicle batteries now, solar photovoltaics. It is making a lot of electronics products, and it is innovating on a huge sort of a lot of the automotive supply chain. But I think they have a little bit less of a focus on AI, and therefore there is not so much political direction anymore to really push forward these consumer applications.
I think it's fair, though, some of those areas, the US is also innovating very, very strongly. So are there any areas where China is innovating significantly better than the US?
Well, I would say something like electric vehicle batteries, where China has something like the 70% of all global expansion, all global capacity of electric vehicle batteries is now mostly in China. When it comes to the clean technology supply chain, again, these very industrial projects, these pieces of heavy machinery, that is a little bit more the focus. I think the US is really strong in things that include semiconductors, artificial intelligence, biotechnology. These are things, the smaller things, where China is not so good, but there are big areas in which China is way outbuilding the US.
I mean, the semiconductors is getting significantly better in China. I mean, partly maybe as a result of the Huawei issue. Helen, what's your view on the semiconductor side of this?
So China's definitely been investing for decades in trying to have their own independent semiconductor supply chain. And they've been making some progress. The thing to know about semiconductors is there's a huge range of sophistication, from the really basic semiconductors, computer chips that go in basic devices, your smart fridge, your car, up to the kind of more advanced chips that might go in a brand new iPhone, up to very advanced chips that go in kind of the data centers, gigantic warehouses full of computing, which is what you're training advanced AI systems on. So China has made a lot of progress on the more basic end of the semiconductor sort of scale, and is still really struggling to hit the most advanced end. And that's where, it's not even, you can't even say the US is, alone able to create those advanced semiconductors. But what you have is an incredibly advanced global supply chain.
Many describe artificial intelligence and its development across these two superpowers as an arms race. Is that framework misguided, do you think?
I think it's a bit misguided. I think you really want to look at what kind of AI are we talking about, and in what way might it be a race. I think the place where it's clearest that it makes sense to think in a competitive framework is in kind of military domains. So, it's just true that the US military really wants to make sure that it is keeping pace with, and ideally a little ahead of, the Chinese, or a lot ahead of the Chinese military in terms of what technology they have.
Dan, Washington has taken some steps to curtail some of China's ability to get their hands on the cutting edge chips that really power these AI platforms. What's your take on that? Is that an effective strategy, or will China just find a way to build their own?
I think that China is going to try to figure out a lot of the way to build their own. A lot of the chip makers now have been under very significant stress from U.S. sanctions dating back to about a year ago now, released by the Biden administration, that is really stopping their ability to access not just the high-end chips, but also the semiconductor production equipment as well.
And I think in general, it's really difficult to distinguish between what kinds of technologies should the U.S. really not want China to be able to develop, and where is it fine. So, you mentioned, clean technologies before, where China, if you're looking at, manufacturing solar panels, as you mentioned, EV batteries, a lot of other areas, China is doing amazingly at that. And what you're starting to hear in some, U.S. policymaking circles is that maybe that's a bad thing, that China is making a lot of kind of clean technology stuff. And I find that a little sort of tricky to reckon with, is at what point do we want to really shut them out or prevent them from being, able to manufacture anything if it's something good, useful that we can use. Of course, if it's technologies that we think have really significant military value, I understand, but then it starts, the lines between those categories start to get very, very blurred.
It seems like these tensions are just ratcheting it up even higher as time goes on. With each administration, they're intensifying. So to your point, if we do need these other technologies, solar technology for this transition into a greener future, I mean, what kind of happens next? How much do we place on kind of the AI arms race that could then potentially work against us in climate change? Is that a concern, or is that too far in the future still?
Well, a few months ago, Beijing did announce some export controls on certain solar technologies involved in making production wafers.
So it's already happening.
It is already happening, that there are some threats out there that, relatively speaking, Beijing has been pretty restrained against retaliating against American companies of the likes of Intel, of the likes of Tesla so far, but these things could escalate more.
How does the relationship between, the ruling party in China play out against the kind of the development of companies?
I think the Chinese system is definitely more top-down when it comes to AI development. You see less kind of individual tech companies like OpenAI or Google taking the lead, and more these kind of multi-institution partnerships, or maybe you have a university and a tech company and a government, department all collaborating on big AI projects. That's much more common in China. At the same time, China is a huge country, so there's a limit to how much the government can achieve from the top. So a lot of what you see is sort of Beijing providing direction, providing ideas, providing sort of signaling of this is what we in the central government would be excited about.
Dan, how would you compare how the Chinese government is handling AI with its people versus how they handled social media?
Well, I think President Xi Jinping doesn't necessarily view AI right now, a lot of these ChatGPT-like applications, as some of the most economically productive things that are coming into our society. So I think that President Xi looks much more at AI like he would at Facebook or Twitter, now known as X or whatever it is. These are platforms like TikTok that, if you're asking me, is something like TikTok or Facebook really increasing my personal productivity? Well, I would say actually it is really horribly detracting from my productivity. And so I think that a lot of these AI platforms right now create speech issues. When an ordinary Chinese person sitting in Beijing or Shanghai asks AI, well, what happened in 1989? Well, what do you think of socialism? What do you think of President Xi's performance? These AI tools are having a lot of challenges actually answering socialist correct values that are in line with the government's ideas. And so these are major speech platforms, first and foremost, and perhaps not really the economically miraculous thing that raises our productivity growth at the very moment. Now, it might happen later on. Right now, I think the party views it as somewhere between economically not that useful and potentially very socially destabilizing.
So from a consumer standpoint, AI is almost, it can potentially create more problems for the Chinese Communist Party. But then if you look at it from like a surveillance standpoint or military type of AI applications, that's kind of in a different camp. Is that right?
Yeah, that's right. And I think they're definitely, one area where China is, I would say, leading in AI is on surveillance. They really have leaned hard into facial recognition, voice recognition, even gait recognition. So how you walk in a crowd, can they pick you out by that? I think in the West, there's been some development of these technologies, but with a lot of criticism from civil society, a lot of hesitation, sort of, I would say, like very yellow light. And in China, it's been blaring green light.
On the topic of WeChat, when we spoke ahead of this, I think we touched on the fact that there are some generalized misunderstandings about China's approach to social media and data and AI. AI relying on huge amounts of data, and the perception is that because of things like WeChat and similar things in China, that there's this huge pool of data that the population in China is very happy giving over and is used to giving over, and therefore is just sitting around waiting to be exploited by AI. And I remember that you made a pretty significant point. It's like, that's probably not really the case. And people think that's the case, but it isn't. So I wonder if you could touch on that.
Yeah, I think people have this perception that because the Chinese government is very controlling and has a lot of access to what's going on in Chinese citizens' private lives, that means that there's these beautifully curated, extremely complete, large databases of information that can be used to train AI systems or to do other things. But for anyone who's ever worked with data, you know that cleaning data, structuring data, making sure that the right information is flowing in the right places is incredibly challenging. So it's both true that the Chinese government can get very detailed information on the private lives of its citizens if it chooses to, and also true that it's incredibly messy the way that works, and incredibly difficult for any given actor to get access to something. So, for instance, a company trying to train some AI model using data is actually subject to a pretty significant data governance setup in China, data governance regulations that make it really challenging to use customers' data for things it wasn't already designed for, or that you didn't already get consent for.
Which we learned from Cambridge Analytica scandal just as one case, and there are many others. That is not the case in the US. It's not the case in Europe. There's a lot going on. The EU's AI Act is pretty widely praised by some people, not everybody, but it's quite broad and far-reaching. But that's not the case in China, in terms of what you're saying.
So China's setup is now more similar to the GDPR that exists in Europe. So around kind of protecting consumer data and giving people the right to opt in to different uses. Of course, in China, there's always the exception, unless the security services think that you might be a dissident, and then they're going to get whatever they want on you. But in terms of kind of companies, they're certainly relatively restricted in what they can do.
Switching gears a little bit, Dan, I'm curious about how China's sluggish economic growth recently weighs into the government's calculus and how they're thinking about AI's potential to spark social unrest.
I think that the Communist Party is very much involved in trying to think about, how to control possible social unrest. I was in Shanghai in November 2022 when there were protests in the streets denouncing zero COVID, denouncing the Communist Party by name, that these were things that were erupting. And so I very much sign on to Helen's description of AI, that China is leading in the AI of censorship. It is leading in the AI of facial recognition. That right now it looks very much like the US is a place where ordinary consumers can tinker with and play around on a lot of these AI tools, whereas in China is mostly reserving these very powerful tools for its own use, potentially to control society. That right now China is in a moment of economic weakness. This might deteriorate further, this might get a little bit better, but there is always this presence hovering over there that the state security might ramp up its technology really to make sure that there are no socially destabilizing incidents.
Well, Helen, Dan, thank you so much for being here. It's been great to learn from the both of you.
Thanks so much.
Thank you very much.
Good morning. This is Horizons Middle East and Africa. Our top stories this morning. The United States launches fresh attacks on Iran after President Trump promised to hit back for strikes on a military base in Jordan. Oil is edging lower and Brent is hovering at around $90 a barrel. Bond rout, U.S. 30-year yields hit a 19-year high after the Fed held rates for a 7th straight month. Investors are concerned Chairman Kevin Warsh is not fully committed to taming inflation. And ADNOC Drilling reports second quarter profits beating average estimates. We'll speak to the company's CEO in the next 30 minutes. It's just gone 8 a.m. across the Emirates. I'm Abir Abu Amr in Dubai. A lot to get through in the show yet again on Thursday this week. But before we do that, a quick markets check starting with U.S. futures that are gaining 0.3%. This is following a slight or a big negative close in the S&P 500 yesterday. It was 1.5% lower after earnings that were reported by both Meta and Microsoft. We'll get into the details of both those Mac 7 names later in the show and discuss just exactly what was happening there, why one was turning higher, the other was turning lower. And then we take a look at Asian equities, quite flat. They were between gains and losses earlier in the session, but now we're seeing very slight movements there. We have Avril in just a second to talk to us about what exactly is happening in Asian equities and what is driving the momentum or the lack thereof this morning. And then Brent crude prices 89.6, edging very close to the $90 on the barrel. Escalations in the Middle East, the U.S. hitting back. We'll discuss that in just a second as well. And then we're also keeping an eye on the yield on the 10-year notes. Not just the 10-year notes, but also the 30-year notes. The yield there surged quite a lot yesterday after a halt or a no change by the Federal Reserve yesterday. But then if we flip the board, we take a look at a fascinating chart that was flagged by our markets teams yesterday, and that is about just the KOSPI and other gauges as well, and the volatility there. Look at that last bar. It is essentially showing the KOSPI, the red is the KOSPI, and it shows just exactly how much volatility there is in its performance over the past couple of weeks or so. So we've titled it Korea's 90-Day of Madness. The KOSPI was on track or was the best performing equities gauge in the world. It is set for a very negative month this year. But we've got Avril Hong, as usual, in our Singapore studio to let us know just exactly what is happening in those Asian markets. Avril, what do you have for us?
Yeah, the KOSPI and tech stocks in the spotlight yet again, Abir. I mean, we're seeing that selling in tech names experiencing a bit of a breather, and it is a much needed one, right? Because we have, of course, been seeing that heavy selling this week. The mood is being lifted by Microsoft Cloud unit, the growth there, fastest pace in 4 years. But you also have Samsung earnings, the chip unit, the profit there surging 254. And then it also expects in this half of the year, robust memory demand to continue. And then Advantis in Japan also with its outlook beating. That's a stock that's surging about 12% today. So overall, you do get the sense that investor concerns that massive capital expenditure might not necessarily translate into huge enough profits. Those concerns are easing off a little. That being said, you have to be quite brave to be a dip buyer, given the specter, especially in Korea, of forced deleveraging as well as these wild swings. That's certainly something that we're seeing in the stock of Samsung today, which is pairing the gains of upwards of 8% earlier, and certainly something that's drawn concern among authorities who are now announcing as well yet more curbs on leverage ETFs. I would also just highlight that in terms of the reaction function to the Fed signals, it's really in the form of bonds today getting hammered and tracking those declines in treasuries.
All right, Avril Hong in Singapore with those details. I quite like that you have to be brave, Avril. But we're going to return to our regional story with Brent crude, which is trading near $90 on the barrel after rallying by almost 8% in the previous session. That is following a fresh wave of U.S. strikes against Iran. U.S. Central Command says it is retaliation for attempted Iranian attacks on its forces in the region. The Islamic Republic targeted a military base in Jordan yesterday. So to unpack all of this, we're bringing in Onur Ant, Bloomberg's managing editor for the Middle East, North Africa, and Russia. Onur, good to have you on this morning. We're seeing kinetic motion yet again in the region. The U.S. now striking targets in Iran, saying it's military targets. So we're not seeing bridges attacked or infrastructure for civilians. But what exactly can you tell us about the latest when it comes to those tit-for-tat strikes?
Well, the tit-for-tats were off for about a week. So this overnight strikes by the U.S. marked the first time that the U.S. announced attacks on Iran since last week. And the lull there was about giving diplomacy a chance to stave off further fighting. But we've seen this pattern of lulls followed by fresh attacks by the U.S. and Iranian retaliation over and over again. And the main reason for that is basically the differences over the key issue, Hormuz, and who controls it and how. They're just too wide, and without a rethink of the fundamental positions held by the U.S. and or Iran, either through military means or through some diplomatic avenue, it's just very difficult to foresee a permanent cessation of hostilities instead of this tit-for-tat followed by lulls come about anytime soon, Abir.
Yeah, and you mentioned the Strait of Hormuz, and we've reported that over the past week, despite the lull that we've seen, now a restart in the attacks, but despite the lull, that movement was paralyzed. But we've also reported that a Qatar LNG ship was able to make its way in Hormuz for the first time in 3 weeks. What can you tell us exactly about the movement in the waterway, given everything that's happening?
It is taking place. It's just very random and unpredictable. This particular LNG carrier was basically sailing around the Persian Gulf for the past 3 weeks or so. We have also seen some other odd movements. There were 3 Japanese vessels carrying Japanese nationals that went through the strait just yesterday, although it went through the so-called Iranian lane without paying tolls, according to Kyoto, the Japanese news agency. So yes, there is some movement. And we know that at least over the past week, there was about 5.5 million barrels a day of oil going through the Strait of Hormuz. But it's nowhere near where the traffic was before the conflict began, and it's very volatile and unpredictable.
Yeah, meanwhile, we're seeing Brent crude really reacting to these headlines every single day. Onur, thank you, as always, for your time. Onur, and Bloomberg's managing editor for the Middle East and North Africa. Now, investors dumped 30-year Treasury bonds, sending yields to a 19-year high, while 2-year bonds were a bit up after the Fed kept rates unchanged. The message was clear. Chairman Kevin Warsh, tough talk about taming inflation is not enough. Here is some of what Warsh had to say after the FOMC's meeting.
Let me reiterate, there is no soft inflation target. There is no soft implicit target. Not on this committee's watch. CapEx is preparing the ground for future growth. Nonetheless, the precise timing and magnitude of effects on the supply side remain hard to predict. I asked for a good family fight and I got one. I heard a lot of commonality on the questions. Were there different leans on the answers? You bet there was. In the high mountain air in Jackson, Wyoming, I'd like to also frame the big questions. There is a tendency, especially with the proliferation of meetings and press conferences, to get caught up in the myopic.
Joining us now to unpack all of this is Rashna Mehta, head of regional fixed income at Maybank Asset Management. Rashna, good to have you on this morning, just in time for us to discuss what happened with the Fed. So I guess I'll start with a simple one. Were you surprised by the decision yesterday? 3 dissents, but still a hold when it comes to the rate.
No, I was not surprised with the hold because we were expecting a hold. And it was actually a hawkish hold. So everything went well, but it's just after the testimony where he was not very clear as to what are the future expectation. I think that surprised the market. And then he looked at the trim mean. So I think it was more about inflation, which he didn't cover it properly. But we were expecting a hold, and it was an hawkish hold, but it's just the testimony was not very clear. And market was surprised by that. And I think that is what drove the 30-year bond yield much higher based on like future inflation expectations.
And so what does this all mean for the potential of what we could see in September? Do you think that we're going to see a hike then, given the 3 dissents, the hawkish hold, as you say?
Yeah, so actually we are expecting one hike. Initially, we're expecting a hold throughout this year. So for central target, there'll be one hike. Either it'll be September or most probably in December. So definitely one hike. But it's just that how he's going to tackle the inflation and the market anxiety about what's happening, and especially because of oil and the war continuing. So as of now, I think it's a lot of volatility, especially given the war situation. So we are staying closer to home. We are just earning the carry in Asian credits. We are buying like 3 to 5 years, 6 years, because the absolute level of yield is still high. But definitely this has not been a good year for fixed income given the volatility. So yes.
So, Rashna, if inflation proves to be stickier and U.S. growth gradually cools down over the next 6 months or so, what part of the fixed income market do you think is going to provide the best kind of returns?
That's why we have realized that a lot of people are pivoting into Australia and CNH markets. If you look at because the dollar rates volatility is too high, so we have seen recently over this year a lot of portfolio managers are switching some of the portfolio from US dollar bonds to Aussie dollar bonds to renminbi bonds. Just to give you an example, Tencent issued a US dollar 10-year bond last month. At the same time, they issued a renminbi bonds. Okay, the US dollar bond yield 10-year was 5%, renminbi bond was 2.5%. Now the dollar bond has sold off about 1 to 2 points, whereas renminbi bond has rallied 2.5%, correct? So this is what I mean, that a lot of investors are saying that, okay, the dollar market is too volatile. From a long-term perspective, even the fiscal deficit is going to be higher. So we have seen a lot of new issues coming out in Aussie dollar market and renminbi market. So that's what we like, those markets.
Okay, so that pivot into Asia is set to continue, essentially. But I want to return to a question about complacency. We've asked that quite a bit in March and April when the geopolitical tensions were at their height. But we're seeing a period of a return to geopolitical tensions, not similar to what we've seen in March and April, but quite heightened. We're also still looking at risks of tariffs and higher for longer Fed. So essentially, what are you looking at? Or do you think that the market has become too complacent yet again when it comes to fixed income in particular?
Yeah, actually, fixed income have sold off a lot. The reason what is happening in the credit market is because we have seen a lot of issuance out of US IG names, hyperscalers. As of now, it has not affected Asian credit spreads that much because Asian credit spreads are in its own world. We don't have that much supply. So I think eventually we do expect credit spreads to widen out, but not too much, maybe another 10 basis point. And I think fixed income players are just sticking to short end, earning because as I told you, the absolute level of yield is still high. So about 5.5%, 6% for a short-term perspective, hold to maturity kind of good quality credits still offers value.
And Rashna, just finally on AI, we've seen those massive companies reporting their earnings, and AI is really fueling domestic growth in the United States, but also we're seeing effects of that elsewhere. So do you see any risk that markets are becoming too bullish on one growth area in particular? And what are the risks of that generally?
Yeah, absolutely. So I feel the AI productivity gains, markets are expecting maybe it'll come end of 2027, 2020. So that is one thing which we are watching very closely, the capital spending which is happening, a lot of debt raising which is happening. Is it going to not, because there's a lot of competition of AI even from China. So eventually we need to watch out this very closely, whether the productive gains will be there in the future and the cash flow will turn positive. So our expectation as of now that we will see the productive gains end of 2027, beginning of 2028. So as of now, we are not worried, but that is one thing which we are watching very closely in terms of complacency in fixed income market, and especially the credit markets.
Okay. Rashna, we got through a lot of those market details. We're going to have to leave it there. Rashna Mehta, Head of Regional Fixed Income at Maybach Asset Management. Thank you for your time. Now up next, the ADNOC Drilling CEO joins us to discuss their second quarter profit beat and the outlook amid geopolitical turmoil in the region. This is Bloomberg.
you the most important news and financial information whenever and wherever it happens. I'm Michael McKee on the Mexican border, and this is Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Technology is embedded in every aspect of our lives, and that revolution is playing out in real time. From finance to defense tech, AI to entertainment, from the road to the stars. Bloomberg is bringing you the stories of companies and people that are pushing tech to new frontiers and the politics reshaping global tech markets. I'm Ed Ludlow, live in San Francisco, and this is Bloomberg Tech.
Every weekday, only on Bloomberg Television.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg. When news breaks,
a redhead across the Bloomberg terminal.
Bloomberg has you covered.
Trump's global tariffs are struck down by the U.S. Supreme Court.
For all the context and clarity you need.
There's going to be now tons of tariff headlines until midterm elections.
Hear it first on Bloomberg.
Welcome back to Horizons Middle East and Africa. The Pentagon has awarded major defense contracts worth billions of dollars as the Trump administration works to boost weapon stockpiles drained by the war in Iran. Lockheed Martin won a $59 billion deal to sharply expand Patriot missile production. General Dynamics and Huntington Ingalls secured contracts worth close to $76 billion for nuclear submarines and upgrading shipyard infrastructure. And Starbucks has raised its full-year outlook after quarterly results topped estimates, suggesting CEO Brian Niccol's efforts to win back customers with faster service and new products are gaining traction. The coffee chain posted a fourth straight quarter of comparable sales growth, and the company says the results reinforce confidence in its growth trajectory. And L'Oreal says surging demand among hairdressers for its professional products helped drive sales in the second quarter. The company reported adjusted quarterly sales gaining 6.3%, rising in all regions, although below expectations in some.
Middle East was below expectations, even though not as much as what we feared. But the fact that China, luxury in China is more positive kind of offsets it. So that's how we navigate.
And a quick programming note, do not miss our coverage on today's BOE decision from the opening trade team. That begins at 12:30 London time. That's 3:30 if you're watching across the Emirates. This is Bloomberg.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound. I'm Jumana Versace. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility.
There's still room to maneuver.
We do see opportunities.
It allows you to increase significantly your net income.
Every trading day, only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
It's Bloomberg Money.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
You're watching Bloomberg Deals.
Welcome to Bloomberg This Weekend.
This is Bloomberg Television.
ADNOC Drilling has reported profit for the second quarter that beat estimates. Profits rose 1.7% year-on-year to $357.1 million, while revenue grew by 2.9%. Joining us now is Abdallah Atiyah Al-Misabi, ADNOC Drilling's CEO. Abdallah, good to have you on this morning after your profit disclosure, essentially 2% almost year-on-year. Congratulations on that. I want to start with the obvious. How were you able to maintain profits on an annual level, uninterrupted operations with everything that's been happening in the region?
Excited to be with you, Abir. I think the simple answer is our people have mastered disciplined execution. What does that mean in practice? I think beating our safety performance, we managed really to reduce our non-productive time by 60%. We deliver new assets ahead of time. We close complex deals ahead of time. I think all in all, it's really disciplined execution what make this performance possible. And from this basic place, I cannot thank enough our people from the rig floor all the way to the boardroom for their support and their discipline. Thank you.
Okay, and so I want to talk about some of the projects that you have. Can you give us any update at all about the unconventional program that's meant to kind of unlock Abu Dhabi's potential when it comes to its assets? Any sort of update on where that is at the moment?
I think we are making very great progress on unconventional to unlock this potential for Abu Dhabi. I think we have started drilling wells in the beginning took us 50 days to drill a well. Today we are about 13 days, so that was a really great performance. I mean, if I can really claim that we have done in this country something is like a benchmark. We are setting a benchmark for the industry. There is no one can claim they have doing 1 mile drilling a day, 1 mile a feet. So this performance is unheard of. So and this is because of the technology, because of the AI, because of discipline of our people.
It's great that you mentioned AI because that's actually going to be my next question. I was taking a look at your report and you mentioned AI efficiency. So how does that work in an industry like yours, and what partnerships are you leveraging within Abu Dhabi, the likes of G42, for example, and its subsidiaries?
I think for us, we believe in AI. AI is there really to help us to be more efficient, more productive. And I think we have really demonstrated the records being broken with the help of AI. Basically, how to anticipate problems in the future. How do you really drill better in the operation? So it's really helping us to efficientize our operation. And that's why we are really setting a benchmark in this industry in the region.
And Abdullah, just finally, you've also reaffirmed or affirmed your outlook for the full year this year. And I want to go back to the geopolitics. Does that factor in the tensions or the escalation that we're seeing in the tensions yet again in the Strait of Hormuz and within the wider region?
We do have a close monitoring of what's happening in the region. I think what matters for us is really how to efficientize and make our operation resilient enough to offset any market condition and situation. And I think this is what you have seen today in our results, that we have beaten last year's performance. And I think that's really clear evidence how resilient this company is to protect its people, its operation, and its customers.
And just finally, expansions in the wider region. We're looking at Oman, Kuwait, anywhere else?
Well, I think our strategy is clear that the growth domestically and in the region is very important. We would like to deliver a sustainable long-term value for our shareholders. So we have closed very good deals on the first half of the year, MBBS and SLDC, and we will continue basically to penetrate other markets whenever we see it at the right time.
All right, Abdullah, we're going to have to leave it there. Thank you so much for your time. Abdullah Atiyah Al-Masabi, ADNOC Drilling's CEO. Now, before we head to the break, some breaking lines across the Bloomberg terminal. SocGen results that just came out. The second quarter equities revenue at around 1 billion euros. The estimate was 997 almost million, so a beat there. We're also looking at a net income, so the bottom line that beat estimates. They're also planning a $1.5 billion share buyback. So another beat for another bank in Europe. That is what it is for Société Générale. And plenty more coming on the show. Stick around.
Anything we do in Africa is going to be more risky than the US. I think the approach we want to take is how are we being compensated for that risk? And one of those is obviously going to be a valuation question. In our minds, valuation is a lot more attractive in Africa, even if we adjust for some of those Africa risks that a lot of Western investors see. So yes, in a lot of ways, you take some of those models that, as I said, might be more asset medium or asset heavy. There might be some more inherent risks. However, if we're saying we're adding some risk because of that kind of model, but we're now solving a core problem as opposed to maybe a nice to have solution in Africa, that might actually offset it. Where if you're solving something that people really absolutely need and can't live without, in a way that then that's a lot less risky. So again, we'd encourage investors to have a less binary view. In other words, the US isn't risky, Africa is risky. That's going to lead to a lot of complications down the road.
Day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Only on Bloomberg.
Bringing you the latest geopolitical news whenever and wherever it happens. I'm David Gura on the Salar de Uyuni in Bolivia, and this is Bloomberg.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg.
Good morning. This is Horizons Middle East and Africa. Our top stories this morning. The U.S. launches fresh attacks on Iran after President Trump promised to hit back for strikes on a military base in Jordan. Oil is edging lower and Brent is hovering around $90 a barrel. Bond rout U.S. 30-year yields hit a 19-year high after the Federal Reserve held rates for a 7th straight month. Investors are concerned that Chairman Kevin Warsh is not fully committed to taming inflation. And a disappointing revenue outlook from Meta, while Microsoft reported better than expected cloud results. We'll unpack the latest U.S. tech earnings with eToro. It has just gone 8:30 a.m. across the Emirates. I'm Abir Abu Omar in Dubai. Let's get a quick look at where markets are sitting at half past. U.S. equities are still turning a little bit higher. U.S. futures 0.4% higher, following a close in the red for the S&P 500 yesterday, 1.5% lower. Now, that did come after President Trump as well said that he will attack Iran quite hard to Fox News. We saw that attack happening at 8 p.m. ET. That sent Brent crude prices higher during the session, but today we're seeing them at $89.8 on the barrel, but still edging very close to that $90 mark. We're keeping an eye on the tech earnings, Max 7, hyperscalers, Meta and Microsoft. We'll talk in details about what happened there just in a few minutes. We're also keeping an eye on Asian equities, 0.2% higher now. They were between losses and gains throughout the session. The Kospi, a big player in this performance. And then finally, we're also keeping an eye out on the 10-year yields in the United States. 2 basis points higher this morning. The 30-year yields, as I mentioned during the headlines yesterday in the session, were the highest since 2007 after that hawkish hold by the Federal Reserve. And so if we flip the board, we take a look at a fascinating chart that our markets teams had flagged yesterday, and that essentially plugs the volatility of different markets. But look at the Kospi. That red bar is the Kospi, was set to have its best year, or was the best performing equities gauge so far this year. But this month, the Kospi really took a beating. SK Hynix, the performance there, the ADRs, we've discussed all of that multiple times. But we're also keeping an eye out on Samsung, which reported earlier this morning. Now, for a deeper dive on what Asian markets are really doing this morning, we've got Avril Hong in our Singapore studio. Avril?
Yeah, Beer, I guess to your point about the volatility, we're seeing Asia's stock gauge pairing the earlier gains. And this is even as some of these investor concerns about how massive capital expenditure from AI names might not translate into huge enough profits. Those concerns seem to be easing off a little bit, especially when you look at the earnings scorecard, cloud unit for Microsoft, that growth there, fastest pace in 4 years. And then Samsung as well, the chip unit doing so well that it was a 250-fold surge in profits, and it even expects solid demand in the back half of the year. Advantis, another AI-related name in Japan, rallying almost 12% on an upbeat outlook. So you have that read-through in pockets of the market, but the concern about forced deleveraging, about wild swings in the market in South Korea, those are certainly still there. So that might keep some investors a bit more conservative, especially at a time where authorities in South Korea seem to be taking a closer look after the market rout and talking about these leverage ETF curbs. Although we are still light on details for the moment, they're certainly looking into the issue. Of course, when it comes to the Fed reaction function, the most keenly felt part of the market, that's been seen in the long end bonds tracking those declines in treasuries. We're certainly seeing in the Asia Pacific that pressure is being felt in bonds as well. Abir?
All right, Avril, thank you as always for those updates. Now moving to the United States and earnings that we saw yesterday. Microsoft shares surged in late trading after better than expected fourth quarter earnings, helped by continued strength in cloud computing and artificial intelligence. CEO Satya Nadella told analysts that the company is on track to roughly double its data center capacity over the next 2 years.
We're also bringing capacity online faster than ever. Over the last fiscal year, we have reduced dock-to-live times for new GPUs in our largest regions by nearly 50%. All up, we added another gigawatt of capacity this quarter and remain on track to roughly double our overall capacity in just 2 years.
Meanwhile, Meta shares fell after a disappointing revenue forecast for the current quarter. It also reported the lowest free cash flow in years. That was a sign of ballooning AI spending. CEO Mark Zuckerberg sought to reassure investors that his focus on AI will pay off.
Our investments in AI are accelerating every major part of our core business. They're improving the experience for people using our apps, driving better performance for advertisers, and helping our teams build new experiences and ship faster. Second, we are developing new personal agents that will be the foundation for our next wave of products and revenue lines in the months and years ahead.
So to discuss all these earnings, joining us now is Josh Gilbert, APAC and Middle East lead analyst at eToro. Josh, good to have you on this morning, timely after those results that we've seen yesterday. Quite a divergence between Microsoft and Meta. So I guess my first question is, when do investors stop rewarding CapEx when it comes to AI and actually start looking at results there? Or has that already started happening?
Look, I certainly think it's already started happening, and I think we've seen that with the divergence between Microsoft results and Meta's results today. I think that's the biggest divergence you're going to get. If we look at Meta, ultimately they're spending hyperscaler money without the sort of the hyperscaler business behind it. They don't really have that cloud business. And, you know, yes, there's promises of compute being sold down the line, but at the moment, pretty much the only way they're making returns off of their CapEx is through the ad business. Whereas when you look at the Microsoft results, it's a completely different picture. Essentially, it was the template for what markets wanted from, you know, the AI spending right now. CapEx was up 70%, but cash flow was, you know, beat by 40%. And that told us it's a business that can comfortably keep spending on this build out without bleeding cash to do it, and whilst growing Azure at the same pace, accelerating Copilot adoption. And I really think the market rewarded that disciplined CapEx. So I think, look, we're certainly looking at those numbers, but it's got to come from a place of, yes, growth, but also not eating into those cash flows.
And Josh, I was taking a look at your notes from this morning, and you say something about Meta. I think you alluded to it just now as well. You say that the core business is not broken, but we're still seeing investors not reacting very positively to those earnings that have come out, especially when you contrast it against Microsoft. Do you think that Meta has a crisis when it comes to its vision, long-term vision, when it comes to AI and all these products that they've launched?
Look, I think the problem is they know they need a second engine. As I say, nothing in the core business at the moment is a problem. Revenue was up 28%, ad impressions were strong, pricing was up 12%. So the machine that's funding all of this is working as it should be. But as you say, the problem comes from margins down, cash flow falling, and CapEx rising, and markets want to return. And when you've got sort of third quarter revenue outlook that came in slightly below forecasts, it's essentially saying, look, Meta is asking the market to fund this increase without sort of a clear acceleration in near-term growth. And I think that, look, let's remember, we've also got this slight hangover as well when it comes from spending at Meta, right? We've still got this sort of worry that, you know, Zuckerberg spent billions of dollars, you know, a long time ago on the metaverse. And Zuckerberg still seems pretty determined to keep spending, which, look, we're okay with, but it becomes hard to justify when CapEx keeps being revised higher. I guess the positive is that, yes, you can slow down your CapEx, but you know, if you're missing on revenues, that's when the fundamental issue comes through. And I think that miss on guidance is what the market is focusing on.
Yeah, but it also shows the market selectivity, really, when it comes to AI spending, the CapEx. I mean, as you have just mentioned. So when it comes to that selectivity and the market really rewarding CapEx in the first quarter of the year, and then a little bit, we saw that into the first month of the second quarter or so. But now the market is really looking at CapEx as a sign to punish those companies. So I guess the question here is, do you think that we'll see a rotation out of those hyperscalers into smaller names, perhaps?
Well, I guess the focus is what we've maybe seen from the likes of your Samsung and your SK Hynix, right? Those CapEx bills usually find their way downstream and into those sort of memory names and wherever we're seeing the bottlenecks. So a lot of the trade over the last sort of few months has been the infrastructure of this AI build out and maybe not in those hyperscalers. I think Meta was a good example again in terms of, they talked about several ways to monetize, compute over time, but they don't really have that at the moment. I think what we're seeing from the likes of SK Hynix, Samsung, Micron, we're seeing huge numbers printed and huge returns, and that's coming from the hyperscalers. Yes, the market is maybe punishing a little bit of that CapEx at the moment because we haven't seen some of the return the market expects. I think Microsoft, though, is a good example. Very early into AI and is now sort of being rewarded through that, through Copilot, and through that Azure growth. But yeah, look, I think that ultimately we're seeing the money flow downstream and, we are seeing some rotation into those names. But also the market is just genuinely worried about if there's going to be oversupply. And yes, we're hearing a lot about demand talk. But again, we want sort of cold, hard numbers. And it's really hard just to look at that forward contracted revenue because there's a lot being spoken about it, but we're maybe not seeing it right now. And that's what's unnerving investors a little bit.
All right, Josh, we're going to have to leave it there. You also alluded to the Asian names there, so that was a good shot. Josh Gilbert, APAC, and Middle East lead analyst at eToro. Now, Airbus reported a 54% increase in second quarter earnings as aircraft production improved. That's refueling the European plane makers' optimism that it can achieve its delivery target for the year. We spoke to the CFO, Thomas Stopfer, about why they're staying away from major deals at the moment.
Well, M&A, we have no big ticket M&A activities in the pipeline. We have said we're looking at some bolt-ons in order to strengthen our portfolio, namely when it comes to commercial aircraft services. We have just closed a transaction with Unical in the first half of this year, but we're also looking into smaller acquisitions that could help to boost our defense business, namely when it comes to cyber or software technologies, specifically for unmanned aircraft. So we're looking, but those would not be, let's say, major acquisitions. It would be bolt-ons, and I think there's nothing specific to predict for 2026.
But when you guys gave the investment update on July 21st, I believe the word you guys used was significant. Are we making too much of the use of that phrasing?
I would say we're looking at our capital allocation priorities are very clear. Number one is we continue to invest into the business because that is the basis for future growth. Secondly, we want to cater for attractive and growing shareholder returns. And number three is indeed M&A. But those things are, I would say, not significant in the sense that they are strategic, transformative transactions. I would always characterize them as bolt-on, and so that means a triple-digit number in terms of million. You may characterize it whatever it is, but from my perspective, those are still bolt-ons that help us to gain some specific capabilities in some areas of our business.
How do you characterize what's going on with regards to the cost cutting on the commercial unit? Should we anticipate additional cost cuts of any significance?
Yes, we've been very successful with a program that we called LEAD in the years 2024 and 25, where we indeed were able to reduce some of the administrative costs, but also were able to contain our R&D costs at the same level as in the previous years. So therefore, I would say the low-hanging fruits we have harvested, but we, of course, still continue to be laser-focused on what I would call cost containment. So we will not allow to let our costs grow in line or even faster than revenue, but they should be growing lower than our revenue growth. And therefore, it should be a contributor to our margin expansion that we're targeting until 2029. And it's absolutely one of the elements that we have for the midterm targets that we've given in our business update last week.
That was Thomas Stopfer, Airbus CFO, speaking with Bloomberg's Romain Bostic. Now, coming up, Anglo is set to be in talks to sell its stake in De Beers. What a $1 billion price tag says about the state of the diamond business is up next. This is Bloomberg.
key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories.
The economy has been doing well. That does not tell you what the future is going to be.
We are taking a step-by-step approach, a very systematic approach with India.
This is a time to put a little more defense into your portfolio.
Insight with Haslinda Amin, only on Bloomberg.
What is going to be the consequence for U.S. markets?
We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
Bringing you the latest business news wherever and whenever it happens. I'm Scarlett Fu, reporting from America's biggest military shipyard. This is Bloomberg.
Welcome back to Horizons Middle East and Africa. Some breaking lines just now from Jordan, which says it intercepted 5 missiles coming from Iran. No casualties were reported. This is according to Jordanian media. Now, oil prices are still in the red, but are edging very, very close at this point to the $90 on the barrel mark, 89.8, 1% lower for Brent. But we're keeping an eye out on those attacks, those tit-for-tat attacks, and the movement in the Strait of Hormuz. But moving on to a different region, Bloomberg understands that Anglo American is in talks to sell its De Beers diamond business for around $1 billion. That is a fraction of its former worth. The current deal structure would see a consortium led by former CEO Gareth Penny paying $750 million upfront and a further $250 million later. So to unpack the story, we've got our chief Africa correspondent, Jennifer Zabazaja, joining us now from Johannesburg. Jen, what exactly is driving the proposed sale at only $1 billion at this point?
Right, Abir, we should remember it was just a few months ago that there were reports that the sale was looking like it was north of $2.2 billion. So this is quite a substantial reduction. Let's just remember, though, that Anglo has been trying to sell De Beers since the takeover attempt by BHP Group back in 2024. Since then, what we've seen with the diamond industry, you were alluding to this earlier, the diamond industry, as many analysts have noted, has been beset with prolonged crises that have really been the deepest that it's seen in quite some time. We've seen a plunge in gem prices for a number of years. Some of this has been because of waning demand of luxury spending in China. We've, of course, covered that. There's also lab-grown diamonds that have been a contributor to diamond prices that are falling. Trade tensions are also a factor of this. And so our Bloomberg reporting is suggesting maybe all of this is contributing to the sale now looking like it could be at a price a bit lower than what people expected. But we should note that the negotiations are still ongoing. So this is just the latest reporting that Bloomberg has.
And Jen, where does Botswana factor into those ongoing or current negotiations?
Botswana is key. We should remember that Botswana sort of tussles back and forth with Russia for the top diamond producer in the world. And so this consortium group that you were talking about in the intro has to get Botswana's approval in order to actually make this go forward. It's not just that. Botswana also partially owns De Beers. I think it's about 50%. They have a 50% interest in Debswana, which is a portion of a group that actually produces the diamonds, but then De Beers, the country owns about 15%. And so any sort of deal needs to be negotiated through the likes of Botswana. So last year, we were actually able to speak with President Duma Boko when we were in New York, and he did tell us up front that the country was looking for a majority ownership in De Beers. And this latest Bloomberg reporting is actually suggesting that potentially sources say that the country would be satisfied with a bigger minority holding. So the question is then, what does that look like for Botswana, especially because this is very key to their own economy? So that's what we're going to be looking for, just what those terms are with this consortium group and with Botswana. And of course, what does that look like for the ownership then of De Beers moving forward?
All right, our chief Africa correspondent, Jennifer Zapazaja, always with those updates. And coming up later, Anglo-American CEO Duncan Wolpland joins the opening trade later this morning. This is Bloomberg.
Welcome to Bloomberg This Weekend. I'm David Gurr.
I'm Lisa Mateo.
And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas.
The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
Bringing you up to the minute geopolitical news whenever and wherever it happens. I'm Anne-Marie Hodern in Beijing, China, and this is Bloomberg.
Technology is embedded in every aspect of our lives, and that revolution is playing out in real time. From finance to defense tech, AI to entertainment, from the road to the stars. Bloomberg is bringing you the stories of companies and people that are pushing tech to new frontiers and the politics reshaping global tech markets. I'm Ed Ludlow, live in San Francisco, and this is Bloomberg Tech.
Every weekday, only on Bloomberg Television.
The Bank of England is widely expected to leave interest rates on hold today at 3.75%. The central bank is sticking to a wait-and-see approach as it attempts to navigate fluctuations in oil and gas prices sparked by the Iran war. For more on this story, let's bring in Bloomberg Daybreak Europe anchor Lizzie Burden. Lizzie, good to have you on this morning. What are you expecting from the BOE later today?
Well, Abir, as you say, the expectation is that the bank will stay in this wait-and-see approach, and that's because it's been given the cover to do so by the latest economic data. So if we run through it, the latest inflation numbers dropped below the Bank of England's expectations to 2.6%. Notable drops for food and petrol. You also had private sector pay growth continuing to ease, businesses' near-term price expectations easing further in July. And the reason that the Bank of England wants that cover to keep its options open is twofold. First of all, the Middle East situation, as you well know, has been flipping from positive to negative and back, and oil has been above $100 a barrel, back down again. So they need to factor that in. And then on the other hand, there's the domestic picture. Of course, we've got a new Prime Minister in Andy Burnham here in the UK. The MPC is going to want to know what his fiscal policy is going to be. Down the line, is there going to be more borrowing? And maybe they'll need to hike rates later down the track. So in terms of today's vote, a split expected of 7-2. Dissents could come from Hugh Pill, the chief economist, Megan Green, an external member, maybe also Catherine Mann, another external member. So we could actually follow the trend of the FOMC last night in quite a few dissents.
Yeah, and then, Lizzie, about the clues on the path ahead, what can you tell us you're expecting out of that?
Well, the guidance isn't expected to change a bit. It's looking like it'll just be a copy and paste from the last time, which is that the MPC stands ready to act as necessary to ensure that CPI inflation remains on track to meet the 2% target in the medium term. That keeps September on the table, but it's going to be interesting how the bank presents its projections. Does it use 3 scenarios like it did in April, or does it go back to having a central forecast with variance around it? In any case, because of those oil price swings in recent days, the projections are going to be mouldy on arrival, but any signal that upside risks have increased would be read hawkishly by the market. Just in terms of where we go from here, markets have been trimming bets on hikes. They only see just over 2 quarter-point hikes for the coming year, and that's compared to 3 or more for a week ago.
All right, Bloomberg's Daybreak Europe anchor Lizzie Burden will be with you in just a few seconds. That is it for Horizons Middle East and Africa. Stay around with us. This is Bloomberg.
Now, some people have written that your bank, Revolut, is worth $75 billion. Have you ever thought of taking your organization public?
Well, the way I think about it, we kind of will be ready probably in 2 years' time. But then again, depends on how good the market is.
Since you don't have an IPO, how do people who work for you make some money? Do you make a market for people to sell their shares internally?
Yeah, so we do secondaries every 1 or 2 years when people can sell certain portion of their stocks to external investors.
So you've done secondary sales for your employees, so employees can then get some liquidity. Do you expect before you go public you'll do any more of those, or are you just going to wait till you go public before you liquefy any more stock?
Yeah, I think so. We might do secondaries as well before we do IPO, because we do it every 1 or 2 years, so we might do secondary as well.
All right, well, if anybody wants to sell their shares to me, let me know. And have any investment bankers told you why they're the best to do the IPO for you?
Yeah, obviously every single one is the best.
Everyone is the best. You're not in a rush to do it. You don't need the money.
So we're a bank, and then for the bank it's super important to have trust, and then public companies are trusted more compared to private companies. So there's
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Live from London, this is Bloomberg Daybreak Europe. I'm Lizzie Burden with your top stories. Worries over wash. 30-year US yields jump to a 19-year high and the dollar slides as investors question the Fed chairman's commitment to tackling inflation. We'll also preview today's decision from the Bank of England. Big tech divergence. Investors reward surging cloud revenues at Microsoft but sound the alarm over Meta's AI spending. And in Korea, bumper chip profits aren't enough to boost Samsung. Apple and Amazon are up next. And the US launches a new wave of strikes against Iran in a return to Middle East escalation. Brent holding just below $90 a barrel. Well, a very good morning. It is a busy Thursday for earnings. We've had the Fed decision. Now we look ahead to the BOE. This is the picture in markets this morning. Asian stocks whipsawing between gains and losses. You can see right now the MSCI Asia Pacific Index is down 0.5%. European futures pretty flat. Nasdaq futures pointing to gains, but of course we closed in correction territory on the Nasdaq yesterday. Futures helped by Microsoft, though Meta falling post-market after a disappointing revenue forecast. Now let's turn to the cross-asset picture. Oil is down 0.6% on Brent at $90 a barrel. The US military has wrapped up that fresh wave of strikes on Iran. It stopped short of hitting bridges and power plants. We've had long-end Treasury yields, as I say, at their highest since 2007 after the Fed stood pat last night. We're up again this morning at 5.23 on the 30-year, up 3 basis points. And the dollar had sunk the most in 2 weeks after that Fed hold. The Bloomberg Dollar Spot Index is pretty steady at the moment, holding at that level. We've got plenty of earnings to bring you this morning, so let's get started. We begin with earnings out of Spain, kicking off with BBVA, one of Europe's biggest banks. Of course, investors poised for another strong quarter. And indeed, we have second quarter net income coming in at €3.06 billion, a beat on the estimate of €2.95 billion, and BBVA announcing that it's going to start a buyback of as much as €2 billion. So that is BBVA. Next up, we turn to AB InBev, of course, the maker of Budweiser and Stella Artois. We're looking for benefits from the World Cup. Can it grow volumes across markets to offset China weakness? What you are seeing is that second quarter organic volume growth is up 0.9%, so just ever so slightly shy of the estimate of 0.96% growth. Missing on that is the redhead for that company. Now, let's turn to broader markets because, as I say, we've had shares whipsawing in Asia. We can get straight to an update from Avril Hong in Singapore. Avril, it feels like traders just don't know what to focus on in Asia this morning.
I mean, I think you used the right word there. Whipsawing is right. You look at the region's benchmark, it's now in negative territory after earlier quite sharp gains. And I think it's just a sign of the times, this volatility that we're seeing, of course, being triggered by the South Korean markets as well. Of course, on the earnings scorecard front, at least, there seems to be a bit of easing of investor concerns that these massive capital expenditures might not necessarily translate into huge enough profits as far as Microsoft is concerned. That seemed to, earlier in the session, boost some of the investor sentiment, but flip the board. We also had earnings in Asia from Samsung Electronics, and for its chip sector, the 250-fold profit surge was handily beating expectations. You also have them seeing memory demand remaining robust in this half of the year. You had Advantas as well, another AI-related name that in this part of the outlook looking quite upbeat, but it's pairing some of the double-digit gains from earlier, and you're even seeing Samsung, which surged 8+% earlier, now slipping. I think it just speaks to the volatility and the continued concerns of these wild swings in the market, forced deleveraging as well, something that's also been catching concern and attention from authorities after they let the leverage ETF genie out of the bottle. They're now under pressure to help stabilize markets given the rout, and they're pledging more curbs for leverage ETFs. Now, flip the board. It's also, of course, about the reaction function to the Federal Reserve's signals, particularly from the words of Kevin Walsh or the lack thereof. We've been seeing in the region tracking Treasury declines, the steep declines in long-end bonds. In Japan, of course, that's in focus because of BOJ tomorrow. Most of the repricing today happening on the 10-year, but we also had a 2-year auction that drew weak demand despite higher yields. This is against the backdrop of expectations of the BOJ tightening. That being said, consensus is for the BOJ to remain on hold tomorrow. Lizzie?
Avril, appreciate the overview. That's Bloomberg's Avril Hong. Well, let's zoom in on the macro side of things, shall we? The US 30-year yield holding around its highest level since 2007 this morning. This after the Fed kept rates on hold for a 7th straight month last night. Now, 3 officials back to hike, but shorter-dated bond yields fell as expectations for a move higher in September ease. So investors questioning whether Chairman Kevin Warsh is really going to deliver on his promises to tackle price pressures.
Let me reiterate, there is no soft inflation target. There is no soft implicit target, not on this committee's watch. CapEx is preparing the ground for future growth. Nonetheless, the precise timing and magnitude of effects on the supply side remain hard to predict. I asked for a good family fight and I got one. I heard a lot of commonality on the questions. Were there different leans on the answers? You bet there was. In the high mountain air in Jackson, Wyoming, I'd like to also frame the big questions. There is a tendency, especially with the proliferation of meetings and press conferences, to get caught up in the myopic.
So a little nod ahead to Jackson Hole, of which we'll have full coverage, of course. But for now, let's bring in Ven Ram, cross-asset strategist at Bloomberg MLive. And Ven, I've got to hand it to you. You told us all week that Warsh was needing a hike for credibility. Now, when we look at the markets, it feels like investors are showing that they doubt his verbal commitments to curb inflation. Could that become a longer-term issue for the new Fed chairman?
Morning, Lizzie. I think that it is definitely becoming a problem already, if not later down the road, because he says that he wanted a family fight and he got one. But what the markets really want to know is, will the real Warsh stand up here? Is he the one who talks very hawkish, as we saw just now, or the one who goes into the FOMC voting committee and then votes to hold rates? That is not what that kind of dissonance is not what the markets want. The markets want clear-cut direction as to where the Fed is headed. Are they going to be able to raise rates as they talk? And is the rates going to be restrictive enough to curb inflation? Warsh is the first one to point out that the Fed has been missing the inflation target for 5 years now, but for 2 meetings now, the Fed hasn't taken any action under the new chairman. So this reminds me of what is happening with the Bank of Japan, which meets tomorrow, as you know, Lizzie, and they have been dragging their feet in raising rates, and the markets have been voting with their feet and sending JGB yields higher, much higher than in most other markets, and they are the worst performing markets. The US is not the worst performing bond market this year, because that title goes to probably Japan and the UK in equal amounts. But I think that the way it's all setting up, I think that the US treasuries are going to be punished, and it's going to become one of the worst performing markets.
OK, Ven, thank you very much. That's Bloomberg MLive strategist Ven Ram. Well, let's also just feed in the tech story here. We'll go back to Asia for this. Samsung's semiconductor arm reporting a more than 250-fold jump in profit, reflecting the headway that it's making against rival SK Hynix in that AI memory boom. The shares, as Avril mentioned, are down now after initially gaining, and we can get analysis now with Bloomberg's Asia tech reporter Newly Purnell. So, Newly, the market reaction has been volatile. How do these numbers sit alongside investors', let's be honest, sky-high expectations for the chip-making industry?
That's right, Lizzie, and that 250-fold increase in profit for Samsung semiconductor arm will be a number that people are going to pay attention to, because there is so much scrutiny and concern, speculation about the demand for these kind of memory gear. There have been concerns over potential overcapacity. Are companies like Samsung and others making too much of this stuff? And then there's also been suggestion that there could be competition on the horizon from China, with a report about companies there perhaps getting closer to making some of this some of the sophisticated tech. So that number will jump out, because it would suggest that companies are still demanding some of the stuff that Samsung is making.
Well, let's also turn to the US because we've had earnings from Meta and Microsoft. Concern around Meta really after it raised the low end of its full-year forecast for both capital expenditures and total expenses. Let's take a listen to the Meta CEO Mark Zuckerberg defending his firm's AI capex plans.
Our investments in AI are accelerating every major part of our core business. They're improving the experience for people using our apps, driving better performance for advertisers, and helping our teams build new experiences and ship faster. Second, we are developing new personal agents that will be the foundation for our next wave of products and revenue lines in the months and years ahead.
Yuli, the market reaction was positive for Microsoft but not for Meta, but both pumping huge amounts into capex. Why has Zuckerberg not been as able to convince investors that his bet's going to pay off quickly?
Right. To understand that, you just have to think about the nature of Meta as a company. Of course, they make the vast majority of their revenue from their billions of users around the world serving ads to them. They had a costly venture into AR and VR and the metaverse, remember that? And now leadership of the company is saying, we're spending these billions and billions of dollars to build out AI capex, and essentially trust us that his stuff is going to pay off. In some other comments later, Mr. Zuckerberg said, we know this is a big bet and we believe it's going to pay off. Microsoft is already making huge amounts of revenue on its cloud business. It said its Azure cloud revenue was up at the highest rate in 4 years. So they have actual services they can sell to companies to take advantage of this boom in AI. Meta, on the other hand, is talking about ways they can incorporate this into tools that users can use. Their AI services, I know they say they've made some advances in some of this tech for helping advertisers on the back end, but users of their front-end AI services, you don't hear them talk about them as much as, say, ChatGPT or Claude or some of these others rivals. So it essentially comes down to Microsoft being able to actually operationalize and make money off of some of this stuff, and Meta saying, we're pivoting, we're spending a ton, it's going to pay off.
Okay, a really useful distinction there. Bloomberg's Newly Purnell, thank you very much for the analysis. Now, let's turn to the geopolitical element in the markets this morning. Brent crude trading near $90 a barrel after the US carried out a fresh wave of strikes against Iran that focused on military targets. It did, though, stop short of hitting bridges and power plants. Also, in the last half hour, the Jordanian military says that it intercepted 5 missiles from Iran. So let's put it all together. We can speak to Bloomberg's Abir Abu Omar, our Horizons Middle East and Africa anchor, of course. Abir, good morning. Just talk us through what's been going on in the last few hours. It's been busy where you are.
Yeah, good morning, Lizzie. I mean, you just alluded to it, right? Tit-for-tat strikes happening yet again in the region. In the past hour or so, Jordan's media put out a report saying that it intercepted, the military, as you have said, intercepted 5 missiles coming from Iran. Now, this follows what was called by U.S. Central Command a heavy night of striking targets in Iran that started 8 p.m. ET. Now, again, you've mentioned that those included military targets. The U.S. this time around did not strike any civilian infrastructure for the time being, right? But it looks like this escalation in the region is returning one more time. This follows a lull over the past few days, Lizzie. We've spoken throughout the course of this week about how the United States stopped attacking Iran late on last Friday, without giving any explanation. The reports that did come about suggested that the United States was running out of ammunition. But nonetheless, we saw that period of quietness restarted by Iran hitting targets in the region. But Lizzie, what's important here is that not only is an escalation returning to the Middle East, but we're also seeing new fronts getting open. Essentially, we're seeing Saudi Arabia and the United States hitting targets in Iraq. Saudi Arabia saying that was an act of self-defense because Iraq militia backed by Iran had targeted energy infrastructure in Saudi Arabia. And so you're seeing new fronts opening up. The Houthis in Yemen also threatening movement in the Red Sea. And so we're seeing these new sort of facets emerging. All the meanwhile, the Strait of Hormuz The movement there still pretty much paralyzed. We saw, though, an LNG tanker that is flagged to Qatar making its way through the Strait of Hormuz with its lights switched on. It's been idling around the waterway for about 3 weeks or so, and so positive signs, but it's riddled in all this negativity that is returning to the Middle East with, as you've mentioned, Brent crude prices now edging very, very close to $90 on the barrel. So it looks like the energy markets are really moving one more time with those headlines that we're seeing coming out of the Middle East.
And indeed, just as you've been speaking, we have tipped past $90 a barrel. 90.75 is where we trade. Brent actually gaining now. Abir, thank you so much. That's our Bloomberg Horizons Middle East and Africa anchor, Abir Abu Omar. Well, turning to the risk events on the docket for today, we have a raft of GDP numbers for the second quarter coming out across the euro area. The euro area number itself at 10 a.m. London time, national numbers in the run-up to that. Then at midday, it's the Bank of England decision, a hold expected, but how much dissent will there be following those hawkish votes at the Federal Reserve? And then at 1:30 p.m. London time, we'll turn our attention stateside for the US PCE and GDP numbers building on that economic picture for the Fed after last night's hold. But still ahead, how is the lipstick effect boosting L'Oreal in times of trouble? Catch our exclusive conversation with the CEO later. But first, French advertising giant JC Deco reports better than expected first half revenue, and the co-CEO will join us next. This is Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything. The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with the close. Weekdays on Bloomberg. Context changes everything.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound. I'm Jumana Versace. Join me on Bloomberg Horizons Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility.
There's still room to maneuver.
We do see opportunities.
It allows you to increase significantly your net income.
Every trading day, only on Bloomberg.
When news breaks,
a redhead across the Bloomberg terminal.
Bloomberg has you covered.
Trump's global tariffs are struck down by the U.S. Supreme Court.
For all the context and clarity you need.
There's going to be now tons of tariff headlines until midterm election.
Hear it first on Bloomberg.
Welcome back to Bloomberg Daybreak Europe, 6:19 a.m. here in London. Well, it is a busy day of earnings. We'll turn to more now. The French advertising company JC Deco reporting better than expected growth driven by digital. And I'm pleased to welcome the co-CEO Jean-François Decaux to the programme now. Great to have you with us, Jean-François. Thank you for making time. Just running through these numbers, you're projecting organic adjusted revenue for Q3 that's just shy of estimates, but there's a beat when it comes to second quarter adjusted revenue growth. What's your message to shareholders this quarter?
Now, we had a very good first half with a very strong financial performance. Revenue was up 5.7%, driven by digital, which grew nearly at 15%, boosted by our programmatic revenues, which grew about 30%. So very good first half. Geographically speaking, as you know, we are very well diversified, which is a plus for the company. US grew at about 20%, UK 12%. We had a very good first half as well in Latin America and in the southern part of Europe, driven by Spain and Italy and Portugal. So very good first half. AI is also helping us in terms of revenues because the tech sector was up 19%. And a lot of campaigns from AI brands. I mean, San Francisco, for instance, but also Shenzhen. About 1/3 of our revenues came from generative AI campaigns.
Okay, well, I'll come back to AI, but just in terms of that regional breakdown, you have got a strong presence in the Middle East. I know you have a presence in Saudi Arabia and the UAE. What impact is the Iran war having on business in the region?
Less than expected. This region is about a bit less than 5% of our revenue. And we were down roughly about 30-35% in the second quarter. And in the third quarter, it's too early to tell. But a lot of companies are basically taking the view that it's business as usual. So they are not stopping advertising as much as one could have expected. So therefore, the impact was not as great as we were thinking when we guided our Q2 numbers.
Yeah, so business as usual in the Middle East, but is there a broader, more global impact of the geopolitical tensions? Are you seeing clients delaying their advertising campaigns? Do you expect a slowdown in activity for the rest of the year?
No, we don't see that. That was the fear in the second quarter. But we grew 5.7% in Q2, well ahead of guidance. And we don't see any slowdown in Q3 across the world. It's a bit too early to tell. Obviously, we said that we think we are going to be up 5% in Q3. But we get a lot of late bookings. Programmatic is now around 12% of our digital revenue. We are well ahead of the sector as a whole, because for out-of-home media, programmatic is about 7% of digital revenue. We're the first company to launch an SSP platform. We also have a DSP and a DMP, which is very unique in the sector. And we are doing extremely well, and the programmatic revenues is almost on a real-time basis. So that's why it's a bit harder than in the past to predict the landing for Q3. Also, we have a lot of late money. But programmatic is helping us to grow the digital revenue, which in the Q2 of this year was about 44% of sales. So very strong digital growth in Q2 and in Q1 as well.
But of course, analysts have pointed out that because you've got such a strong outdoor business, it somewhat shields you from how much AI is changing the media landscape. I just also want to come back to France, a key region, your home, of course. It's less than a year to the presidential elections. Are advertisers concerned about the potential impact of that? Is the politics having an impact on volatility and business decisions for JCDecaux?
Advertising is mainly driven by consumption and by the economy. And the economy in France is not doing as well. Having said that, out-of-home in France has a very strong share of ad spend. It's about 9%, so it's well above the worldwide average, which is about 7% of ad spend. By the way, we are getting market share in a lot of markets, especially in markets where there has been some sort of consolidation and where digital is more than 50 or 60% of sales, like Australia, Brazil, and to a lesser degree, Germany. So France grew at about 1% in terms of advertising revenue in the first half. Our business continues to be very strong. We have a unique network covering more than 600 cities in France. And outdoor is part of most advertising campaigns, whether they include online or television. So the outcome of the next presidential election for the time being is very uncertain, as you know. and we don't see any negative impact on the advertising market as such as of today. Our Q3 is well advanced, and we are quite optimistic about the French business, given our very strong presence in this country.
Okay, Jean-François, thank you
But
so much for making time for us this
AI,
morning. An optimistic outlook. That's all we've got time for, unfortunately. Really appreciate it. Thank you so much. That's the co-CEO of JC Decaux. Well, coming up on the programme, Airbus earnings jump as it ramped up aircraft production. We'll get you the details next. This is Bloomberg.
Bringing you the most important news and financial information whenever and wherever it happens. I'm Michael McKee on the Mexican border, and this is Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
It's Bloomberg Money.
This is the Asia trade.
This is Wall Street Week.
Welcome to Balance of Power.
You're watching Bloomberg Deals. Welcome to Bloomberg This Weekend.
This is Bloomberg Television.
And we're now, for the most part, in an environment that does not impose any tariffs on the products and ship sets that we're shipping around the world. So that is good news. And I think it's also in the mutual interest of all the manufacturers in the world. And so therefore, tariffs is not a headwind for us anymore.
The Airbus CFO, Thomas Terpfer. This is Bloomberg.
A multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
The trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Only on Bloomberg.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate.
More than what you need to know, it's what you need to think about.
Live from London, this is Bloomberg Daybreak Europe. I'm Lizzie Burton with your top stories. Worries over wash. 30-year US yields jump to a 19-year high and the dollar slides as investors question the Fed chairman's commitment to tackling inflation. We'll preview today's decision from the Bank of England as well. Big tech divergence. Investors reward surging cloud revenues at Microsoft, but sound the alarm over Meta's AI spending. And in Korea, bumper chip profits are not enough to boost Samsung. Apple and Amazon are up next. And the US launches a new wave of strikes against Iran in a return to Middle East escalation. Brent edging above $90 a barrel. Well, a very good morning. Checking in on these markets, 6:30 a.m. here in London. And we have Nasdaq futures pointing higher 0.5%. Of course, the Nasdaq closed in correction territory off the back of earnings yesterday. Futures, though, helped by Microsoft reporting its fastest cloud computing growth in 4 years. Meta, though, falling post-market after a disappointing revenue forecast. Now we have oil at $91 a barrel on Brent now. After the US military wrapped up that fresh round of strikes, it did, though, stop short of hitting bridges and power plants. But if we look at the 30-year yield, we are now at 5.22 on the 10-year. Of course, we had the Fed standing pat last night, hawkish messaging. Are we going to see hawkish action down the track? We are currently up 3 basis points on the 30-year as things stand. Now, turning back to the earnings story, we've got so many earnings breaking this morning, but a redhead dropping from Sanofi, raising its 2026 forecast for sales growth ex-FX to about 10%. That is the redhead from them. We are also looking over to Adidas, and we have second quarter earnings from them. Surely a Jude Bellingham World Cup boost we are going to see in these numbers. The redhead is that second quarter operating profit comes in at 574 million euros, so very much shy of estimates of 615.6 million euros. If we dive into this, traders really wanting to see that momentum was going to be there for years and months ahead, so it could take on Nike in the United States, but gross margin at 52.5%. That's a beat on the estimate. We shall have to dive into these numbers more deeply, but they've named Birgit Kretschmer as their CFO. So can she turn these fortunes around? I do wonder. The share's down nearly 9% in the past year, and that compares to the broader German DAX index up nearly 5%. Now, let's also turn to the latest economic data out of France. Second quarter GDP numbers breaking. Economists had expected a move from expansion to growth, but so much uncertainty around this print, given the geopolitical developments, the recent heat waves as well. What you're seeing is a rise of 0.2% quarter on quarter, bang in line with estimates of 0.2%. And just in terms of euro dollar, as you can see there, we are weaker, 0.1% at a 114 handle. Of course, we'll also get Spanish, German, Italian and euro area numbers throughout the course of the day. Well, staying with economics, Fed Chairman Kevin Warsh has insisted that policymakers' decision to leave rates unchanged was not a sign of inertia at the central bank. Next up is the Bank of England. It's expected to hold later as well, as it sticks to a wait-and-see approach to navigate the wild swings we've seen in oil and gas markets. With me now for analysis is Ellie Henderson, economist over at Investec. Really good to have you around the desk, Ellie. So if we look at the latest economic data out of the UK, it's kind of given cover, hasn't it, for the BOE to sit on its hands today. Is there a risk, though, that by holding rates steady, it's too complacent about the risks ahead?
So our view is that the Bank of England will vote today to keep rates steady, bank rate at 3.75%. But we think there'll be a lively discussion around the table. We think there'll probably be a couple of dissenters.
Just a couple?
Just a couple of dissenters voting instead to raise rates at this juncture. Yep. We understand the arguments. Oil prices are sharply higher. But we point out 3 key reasons why we think the MPC collectively will vote to hold. Firstly, policy is already restrictive. So what that means, it's already doing some of the work weighing on inflation. Secondly, the labour market is relatively loose in the UK, so the risks of second-round effects from this oil shock stemming from higher wages is arguably reduced. And thirdly, the MPC would likely be cautious about overreacting to recent developments because the situation in the Middle East is so fluid. We've seen oil prices tip up above $90 per barrel this morning, but last week they were over $100 per barrel. So unless the MPC judge that energy prices will be elevated over a longer period, we think for now they will hold off and wait and see.
We talk about a lot about the international factors. What about the fiscal domestic factors? Of course, we've got a new government in, a new Chancellor in, John Healey, big promises on defence and the cost of living. Do you expect to see borrowing after the autumn budget and that precipitating rate hikes from the Bank of England down the track?
So I think it's going to be a long wait until the budget. The government have to give the OBR 10 weeks warning, so we know it's going to be at least in 10 weeks' time. Of course, a lot of pledges have been made by the government, a lot of promises. At the moment, they're going to be fully funded, and we expect them to be fully funded in the budget. It seems like financial markets do believe that pledge. You know, we look at the spread between gilts and treasuries and bonds, and it's not widened dramatically. But as always, the devil is in the detail, and we do wait till the budget for that.
I mean, just on that, do you think that the margin against the fiscal rules will go back to being razor thin?
So there's been estimates out over the week as to what the headroom will be. Of course, the rise in inflation that we've seen doesn't help, but we have to wait until the budget, see what the OBR comes out with, and also see what cost-saving measures that the Chancellor, John Healey, comes up with. But there's a growing list of wants and needs, and the public finances are tight, but the government does seem committed to sticking to those fiscal rules.
Were you, let's return to the Fed, in the camp expecting a surprise hike from Kevin Walsh at his second meeting? Should he have gone for a hike, even if that's a different question to, whether you thought it was likely?
So we were in the on-hold camp. We thought that the FOMC would collectively opt to hold the federal funds target range at 3.5 to 3.75%, which is what they did. I watched it last night. It certainly was an interesting meeting. We did have 3 dissents. We're not quite sure at this stage why those 3 dissenters voted for higher rates.
Yeah.
Walsh did say that in time, the individual people that voted for a hike will explain their actions. So we wait for those comments, but I think the financial market reaction was very, very interesting.
Well, yeah, does the fact that you had 3 dissenters for a hike make September more likely?
It's hard to tell because we've got very little explanation as to why those dissenters wanted a hike. It's easy to understand. We don't know their views, but, you know, oil prices are higher. Inflation has been above target now for over 5 years. There's got to be a pain threshold at some point where the Fed would want to act, but we don't actually think we're there yet. We had a soft CPI print. We've got obviously PCE later today. There's obviously disinflation in other areas outside of energy, and we think that will be enough for now to satisfy the majority on the committee to hold steady, given that rates are restrictive.
But as you suggest, the comms are in a very different place right now. That statement notably short. Yeah. Walsh, of course, has cut forward guidance. Does it suggest to you that the Fed's deliberately trying to look through the geopolitical noise? And really, when we see this kind of from the Fed as well as the BOE and the ECB, how much harder does it make your job right now?
So a Walsh Fed is very different from a Powell Fed, and change is always hard, but I'm sure in time we'll get used to the new communication strategy, as do I. But yeah, I think what Walsh will be looking at will be the financial market reaction, and that actually, if you saw the moves in the policy-sensitive 2-year yield and the longer-term 10-year, 30-year, that our market's starting to question whether actually the Fed will deliver on its longer-term price stability. I think we've had 2 meetings. It's too early to tell, but that's something definitely I'm sure his communications task force will be looking at.
OK, so big questions on credibility. Thanks for underscoring them. Ellie Henderson there, economist at Investec. And we will be coming back to the Fed story later on in the programme with some charts on this. Meanwhile, viewers in the UK and Europe can watch our special coverage of the Bank of England decision and press conference from 12:30 p.m. London time. You can also see it on the terminal, Bloomberg.com and YouTube. Later on as well, Francine Lacroix will be speaking to the Governor, Andrew Bailey himself. That conversation at 4:30 p.m. London time. But coming up, we shall turn our attention back to earnings. Schneider Electric raising its forecast as second quarter earnings beat. The CEO joins us for an exclusive conversation next. This is Bloomberg.
Look at the more successful economies in the region. The key to their success is continuity. But the way our constitution is written, it actually encourages a lack of continuity. And that's a problem. The term for local government is 3 years when I first became a congressman. It takes you a few months to learn the business and to make your connections, to network, etc. If, for example, you are not particularly favored in the majority, passing a law in a year and a half is not that easy to do. After about a year and a half, you already hear that there's somebody in your district beginning to campaign and is going to oppose you in the next election. So you have to go back to your district to take care of that. And how much work do you get done?
What is going to be the consequence for U.S. markets?
We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
Bringing you the latest geopolitical news whenever and wherever it happens. I'm David Gura on the Salar de Uyuni in Bolivia, and this is Bloomberg.
Welcome back to Bloomberg Daybreak Europe. Now to earnings. Schneider Electric has raised its sales and profit guidance for the year. This after the AI spending boom drove unprecedented demand for its data center equipment. I'm pleased to say the CEO, Olivier Blum, joins us now for an exclusive conversation. Olivier, really great to have you with us on Daybreak Europe. This is a strong set of results. I'm sure you're happy. I can see it on your face this morning. It doesn't seem like you're expecting any sign of the hyperscalers moderating their investments in data centers. Just give us your outlook for the months ahead, please.
Sure. So good morning. Thanks for having me. Look, it's a solid H1, but you know, I like always to compare in sport. We are at the halftime of the game for 26, so let's make sure we continue to deliver very well for the second part of the year. To answer your question, I'd like to remind you that data center, indeed, at the end of last year was 25% of our revenue. But when you see the performance of Schneider Electric at the end of the first semester and the revised guidance, it is indeed thanks to data center, but it's also confirmed the increase of the electrification, because the fundamental driver of growth for Schneider is everything which happened in electrification and in the digital world, therefore AI. And of course, that combination helps Schneider Electric to deliver a pretty strong growth in H1. So data center, you know, is on the rise. We all consume AI. Schneider Electric bring AI in every kind of solution to make energy more efficient for our customer. So definitely we see a solid demand. It's confirmed. We see it for the next 2 coming years, and we are well positioned to capture a large part of the growth.
Well, you've got a really interesting tie-up with AMD, a blueprint for building AI data centers, as well as a separate collaboration with Foxconn out of Taiwan. What's next in that space?
Look, you know, Schneider Electric has been for 190 years an industrial company. I like to say we advance energy tech to the next level. And moving from an industrial profile to a more tech profile, you need to work more with partners, with technology partners, with suppliers, because we need to bring all our capability to deliver more and faster to our customer. So indeed, when you work across the life cycle in the data center, you need to anticipate what are the next generation of GPU with AMD, with NVIDIA, with the hyperscaler. And we are using all our software to make sure we optimize the design. Then we make it easy for our customer to execute and again, to deliver efficiency in the field of power and cooling. Foxconn is a partnership, of course, to support the growth of what we have in data center. We like to build our own factory, but we like also to use partner to deliver even more, even faster everywhere. And we started with Foxconn in North America.
Well, just as another example of how you're partnering with others along the supply chain, you've also announced a deal to buy Cognite for $3.1 billion. That's to expand your industrial data and AI software operations. What's the integration timeline there?
Well, look, in that case, it's a little bit more than a partnership because, as you know, it's an acquisition. It will take a couple of months between signing and closing. But it's a very fundamental acquisition for Schneider. We like to say that our ambition, our strategy is to connect the physical and the digital world. We are everywhere in home, building infra, data center, and industry. We have been providing all those equipment. And our vision is that if we are able to bring the layer of intelligence, we go to the next level of efficiency and sustainability. What Cognite helps us to do is to create a very, very strong data layer, a foundation for data, which is AI native, where we can capture data from the physical world and amplifying with agentic layer and workflow, we deliver eventually more value for our customers. So it's a very, very important acquisition. I've met the team. They have great engineers here in Europe, in Oslo, and we are very, very excited to work with them in the future.
You're also in talks to acquire Shelley Group. What other types of deals are you exploring? Just so much going on. Could we see more in the Internet of Things market?
You know, we are at a very exciting time. For more than 10 years at Schneider, we say we believe in electrification and digitalization. That's what delivers the next level of efficiency and sustainability. And I would say what we have been used to seeing in digitalization in the software world was good, but probably not good enough to deliver that full level of efficiency. Again, if I come back to what I said about Cognite, when you are able to capture data from the physical world and you bring a next level of intelligence for your customer, it's exciting. So to answer your question, our strategy is to grow Schneider Electric organically as much as possible. But every time we find great tech company that help us to accelerate that strategy, of course, we will look at it. And of course, always if we have the right price in front of us.
Okay, so some really interesting hints when it comes to future M&A. Just look, in terms of these results, what's been the impact of higher raw materials costs and tariffs as well on your margins, Olivier?
Well, look, since last year, you know, it has started in 25, we have been impacted by tariff, even if we have a strategy to manufacture 90% of what we sell in every region. So that was the case in North America, but we are accelerating. We've been impacted big time on our product by the increase of raw materials, silver, copper, it continues. And of course, with the Middle East crisis, energy costs are rising, same on transport. So we try to be very responsible. On one side, we push our team to drive more productivity, more cost reduction. And we had also, in some cases, to price up to our customer to make sure we are able to continue to deliver great profit and great return for our investors.
Okay, and geographically, Barclays analysts have said that the market's missing your data center opportunities in China. Would you agree with that? What can you tell us about the Chinese market?
Well, the Chinese market for Schneider Electric has been a very exciting market. You know, I had myself spent 6 years of my life in China. At Schneider Electric, we decided we need to have a China for China strategy. So even from a technology standpoint, there are stuff we do in China we don't do in the rest of the world. But I can confirm that as far as Schneider is concerned, number one, our H1 results are great in China. It's really boosted, one, by the external demand, the export, I would say, the industrial sector, but also data center in China. It's just that the Chinese market is structured differently. The stakeholders are different. The technology might be different, but we see definitely also a fast growth in data center in China.
Just finally, Olivier, I want to get your take on the fears that we've seen, especially this week, this quarter, when it comes to circular funding and AI capex. You've seen the likes of Alphabet and SK Hynix really seemingly punished for investing more. You're someone who's cashing in on the AI rush. What do you make of the market response to all of this?
You know, I would tell you, of course, we've been benefit from AI because we deliver infrastructure, but we leverage AI in everything we do at Schneider Electric. When I talked to you since the beginning about energy intelligence, industrial intelligence, we are a big consumer of AI to amplify everything we do. And I do believe as a company, if you take the way we consume AI for our own technology, for our customer, but also to make Schneider Electric more efficient internally, I'm just at the beginning of the journey. So I cannot comment whether the level is correct or not correct, but I do believe we will consume more AI because it brings more efficiency to our customer and more efficiency to Schneider Electric. Now, we are a very reasonable company. We look at this forecast. We try to be very disciplined in capital allocation, in capacity, but I would say for the time being, we are very, very comfortable with the growth we see in front of us, and we believe it's a very solid one.
Olivier, thanks so much for coming on the show this morning. I'll let you go and enjoy those results. Olivier Blum, CEO of Schneider Electric. Great to see you. Well, we'll be watching L'Oreal as well as Schneider at the Open after it reported quarterly sales that beat expectations on the back of rising demand for hair care products. L'Oreal's ADRs rose as much as 4.7% following the results, and the CEO, Nicolas Hieronimus, spoke exclusively to Francine Lacroix about how the company has been so resilient.
Beauty is a very dynamic category, and it shows once again its resilience in times of trouble. We call it, whether you call it the lipstick effect or the dopamine effect of beauty. The market's growing. It has accelerated a bit in Q2, and people are going for innovation, for quality, and that's probably the reason behind our great first half at plus 6.5%, way above the market growth, is that we brought a lot of innovation and of superior quality into the market.
Do your customers spend differently in the US than they do in Europe than they do in Asia?
Well, the markets are different. Asia is a skincare market, and the good thing about Asia is that it confirms that China is back to positive territory and is driven by luxury. So there's, I would say, a stronger appetite right now for premium in China, and our L'Oréal Luxe division is at plus 10 after 6 months in China, which is very positive. So China is more about skincare. The US has always been a very strong makeup market and remains so, but it's true there's been really an acceleration of hair care a lot in the US. Overall consumption is pretty good in the US. Consumers are pretty resilient. So
what's the hardest thing that you have to navigate, either in terms of tariffs, inflation, or trade in general?
Well, what's clear is that you have to be agile and you have to be able to adapt, whether it's on tariffs, whether it's the price of oil, which has an impact on the cost of transportation, whether indeed it's the impact of the crisis in the Middle East on consumer behaviors as it relates to travel retail, for example. So it's a lot about agility. Of course, currencies also have an impact, and we are happy for L'Oréal that the dollar is a bit better than it used to be. So in the end, it's about seizing the ascending trends and trying to leverage what I think is unique at L'Oréal is the fact that we are very spread. We call that a multipolar model. We are spread across regions and across price points and divisions. So whenever something is struggling a bit, we can bounce back in another area.
Nicolas Hieronimus there, the CEO of L'Oréal, speaking, of course, to Francine Lacroix. Plenty more coming up. This is Bloomberg.
Bringing you the latest business news wherever and whenever it happens. I'm Scarlett Fu, reporting from America's biggest military shipyard. This is Bloomberg.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories.
The economy has been doing well. That does not tell you what the future is going to be.
We are taking a step-by-step approach, a very systematic approach with India.
This is a time to put a little more defense into your portfolio.
Insight with Haslinda Amin, only on Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Welcome back to Bloomberg Daybreak Europe, 6:55 a.m. here in London. And just in these last few minutes, I want to bring you some terminal charts on last night's Fed decision. A 9-3 vote split really crystallising September as a live event, as you can see. Chairman Walsh saying explicitly that rates could be part of the solution if inflation stays elevated. But flip the board over, because the question is, does the market believe him? Credibility in question at this point. The 30-year yield at its highest since 2007. So in other words, the bond vigilantes doing the tightening the Fed hasn't so far. And flip the board one more time, because you can see how long bonds have broken with inflation. Arguably, this is where the capex plans of the hyperscalers and their potential inflationary impact is meeting the macro story. So the Fed holding, the bond market not. And the question for September is whether Kevin Walsh follows the market or lets the market do his job for him. Now let's take a look at the risk events on the docket for today, because that's not the last central bank decision of the week. We've still got the Bank of England decision to come later on today. We also, before that, have preliminary GDP data across the euro area. And at 1:30 p.m. London time, another read for the Fed on the US economic picture in the form of PCE and GDP. It's also a busy day of earnings. The opening trade's got interviews with 5 CEOs over the next 2 hours. Wish Anna and Guy luck. They'll take you all the way to the European cash open. Stay with us. This is Bloomberg.
Today, Wayfair sees immense potential in brick-and-mortar stores.
When we got into physical retail, our view was that, even if the market continued to grow for e-commerce, probably a large chunk of the market in this space would stay offline.
Kate Gulliver showed me around Wayfair's new 150,000 square foot Atlanta flagship store.
When customers who have seen us online come into the store, they're generally a bit surprised by actually the breadth of what we offer. Often if you're going online, maybe you're looking for something particular. But when you come into the store, you walk in, you see the market square, you see all these pillows, you see the decorative accents. So what we're seeing actually is that in store, we do really well in some categories that online are, less a percentage of the total.
How does technology help in kind of making it seamless online to store?
I think
and vice versa.
The biggest thing is for the customer on the front end, that she can be in the store, that she can actually shop here, go back home, complete that purchase. And if you look at these sort of price tags and everything, they're all these digital tags. That's because they're the exact same prices they are online. So you're not going to be surprised that you saw something in the store and then you decided to purchase it online, that it's somehow different and that the offering is different. It's actually very consistent. But when she's here, she can have her app open and everything that she's doing here can be very similar to what she's doing at home. And I think that consistency is quite important.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Bringing you up to the minute geopolitical news whenever and wherever it happens. I'm Anne-Marie Hodern in Beijing, China, and this is Bloomberg.
Good morning. It's Thursday the 30th. What do you need to know? Well, there's a lot. So let's start with the Fed. The market is questioning
the Fed's credibility. Anna's about to show you the US 30-year. There has been a big move. Samsung's chip profits surging 250 times. It's also saying that the memory shortage will worsen. Get this, its stock is lower. And the US and Iran launching fresh strikes overnight. The oil price responding accordingly, moving higher, Anna.
Absolutely. Let's get to another story, because as if that weren't enough to manage this morning, we have a host of European earnings this morning to deal with. Lots of corporates reporting. In the context of that, Euro Stoxx 50 futures up 0.1%, trying to keep our heads amongst all of the drama in the tech story. This is what we see, as you mentioned, Guy, in the 30-year yield, 5.22%. Interestingly, it ticked up on the back of that, or moved higher substantially on the back of the Fed meeting, questioning perhaps then the inflation credibility of the Fed, and it hasn't budged lower again. It hasn't moved lower. It hasn't retreated back. So 5.22 is where we stay. Brent crude up by 1.5% this morning. We've seen a return to the tit-for-tat violence in the Middle East, and as a result, we have a higher oil price. The countdown to the opening trade starts right now.
OK, so let's get Thursday going. It's already going. It's been a massive story overnight. The Fed, the big move that we've seen in the 30-year, the complete kind of repricing, I think, to a certain extent of where inflation expectations are likely to go. Look at where tips are. Basically, Walsh came out last night and said, I'm going to be hawkish. But the market only saw that as talk. It really wanted further action. And, Anna, the Fed's credibility is now firmly on the line. If you look at the work function on the Bloomberg this morning, 66% probability of a Fed rate hike in September now priced.
Yes, indeed. I mean, is that, yes, there's the credibility line. Is it a questioning of the credibility? We saw the movement at the long end of the US curve, as you mentioned. We've also seen a growing number of dissents at the Fed.
Yep.
And so perhaps if you took that as a signal, that could also add up to a higher probability. Maybe the Fed is building toward doing something. But this is only 3 out of all of the FOMC now talking about a rate hike. There is a slightly different interpretation. If you were looking for a more generous one, could you say that the Fed is trying to tighten with language and it's succeeding at doing it at the 30-year horizon? Maybe that's not where they want to tighten. But that is something that some people are talking about. But yes, a lot of people talking about a lack of credibility, because if you just talk and you don't act, where does that leave you?
The curve has steepened significantly. The market is pricing less at the front and more at the back. Basically, that's telling you that it hasn't got a handle on inflation. That's the message, clearly, from that steepening that we're getting out of the curve, I would argue. And certainly that seems to be the interpretation of an awful lot of people. I've read commentary after commentary out of bank after bank overnight saying the Fed needs to get a grip on this situation fairly quickly. It is going to be forced, therefore, to act, probably in September. I can't remember the last time the Fed went once. That probably implies that the Fed is going to go 2 or 3 times. What does that mean for other assets? Where does that take the 10-year? Where does that take the 30-year? Big questions, I think, this morning.
And the statement was only 115 words. This is a Federal Reserve that doesn't really want to say anything.
But
we
that's
have
the problem.
The meetings until the end of this year, but we might not even get those post-Fed decision meetings in the future. It's such a new Fed, and we're still all finding our way.
Let's talk tech.
Let's talk tech. We've had a lot of tech earnings out, of course, overnight and into this morning. So on the upside, on the positive side, you look at cloud, you look at Microsoft, what they're doing on the cloud side, up 43% in terms of those Azure revenues, growing the fastest pace since 2022. That's the upside. That stock up by 9% after hours. Samsung, also a positive story, a 250-fold increase in chip profits, as you said, above the estimates. But even there, you've got the negative around what's happening at their electronics unit, which includes phones. And there, you've got that dropping into a loss for the first time, and this is to do with memory, and where where you're seeing the chip makers moving into the types of chips that data centers need. They're not making the types of chips that phone companies need. Even Samsung, that makes its own chips, isn't doing quite so much of that, and as a result it's harder on the phone side, and that weighs on ARM and it weighs on Qualcomm, which is the other tech story, which was more negative overnight.
Meta, also not good. So that's a narrative that we also need to fold in here. Another one of the hyperscalers that's talking about increasing in terms of its footprint on the capex spend, but also just kind of increasing in terms of the inflationary element to that spend. So it's talking about what leases look like on data centers. They're just going up and up, and it's moving guidance higher and higher. So the costs, therefore, continue to rise, and the market just doesn't like it. And you look at the move in Meta overnight, it is epic. These stocks are getting hammered if even slightly signal any concern around what the cost of the AI build-out now is going to look like.
Yes, and I do think it justifies why we keep asking CEOs and business leaders about return on investment around AI, because it's one thing to say that you're spending a lot on CapEx, but what is that getting you in return? And the positive surprise at Microsoft and the negative surprise at Meta kind of illustrate the importance of those kinds of questions.
Okay, let's talk about what is happening with the Iran story. We've seen further strikes. The US have hit IRGC sites in Iran. The Iranians look like they are hitting back again overnight as well. There's talk of targets being talk of targets in Jordan. You've got also a story kind of breaking around what is happening with LNG tankers on the Red Sea side of things, both at the bottom and increasingly at the top of the Red Sea. And I think this is just going to further cause concern. We've seen a dip in oil prices. They're now coming back up very sharply. How much further do they have to rise going into a weekend which, once again, could prove very tricky?
Yes, exactly. And some of the questionable activity, we're not sure exactly what it is, taking place even into the Mediterranean on the Egyptian coast. So a couple of LNG tankers there, the victims of hits from projectiles. Unclear what the source of those was, but there were fires on board, brought under control. But does this give us another geography to worry about? We're worried about the Strait of Hormuz. We worry about the Red Sea. Do we have to actually start thinking about that part of the Mediterranean? And in amongst that, we see US commercial stocks of oil at their lowest since 2018. Okay. The Strategic Petroleum Reserve down to the lowest since the 1980s.
So let's pull this all together. You've got a Fed that is struggling to get inflation under control. You've got an inflationary input that is coming in from energy. You've got the data center story, which Meta's kind of pointing us towards the inflationary impact there. You look at the 250-fold rise in profits at Samsung's chip business. Where does that? Do we have an inflationary situation that is under control? And have markets adjusted to that fully yet? I think is a question that I think is just kind of ringing around all aspects of what we're watching this morning.
Yeah, absolutely. How do you get anything under control when we see such volatility in the oil price? Let's move on to some of the earnings stories we've had out this morning then, Guy. And let's start with LSEG. So we get numbers out of London-listed LSEG. Full-year revenue at constant currencies. The forecast is 7 to 7.5% growth range. So that's sort of on the outlook side of things. The first half adjusted EBITDA coming in at 2.53 billion. The estimate was 2.49 billion. So that looks to be better than expected and raising that EBITDA margin guidance. So let's start the conversation there, shall we? We are joined now by David Schwimmer, who is here on set with us, the CEO of LSEG. David, good to see you this morning. Thank you so much for coming to speak to us on what is no doubt a busy day. So you're upgrading your guidance for the EBITDA margin. I wonder what visibility you have around the business, what leads you to be confident enough to do that upgrade today?
So we've had a record first half. This is the strongest performance that we have had since the acquisition of Refinitiv 5 years ago. We continue to improve our margin. We're getting great operating leverage out of the business. We're seeing strong traction with our new AI products. We've got thousands of users. And we do have a lot of confidence in the second half. So we have upped our full-year guidance on both EBITDA margin, but also tightened it on the revenue line as well. So feeling very, very good about the business.
Okay, so lots to be positive about. You mentioned AI, and you were waiting patiently as we were just discussing some of the other themes going around these markets. So you won't be surprised if we ask you about return on investment in AI. What are you seeing there? What are you seeing for the amount of money you spend, for the innovation that unleashes, what you get in return?
So first of all, we're seeing significant benefits ourselves in terms of how we operate, in terms of the efficiencies internally, in terms of rolling out new product more quickly. Perhaps more importantly, we are seeing the product that we provide, the data, the content that we provide, being used very actively by our customers in terms of wanting to consume data through AI channels, whether that's LLMs, whether that's through their own technology stacks. And it's actually fascinating because here we are sort of 1 year in, if you will, from the wave of AI disruption last summer. And we can now see real evidence in a lot of areas where, for example, agents use roughly 10 times more data than a human in terms of our MCP channel.
So the SaaSpocalypse drama overdone in terms of worrying about the LSEG business model then?
Certainly. From our case, what we see, our revenues are higher, our sales are higher, our retention is higher, our margin is higher. We've got new products out there that our customers are using in this AI environment.
Ironically, London is perceived as being the anti-AI trade right now. Do you think that's fair?
Well, if you look at a lot of the big companies here, you've got banks, you've got energy companies that are doing very well in this environment. So I think that there are a lot of companies here that are doing a lot of innovative, great things. The market has not benefited, the market here has not benefited from, I'll call it, some of the froth in the U.S. or in Korea.
Yes.
And as we see some questions about that froth, we're seeing a lot of appetite for the great companies that we have here. We saw the FTSE hit a record this week.
Absolutely.
So, yeah.
Kind of picking up on that point, trading in Q1 was good. What's trading in Q2 look like?
So Q2 was a little slower than Q1. I would say a little bit more normalized compared to Q1, but also was compared to Liberation Day of last year, which was a huge Q2 last year. But overall, we saw a very strong Q2, which is you put Q1, Q2, which is why we had this record first half. So,
how lumpy do you think that's going to be? It's interesting. I was talking to Sergio Mossi in Zurich yesterday, and he was saying he expects spikes of volatility going forward from here. That is effectively what we're going to be looking at as the new normal. How lumpy do you think quarter to quarter is therefore going to look like?
So we have had a lot of volatility in the first half. All the events that you all were talking about in terms of kicking things off this morning, it doesn't feel as if the volatility is going to slow down. And almost by definition, volatility tends to happen in spikes. So volatility is good for our business, whether we see that across the FX trading, the equity trading, the clearing we do of rates, the TradeWeb business. So I do expect, given what's going on, whether it's a question about inflation, whether it's a question about the geopolitics, I expect that we're in an environment where there will be, I'll say, persistent volatility.
Yeah, persistent volatility. And I wonder what opportunities lie in that then for investors of the human or the AI variety. You mentioned agents and the rate at which they want to consume data and use data. I wonder what kind of step change you're looking at then in your customer base. I mean, can we call it that, David? I mean, they're run by someone, so I guess there's always a human in the loop.
So what we're seeing is that our customers, whether big banks, hedge funds, asset managers, pension funds, sovereign wealth funds, the array, they're all trying to address this in slightly different ways. What we are often seeing is a mix, sort of a lot of kind of nuance, if you will, in terms of how our customers are incorporating AI into how they consume our data. Sometimes they're consuming our data through the MCP channel, Model Context Protocol servers, which is a very effective new distribution channel for us. Sometimes they have their own technology stacks, and they may be accessing our data through an API or other channels, and then bringing that into their own environment where they're applying the AI to it there. Sometimes they're accessing it on our workspace, our desktop product. So in many ways, lots of new capabilities, a lot of opportunity to use data in a, I'll say, more empowered way. Mm-hmm. We have so much data within our state that a human could never access, any kind of tiny percentage of it. So to have the agents, to have models accessing it, it's much more powerful for our customers.
I have to ask you about IPOs and whether you're concerned about possibly a couple of them that have been talked about coming through the summer, maybe being delayed. Does that tell us anything about the IPO pipeline and what difference 24/5 trading can make to that?
So with respect to the IPO pipeline, it is stronger now than it's been really since the financial crisis. The timing, of course, is dependent on each issuer. And here we are sort of in the depths of summer, unlikely to see a lot of IPOs coming over the next month or so. But I would expect in the fall, and then certainly going into 2027, we'll see a number of these. And they're reported on a regular basis in terms of companies choosing to come here. So that's looking good. We also have the private securities market, where we've seen some real traction there as well, with Wave and Moneybox and some others just going over the last month. So private companies able to access the London market, the London Stock Exchange infrastructure. You asked about LSE24, which we have just announced. So we'll have basically 24-hour a day, 5 days a week trading on the London Stock Exchange. Yeah. The initial products will be exchange-traded products. And then we may move on to equities further down the road. But this is seen as very attractive for typically either investors around the world, often in Asia, who want to get access to the markets out of our hours, and also for retail on a global basis.
Can I just say before we finish? This show's called The Opening Trade, okay? So that's going to cause us a few problems. I'm just going to point that one out. If you're going to do it 24 hours a day, I don't know what we're going to call the show.
We'll see what we can do for you.
Yeah, we need a new name.
Okay.
We'll work on that. David, thank you very much. Thanks so much for joining us. David Schwimmer, the LSEG CEO. And, of course, we should note, Bloomberg LP, the parent of Bloomberg News, competes with LSEG in providing financial data. So there's the disclosure.
OK, coming up, what are we going to be talking about? The bond market sending a firm and clear message to the Fed chair. Talking tough on inflation last night. That was not enough. We're going to have more on the big moves, particularly at the long end of the bond curve. Plus, we're going to be talking about more on those big tech earnings that we've seen. Samsung overnight, Meta overnight, Microsoft overnight. We're looking forward to Amazon and Apple coming a little later today. Plus, we've got the CEO of Shell coming up next. We're going to focus there on what is happening in the Gulf. It is a very busy morning. You want to join the conversation, and we'd love to hear from you. IB Plus, BBTV Go on your Bloomberg. This is Bloomberg.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo.
And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas.
The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg. When news breaks,
a redhead across the Bloomberg terminal.
Bloomberg has you covered.
Trump's global tariffs are struck down by the U.S. Supreme Court.
For all the context and clarity you need.
There's going to be now tons of tariff headlines until midterm election.
Hear it first on Bloomberg.
Technology is embedded in every aspect of our lives, and that revolution is playing out in real time. From finance to defense tech, AI to entertainment, from the road to the stars. Bloomberg is bringing you the stories of companies and people that are pushing tech to new frontiers and the politics reshaping global tech markets. I'm Ed Ludlow, live in San Francisco, and this is Bloomberg Tech.
Every weekday, only on Bloomberg Television.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound. I'm Jumana Versace. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility.
There's still room to maneuver.
We do see opportunities.
It allows you to increase significantly your net income.
Every trading day, only on Bloomberg.
Welcome back. 90 minutes past the hour. It is a massive morning for earnings on both sides of the Atlantic, actually. Let's talk about what is happening here in Europe, here in the UK. Shell is out with numbers, planning a new share buyback of $3 billion to be complete by the Q3 results. The adjusted profit coming through at $9.84 billion. Just to give you a sense of kind of where the market thought that was going to be, 8.68 was the estimate there. In terms of the adjusted EPS, 176 versus an estimate of 155. So these numbers are strong. Let's talk about why. The CEO of Shell is Wael Sawan, and he joins us now. Good morning. Thank you very much indeed for your time, as ever. Are these results extraordinary? I.e., are they normal? You put a lot of hard work into getting to where we are now, but do you see the environment at the moment as being extraordinary rather than one that you can kind of extrapolate and use as a new benchmark?
I'd say there's three key factors. Definitely the macro around us is volatile. And then the two key factors that we can control, one is operational performance. Teams have been working really hard. This has been a focus area for us, Guy, relentless focus on operational performance improvement, and we're seeing that consistency playing through. But the second feature as well is we are a company built to be able to handle volatility. We have the world's leading trading and optimization capability. And what that allows us to do is to be able to unlock value during times of high volatility. But we're also built to be able to protect for the downside, given our downstream businesses, given our trading as well. And so really what we are trying to do is to be the name that allows a shareholder to be able to benefit from that upside volatility and to have the downside protection.
How much, therefore, of the kind of outperformance relative to expectations that I'm seeing this morning is down to volatility? How much of it is down to trading doing very well and really benefiting from the kind of volatility you describe?
Very difficult to apportion because you will not have the trading and optimization value without the length in the assets that we are currently have. So just to give you a flavor, in our refining business, we have had record utilization, 102%. We haven't seen that in over a decade. That meant that we can actually have the products, the jet fuel, the diesel, the gasoline, to be able to indeed supply our customers at this point in the cycle. Our integrated gas business is on a high. Our LNG Canada venture, for example, is up to its 100th cargo and really achieved full capacity. Our Brazilian upstream business just hit a record this quarter. So all of that, in essence, underpins all of these opportunities to create value. And that's what we continue to do across our businesses.
Good morning to you, Wael. Can I ask you about the Qatar business and focus in on the Middle East for a moment? How long are you assuming that the Qatar business remains offline? What are your assumptions around Qatar at this point?
I wouldn't go into making assumptions simply because the situation is so fluid on the ground. And I was there just a couple of months ago to be able to meet with the team. Of course, we had some real challenges there. A missile hit one of our facilities. Thankfully, no one was hurt, and we are well on our way to repairing the damage that was incurred there. What I would say is at the moment we keep a very close eye on what's happening in the Straits because at the end of the day the facilities are offline pending our ability to evacuate product, as of course is the majority of the oil and gas resources that are needing to traverse the Straits. And so no guesses on how long it's going to take, but suffice it to say we continue to focus on first and foremost the safety of our people and then finding alternative supplies to meet our customers' demands.
Well, is your willingness or enthusiasm for investment in the Middle East, is it being challenged at this point by what we've seen over the last 3 months?
The Middle East will always be a core region for energy. And when we look at any investments, we are, of course, always looking much, much longer term. So while, of course, the short-term disruptions are concerning and we need to be able to sort of grapple with what they mean at the right points in the cycle, longer term, we continue to have high confidence and look to continue to have a diversified portfolio of supplies. Of course, we saw the impact of us pulling out of Russia. If we had concentrated on one region or one country, it doesn't play to our model of being a global, diversified energy supplier and one that is able to optimize those supplies to meet our customers' demands. And therefore, I wouldn't rule it out or double down. I think at the moment, we continue to have that long-term view of fundamentals and we'll operate accordingly.
Well, can I just come back to something you said just a moment ago regarding refining? Record utilization. Did you say 101%? Is there a cost further down the road? How long can you run your refineries at that kind of level? What happens with maintenance further down the road? Is there a price to be paid in terms of products further down the road that you think the global economy is going to have to pay?
Yeah, what I would say is 102% indeed what we were able to achieve is testament first and foremost to operational rigor and resilience. Of course, we continue to take the stoppages we need to be able to maintain the facilities, to turn around the facilities. That continues. But the beauty of the facilities, many of them have been with us for over a decade, is that we understand the operating envelope of those facilities. To the heart of your question, though, where are the challenges? The biggest challenge, of course, is the fact that as we err towards producing more jet fuel to meet that season of demand, it does mean that you are reducing gasoline and diesel production. And what we are finding at the moment is both gasoline and diesel are at decadal lows in terms of inventories, which starts to put pressure on those price lines. So we are responding to price signals in the market. And as a company, the biggest thing we can do is to make sure that we get as much production as we can, which is what we are focused on. And then secondly, to make sure that we are then leveraging that trading and supply capability to place those barrels where those price points are most attractive.
Wael, just very briefly, 20 seconds, has the messaging from the new UK government changed at all, given we have a new Prime Minister, to the sector?
Early days, of course, congratulations to Prime Minister Burnham for stepping up to the role. What I would say is at this moment in time, we are trying to continue to relay one core message, which is that we need to be able to have stability in the fiscal environment, stability in the investment environment. That is the biggest thing that any government can offer us anywhere in the world, and we continue to encourage this government and any other government to do that.
Wael, thank you very much for joining us. Really good to speak to you. Wael Sawan, the Shell CEO. Coming up on the programme, we'll get back to the central banking narrative. The Fed keeps rates steady, but investors signal their worries over Kevin Warsh's commitment to taming inflation. We'll focus on that long end of the curve once again. We'll speak to Kim Crawford, JP Morgan Asset Management. This is Bloomberg.
Wanted to say, Primer is back. We've been scouring the frontiers of science and technology to help explain the difference between the next gold rush and whatever this thing is. And in Season 2, we're upping the stakes. More danger.
Now that is some high-grade uranium mineralization.
We used to have a stable climate on this Earth. Right now, we do not.
More science.
We're pushing the envelope of technology in multiple directions. Software, hardware, chemistry, physics.
The cable is, very cold.
And more CEOs that can nail the photo shoot.
Hundreds and hundreds of billions of dollars are at stake.
While the problems are economic, the solutions are too.
And yes, we will be talking about AI.
There is a lot of humanoid hype out there.
But our future doesn't run on hype. It runs on innovation. Watch Season 2 on all these lovely channels.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Thursday the 30th, good morning. 29 minutes to go until we start trading here in Europe, equity trading. Futures at the moment, you almost wonder whether we're at the point where there is so much going on that there's nothing to do. How do you price in all of this extraordinary news that we're seeing at the moment? The earnings story that we're talking about, what happened last night with the Fed, the story around what's going around AI and the earnings that we're seeing there. So much to fold in. Geopolitics is another factor. It goes on and on and on. Anyway, basically what Europe's doing this morning is nothing.
Not very much, with a whole lot of news. We are dealing with a slightly higher rates environment, aren't we? And that was the handover from the United States yesterday. Certainly the long end of the Treasury curve got a lot of attention as a result of what the market interpreted as not enough hawkishness coming through from the Fed, not enough action, perhaps. You know, do they still have the credibility when it comes to fighting inflation? So we saw those long end yields go higher. And how is that playing out into Europe? Well, it is pushing those yields higher in Europe as well. That's the 10-year you've got on your screen. I'm looking at the 30-year on my screen. We're up by about 5 basis points on the French, the German, the Italian. So we do see a bit of read across from the Fed into the European rates picture. Let's talk about that then some more. The US 30-year yield soared to its highest level since 2007 as investors question whether Chairman Kevin Warsh will deliver on his promise to tackle price pressures.
Let me reiterate, there is no soft inflation target. There is no soft implicit target, not on this committee's watch. CapEx is preparing the ground for future growth. Nonetheless, the precise timing and magnitude of effects on the supply side remain hard to predict. I asked for a good family fight and I got one. I heard a lot of commonality on the questions. Were there different leans on the answers? You bet there was. In the high mountain air in Jackson, Wyoming, I'd like to also frame the big questions. There is a tendency, especially with the proliferation of meetings and press conferences, to get caught up in the myopic.
Well, let's not do that. Let's talk to Kim Crawford, Global Rates Portfolio Manager over at JP Morgan Asset Management. So we won't get caught in the myopic, but certainly the focus for markets yesterday was this big move in the long end of the curve. What did it signal to you then, Kim? Is this about a lack of credibility because there's a lot of talk but no action?
Yeah, I think, given core inflation is at 3.4%, at least the PCE measure is, I think it's a signal that it was too dovish a hold. We need a slightly more hawkish hold. So we saw earlier that, in theory, the resolve to maintain price stability is there, but there were a lot of dovish elements in the Q&A. So Warsh talked down the importance of the last soft inflation data print in this decision. He talked about needing time to understand underlying inflation and what's driving that. He even alluded to the possibility in the future of looking at AI-led inflation a little bit separately from the core. And then also now there's a question mark of whether PCE is going to be their actual inflation measure next year. And then just 2 more points as well. I think it was interesting that he talked about the markets having done some of the tightening, some of the work for the Fed.
Yeah.
Well,
so on that point, so not hawkish enough, but on that point, so it's interesting because you can either cut, and the dominant story this morning does seem to be lack of credibility. That's why the long end yields went higher. But yes, the Fed acknowledges that actually the market is doing the job for it to some degree, and so to some degree, they want to see higher rates, don't they, from all this hawkish language? Maybe not at the 30-year, maybe they want to see it in a different part of the curve. But how do we sort of balance that narrative?
I don't think they would have wanted a twist steepening in the curve. So saying that we are going to stay on hold for longer than you expect, but then that increases inflation risk premium at the back end. Look, I think it's a question of understanding their reaction function as we go. It's the second meeting so far. For me, I still think that the disinflation progress could be enough by September to actually mean that the message seems a bit more coherent with the data that we're getting. And so if I think of a scale and what's on the inflationary side, the disinflationary side, we've got those AI-led pressures on the inflationary side. We've got some energy pass-through lingering shocks there into core goods. But then if you look into the second half of the year, you do get seasonality on your side. You do get a methodological change to PCE measurement. We are seeing in the rent factors and the healthcare factors that there are some weakening, some renormalization, and we do think that's there to stay. So I think if I were to look at the scales, I think it tips slightly in the balance of that disinflation picture coming through. Okay. But the margin for error is small.
I'm on the work page on the Bloomberg, the legendary function. It's just in the last couple of seconds tipped to being 70% probability of a rate hike in September.
Yeah. Yeah, no, I think the inflation risk premium, the markets have to price that way, right? The risks to inflation are only to the upside. So you have to price closer to that hike than no hike. But we do have 2 rounds of labour market data, 2 rounds of inflation data by that meeting.
The data's important, but credibility is important as well. Mm-hmm. And the market's questioning, you could argue, credibility last night, into this morning. In order to get credibility back, regardless of the data, does the Fed have to hike at this point?
No, not yet. And I think we're going to hear a lot more from the rest of the governors before the next meeting, and we'll see what their reaction functions are as well. I do think a bit of what Walsh has maybe mentioned is more, some of them lean more towards his views. And, we might hear a bit more, Waller has said as well that if inflation is too hot, we will need to hike. Williams has given us a pretty clear guardrail of what he needs to see for the rest of the year, which is 0.2% PCE, averaging for the rest of the year. Yep. So there is a bit of a credibility question mark, but I don't think we can throw everything out the bathwater yet.
Kim, what's the headline going to be out of the Bank of England? Are we going to be focused on the number of dissents? Are we going to focus on QT and new guidance around QT, or new analysis ready for a policy announcement in September? What's the focus for you?
So not as contentious a meeting as the Fed meeting, but a hawkish hold. It has to be hawkish. Inflation is still too high. The risks are to the upside, but the hold is pretty consensus. Inflation has come below the bank's forecast since the last meeting. There's nothing particularly worrying in the run rates of core goods or core services inflation. And at least for now, the bank's not seeing really that energy price effects spiraling into indirect and wage price settings yet. So staying on hold makes sense. The QT decision will be important too. We've always looked at that in terms of the technicals and the back end of the curve. But I think the direction of that is pretty clear from the bank as well.
Do you think the bank needs to get a greater understanding of what the fiscal picture looks like before it moves? Before it moves or after, it depends what the inflation data says before the next meeting as well. But the fiscal news definitely matters. How net stimulatory is it for the economy, and hence what the impact is on inflation. We expect the fiscal rules to still be held, as the government and the Chancellor have told us so far. So I don't see a big immediate boost to growth that's going to be inflationary and demand-led, which the bank will have to react to. But we still need to know what the revenue-raising measures are. Yeah. We haven't gotten them yet. We expect we will. And so I think it will factor in, but they'll have to wait to see what the extent of the measures are before they can react to it. Busy morning, Kim. Thanks for stopping by to see us. Kim Crawford, Global Rates Portfolio Manager at JP Morgan Asset Management. And on a programming note, we've got it all covered for you. We've got a special programme coming up on the Bank of England rate decision. We are going to kick things off at 12:30 p.m. today.
Yes, we will. So bring your lunch. Join us. Let us. I don't know why I suddenly thought about that. I'm not sure. Maybe I saw 12:30.
I like the idea.
I thought, when am I having lunch? Yeah, that's an important question. We'll sort that one out. Let's turn our attention to the markets in 3 minutes on the opening trade with Markets Live Executive Editor Mark Cudmore, who's probably ready for lunch where he is in Singapore. Mark, good morning to you. So let's talk about the press conference with Walsh at the Fed. I mean, you've been quite a fan of stepping away from forward guidance. We're supposed to pour more attention onto the data and less on the Fed meetings. What did you make of yesterday?
It was a disaster. Just absolutely terrible press conference. As you say, Anna, I'm all in favour of stepping away from forward guidance, returning to where it was 20 years ago, where people actually look at the data. I think we've become stupider over the last 20 years as we wait for Fed officials to translate data that we could have seen a week before. So I'm delighted that we stepped away from forward guidance. And I also think that Walsh had done a great job until yesterday, in terms of that he kind of sounded quite hawkish. As he said, he was letting the markets do his work. I have no particular quibble on the policy decision. Look, it's a very hard job, whether you hold or hike rates. You know what? It was in the balance either way, right? So I'm not going to quibble with any of that. My issue was with the press conference, where he basically undermined the Fed target, kind of saying that, oh yeah, the PCE is the way they're measuring it. Until January, he kind of implied they might have reassessed it then. He kind of talked about that's their one thing they're really targeting, but then talked about a bunch of measures. And then the kind of way he talked as if like he was essentially new to the job and kind of working it out as if he was just going along and, it would evolve over time. I have to say, it was an extremely disappointing press conference in terms of credibility. It is bad for the dollar. It's bad for long-end bonds. So we're going to continue to see steepness in the curve and weakness in the dollar until that credibility gets back on track.
Okay, so you basically got a signal you know what you're doing, and you're questioning that. Would a rate hike restore that credibility, signal that he knows what he's doing?
It might do. I think what's important is if you're going to look, it's a very hard job. I'm not trying to say this is an easy job to do, but if you're going to step away from forward guidance, well, then don't say things that imply you kind of have no authority to do the job, no idea what's going on, you're kind of feeling your way around it, and that the inflation target may change and kind of undermine both the committee and the targets and the measurement methods. So it's not specifically, it's the policy, it's the impression you give. And I thought Warsh had done an incredible job up until yesterday. But because expectations were so high, people were actually very optimistic that this was going to be a sensible way to manage policy going forward. Everyone knew there'd be a transition period. The data's going to matter more, which means more cross-asset volatility in the short term as we adjust to that. But ultimately, people thought this was going to be a good sign, and Warsh had kind of conveyed it with authority until yesterday. So that's changed. So, sure, if he's forced into a hike, does that really add to his authority? So if it's kind of seen as, uh-oh, this is a policy mistake, and now he's been backed into a hike he didn't want to do, that doesn't help. So I don't think it's whether it does a hike or not. I think it's the communication going forward. Look, if a politician talks a lot but says nothing, that's kind of admirable, but it doesn't kind of build his validation. It's the same for him. That's kind of crisis policy mode here. He should not imply he doesn't have a clue what's going on just because he doesn't want to say too much forward guidance.
Yeah. Jackson Hole's going to be interesting, isn't it? Mark, great stuff. Thank you very much indeed. Mark Cudmore, not mincing his words when it comes to the Fed. You can obviously follow all of the MLive team's view on what is happening here. There's a very simple way of doing it. MLIV Go is the function on your Bloomberg terminal. We're going to talk toothpaste next. Haleon sales rising more than expected on robust demand for Sensodyne. We will have a conversation with Brian McNamara, the CEO of this business. He's coming up. This is Bloomberg.
Do you mind being called an ideological lunatic or a bunch of left-wing nut jobs?
I've been called worse things than that.
Oh! You'd think she owned the place.
23andMe, I think, is so incredibly valuable. We're coming back.
It had that kind of detective story feel to it. When you're hot on the trail of something, you know that it's very exciting. What magazines were you reading as a kid?
I don't think I was reading magazines until I was in them.
You are on the cover of all of these.
Oh, and there's many, many more, but we just don't have time.
Why should people trust you?
I don't think anybody should trust any company or entity completely with any of this.
It's very uncomfortable. Artificial intelligence is this force that is far bigger than we are.
I want to build better businesses around these brands.
The shock will never wear off.
So you're a brother and sister running one of the most powerful companies in the world. When you argue, who wins?
No one. The way I could see AI being banned or blocked is if something really went wrong. And if something really went wrong, then maybe it deserves to be.
So is it Paradise ahead or Gattaca?
Maybe somewhere in the middle.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
It's Bloomberg Money.
This is the Asia Trade.
This is Wall Street Week.
Welcome to Balance of Power.
You're watching Bloomberg Deals.
Welcome to Bloomberg This Weekend. This is Bloomberg Television.
Bringing you the most important news and financial information whenever and wherever it happens. I'm Michael McKee on the Mexican border, and this is Bloomberg.
Welcome back. This is the opening trade. 15 minutes until the start of cash equity trading for European stocks. And the futures picture looks a little lackluster, really. Maybe not so on the French market, but the German market a little bit under pressure. We'll watch Adidas over in that market. That's one of the stocks could be on the move. We're watching Anglo-American. We're watching a whole host of corporates, some of which we're going to be talking to. CEOs we're going to be talking to during this program. Guy Elsek, Shell, Haleon.
Let's talk about oral hygiene, shall we, for a moment? Just take a brief pause to talk about how sensitive your teeth are feeling. Haleon, out with numbers this morning. The top line's definitely moving. The margin line's definitely moving. Toothpaste continues to outperform and continues to do very well versus its rivals. We're talking Sensodyne here. We're also talking Panadol, painkillers, and various other products that you probably find in your bathroom cabinet. Brian McNamara is the CEO of Haleon. He joins us around the table this morning. Revenue matches expectations, but looks pretty strong. The operating margins ticked up in the first half. 24.3 is the number, the estimate 23.6. Where is the strength coming that drives those kinds of numbers?
Yeah, thanks, Guy. 3.1% organic sales growth in the quarter, and that is a sequential improvement from Q1, which was 2.2%. U.S. has made good progress in the quarter and actually delivered that 3.1% growth, also underpinned by 2% volumes. Operating profit growth up 8.2%, and that was driven by our gross margin improvement of about 140 basis points. And that's linked to the productivity program we announced 2 years ago, which continues to deliver ahead of our expectations. Strong cash flow, so leverage is down to 2.5 times, and we reiterated guidance of 3 to 5% organic sales growth and high single-digit operating profit growth for the year. And you also mentioned star performer continues to be our oral health business, where oral health grew 7.2% in the first half.
Why has the U.S. made this step change? I've read a lot this morning about sort of shelf adjustments, which I'm assuming is not a DIY term. So what is it that you've done in the States, self-help, that has allowed you to deliver?
Yeah, I think a few things. First, we made some changes in the U.S., and we announced a new operating model change in early January, and the U.S. was the first to go. So commercial execution, for one, which is the shelf changes. We've seen increase in distribution, increase in shelf placement across the portfolio. Second, I would say, is innovation. We've launched clinical repair, for instance, in the U.S., which is the third pillar of our clinical range, and the share growth on Sensodyne continues to really outperform in the market. And broader innovation, things like Centrum Agify. We have a Centrum specifically designed for GLP-1 users, Excedrin, Rapid Relief, some good wins across Voltaren in the portfolio. So really about execution and delivering great products to consumers at a time when they really need them.
Good morning, Brian. Yeah, being GLP-1 adjacent in some sense, it seems to be something of a theme this quarter for some corporates. Let me ask you about, so Sensodyne, the mindset you brought to Sensodyne, or the successes you've had there. Is that something that you can learn from? And thinking about the over-the-counter drugs, the more pharmaceutical products, is there more room to improve things there?
So, yeah, first of all, on Sensodyne, it's been an amazing success story, and we are focused on what we call therapeutic oral health. So both Sensodyne and brands like Parodontax or Corsedil here in the UK are focused on things like gum health, sensitivity, and enamel health, providing real benefits for consumers. We do clinical studies, we develop products, and the dental recommendation drives 70% of the trial that we see in those categories. So there's huge opportunity, and that's a flywheel that keeps on delivering. If you look across our portfolio, we believe there is opportunities in areas like vitamins, minerals, and supplements to bring a more of that science base to those categories, and we've done some of that. We've had cognitive claims on Centrum Silver, for instance, and we've seen real good pickup from that kind of thing. And then across our OTC portfolio, the pharmacist recommendation really matters. And we have the largest pharmacy sales force in the world for OTC business because we are the largest in the world. And we see really good opportunity there in that pharmacy recommendation.
On another subject, can I ask you about the impact of war in the Middle East, what that does to a business like yours? And I guess that's, in terms of sales in the region, probably small for a business like yours, but interesting to understand. And then maybe on the cost side as well.
Yeah, so on the cost side, like everyone, we're seeing, obviously, increases in oil costs. Now, we're probably less exposed than many other companies in that area because we just have less exposure to petroleum-based kind of derivatives in our products, smaller packaging and things like that. And because we have productivity program that's going so well, we can absorb those costs and we can move ahead and not need to necessarily take pricing to cover those costs. On the Middle East specifically, we do have a disproportionately large business in the Middle East. It's about 5% of our business, and we have really strong shares there. And we have seen an impact. So areas like Dubai and Pakistan, where we have really strong businesses, we've seen double-digit decline in the category. So our Middle East Africa segment was flat on the quarter, but we do expect that to improve despite the conflict continuing in the second half.
Is that fewer visitors? What's the driver?
Yeah, quite a bit in certainly in Dubai. That's it. Just the visitors are down.
When I think about your business, I think about a business that is stable. It is people talk about these kinds of businesses as being staples. How inelastic is demand? How price insensitive are consumers? What is the message you get on the consumer right now, particularly in the US? What are retailers telling you? Can you just give us a sort of macro backdrop to kind of your impression of the macro backdrop?
Yeah, so if I take a big step back and think about first the consumer in the U.S., no question the consumer in the U.S. is under a lot of pressure, and there's a lot of uncertainty if it's the Iran war, if it's oil prices, if it's potential inflation. Yeah. So there's no question you see a cautious consumer environment in the U.S. If you get then to the categories that we're in consumer health, listen, health really matters to consumers. And in health, brands really matter. And we have fantastic brands. And that's why I think we continue to see great growth in Sensodyne. And, in Q2, we've seen, really good growth in Centrum in the U.S. Brands like Benefiber and Tums grew double digit. So for me, we can't really impact how the consumer is feeling per se. What we can do is focus on our own execution, driving value for the consumer. Mm-hmm. So you would expect our categories to be a bit more resilient than others, but we're not immune to the consumer dynamic. So we're just focused on execution and delivering the value that consumers want.
Brian, thanks so much for joining us. Good to speak to you. Brian McNamara, the Haleon CEO. So we've talked about a lot of corporates this morning, a lot of earnings out. Alex Morgan has a rundown of the stocks we're watching.
Morning, Anna. Yeah, goodness me, what a busy day it is today. Let's kick off with Shell. We've had that second quarter profit beat from Shell. Year to date, up 21%. And this really is coming from the oil refining boom. One thing that is interesting, though, is there was that focus on Qatar. Shell is the world's largest LNG provider. There is still disruption there. So while, of course, there is a boom for the super majors from the disruption, there is also a pain point around refining in that region. Let's turn it over then to look at Airbus. We've had Airbus out this morning and a note of confidence that they will meet the deliveries this year. We also had Boeing's quarterly update yesterday as well. But you can see Airbus here in the orange sort of if you like, climbing ahead of where Boeing is right now. Turning it over to hear from Guillaume Fauret, the CEO, saying it's across Airbus's business that they're seeing positive noises. Of course, that is the commercial airliners, but also defence. I mean, it's a big focus in Europe. And then let's flip it over to L'Oreal, and here it's hair products. volume, very important when it comes to hair products. They're really driving them. They're proving more resilient than compared to the US rival, Estee Lauder, for example. We're seeing here it's the focus on their hair care brands, and apparently a new trend of women wanting to wear their hair longer, helping to keep that profitability up. So an update from L'Oreal, we'll be keeping an eye on them as well. A really busy slate this morning of stocks to watch.
Alex, thank you very much. Yeah, hair care appears to be worth it. Adidas in focus as well. Maybe too soon to see the positives from the World Cup for Adidas, and we'll watch that one at the start of trade.
All right, there's all kinds of things going on. Keep an eye on the car sector, what is happening there. You've got some asset managers, Amundi's out, Sanofi's there with better than expected numbers. It's a busy morning. Those are the numbers you're seeing on the screen. This is Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
The trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories.
The economy has been doing well. That does not tell you what the future is going to be.
We are taking a step-by-step approach, a very systematic approach with India.
This is a time to put a little more defense into your portfolio.
Insight with Haslinda Anand, only on Bloomberg.
What is going to be the consequence for U.S. markets?
We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
Welcome to Bloomberg This Weekend. I'm David Gurr.
I'm Lisa Mateo.
And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate.
More than what you need to know, it's what you need to think about.
Technology is embedded in every aspect of our lives, and that revolution is playing out in real time. From finance to defense tech, AI to entertainment, from the road to the stars. Bloomberg is bringing you the stories of companies and people that are pushing tech to new frontiers, and the politics reshaping global tech markets. I'm Ed Ludlow, live in San Francisco, and this is Bloomberg Tech.
Every weekday, only on Bloomberg Television.
Okay, we're getting to the point where the rubber meets the road. We're about to see how some of these earnings stories that we've been talking about this morning are priced in. That's one factor we need to fold into the opening trade here this morning. The other one is what happened last night with the Fed. We went out here in Europe. We finished down there. This is the move into the Fed. This is the move after the Fed. Big move in bond markets, but that was reflected as well in the pictures surrounding what the stock market did. So there's a lot going on, a lot to fold in. You've also got the oil factor to fold into the narrative as well, given what is happening in the Gulf. So that's the story. You've got an awful lot to think about, but in many ways, what you're not getting is a big reaction. Eurostoxx 50 futures are absolutely flat. The FTSE's down by 0.2%. The German market's a little bit weaker than that, down by around 0.4%. You don't necessarily get the volatility that you're getting in tech, maybe reflected in Europe, but there's so many corporates reporting this morning. It's going to be a bottom-up rather than a top-down market narrative, I suspect, Anna.
Yes, absolutely. So let's get to some of those bottom-up stories, shall we? And we'll start with the energy space, where we had numbers out of Shell. We spoke to the CEO, Wael Sawan, a little bit earlier on. They've got a new buyback in the offing. Their adjusted profit for the second quarter came in well above expectations. So we will see where that one heads at the start of trade. We're also watching Adidas. They posted their numbers for the last 3 months through to June, and they came in a little lighter than expected. They missed estimates. There was a jump in World Cup marketing spend. So on the one hand, they might have seen some successes on the field, but there was this marketing spend dimension, the cost side, to think about. And so that seems to be taking the edge off optimism around that particular business this morning. We'll also watch the auto sector, lots of earnings out there. We'll also watch the banking sector, SocGen, BBVA, Erste, all improving their outlooks, and ING and Lloyds Banking Group beating estimates, Guy.
Yep, got a new 5-year plan from Lloyds. We'll talk to the CEO a little bit later on. Let's talk about the numbers right now and show you what is going on. The opening trade is here. Let's price in some of these earnings that we're getting out of Europe this morning and see what they deliver. FTSE 100 a little higher. I'm fascinated to see how Shell goes this morning, how Lloyds goes this morning. That, I think, is going to be a really interesting narrative. But there's also the kind of the macro top-down story on what is happening with iron ore and what is happening, obviously, with oil and gas. Stock 600 is down by circa 0.1%. These feel like very small moves at an index level. That is maybe going to be the narrative today. FTSE 100 maybe a little softer than anticipated. The CAC's flat, coming out of the gate, absolutely flat. The AEX is absolutely flat as well. The IBEX, I think you've got BBVA to price in there. It is down. The IBEX is down by 0.2%. And as ever, we're going to have to wait for the DAX, Anna.
Yeah, absolutely. Waiting for the DAX to open then, but we see a flat to negative picture then overall across these European equity markets, and a bit of outperformance coming through in the French market. So let's get to the sector breakdown and find out what is moving higher. To the upside, we have construction and materials, and that instantly takes us to France, because the top three in that space are Vinci, Bouygues and Eiffage. So some sizable French names moving higher, and so maybe that's adding some upside to the French markets. We're up by 5.3% on the Vinci share price, which is the best performer of all of those. Chemicals is also an area of resilience this morning, so despite the broad downdraft, we're seeing the chemicals sector not doing too badly. Not huge standout performers within that sector, but there is some movement on the upside. And basic resources also doing pretty well. We've got numbers from Anglo American this morning. We'll be talking to them about higher copper prices shortly. That stock is up by 0.9%, and more broadly, we see some positive performance across the sector, with Rio, Antofagasta both moving higher by more than 1%. So 5 sectors are in positive territory, Guy, despite the direction of travel, which is broadly weaker, and healthcare is the worst performing sector.
Yeah, that's fascinating, isn't it? Look at the upside, though. Schneider's the biggest points gain this morning. That's certainly helping out both the Paris market and the stock 600. Rolls-Royce is doing well. ASML's not having a bad night either, which is interesting given what we've seen from Samsung. ASML's having a good morning, not a night. HSBC's up. Shell is up by circa 1%, but Rio's up as well. So the miners, some of the oil stocks and some of the tech stocks, adjacent tech stocks, are doing well. But as you say, Roche, BAT, Sanofi, AstraZeneca, UCB, Novartis are the losers. I would say probably, it's the pharma space that looks like it's under pressure. It's Thursday, so I'm always slightly nervous about Thursdays, given the fact that we do see some ex-dividends. So I'm just going to go and check that as well. But Adidas has just opened, to your point. It's down by 15%.
Yeah, so a big, brutal move on that particular marketing spend from Adidas. Let's broaden the lens and talk about these markets then with Claudia Pansari, who's France CIO over at UBS Wealth Management. Claudia, nice to speak to you this morning. Let's talk about European earnings, shall we? We've had so many of them to deal with. Net, they add up to not a lot of movement this morning for European stocks. How optimistic were you going into the earnings season, and how intact are positive expectations for European earnings?
Hi, good morning, Anna. Thank you for having me today. Very positive, I have to say. We are great European stocks a few weeks ago, and we also great the banking sector, and we see that results are pretty good. I think people have been focused since the beginning of the year on AI and tech in US, and then across emerging markets. And reality is that the economy is not doing so badly in Europe. We had French GDP figures this morning, results from some consumer names, but also results from the banking sector. And clearly we see some upgrades coming for a segment which was not loved until a few days ago, when we had this turnaround in the tech name, and then Europe is now outperforming, which is pretty good and in line with our expectation.
Okay, and so what is standing out to you, Claudia, as being new information in this earnings season? What do we take away from the earnings stories? I mean, is there a story of resilience around higher energy prices? Because as that concern lingers in markets, with the Brent price over $92 a barrel, we maybe need that narrative.
I mean, there are a few elements. The resilience to energy price, the resilience to higher bond yield, a turnaround on the margin. Margin has been under pressure in the European market for a long period of time, and now we see a turnaround. I will also say there is a recovery in manufacturing. We have seen PMI data improving quite a lot. Improving especially in manufacturing, where the data has been under pressure over the last few years. So the resilience is there. Probably there was a bit also the negative feeling about the capacity for Europe to rebound in terms of earnings, with energy price around $90 a barrel, and then with also the bond yield being at very high levels since the beginning of the conflict in the Middle East. And now we see there are surprises on the upside. There are upward revision in terms of earnings for 2026. We will probably also sign revision in 2027. We are ahead of consensus in terms of expectation. We are expecting more than 20% EPS growth between 2026 cumulative, between 2026 and 2027. So clear there is a sort of catch-up. And investors have been, once again, focusing quite a lot on other market and essentially on IT. So now the surprise is coming from sector where investors are not positioned yet.
Okay, so is Europe the anti-AI trade?
There is a small portion of Europe in AI. You have only a few stocks. The AI trade is mainly in US and in Asia. So this was the reason why we saw the stocks performing so well, and also some markets like Korea and Taiwan, which are really concentrated on few names and mostly on semiconductor. You have some stocks in Europe, but it's not the big part of the market cap of the European index.
When do higher bond yields start to become a problem?
I think already this morning, because you see the earnings are quite good and the market is slightly down. I think the message out of the Fed yesterday is driving up this bond yield in US and by correlation in Europe. The problem of the high yield is also linked to the fact that there is less space in terms of government of increased spending, there is a slowdown. So I think we are already at a level of yield which may start to impact the equity market. Unfortunately, I mean, there are few elements which are driving up this yield. One is inflation expectation. And after yesterday Fed comments, inflation expectations are up this morning. Then there is still this energy price, which remain very volatile. And then there is a premium, which is quite high on the long end of the yield curve, which is due to the level of debt we have in Europe. But I think we need to be very careful about this moment. On Europe, but also in the US, we have yield which are at all-time high since 2011. Probably this morning we are getting close to 4% for France, which also means the cost of debt is getting more expensive, which also add a risk on the long part of the yield curve. So I think we need to be very careful. But I also believe that the current level of yield is really attractive, especially for corporate or for sovereign, where the quality is there. So we should take profit of this level of yield if we believe, like we believe, that the yield will come down in the month to come.
Okay, well, we'll see if that happens. For the moment, the story has been about higher long-end yields then, Claudia. What do you think that does to the US tech landscape if we see persistently higher yields at the longer end?
I mean, it's quite interesting because the landscape in US for now is mainly be driven by the performance in semiconductor, with CapEx spending. CapEx spending has been one of the major drivers of growth since the beginning of the year, both in terms of economic growth and GDP growth. If yield move higher, but this movement is low, I think equity can be resilient because the earnings side is still positive. The probably is about the velocity of increase in the yield. If we have a sharp rise in yield, of course, that will be damaging the equity market. But once again, there are two elements, the earnings and growth, and on the other part of the yield. If we have a rise in expectation and revision on the earnings side, I think US market can still be very resilient. The yield at one point will have some impact, probably on growth, and the moment will be, I will say, in two stages, probably firstly up, and then with some data declining, job market to be impacted, we will have a second stage with yield down. And then we will have also more support coming from the bond market. But for the time being, the bond market is really probably the main risk for this run on US, but also for the rest of the world.
Claudia, thanks so much. Thank you very much for joining us. Claudia Pansari, the France CIO for UBS Wealth Management. Let's pivot to another corporate earnings story this morning. The mining giant Anglo American has reported a profit increase and raised its dividend, joining the competition to cash in on record copper prices. The company is nearing the end of a transformation plan that will see it shift from diamonds, coal and platinum to focus on copper. Let's bring in the CEO of Anglo American, Duncan Wanblad, who's with us this morning. Welcome to the programme once again, Duncan. Thank you very much for being with us. How much of the strength in the performance that you're reporting today, how much is that very much a read across from a higher copper price? How much is it other things?
Well, look, it's certainly been bolstered by a higher copper price, and certainly that's been augmented a little bit by higher prices associated with the minor metals, particularly those like molybdenum and silver that come with the copper complex. However, the underlying performance in the business is really, really good. Solid performance against the plans, bang on guidance in terms of the outturn of the business, and a pretty laser-like focus on the costs. Of course, we're in a world where seeing loads of inflation driven by all sorts of factors, and really thrilled with the work that the guys have done in terms of keeping costs under control. So I think it's a good balance of both, but fundamentally underpinned by good operating performance.
OK, and sticking with the copper theme, Duncan, when do you think that we will see completion of your expected merger with Teck? Because that is very much about copper. And where do the synergies come from in that deal? Is it all about two plants in Chile and bringing those more cost effectively together?
Yeah, sure. So look, as far as the completion mechanics are concerned, we're just now waiting for approvals from China. And our expectation is that we should see these come through somewhere between September of this year and March of next. And as far as the synergies are concerned, well, of course, you know, there is the large proportion of revenue synergies that we would see coming from the combination of Collahuasi and Quebrada Blanca. But actually, there's also a number of other synergies which result as a consequence of putting the two companies together. So we have some SG&A synergies, we have some marketing synergies of the combined business that will come through, and then, of course, a large proportion of procurement synergies as a result of putting this together. So we're well on in terms of setting up the integration process. We've got a team working together, trying to get this all sorted out so that we're absolutely good to go on day one, whenever that occurs, somewhere between September of this year and March of next, and really getting ourselves in the greatest position we can to accelerate the delivery of those synergies.
Duncan, good morning. Can you update me on the sale process surrounding De Beers?
Yeah, sure. Look, I mean, this has been a very long process, a process that's been characterized by many sort of complications, particularly those associated with the state of the diamond markets over the last few years. But despite all of that, we've really made great progress, and we are now pretty close to the end of that. And you know, having said that, of course, this is exactly the time in the process where things are very delicate. So a number of parties have to all get together, have to all agree and ultimately sign on the dotted line. But looking good for getting it done, ideally somewhere between now and the end of this year.
OK, we're reporting that you are in talks to sell the business to a consortium led by Gareth Penny for around $1 billion. Is that what we're talking about here?
Well, we're not exclusive with anybody yet, and what I'm doing is busy working with all the parties to optimize, the outcome, and I'm certainly not going to be drawn on talking about any of the specifics associated with any of those parties at this stage.
That valuation would be significantly below where I think the market had priced the business. How close is that number? Are shareholders going to be disappointed by the valuation, do you think, that ultimately you have to apply to this business? How are you communicating that to them at the moment?
Look, this is a competitive process, and the number will be what it needs to be when it comes out of this thing. I'm not suggesting I'm not suggesting anything about the specifics of that number. As I say, we are working through that with the potential buyers at this particular point in time. And I think what we can be certain of is that this will be a very realistic valuation of the business going forward.
OK, Duncan, can I ask about the costs? You talked about the inflation challenges. You're pleased with what the team is doing to keep those under control. But I'm thinking about the impact of the war in Iran, the events in the Middle East, what that does to the business, and what self-help measures you can take to bring down the negative effects of that.
Yeah, sure. Look, I mean, certainly in and around the Middle East, we are impacted by two things, really. One is the general inflation that creates on a global level, but of course, some of our iron ore product goes through the Straits of Hormuz to Bahrain, and so we've had to reroute some of that material as a result of the war in the Middle East at the moment. But I think, fundamentally, it's really all about staying on top of cost control, and this is a muscle that Anglo-American has certainly developed over the last few years, and I think is absolutely paying dividends. Getting on top of this more rapidly than many others might be able to do was sort of the secret of success in the first half of this year. It's not over. I think we've still got more work to do, and to stay on top of it. But as I say, a good muscle developed to get that managed. The iron ore markets, have enough diversity for us to be able to move stuff outside of the Middle East for the time being.
Duncan, we've talked in the past about the impact of electrification and the energy transition on some of the metals that you mine and increasing demand for those. On top of that, do you see increased demand from the wave of data centres that are being set up, or is it all just part of one big trend for you?
Well, look, I mean, it's all part of the same trend. The use of copper has now many applications, and data centers is absolutely one of those. The rate at which these are being built, I think, will augment the short-term demand for copper, and certainly is very positive for copper demand at the moment. So it is part of the underlying thesis for copper, without a doubt, AI data centers, but so is the re-electrification of the world. I think that also will continue to play a very important underpin to the copper story. And then, of course, we don't talk about this as much as we used to anymore, but it is very important to think about the role that copper plays in the improvement of people's lives generally. So I think that there's still, a fantastic underpin from that. So the fundamental drivers of copper and copper growth are very robust.
Duncan, one final quick question from me on, just can I come back to iron ore? Do you think, when does China bounce back on construction? What are you assuming? Are you assuming that current levels are here to stay for a while? What is your expectation in terms of how that picture turns? It's been difficult for a while. Is it bottoming out right now? What assumptions are you making?
Yeah, look, I mean, we're not expecting a significant turnaround in the current state in the short run. Our view is sort of more medium to long run. And again, it's very much underpinned by the role that steel plays in the development of societies. Without a doubt, the intensity of use in the developing world of steel is so much significantly lower than that of the developed world today, that it will absolutely continue. But there is absolutely now a bit of a surplus in steel making in China, and that will need to wash itself through in the next few years. despite that, the businesses that we have a very unique offering to the market in the context of the type of iron ore that it produces. We're relatively niche and small in that context, and so we're forecasting that we should be able to ride through this period very well with those two businesses.
Duncan, thank you very much indeed for your time this morning. We really appreciate it. We'll look forward to the update on De Beers very shortly. Anglo American's CEO, Duncan Wanblad. What are we going to be talking about next? More earnings. The conversation will switch firmly to what is happening here in the UK. Lloyds Banking out with a 5-year plan. The group's CEO is Charlie Nunn. He is next. This is Bloomberg.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound. I'm Jumana Versace. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility.
There's still room to maneuver.
Reduce the opportunities.
It allows you to increase significantly your net income.
Every trading day, only on Bloomberg.
Bringing you the latest geopolitical news whenever and wherever it happens. I'm David Gura on the Salar de Uyuni in Bolivia, and this is Bloomberg.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg.
Bringing you the latest business news wherever and whenever it happens. I'm Scarlett Fu, reporting from America's biggest military shipyard. This is Bloomberg.
Of course, with the Middle East crisis, energy costs are rising, same on transport. So we try to be very responsible. And we had also, in some cases, to price up to our customer to make sure we are able to continue to deliver great profit and great return for our investors.
Definitely the macro around us is volatile. So really what we are trying to do is to be the name that allows a shareholder to be able to benefit from that upside volatility and to have the downside protection.
This is the strongest performance that we have had since the acquisition of Refinitiv 5 years ago. We continue to improve our margin. We're getting great operating leverage out of the business. We do have a lot of confidence in the second half. We're probably less exposed than many other companies in that area because we just have less exposure to petroleum-based kind of derivatives in our products, smaller packaging. We have seen an impact. So areas like Dubai and Pakistan, where we have really strong businesses, we've seen double-digit decline in the category. So our Middle East Africa segment was flat on the quarter, but we do expect that to improve despite the conflict continuing.
It has been a busy morning so far. Some of the CEOs we've been talking to just today on what they see in terms of their businesses and what it's telling us about what the wider market picture looks like. It's been a busy morning. Let's take a look quickly at the core six just to give you a kind of reset on what we're getting there. And as you can see, it's a game of two halves. On the right-hand side, ASML, Schneider and Nestle all rising and rising quite nicely. Schneider in particular is the standout story. But you've got Novo down. The pharma space is under pressure this morning. LVMH is under a little bit of pressure as well. Defence is certainly being rotated out of too, so that's interesting. What else are we watching? Let's turn to footwear. Alex, over to you.
Footwear and footballs, Guy. At this World Cup, Adidas sold 4 times as many jerseys and twice as many balls as the last World Cup. And this morning, they are down as much as 17%. And the clue in there might be this $212 million spend on marketing around the World Cup, weighing on what is otherwise a very good second quarter for Adidas. This morning, out of the gate, down around 17%. A really significant drop there. Let's flip it over and look at Rolls-Royce. Well, they've lifted their outlook this morning. They're in the green, up around 4%. Turning to Campari, the spirit maker. Good numbers there this morning. They're in the green. Obviously, they're the makers of Aperol, Campari, among others, up around 3%. And then turning to Magnum. Now, Magnum was spun out of Unilever at the end of last year. They sort of have got the Walls brand, Carte d'Or, and, of course, the Magnum ice cream brand. You'd think with the heat waves and beating estimates this morning that they might be up. There's actually down this morning around 3%. Something more to dig into there. Have a look through those full figures. But Magnum ice creams there are down around 3% this morning. Those are some of the names on the move, but really it is Adidas that's got a sharp drop this morning after that big World Cup marketing spend.
Alex, thanks very much. Alex Morgan with those stocks that are moving. And that Adidas story is quite fascinating, isn't it? I mean, all those very expensive footballers they paid to be in that commercial, you know, maybe that adds to the marketing spend. So watching that, we're also watching Stellantis. The numbers there didn't look bad, but the stock under pressure.
Airbus sounded quite positive. Its stock's down by 2%. It's had a good run into the numbers. The pharma space is under pressure more broadly. I'm trying to figure out kind of what do the rotations look like this morning in terms of what the market is signalling. Schneider, in terms of point story, Schneider, Rolls-Royce, ASML, Shell, BBVA are the big winners. And are lifting markets this morning.
They are. And when we come back, we'll dip into the banking sector. A conversation with the Lloyds Banking Group CEO, Charlie Nunn, will be with us next. This is Bloomberg.
How do you see AI changing gaming and game development in the future?
Look, I think the biggest thing that I'm thinking about is how do we just make sure it's solving problems. On the game development side, I've gone to a lot of our studios, you know, with big and small, and I'm blown away with how they're using AI in the production pipelines, how they're using it for iteration and prototyping. That's not production ready, there's still work. And so, you know, 30% of game development is software, and so there's the traditional applications that we see in enterprise. At the same time, I do not think AI will replace AAA games. I think it's entirely possible, though, that AI represents a new category of games and a new type of development and enables more people to create and participate. And we'll keep an eye on that, and we'll see how we best serve that.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories.
The economy has been doing well. That does not tell you what the future is going to be.
We are taking a step-by-step approach, a very systematic approach with India.
This is a time to put a little more defense into your portfolio.
Insight with Haslinda Amin, only on Bloomberg.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo. And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington. Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
This is the opening trade, 30 minutes into a really busy session when it comes to corporate earnings then here in Europe. And broadly speaking, we've done quite positively with that earnings story this morning. European equity markets are on the front foot. But this perhaps over on the DAX in Germany represents the World Cup Adidas story you didn't think you would hear about this morning. They have been upgrading expectations of the top line and what they do on revenue as a result of their successes at the World Cup. But it does seem to be that marketing spend number that's weighing on the business, and that's taken a real hit. So the underperformance of the DAX, it isn't all Adidas, but that certainly adds up to a big headwind for them. In the meantime, the CAC 40 moves higher, up by 0.6%. Construction to the upside. Guy, what do you see?
Absolutely. In some ways, Europe isn't moving a lot, considering the volume of information that it's being delivered with this morning. And the reason for that's fairly straightforward. 345 stocks are up, but 234 are down. So basically, you've got a market that's slightly on the front foot, but not by much in terms of the balance. Volume picture, though, tells you a lot. This is a very busy market this morning. There is a lot to price in. There is a lot going on, both from a kind of macro story, but from a kind of bottom-up single stock narrative story as well. So let's deal with the latter of those two factors. Schneider out with numbers. Remember, this is a company that highly exposed to the data center build-out. It is up by 5.33%. Airport de Paris is up by 11.41%. I suspect a lot of this may be down to the fact that what we are seeing here is actually a read across from the Gulf. You take out the big hubs like Dubai and Doha. I don't mean take them out. I mean kind of you reduce their capacity. And what you see, therefore, is maybe a benefit coming through from some of the European airports, and maybe that's a benefit that we're seeing being reflected in the numbers coming through this morning. So there's a readjustment, maybe, as a result of what is happening with the Iran war. Vansi, you mentioned it, big driver of the Paris market this morning in the infrastructure space, up by nearly 5%. So some really interesting stories on the upside. Adidas is the obvious one on the downside. This is a cost story. It is certainly impacting the business, and the market is marking it down quite sharply, 70% now. Stellantis is down by 4.71%. It's a busy morning for European autos. Look at names like BMW, Renault also out with there as well. And a big disappointing set of numbers coming through from Rentokil this morning. That stock in London down by 16%. So there's really big moves on either side, but in some ways, Anna, they're just balancing each other out.
Yeah, that's the market story then, Guy, this morning. Let's get to some of the other news flow that we are following. The US launched a new wave of strikes against Iran. The strikes came after a surprise assault by Iran on an American military base in Jordan, which intercepted multiple ballistic missiles and sent oil prices soaring. Meanwhile, in Egypt, fires broke out aboard two liquefied natural gas vessels at the port of Damietta in what appeared to be the first attack on that country's territory since the war began. Over in Poland, Poland says it's investigating an unidentified object that crashed near its border with Ukraine. Air defense radars tracked the object over Polish airspace before it came down near a village about 100 kilometers from the border. The military says the incident happened as Russian long-range aircraft launched missiles over western Ukraine. And 30-year government bonds in Australia, New Zealand and Japan came under pressure after similar-dated US yields jumped following the Fed's decision to leave interest rates unchanged for a seventh month. The Fed chair, Walsh, insisted the decision was not a sign of inertia at the central bank, which he reiterated is committed to tackling inflation. Bond traders have lowered expectations the Fed will raise interest rates at its next meeting. Guy.
Okay, let's talk about some of the corporate news that we are watching and continue to watch. Second quarter earnings from Lloyds Banking Group this morning have beaten estimates. Pre-tax profit rising 14% from a year ago. Britain's biggest lender also unveiled a 5-year plan taking us to 2030 to boost non-interest income, basically diversify away, make the business less susceptible to that interest rate story. The stock is up by 0.4% this morning. Which actually, in some ways, a little bit of a surprise. Maybe it's the guidance that seems to be the factor here. Let's find out. The Lloyds Banking Group CEO is Charlie Nunn, and joins us now. Charlie, you've unveiled what appears to be a fairly good set of numbers. You've got a 5-year plan that looks ambitious. The stock is only up. The stock is up by 0.5% now. See, that's an underreaction. Would you have expected more? This is an exciting picture you're painting here, isn't it?
Yeah, look, as you said, announced 2 things today. First of all, a strong set of Q2 results, but that's really the end of our 5-year strategy. And that strategy, we've got the group back to growth. We've been winning market share. And we've actually had really strong support from our shareholders, and they've seen the story and realised the transformation that we've been leading. And then the second thing is laying out our new strategy for 2030. We're calling it Accelerate 2030. And that's about raising our ambition on how we make every one of our customers get a simpler, smarter, more connected experience right across our retail, commercial, insurance and wealth businesses. And we're going to be investing £3 billion a year over that 4-year period. And we've got some exciting growth to do what you said, continue to grow at mid-single digits, continue to diversify the revenue streams and deliver very strong shareholder returns. And there's some exciting things coming. I'll give you some teasers, but a new smart wallet, Lloyds Smart Wallet being launched today, the first integrated transport ecosystem being launched. We think we can get 1 million new people saving with our AI tools, and we're going to be the most rewarding bank in the UK. So lots to come.
Lots to come. In the near term, and I'm just reading a series of analyst notes that are beginning to pop into my inbox this morning about what you've done. The sense seems to be that you're being slightly conservative on guidance. Are you being slightly conservative on guidance, Charlie? Is that your feeling this morning?
Look, there's 2 parts to our revenue guidance, which is obviously the important part of our story alongside our cost discipline. One is mid-single digit revenue growth. We're committing to a decade now, given what we've delivered now for the last 5 years, of mid-single digit growth based on Lloyds Banking Group. That's a really strong story, given who we are and in terms of how we're delivering value for our shareholders. Within that revenue growth, we're committing to another 8% CAGR per year of other operating income. Those are those businesses we've been growing, investing, winning market share, like transport, like wealth, like our Lloyds Living proposition, and we can see that's a pretty ambitious plan. The second part is our big balance sheet-based businesses, which is, we've grown successfully. And as you'd expect from Lloyds, we always give sensible and prudent assumptions to underpin those businesses. But we don't make assumptions around the yield curve or competitive pricing that would put our forecasts at risk. So that's available for our shareholders and our investors to make the choices they want around those things. But we've given good growth on net interest income, ambitious growth on other operating income. And we're really excited that we can look to a decade of that kind of value creation for our shareholders. The one other thing we've announced today is a step up in our dividend by 30%. And another £1 billion buyback at the interim. It's the first interim buyback we've done. And that's really because of the board's view that we have really de-risked the business and we have very sustainable returns going forward. So we think it's a good story for our investors, an even better story for our customers.
Charlie, good morning. So you've announced and you've given us some highlights of your new strategy this morning, which is interesting to hear about. How does wealth fit into that strategy, and what is it dependent on? Is that a sort of macro growth dependent ambition that you have around wealth in the UK?
So actually we have some really sustainable long-term wealth businesses, and then we have some new ones that are going to be evolving. So we have the second biggest workplace pensions business in the UK, and that's a very stable, mature business. It's obviously hugely important in terms of building broader financial stability for our customers in the long term. That's been growing well, and we'll continue to grow that business. But we also have a self-directed wealth business, a full advice business, and this year we've been the first to market with a new AI invest agent that can start to bring investment advice to the whole of the population, to all of our 28 million customers. Now that's really exciting. It's the first time that's been launched anywhere, and later this year under the new regulatory regime called targeted support, we'll be allowing that to talk to all of our 28 million customers and bring investment advice to the whole of the UK. And that was our promise I kind of teased you with around we think we can get 1 million new investors into investing. And that's going to be brilliant for driving better outcomes for our customers and a broader distribution of our direct-to-consumer and advised wealth propositions.
Okay, so that's really interesting. This saving AI tool that you were talking about at the start. So interesting that what that is able to do. How do you evaluate your spending on AI? Everybody in this sector is rushing to spend a lot of money to try and capture the benefits of AI, Charlie, but they're not for free. What is the return on investment on AI spending? What does it look like right now?
Yeah, so look, it's early days in AI is our view, and we're right at the forefront, certainly within the UK, of applying financial services for customers. This year, for example, we have announced that we're delivering £100 million of benefits in year, not multi-year, in year, from the application of just generative AI and agentic AI. Obviously, AI is a much broader set of benefit for customers in the business going forward. When we look at it, we think it's a really important part of the next few years, along with digital assets, which is going to be very important, not just stable coins, but digital assets, especially for our corporate and institutional clients. And we see it very two-sided. At least 50% of our investments are going into differentiation and revenue growth, things like the coaching and investment and advice tools that we just talked about. And then 50% of our investment is going into enabling our organization to do more efficiently, scale more efficiently, and be better around things like fraud and risk management. So we see strong returns today, and it's absolutely part of our plan to be right at the forefront of that for our customers in the context of our business.
Charlie, when we came into this conversation, the stock was up 0.4. It's now up by 1.4. So you're obviously saying the right thing right now in terms of how the market is reacting to what it is hearing. So that's great news. Can we just wrap it up with a quick take on what is happening in the UK and what you see in terms of the macro picture here? Your assessment thus far of the new government and what it's going to try and do and what that means to the banking sector and what you think it means for your customers, the consumer.
Yeah, so look, the economy has been quite resilient and consistent now for a while. Clearly, there's a lot of uncertainty. There's some issues around inflation for households and businesses. But when you look at the data underpinning that, it's a very resilient economy. People are being very adaptable, but it's a slower growth out forecast. When we've laid out our forecast for the next 4 years, we're seeing GDP growth, real GDP growth of about 1 to 2%. Unemployment increasing a little bit, but then coming down, so pretty stable in that context. And rates we see coming down only one more time, actually probably next year, from 3.75% to about 3.5%. So that's the kind of outlook that we have. Underlying that, households and businesses are actually at their most resilient level that they've been for a very long time, for probably since the financial crisis. You know, indebtedness levels of households and businesses have fallen 20 to 30% in the last 5 years. So there is the capacity to move to a higher level, but not the confidence today. And then from the government, look, it's early days, but the government's commitment to growth, to reform at all levels, but including regulatory reform for our industry, driving place-based growth and economics at a community level, focus on housing, infrastructure. These things we think will benefit as communities, will be good for the UK, and obviously are very aligned with Lloyds Banking Group's purpose and how we support customers.
Charlie, thanks very much. Thanks for joining us, the Lloyds Banking Group CEO, Charlie Nunn. Coming up on the programme, oil prices swing as the US wraps up a fresh wave of strikes against Iran that focused on military targets. More on that next. This is Bloomberg.
Everybody has a moment where they put into action all they've practiced, where they step up to a challenge and either succeed or fail. But what are those moments for some of the world's most influential leaders?
It was a rough and tumble world, and I thought, okay, I can rise up, I can play this game, and I did play the game.
It was great, and it was depressing, and it was disappointing.
My chair at the time sat down with me and said, succession starts now.
I'm Francine Lacroix, an award-winning journalist. For the last 25 years, I've interviewed world leaders, bank bosses, even fashion icons. I'm often asking about the news of the moment. But I've always been curious, who are these people as leaders? Join me for the podcast version of Leaders with Francine Lacroix. I'll start your week with conversations that explore what drives the world's most influential people, how today's leaders got to where they are, where they're going next, and how they've transformed their organization in the process.
Make decisions. A poor decision is always better than no decision.
You have to have truth tellers around you, and you have to be willing to listen.
You don't want to be setting strategy in the middle of a transaction, that's for sure.
Do it for the right reasons. Don't do it because of FOMO.
We'll also learn lessons which we can apply to our work and daily lives. Tune into the podcast version of Leaders with Francine Lacroix. Listen and watch on Bloomberg Television or wherever you get your podcasts.
When news breaks,
a redhead across the Bloomberg terminal.
Bloomberg has you covered.
Trump's global tariffs are struck down by the U.S. Supreme Court.
For all the context and clarity you need.
There's going to be now tons of tariff headlines until midterm elections.
Hear it first on Bloomberg.
Bringing you up to the minute geopolitical news whenever and wherever it happens. I'm Anne-Marie Hodern in Beijing, China, and this is Bloomberg.
Morning, how you doing? 45 minutes into the session, and maybe a time for a pause, maybe a kind of catching of breath to assess what the situation looks like. A little bit more positive, I would argue, maybe to what we had anticipated first thing this morning. There are some outliers. Certainly Germany is one of them, and the Adidas story, I think, is interesting this morning, but there's also the auto trade to fold into that story. But generally, European equities are on the front foot. US futures are actually also on the front foot after being battered yesterday by, well, a bunch of things. Tech was one of the factors, and also the Fed. Plus, we've also got higher oil prices to fold in.
We do have higher oil prices. Brent crude up by 1.5%, now trading above $90 a barrel, after the US carried out a fresh wave of strikes against Iran that focused on military targets while stopping short of hitting bridges and power plants. Let's get an update then from Bloomberg's Abir Abu Omar. Talk us through the latest on these strikes, Abir. For a number of days, it seemed we'd stepped away from the tit-for-tat format, but we seem to be back to that this week.
Good morning, Anna. Yes, we're back to that is what is seemingly happening on the ground. Perhaps I start with the latest. From moments ago, we heard that in Kuwait, a Chinese company was hit, killing one worker there. That is the latest, again, just moments ago, that happening. And that follows what was described as a heavy wave of strikes by the United States Central Command against targets in Iran, as you have suggested. Those seem to be a little bit more measured strikes because we're not seeing attacks against civilian infrastructure, bridges. We're seeing mainly military targets being hit in Iran. But nonetheless, tit-for-tat attacks are back in the region. That ceasefire that was signed in June in Switzerland seems to be out of the window for the time being. Neither side is coming back to the negotiation table actively to discuss those concessions that were mentioned in the MOU that was signed, those 14 concessions, Anna. And meanwhile, we're also monitoring the traffic, or the lack thereof, in the Strait of Hormuz. We did report that a Qatar LNG ship was able to make its way through the Strait of Hormuz. It was idling around the waterway for about 3 weeks, but it was able to make its way through with its lights on. So we're seeing some movement in the Strait of Hormuz, but nothing compared to pre-war, and especially over the past couple of weeks or so, we're seeing a movement slow down significantly. We're also keeping an eye out on the Red Sea. Bab el-Mandab, the strait there, is also at risk of Houthis in Yemen attacking it. So really what could be dangerous here is new fronts opening up in this war. That is what we're keeping an eye out on, as well as that Brent crude price now, as you've mentioned, above $90 on the barrel.
Abir, thanks very much. Bloomberg's Abir Abu Omar. Let's take a look at some of the other events we're watching out for today. We'll keep an eye on that oil price, 92.27, up by 1.7%. In terms of data, then, we get Euro area GDP at 10 a.m. UK time. The Bank of England rate decision, which we will be across as a team shortly. 1 o'clock UK time, we get German CPI. We get US GDP, core PCE, jobless claims. That's the sort of data deluge that we get from the States later on. And there's a lot of earnings news to get excited about from the tech sector over in the United States and here in Europe. We've got other earnings stories to cover as we, I was going to say, round out the week, but we're not quite there yet, are we, Guy?
We're definitely not done yet. And join us for lunch for that Bank of England decision. We're looking forward to it. OK, let's talk about tech. Before the bell, before we get to those results from Apple and Amazon that we've just been talking about, we've also got to factor in what we've basically learned overnight. We've got Microsoft surging in late trade, continuing to strengthen its cloud computing story. Meta had a tough night, slumping after disappointing revenue forecasts and that ballooning AI spend that everybody's now questioning. Bloomberg senior strategist Neil Campling joining us to talk about all of this. What stands out?
Yeah, I think what's interesting is that we have contrasting fortunes here in that Microsoft has delivered 43% Azure cloud growth.
Yep.
So such stunning growth is, if you like, justifying the big AI investment spend on their own AI network. So that's kind of paying off. Whereas, I think in simple terms, Meta hasn't got the same kind of growth forecasts and a confusing kind of outlook in terms of what they're actually going to be building this AI compute power for. In simple terms, Microsoft revenues are $90 billion for a quarter. Meta's are $60 billion for a quarter. But in CapEx terms, Microsoft's only spending $10 billion more than Meta is. So you've got that as Microsoft's OPEX grew 10% year on year in the quarter. Meta's operating expenses grew 65% year on year in the quarter. I mean, it's a substantial difference. Microsoft generating nearly $20 billion of free cash flow in the quarter, whereas Meta's almost disappeared completely, down 80% year on year to around about a billion, depending on which measure you use. So they are contrasting fortunes here.
So that's the contrasting story there. And how does Samsung fit into all of this? Because we've got numbers out overnight. If you look at the bit of the business that contains smartphones, that's not doing that well. But actually, that's not a very big part of the business anymore.
It's not at the moment. And actually, if you listen to the conference call, they were talking about they actually saw consumers trading up to the higher end smartphones within that division. But then we look at Qualcomm and ARM earnings, which were both impacted by lower volumes in that division. Now, the upside was all in the memory side. That's going to be of no surprise to anyone. The one caution I'd have there is that we now have like 4 memory-related companies with 80% plus gross margins. And historically, that's unsustainable. And, of course, they and Micron and Hynix are all ramping CapEx massively, and that's going to be an impact for margins going forward, I would suggest. And also, of course, that's going to lead to lower DRAM pricing eventually, and we're already seeing the prices of AI tokens coming down significantly in the last two months.
Amazon, Apple?
Amazon and Apple, the focus on Amazon's clearly going to be on CapEx again, plus what they'll do with the AWS growth. Can they do what Azure's just done? And Apple really is all about the cash flow. Yeah. And I think probably really good free cash flow generation, unlike...
It's going to be extraordinary.
Well, Apple, I think, are just sitting there to wait to see which AI model wins out.
Yeah.
And then they can sign a deal like they've done before with Google on search. So don't need to invest in the AI. They'll just rent it.
Yes. Neil, thank you very much indeed. Neil Campling on what we're seeing in tech. Tech's not the only story. You've also got a Fed to fold in, plus a series of earnings. Let's talk about some of those narratives that we need to talk about this morning. Skylar Montgomery-Koenig is here. Fed.
Yes.
So the market didn't like it?
No, not at all. I think it's almost like the market now wants to bully the Fed into hiking in September in terms of there's this worry around are they actually having credibility around inflation fighting? You have inflation on a PCE basis that's 2 times target. And there was an expectation there would be some kind of policy move or at least kind of firmer footing around that hawkish guidance. And there was no guidance. So the market's saying, you want us to tighten policy for you? We'll do it. Yeah, exactly.
And I mean, thought we might see more of an impact. I guess we are seeing an impact of the Treasury story onto European government bonds, in that we are seeing the same directional move. We're seeing yields at the short end come down, and we're seeing yields at the longer end go up. Not by a huge amount, but there is some read across then into Europe.
Yeah, absolutely. And it seems kind of unfair, right, in terms of the ECB has hiked. Inflation is definitely not as big of a problem there, particularly when you think about persistence in terms of the demand side. And if you look at government bond correlations, they're very, very high to the U.S. just generally. It's kind of 0.8 across the board for G10. And it makes sense, right? The U.S. is the risk-free rate. It has the benefit of being the world's reserve currency, big, deep liquid markets. And so when yields in the U.S. rise, you get demand for higher compensation elsewhere. And then I think the other important thing to remember is that, yes, it's the U.S. inflation fighting credibility that's under speculation, but it reminds investors generally that we have more macro shocks, that term premia should be higher, that yes, yields are the highest in many places that they've been in more than a decade, but we had an unusual last decade.
They're not the only central bank hawkishly holding, talking hawkishly but not actually doing anything.
Bank of England?
Yes. I mean, the Bank of England, the bias, again, I think is probably higher yields. Nothing's expected from this meeting, but it's what the pricing is telling you in terms of a full hike isn't priced till November. Now, there's no reason for them to push back against that because you don't know what's going to happen with US-Iran. And the key thing for the UK is that July inflation data, and that we know it'll be higher because the UK is quite unusual in terms of it does these price resets on bills. Utility bills in general, often gas sets that price. That gas price is still very, very high. So we know inflation in July will be higher, and you're better off waiting to see what that happens from a Bank of England perspective and how that feeds in than anything else. So no reason to push against hawkishness, and if anything, that means the risk is that that hike gets brought forward.
Sorry, just kind of thinking about inflation narratives back to the US, we actually get quite a lot of data out today, don't we, including PCE. But given that the last CPI print dropped, does that mean that the only surprise would be if we got a stronger PCE print?
Yeah, I think that's largely the skew in terms of, yes, we had that soft CPI print. It's also definitely fed into expectations for this PCE print. So year-on-year headline is expected to drop 40 basis points versus last month. Month-on-month is negative. So I think that's certainly the skew, and it's something we need to be watching because Wirsh has told us that that data is what is really driving, and we'll get two more economic rounds of data before the September meeting. What I will say, though, is it's unlikely to completely derail the narrative, even if it's a downside surprise, because you're still at 3.7%, right? It doesn't mean that you won't get hikes eventually.
Skylar, thank you very much. Skylar Montgomery-Coning from our Bloomberg Markets Live team, setting us up perfectly, Guy, for the data at the States later on today, and also the Bank of England rate decision, of which we will have special coverage. Don't miss the BOE Decides. That's a special programme today, 12:30 p.m. London time.
Just selecting my lunch menu. OK, let's talk a bit about how these markets have managed their way through this morning. It's a really complicated morning. You've got the macro story, the top-down narrative, the Fed, what's happening with oil prices. You've got a whole series of earnings coming through, which I think are fascinating, and you're getting real divergence in terms of some of the performances that we're seeing, both on the upside and on the downside. That's kind of cancelling itself out on this picture, but some big moves.
French construction doing really well. German athletics wear doing less well. Seems to be the narrative on European stocks this morning. That is it for the opening trade. The Pulse is up next. This is Bloomberg.
Technology is embedded in every aspect of our lives, and that revolution is playing out in real time. From finance to defense tech, AI to entertainment, from the road to the stars. Bloomberg is bringing you the stories of companies and people that are pushing tech to new frontiers, and the politics reshaping global tech markets. I'm Ed Ludlow, live in San Francisco, and this is Bloomberg Tech.
Every weekday, only on Bloomberg Television.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound. I'm Jumana Bersetchi. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility.
There's still room to maneuver.
We do see opportunities.
It allows you to increase significantly your net income.
Every trading day, only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
It's Bloomberg Money.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
You're watching Bloomberg Deals. Welcome to Bloomberg This Weekend.
This is Bloomberg Television.
Investors dump 30-year Treasury bonds, sending yields to 19-year high on concerns that the Fed chair is not fully committed to taming inflation. Well, tech earnings in focus. Microsoft jumps on surging cloud revenues, while Meta dips on a disappointing revenue outlook. In Korea, bumper chip profits are not enough to boost Samsung, and the U.S. launches new strikes against Iran, hitting dozens of military targets in a return to Middle East escalation. So there is definitely quite a lot going on. We also have Germany preliminary second quarter GDP rising 0.2%. If you look at the markets overall, look, U.S. stocks are still edging higher. We've seen some strong growth at Microsoft, reassuring some traders that expensive AI bets are starting to pay off, outweighing actually some of the resurgent concerns about inflation. We do have question marks about Meta, which we'll get to in a second. Oil advancing as the U.S. retaliating against Iranian strikes on American forces with a fresh wave of attacks. And then, of course, the 30-year 5.2348. We'll have a pretty big look at that. And then sterling ahead of the Bank of England, 133.38. Now, Microsoft is also gaining results showing strong cloud revenue. Meta shares actually falling pre-market after the Facebook parent raised the low end of its full-year forecast for both capital expenditures and total expenses. So for the conversations that matter and the insights you need, let's get started.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, the bond market sends the Fed chairman a clear message. We'll discuss the reaction with Catherine Nice from PGIM Credit in just a moment. But there's also been another escalation in the Middle East. More on that shortly. Let's just kick off with what's been a bumper 24 hours for earnings, both in the U.S. and here in Europe. Our Charlie Wells is here with the latest. Hi, Charlie. So we're in the middle of tech earnings. The standout story, Samsung. What's happening there?
Well, Francine, Samsung really demonstrates the sort of compare and contrast dynamic that we've been seeing across this earnings season, because they reported a 250-fold increase in chip profits and yet ended the day down. So if you just take a look at this chart, you can see over the past few days and on this past trading day in particular, the volatility that we've seen at Samsung despite stellar results and reports of strong demand ahead. Let's talk about two compare and contrast stories as well. That is Microsoft and Meta. You can take a look at this pre-market chart behind me, you see one red, one green. Well, that has a lot to do with earnings. You saw Meta reporting a disappointing revenue forecast for the months ahead, and also capital expenditure that concerned investors, raising the lower end of their expected expenditure at this time when there were questions about AI spending. Different story, contrasting story with Microsoft, where you saw that cloud unit up 43%. So again, management there talking about keeping a lid on expenses. A real compare and contrast there, but that's not it for tech earnings. Let's look at what we've got coming ahead. We've got Apple and Amazon down the line. Now again, we're expecting to see revenue increased at Apple, up some 16% for Tim Cook's final full quarter as CEO. That's attributed to a lot of the iPhone growth that we've seen. Given that redesign, Amazon, all eyes are going to be on those web services. That is their main source of profit. And again, investors also asking questions, though, about expenditures.
Talk us through, Charlie, the flurry of European earnings that we've also had today.
Huge day here. Let's start with Shell because, of course, we know that they have been up significantly. Year to date, they're up over 23%. Now, they have benefited from a lot of volatility in the oil markets that we've seen, given that Middle East disruption. But they didn't get off scot-free, and they did report in their earnings disruptions because of their gas operations in the Gulf. So, again, one to watch there on Shell. But let's flip and take a look at AB InBev as well to see how they are performing in the markets because they reported softness. They are contending with some difficulties in China, some structural changes, consumers simply drinking less in this era when health concerns are top of mind. But we also saw a World Cup boost here. They saw some growth in the United States, in Mexico, on the back of the World Cup. World Cup theme, though, not boosting Adidas. Let's bring up Adidas because they reported a disappointing earnings release today. We're seeing them down significantly, down 17%. And what we're really hearing is investors latching on to World Cup marketing spend. That's just not translating to the sort of growth that investors really would have wanted to see there. Now, let's end on banks because it's been a very good time transatlantic to be a bank, and we're seeing that this morning. You see green from BBVA. You saw a surprise €2 million, as much as €2 million buyback from BBVA, and Societe Generale up as well, up about 1%, also announcing a buyback. But again, a little compare and contrast there. They didn't, Societe Generale, their trading desk, did not grow as much as a lot of competitors, but still in the green this morning.
Charlie, thanks so much. Charlie Wells there with the earnings wrap. Now, the U.S. has carried out a fresh wave of strikes against Iran that focused on military targets while stopping short of hitting bridges and power plants. So let's get more with Abir Abu Omar in Dubai. So, Abir, just talk us through the latest strikes and how much of an escalation is this?
Good morning, Francine. Quite an escalation this morning. The latest, perhaps, I would bring that to the table, is Iran just now reportedly hitting a Chinese company in Kuwait with one person there killed. We'll wait further details. But those tit-for-tat attacks seem to be returning to the region. That ceasefire, Francine, that was signed in September in Switzerland back in June seems to be out of the window. Now, that follows, as you can see on the screen there, it's Central Command in the United States saying that they've hit heavily, the last wave of attacks was heavily hitting Iran. They did not hit civilian infrastructure this time around. It was mostly military targets. And so you're seeing slightly a more measured round of attacks by both countries, but definitely further escalation in the Middle East with new fronts opening up.
So, Abir, what's the status of shipping through the Strait of Hormuz?
Yeah, that's what everyone's keeping an eye on, Francine. Brent above $90 a barrel. Movement there is still pretty much paralyzed. We're keeping an eye out on the ships that are trying to make their way there. We know that a Qatar LNG ship was able to make its way through the Strait of Hormuz with its lights open. It's been idling around the waterway for about 3 weeks. So that is positive, but in the midst of really negative news when it comes to ships and tankers in the waterway, because movement there is still pretty constrained, with ships unable to take the risk of crossing either the United States or Iran.
Abir, thanks so much. Abir Abu Omar there with the very latest. Now, Fed Chairman Kevin Warsh has insisted that policymakers' decisions to leave rates unchanged was not a sign of inertia at the central bank. Now, the BOE is also expected to hold later as it sticks to a wait-and-see approach to navigate the wild swings in oil and gas prices. With us now to talk through all of the details, Catherine Nice, Deputy Head of Global Economics at PGIM Credit. Catherine, thank you for joining us. I mean, it's a huge week, actually, when you look at some of the market volatility. It's very clear that bond yields at 19-year high send us something. It's a warning signal for Kevin Warsh at the Fed. Like, does that challenge his expectations?
So I think it was a real surprise. I think a lot of people were expecting him to come out and give a strong performance at the press conference, and fairly or unfairly, the market has sort of judged this as a weaker press conference than expected. And I think principally because there was an air gap between the rhetoric around commitment to price stability and an awareness that inflation has been away from the 2% target in the U.S. for really quite a long time, 5 years, and yet looking like there was no appetite to surprise markets with what is, not a very dramatic 25 basis point hike. Now, a charitable view of that would be, that perhaps he's finding his feet a little bit like President Lagarde in the early days, you may recall, and now, she's seen as quite a credible central banker. So I think, clearly all is not lost, that perhaps he's falling more in the footsteps of an incremental approach, despite, what he was talking about at the press conference. And I think for us, the view is still that hawkish tilt is going to come in September with 3 sequential hikes. But clearly there is a big risk here because it's got a whiff of discretionary monetary policy, which we know doesn't work. And the market could sort of bully him into doing, perhaps even a 50 basis point hike. So I think that is the real risk here. Because, Catherine, there's no doubt in your mind that that the Fed should deliver something faster. From a pure, economics perspective, I think it is a complete no-brainer that rates need to be higher in the U.S. And that is not something that is new this month in July. The writing has been on the wall for quite some time. I mean, the ECB, with a much weaker economy, with inflation at the target and inflation now really not that far above the target, they're already hiking, and markets have a very clear view around the ECB's reaction function. And because of the resurgence in these tensions in the Middle East, gave what, had a, quite a hawkish tone at their meeting. So we kind of know what to expect. And it does seem at odds a little bit with the messaging that we've had at the Fed. That I think people were expecting that to get put right, yesterday. People were expecting something yesterday, right? And there was a bit of a repricing. So what do you do with Treasuries right now, especially the 30-year, which has moved quite a lot? Well, as I said, my base case will be that they will come out and do the right thing in terms of hiking rates and being very decisive in doing so in the next sequential meetings, and that by doing that, that it will be vol dampening at the long end. But it's risky. It's risky. And it may be a bit of a painful path to get to that point. It may be that, we experience some volatility before we get there. But I think ultimately they will do the right thing and hike rates, and that they will double down on the commitment and put their money where their mouth is in terms of, being committed to the price stability target. But, as I say, the signal, it's confusing. Yeah, I mean, just to be, you're very, very clear, but do you think it's the bond markets that will, continue to put pressure until that's achieved? I think that is, one element of pressure, but there are other elements. And, Chairman Warsh, referenced this in the press conference. What about inflation expectations coming from households and businesses? We know that, energy prices feature significantly in headline inflation. People have a really high degree of awareness. You're filling up the tank in your car every week or every couple days. You know what that price is. You notice notice those price changes. Same with food prices. Food is very energy intensive. Plus, we've had, extremely unusual weather patterns that are affecting agricultural yields. That is something. So I think, and plus we've had an experience of, exceptionally high inflation, just a few, in the recent past. So I think against that backdrop, there should be a concern amongst policymakers that inflation expectations are going to be a lot less sticky and more reactive to what's happening in the data. And that means that central banks need to move in order to demonstrate a commitment to getting things under control. And I think, that is the fear. And if that gets out from under you, then the risk is if you've got to act even more decisively down the line, which has, of course, a real economic cost to it.
What are you expecting from the Bank of England? Because, again, if you look at the ECB as a kind of template, right, on how to get inflation under handle, we should be expecting something today.
Yes, well, it's tricky. I mean, we do have to accept that policy rates in the UK are significantly higher than policy rates in the euro area, and yet our economies are very closely linked and not behaving in wildly different ways. Inflation is roughly in the same place. Growth is roughly in the same place. And yet we have much, much higher rates. And moreover, the trends in the latest data flow have been one of downside surprises on inflation, and even downside surprises on forward-looking elements of inflation, like wage growth. And, the economy is actually, it's not falling through the floor. So I do think that the Bank of England can take its time, be on hold, that is credible. I agree with Skylar, who was on, just shortly before me, when she said, that it's good for the Bank of England that the market is, leaning hawkish. My own view is that actually when we get towards the end of the year, the Bank of England could well be in a position where they can actually cut rates. And again, it's not all at the doorstep of the Bank of England. We have a lot going on politically here in the UK that matters a lot for markets as well.
Which, of course, complicate things. But, when you look at the German 10-year bonds, they fared better than gilts. So how much of it is it the political situation, and how much of it is actually punishing the UK for this lack of, inflation discipline?
My sense, I mean, it's very difficult to prove this, empirically, but my sense is that quite a lot of this is now sitting on the doorstep of, political uncertainty ahead of this autumn budget. Yeah. I mean, the signals so far are reasonably positive. This change in leadership was less painful. It was smoother than we expected. We have a prime minister that is surrounded by people that the market has confidence in, etc. But, the difficult questions, the difficult trade-offs have not been addressed. No one really knows how that's going to resolve itself. We are paying the price for not having resolved those questions for quite some time, and people just want to see. They want to see action. Words alone are not enough. Actually, you've got to start doing something.
Catherine, great analysis. Catherine Nice, Deputy Head of Global Economics at PGIM Credit. Coming up, a sales beat for Campari. We'll speak to the Chief Executive of drinks maker next. This is Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything. Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories.
The economy has been doing well. That does not tell you what the future is going to be.
We are taking a step-by-step approach, a very systematic approach with India.
This is a time to put a little more defense into your portfolio.
Insight with Haslinda Anand, only on Bloomberg.
Trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Only on Bloomberg.
Today, the Bank of England makes its next interest rate decision, and investors will look to BOE Governor Andrew Bailey for signals on the rate path ahead.
Inflation is higher than we expected. Of course, now what we've got to do is get it back to 2%.
Join the opening trade team for live market reaction and analysis and on-the-ground coverage at the Bank of England. It all starts today at 12:30 p.m., only on Bloomberg.
Well, investors this morning cheering the results of Campari, which has reported sales for the first half that beat estimates. Now, the Italian drinks maker has been on a push to grow sales in the U.S., and we're delighted to be joined by Simon Hunt, the chief executive of the Campari Group. But Simon, thank you so much for joining us. So what's your first take on the ongoing summer season?
Yeah, I think, look, we've started the peak season very well, as you can see in our results. And I think that's, through Q2, we continued the momentum we had in the first quarter. And the big thing for us is just about staying true to the strategy that we've shared with everyone and being very clear about fewer, bigger bets. I think one of the best bits of commentary I saw this morning as I was just coming in was one of the analysts talking about fewer bets, better delivery. I think that's a very good summary of where we are.
So, I mean, when you look at, have you seen overall an increase or decrease depending on the geography and the heat waves? Again, are people consuming for the summer? Like, are they consuming alcohol differently because of the rising temperatures in Europe?
Yeah, I think, look, we track the weather like many companies, and the actual number of sunny days, which is really what we look for, is quite similar to last year. But you're right, the temperatures have definitely been higher. And what we see, though, in those occasions when people are out is they're looking for more refreshment cues. So we see more traditional cocktails under pressure, but actually our spritz portfolio, big glass of ice, very refreshing even in hot climates or exceptional temperatures, does very well. I don't think it's been a big lift for us, but I think it's been positive.
What's been the U.S. like? I know in the past you were destocking in the U.S. That seems to be changing.
Yeah, again, we've continued now, and we will have delivered as a total business 5 quarters of consistent growth. And I think compared to our peers, that's a consistent delivery. And one of the big drivers on that is the US. And our performance in the US is we are investing behind our brands and we are gaining share in the most important channels. So, for example, at the moment, on Aperol, on Espolòn Tequila, and on Campari, we're growing double-digit in the on-premise. And that's where brands are built. And so for me, I'm really pleased with the performance. Yes, the market is tough, but gaining share now, I am confident the consumer will come back. Exactly when, as your previous commentator just said, we'll have to wait and see. But ultimately on this, gaining share now puts us in a very good position for that recovery.
Are you focusing on the two coasts, or have you also started penetrating markets in the middle of the U.S.?
Yeah, we operate nationally. I mean, we've prioritized the development of our spritz portfolio really on either sides of the coast, and then select markets in the middle of the states. But what we're seeing is broad growth across all of our states. And I think that's the encouraging part, where we talked about last time, consumers are looking for that moment, that conviviality, that social connection with their friends. And we create those moments. And as a result, we're seeing people really get behind that, whether you're in the Midwest, whether you're in Manhattan or LA.
I know there's been a talk, of course, and I think you mentioned it briefly, about the rollout of the Campari bottled spritz and the Aperol spritz in a bottle. How's that going specifically?
Yeah, I'm really pleased with this. It was one of the key tenets. What we'd worked out is consumers wanted to enjoy Aperol spritz or Asati spritz or Campari spritz in occasions that we couldn't offer it. So there are two key areas. One, we do a lot of work with music festivals, particularly in Europe. We run, I think, about 260 music festivals. We'd reached a point where we just couldn't meet the demand, where you couldn't make an Aperol spritz fast enough. So by moving to Aperol on tap, we've managed to unlock an occasion. And some of the initial results, we tested it last year, we've rolled it out this year, really, really encouraging. So far in Italy alone, we've taken about a 1.5% of share of premium beer, which for me is a massive opportunity for us as we look to expand those occasions into more beer occasions. So really positive on that side. We've also launched the Ready to Go. So if you're on a boat, you're up in the mountains, you're not somewhere where you can make a Aperol spritz, then we've got a Ready to Go can. And the initial launch on that, the velocity looks good in the key accounts. We've only in 4 markets in Europe so far, but if your listeners are traveling around on EasyJet or British Airways, you'll see it on those planes as well. So please enjoy it.
Simon, you said last year that you were pausing inorganic growth for the moment to actually focus on your top brands. Have you seen any opportunities to get back into M&A?
Yeah, I think you will have seen in the industry, there's a lot going on. There's a lot of speculation, CEO changes and restructures and mergers, and a lot of the commentary around the industry is quite busy. I think for us, we're just focusing on executing the plan we've got. We continue to look at anything that comes available, but at the moment, I'm not seeing bigger opportunities outside. Further down the line, there might be some opportunities that we could bring into the portfolio, but for now, we feel like we've got a significant opportunity with what we've got.
When you look at, the next couple of months or quarters, there's a lot of worry about geopolitics, inflation. Like, how do you see spending going forward? Are people deciding to drink and spend differently?
Yeah, as your previous commentator just talked about, the impact of inflation, and particularly when everyone's following the oil price daily, given the volatility there is a knock-on effect. For us, it's more short-term. It's in logistics, it's in insurance, it's in warehousing. So there are some cost pressures that we've reflected in our guidance in the second half to say, look, let's wait and see. It's still very volatile. But I think what we are seeing is even when the consumer is under pressure, which is what we've seen now for a number of years, and what I talk to about 2,500 bartenders or bar owners a year to give you an idea. And the consistent theme I hear from all of them is people are coming out, they still want to come out, they're just spending a bit less because they're feeling the pinch in their wallets.
Simon, if there's one thing in the next couple of months that you worry about, is that people are starting to feel a bit of pinch, so you have to make sure that maybe not focus on your margins so much, or is there something that we should be watching out for in terms of a change in behavior?
Yeah, not really. I mean, I think you're seeing a bit of tightening, but to be honest, this is not a news story. We hear about moderation. It's not a news story. And so I think what we're doing is we're just really executing the plan. We talked about last time, Campari has opportunities other companies don't have. We have a great portfolio that's now really focused. We've got a geographic expansion that you can see in our results. We're growing plus 9% in our developed markets, where we still have massive room to go. Convenience, tap, in can, getting share of new occasions we had. And then all of that tightened up with a better, tighter machine behind it is really where the team and I are focused. So I think that's where our effort goes. We're not too worried about what's happening around us. We still have a massive amount of share to go after. And the results you can see, we're gaining share in every one of the markets.
Simon, thank you so much for joining us today. Great pleasure to speak to you as ever. Simon Hunt, the Campari Group Chief Executive. Now, this is a picture across the board. If you look at some of the anxiousness that we're seeing out there, are certainly some of the questions that we need to focus on. So, look, U.S. stocks are rising. Microsoft is countering some of the bond rout that we're seeing. U.S. stocks are rising on the strong growth at Microsoft, reassuring investors that expensive bets on AI are starting to pay off, outweighing resurgent worries about inflation. Microsoft jumping pre-market trading as its cloud unit grew at the fastest clip in 4 years, while the company also is holding the line on spending. Coming up, we'll discuss the construction outlook with the chief executive of building materials giant Heidelberg Materials. That's next, and this is Bloomberg.
anything we do in Africa is going to be more risky than the U.S. I think the approach we want to take is how are we being compensated for that risk? And one of those is obviously going to be a valuation question. In our minds, valuation is a lot more attractive in Africa, even if we adjust for some of those Africa risks that a lot of Western investors see. So yes, in a lot of ways, you take some of those models that, as I said, might be more asset medium or asset heavy. There might be some more inherent risks. However, if we're saying we're adding some risk because of that kind of model, but we're now solving a core problem as opposed to maybe a nice to have solution in Africa, that might actually offset it. Where if you're solving something that people really absolutely need and can't live without, in a way that then that's a lot less risky. So again, we'd encourage investors to have a less binary view. In other words, the US isn't risky, Africa is risky. That's going to lead to a lot of complications down the road.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo.
And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
What is going to be the consequence for U.S. markets?
We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
Bringing you the most important news and financial information whenever and wherever it happens. I'm Michael McKee on the Mexican border, and this is Bloomberg.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. Investors dump 30-year Treasury bonds, sending yields to a 19-year high on concerns that the Fed chair isn't fully committed to taming inflation. Tech earnings in focus. Microsoft jumps on surging cloud revenues, while Meta dips on a disappointing revenue outlook. In Korea, bumper chip profits are not enough to boost Samsung. And the U.S. launches new strikes against Iran, hitting dozens of military targets in return to Middle East escalation. Now, Poland says it's investigating an unidentified object that crashed on its territory close to the border with Ukraine during an intense Russian missile attack. Now, we understand that, Mr. Tusk saying the missile incident is serious, all points to a Russian ballistic missile. We haven't had confirmation on that yet, so we'll stay on top of it very, very closely. The Ukrainian foreign minister said a Russian Kh-101 cruise missile crossed into Poland. In a statement on the X platform, Polish media reported that it was a Russian missile, citing a government source it did not identify. Now, the Bank of England is widely expected to leave interest rates on hold, sticking to a wait-and-see approach as it attempts to navigate fluctuations in energy prices sparked by the Iran war. Now, for more, let's bring in a Bloomberg Daybreak Europe anchor, Lizzie Burden, outside the Bank of England. Lizzie, what are we expecting from the BOE today?
Well, much like the Federal Reserve last night, Francine, a hawkish hold expected from the BOE today, with possibly a couple of dissents from the chief economist, Hugh Pill, external member Megan Green, maybe throw in Catherine Mann as well. But the reason that they'd want to take that wait-and-see approach is because things are uncertain on the geopolitical front, of course, when it comes to the Middle East war. We've seen those huge in oil price swings in recent weeks, but also uncertain on the domestic front. We've got a new Prime Minister, Andy Burnham, of course, and maybe down the track they'll want to hike rates if there's a load of borrowing at the autumn budget. Now, the data recently gives them cover to hold. We had inflation dropping below the BOE's expectations to 2.6% in June, and therefore it looks like perhaps we'll have the guidance not changing at all since April. Bit of a copy and paste job expected by economists today.
Lizzie, thanks so much. Lizzie Burden there at the Bank of England. Now, viewers in the UK and Europe can watch our special coverage of the BOE decision and press conference from 12:30 p.m. London time. You can also see it on the terminal, on Bloomberg.com and on YouTube. And then a little bit later, we'll also be speaking to Governor Andrew Bailey. Catch that conversation at 4:30 p.m. Now, Heidelberg Materials has narrowed its full-year profit guidance but expects demand in the construction sector to continue stabilizing. The German company is one of the world's biggest cement producers. It's described the environment as geopolitically and economically challenging. We're now joined by Dominic von Achten, the chief executive of Heidelberg Materials. Mr. von Achten, thank you so much for joining us. There's a lot going on in terms of risks and guidance. If you look at what you said for the forward guidance, what gives you the confidence that, you know, what we've seen this quarter marks a sustained demand recovery?
Yeah, Francine, thanks for having me. I think fantastic to be with you. Look, there is a lot of volatility geopolitically and economically, but we target clearly to be the stable anchor in this, and that's why the growth momentum that we saw in the second quarter of 26 was very important for us, because it was comprised of two things: organic growth for the first time, Francine, for the first time since more than 4 years. We have seen volume growth. That is really encouraging. And we top it up with some nice acquisitions that we've done in Canada, in the US, and also in Turkey.
So give us a sense of what regions you think will most likely drive volumes in the second half of the year.
Yeah, you know, we cover a lot of the world, so I can go from east to west. So Australia is coming back after a couple of dire straight years. We see volume growth in Australia. We see volume growth in our core markets in Asia. That's outside of China, mainly Indonesia and also India. There is growth in Africa, I think, especially also in Sub-Sahara Africa, East Africa. I think the growth is coming back. In Europe, growth is coming back in Northern Europe. Two important markets for us are Norway and Sweden. I would say your home country in the UK, together with Germany, Benelux, is still a little bit sluggish, but there is still good growth out of Eastern Europe and also Southern Europe. And then in the US, we had a tough first quarter, but you saw also our figures in the US. Revenues are up 5% in the US. So also the US is growing on the back of some very big projects that really drive the growth in the US.
But overall, I understand you've narrowed your guidance a touch. Is this due to better visibility, or is it because you're just more cautious in the second half of the year? And if you're more cautious, what is it exactly about?
It's clearly the first. It's it's just to be more precise. You know, the guidance had a pretty far gap, and that's something we usually do, that we then specify it. So I think we are absolutely confident for the second half to deliver this guidance. As we said, the demand signals are encouraging. We continue to do bolt-on acquisitions. You should see some additional movements here in the next couple of months also. So we are absolutely confident that we will deliver on this guidance.
So on your acquisitions, what parts of the world are a priority? What kind of companies are you looking at?
Yeah, important point, Francine. It's in the end bolt-on acquisitions in existing markets. Mostly, I think that's clearly our target. So that's why we have moved on Turkey, because we know the assets for 35 years in a joint venture. We have stepped up into a majority position. We continue to do acquisitions in North America. We've just closed one in Edmonton, so west of Canada. We have done an acquisition in Texas. So the US will stay on the radar. But we are open for acquisitions in the parts of the world where we operate or where we currently trade. I think that's our clear focus.
Given everything that's going on in the Middle East with price action and the price of oil, when do you expect actually these energy and freight costs to come down?
Yeah, Francine, if I could give you that answer, I probably would be in a different job. But it's important for us because we are very energy intensive. So yes, that volatility will stay with us. I think we expect underlying energy costs to be still high, because, you know, that's also when you talk coal, petcoke and other commodities, that's something that you can't turn on and off in just a couple of days. I think the diesel will need to fluctuate with what we see at the pump, basically. But the underlying energy costs will be high in the second half. But we are working and we are doing our homework. We've just done our 2.5 weeks of discussions with our management team teams globally. We are working on the pricing side with surcharges. So we are very confident, again, that we will deliver on our guidance for the second half.
I was going to ask you about that. How much further pricing or fuel surcharges are you expecting to have to implement if energy costs stay elevated to protect your margins?
Well, I think if we stay at the current level, or if we come down what we saw, for example, in end of June, beginning of July, I think we are moving in the right direction. But if we see others or more sustained spikes in energy and oil prices, I think we need to continue to implement surcharges and implement price increases. We are on it, and we see good traction for the second half. The management teams are fired up to get it done, and I'm very confident that we will deliver on this.
I mean, going forward, how much of your future growth will come from infrastructure or data centers linked to AI, and how much of it will actually come from more traditional housing and infrastructure?
Yeah, I think right now, I think it's fair to say that the predominant amount of the growth comes from, what you mentioned, we call it industrial segment. So that's basically data center and AI, predominantly in the US, but also partially in Europe. And then also in infrastructure. You see big infrastructure projects in the US, you see big infrastructure projects in Europe coming. You know that Germany is up to spend a triple-digit billion number on infrastructure. So the projects are coming into the pipeline. Housing continues to be sluggish around the world. There is very little movement on housing. There is some stabilization. I think now in Germany, there's stabilization in Northern Europe on the housing side. And it very much depends on what you covered in your program before, what the interest rates are doing. And I don't have to talk to you. You're sitting in the UK, so you probably know what the Bank of England will decide will have an impact on whether the public in the UK goes back in building their own houses.
Yeah, that's the question that hopefully we'll have answered in just a couple of hours. Dominic van Achten, thank you so much for joining us. That was, of course, Chief Executive of Heidelberg Materials. Now, L'Oréal has also reported quarterly sales that beat expectations on the back of rising demand for hair care products. Well, I spoke exclusively to the Chief Executive, Nicolas Hieronymus, about the company's resilience.
Beauty is a very dynamic category, and it shows once again its resilience in times of trouble. We call it, whether you call it the lipstick effect or the dopamine effect of beauty. The market's growing. It has accelerated a bit in Q2, and people are going for innovation, for quality, and that's probably the reason behind our great first half at plus 6.5%, way above the market growth, is that we brought a lot of innovation and of superior quality into the market.
Is there a section of the market, because you're really exposed to some of the very high-end brands and some of the more mass market, is there a section of those that is actually doing better than expected?
Well, the overall, what's great this year is that, and that's probably the strength of our portfolio, the breadth of our portfolio, which goes from products at 4 or 5 euros to product at 300, is that all our divisions and brands are contributing. If I look at the top 4 brands that are contributing to my growth, you have L'Oréal Paris, you have Kérastase, you have La Roche-Posay, and Yves Saint Laurent. So a luxury brand, a Dome brand, a mass market brand, and a professional brand. And that shows that you have to have beauty for everyone. Now, if you look at the categories or the type of products that are flying the most, you've got 2 categories that are really driving the growth: is hair care and fragrance. And as far as market is concerned, you continue to see dermatological beauty extremely dynamic, because people want safe and efficacious product, which is what we provide with brands like La Roche-Posay or CeraVe, which are doing phenomenal in the beginning of the year. Do your customers spend differently in the US than they do in Europe than they do in Asia? Well, the markets are different. Asia is a skincare market. And the good thing about Asia is that it confirms that China is back to positive territory and is driven by luxury. So there's, I would say, a stronger appetite right now for premium in China. And our L'Oréal Luxe division is at plus 10 after 6 months in China, which is very positive. So China is more about skincare. The US has always been a very strong makeup market and remains so, but it's true there's been really an acceleration of hair care a lot in the US. Overall consumption is pretty good in the US. Consumers are pretty resilient. And then we see all around the world, the need for better skincare, for UV protection. And that's also an area where some of our brands thrive with just long CeraVe sun care, which is doing great too. So but in the end, I think I know you're trying to find differences, but there's an overarching trends that people want beauty and want innovation. And, one of the things we've done at L'Oréal is that we've more than doubled the weight of innovation in our business between this first half and last year's first half, which is also why we are gaining market share, because consumers are constantly tempted by new ideas, new products. And you're right to mention influencers that play a very important role in bringing these new products to life on TikTok or other channels. And you have to be in that game and to be providing very exciting new products. And that's true all across the world, whether Asia, North America, or even the Middle East.
As you mentioned, a good set of results, but there is a lot of pressure economically and on geopolitics. What's the hardest thing that you have to navigate, either in terms of tariffs, inflation, or trade in general?
Well, what's clear is that you have to be agile and you have to be able to adapt, whether it's on tariffs, whether it's the price of oil, which has an impact on the cost of transportation, whether indeed it's the impact of the crisis in the Middle East on consumer behaviors as it relates to travel retail, for example. So it's a lot about agility. Of course, currencies also have an impact, and we are happy for L'Oréal that the dollar is a bit better than it used to be. So in the end, it's about seizing the ascending trends and trying to leverage what I think is unique at L'Oréal is the fact that we are very, very spread. We call that a multipolar model. We are spread across regions and across price points and divisions. So whenever something is struggling a bit, we can bounce back in another area. And if I take this first half, Middle East was below expectations, even though not as much as what we feared. But the fact that China, luxury in China is more positive kind of offsets it. So that's how we navigate. And in the end, going back to what I was saying earlier, I really see, it's not that I feel, I can observe that when the world's getting tougher, people are really more inclined to indulge in pleasurable beauty products. There are people that want more indulgence, others that want more health-related products, and we have both. So that's how we navigate this crazy world.
Well, that was the L'Oréal Chief Executive, Nicolas Hieronimus. Now, coming up, we go inside the uproar engulfing international football as FIFA looks to press ahead with controversial sale plans. So that's coming up next, and this is Bloomberg.
Technology is embedded in every aspect of our lives, and that revolution is playing out in real time. From finance to defense tech, AI to entertainment, from the road to the stars, Bloomberg is bringing you the stories of companies and people that are pushing tech to new frontiers and the politics reshaping global tech markets. I'm Ed Ludlow, live in San Francisco, and this is Bloomberg Tech.
Every weekday, only on Bloomberg Television. We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound. I'm Jumana Versace. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility.
There's still room to maneuver.
We do see opportunities.
It allows you to increase significantly your net income.
Every trading day, only on Bloomberg.
Well, the Polish Prime Minister Donald Tusk says an object that crashed near its border with Ukraine was a Russian missile. Well, Poland says the incident took place at 3:40 a.m. local time during an intense Russian attack targeting Ukraine. For more, we're joined by our chief Europe correspondent, Oliver Crook. Oliver, this feels like a big deal. What do we actually know about this incident?
Yeah, absolutely, Francine. It's something we've been monitoring over the last couple of hours. As you say, overnight you had a massive barrage of missiles attacking Ukraine and also specifically the western part of Ukraine. Then there were reports that there had been an object that crossed into Polish territory. The Polish authorities were really waiting to see what that actually was. And it seems now that the Polish Prime Minister, Donald Tusk, is satisfied to say that this item was likely a Russian missile that crossed over into Polish airspace. Obviously, Francine, that's significant for a very great number of reasons, not least of which that Poland is, of course, a member of NATO. And you'll remember in the early months of the war, right after the war began back in 2022, there had been another missile that entered into Polish airspace, exploded there in Poland, but that was a Ukrainian air defense system. But at the time, nobody knew that. People were very concerned that this could have been a Russian infraction, and that will obviously bring into the fore this very important conversation about invoking potentially Article 5 of NATO. Now, that obviously did not happen, and we've had a number of Article 4 of NATO being triggered. That is consultations over things that have been of concern. They happened very recently by the Poles when a number of Russian drones entered into the airspace. But we're watching it very carefully, Francine. We're going to see after the sort of crisis meeting over in Poland what we get from the Premier, how big a deal they want to make of this. But of course, another likely step could be that the Poles invoked Article 4 of NATO, which would be consultations on defense in order to figure out how to respond to this incident.
Yeah, it feels like very delicate times. Ollie, thanks so much. Oliver Crook, our chief Europe correspondent. And of course, we'll be monitoring the situation very closely. Now, the insurance firm Munich Re is warning that the industry should be braced for losses tied to the fallout of this year's extreme heat waves. Now, much of the U.S. and Western Europe remains in a heat wave, with 2 firefighters dying tackling a wildfire in Greece. Now, for more, we're joined by Alistair Marsh, our climate change reporter. Alistair, I mean, if you look at the pictures, they're just absolutely incredible. And in many parts, they just can't get a handle of the wildfire. Yeah. So how serious does Munich Re say the situation is?
Well, Munich Re, as always, these reports are very grim reading. I mean, it's $112 billion of losses in the first half. That's all types of natural catastrophe. If you think about specifically the fires in France and Spain right now, insurers are only just starting to kind of come together with estimates of the size. We're talking about several hundred million euros as an estimate we have from Aon at this point. But interesting to note that of the 112 billion from Munich Re, only 44 billion is insured. And that's sort of the future that we might be looking at as we have El Nino and climate change. There may be some sectors and industries where insurers start to say, not so sure I want to be involved in that anymore.
Yeah, because actually if it's a natural disaster, then it's force majeure, and actually a lot of these, insurance and reinsurers won't pay up. Now, the firm scientists also say that the world is headed for a super El Nino.
Yes.
So what does that mean in terms of economic but political consequences?
Well, yeah, the super El Nino is, I guess, accelerating a natural phenomenon, but it's going to mean more losses, more fires, more flood, more extreme events of this sort. In fact, we've had scientists saying that next year there's some predictions that for the first time we'll have a monthly global temperature rise of above 2 degrees, which would be the first time ever. And all of that means disrupted weather patterns, fires, floods, and the like around the world, and cooling as well. It's not just some places being on fire, it'll be disrupting monsoon events, etc., which has obvious implications for commodities and the like.
I mean, do you see a change in how people are interpreting this or changing their habits, or is it just people, it feels like every year is a surprise, but we know what's happening to the climate?
Yeah, well, I think that there's a waking up, a realization amongst especially amongst the investor community that this is, regardless of the politics, these issues are not going away. And when you see France on fire, It's very obvious, yeah.
Yeah, Alistair, thank you so much. Alistair Marsh there with some great reporting, of course, on the wildfires. Bloomberg also understands that FIFA began secret talks over its plans to sell a stake in its new media division last year, meeting with Joshua Kushner, a venture capitalist with family ties to President Trump. Now, football's governing body is looking to secure its first ever private investment, raising as much as $4.2 billion. But the plans, we all know, have sparked a backlash, with Europe's Football Association saying said to be considering a boycott. Well, Bloomberg's Tiwa Adebayo has been following the story and joins us now. Tiwa, I mean, these are very controversial plans, to kind of put it diplomatically. Why so?
Well, it's controversial because it really goes to the heart of this issue that is concerning so many football fans around the world. The businessification, shall we say, of football, and many are worried that it will lose the essence of it as a sport. FIFA have tried to sort of assuage these concerns. They've said that the proposed company won't be under the control of investors. It will remain under the control of FIFA. But it's not been convincing. There have been some big critics from the EU, also new Prime Minister Andy Burnham criticising this as well. And for a lot of people, this hasn't just started with these plans. We've just seen the World Cup. There were huge concerns about the commercialisation of that as a tournament. It was the most profitable World Cup of all time for FIFA. So for many, this is the latest in a long line of incorrect actions that FIFA has taken.
I have to say, I was impressed by Andy Burnham. He was like straight in there, like faster than a lot of the football commentators. What hurdles could FIFA then face as it tries to get this deal done? I haven't even seen that much private equity, or investors being behind this.
Yeah, well, they are likely going to face hurdles from fans. There's going to be major backlash there. But also, we mentioned UEFA, who are in charge of European tournaments. They have come out very strongly saying that this deal crosses a line in football. They're talking about a boycott of FIFA events. But also, what's important for FIFA, UEFA make up 55 of their associate members. And also, it's UEFA who often give permission for players to go to FIFA tournaments during the international breaks. If that relationship does break down, it could make things very difficult for FIFA, who are, in some respects, dependent on UEFA.
I mean, how does, if you look, I don't know whether there are parallels with, what we saw with the Super League, or if you look at kind of other things that were so controversial. But, I mean, could this last? Could the controversy last for a long time? There's also a deadline, which is 30 days.
Well, if we look to parallels in other sports, we've seen with the PGA Tour in golf, that started in 2024. We're still talking about it now. So if that's anything to go by, this looks set to continue for a long time. But I don't think it will go away anytime soon, just because of how poignant it is for so many football fans and how anxious a lot of people are about where football is going, what hands it's going to be under. There are these concerns about the links with Trump. Of course, the company that is helping to raise this money, or will be helping to raise this money, is run by the brother of Trump's son-in-law. And there's concerns there as well. So there are likely many different angles that we'll continue to talk about when it comes to this deal.
Tiwa, thank you so much for the great briefing on FIFA. We're all hooked to see what happens next. Tiwa Adebayo. Now, this is a picture across the board. Now, we have a lot of earnings. Microsoft gaining as results seem to be showing strong cloud revenue. If you look at Meta, those shares actually falling pre-market after the Facebook parent raised the low end of its full-year forecast for both capital expenditures and total expenses. A couple of things we need to watch out for is, of course, what's happening with bond yields. I have to say investors definitely yesterday dumped those 30-year Treasury bonds, sending the yield up as much as 14 basis points to nearly 5.23% after the Fed kept interest rates unchanged for a seventh consecutive month. And then since S&P futures gaining 0.2%, but I do think that it's the market measuring these inflation expectations that are rising, the dollar sliding, and so the main focus today will probably be on the Fed and Treasuries again. Up next, Bloomberg Brief, and this is Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
in 2 years' time. But then again, depends on how good the market is.
Since you don't have an IPO, how do people who work for you make some money? Do you make a market for people to sell their shares internally?
Yeah, so we do secondaries every 1 or 2 years when people can sell a certain portion of their stocks to external investors.
So you've done secondary sales for your employees. So employees can then get some liquidity. Do you expect before you go public you'll do any more of those, or are you just going to wait till you go public before you liquefy any more stock?
Yeah, I think so. We might do secondaries as well before we do IPO, because we do it every 1 or 2 years, so we might do secondary as well.
All right. Well, if anybody wants to sell their shares to me, let me know. And have any investment bankers told you why they're the best to do the IPO for you?
Yeah, obviously every single one is the best.
Everyone is the best. You're not in a rush to do it. You don't need the money.
So we're a bank, and then for the bank it's super important to have trust, and then public companies are trusted more compared to private companies.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
It's 5 a.m. in New York City, 10 a.m. in London. Good morning. I'm Bonnie Quinn with your Bloomberg Brief. Let's get you set up for the day. Credibility in question. Long-end Treasury yields spiking to a 19-year high following the FOMC rate decision. Microsoft earnings overshadowing that bond rout as stock futures rise after the Nasdaq 100 entered correction territory. And the U.S. striking Iran with a new wave of attacks, keeping the prospect of a peace deal hanging. All right, let's get a check on markets around the world now. Post-FOMC, post-news conference in particular. Let's get to Winnie Su for the latest from Asia. Winnie.
Yeah, good morning, Bonnie. Well, we are seeing Asian stocks under pressure for a third day, with South Korea's Kospi index here leading declines, falling more than 1%. Now, this is coming after Samsung Electronics actually reported better than expected earnings, and also some positive comments from the earnings call that the memory crunch is here to stay. Now, still investors are concerned around the capex spending, as well as this extreme volatility that we see in the South Korean market, and hence a bit more hesitation when it comes to just buying the dip. Now, we also see the onshore market in China also still under a bit of pressure following those readout from the Politburo just earlier today. Now, this is showing overall the supportive tone for the economy, but lacking those fresh stimulus that investors were expecting. Flipboard, we take a look cross asset because you just mentioned bonds really in focus. And in Japan, we do see the 30-year bond yield tracking gains of the U.S. peers overnight. Still, the doubts around the Fed credibility, but we are also focusing on the Japanese yen under a bit of pressure, along with the 10-year bond as well, ahead of the Bank of Japan meeting tomorrow. Still, we are expecting the decision to be a hold.
Exactly, Winnie. Thank you so much. Winnie Su there in Hong Kong. A week of central bank decisions in Europe. We're preparing for a Bank of England decision. Let's get to Justina Lee for a look at markets there.
Good morning, Ronnie. Now, we've had a spate of earnings here, and generally we've had some pretty positive numbers from the likes of Schneider Electric and L'Oreal and Rolls-Royce. And altogether, we're seeing the Stocks Europe 600 up 0.4% today, with some pressure from some terrible numbers from Adidas. Now, when it comes to the bond markets, we're seeing very similar moves to the reaction in treasuries yesterday, with a drastic steepening in the yield curve. The 30-year German bond yield up 4 basis points. And on the other hand, on the short end, we're seeing this all across Europe. But I want to highlight the move in the UK especially, with the short end bond yield down 4 basis points. Now, we flipped the board here. Yesterday we saw a bit of weakening in the US dollar, and of course that's reflected in appreciation across the euro and the pound sterling. And today it's kind of weakening a bit again today, but of course when it comes to the pound, we're all watching the BOE decision coming later today, and everyone's expecting the BOE to hold again with possibly a rate hike later this year. But you know, like with the Fed yesterday, it's all about what policymakers are going to say about the inflation outlook, and also how many hawkish dissents are we going to get from the Monetary Policy Committee. And we can see from yesterday, you know, that sometimes you can have a cold, but still a pretty dramatic market reaction. So let's see if that comes out of the UK today, Bonnie.
That's for sure. Justina, thank you so much. Justina Lee there. And as Justina said, markets went into the FOMC meeting expecting no hike. Markets got no hike. Markets also got no change to the statement. And yet we had an absolutely massive reaction. And the reviews are in. It turns out markets are suddenly thinking that perhaps the Fed's credibility on inflation fighting isn't so strong after all. In fact, Michael Feroli's literally titling his note, "That's incredible." Ed Yardeni saying, the Fed just isn't listening to us, as in the bond vigilantes. So let's start with the bond board, because we had twist steepening after that FOMC press conference where everything just really went haywire. You had the 2-year yield coming down. You had an 11 basis point rise for the 30-year yield, and you have to imagine that some of Kevin Warsh's former employers won't be too pleased about that. The 30-year yield putting on another 3 basis points today, 522 and change. We're at levels that we haven't seen since 2007. We have TD Cowen saying, look for technical levels here on the 10-year yield to get broken today. This market is digesting everything that was said yesterday, and it turns out that those 3 dissenters may have been onto something. If this market suddenly is not as confident in Kevin Warsh's ability to fight inflation, then there will be a continued reaction. Now, let's look at futures, because we are in the green today. Nasdaq 100 down for 6 straight sessions and into a technical correction. But we are pointed a little bit higher. Microsoft on the positive side. Really, all of the other earnings turned out to be pretty negative in terms of market reaction, including Samsung, which again blew away revenue estimates. It's also lower in the Korean trading session today. And then let's take a look at oil, because we also have some pressure coming from oil. And of course, this is what's clouding the picture, of course, for the Fed as well as for markets. We're back above $91 today after the US responded to Iran's strikes overnight. New York crude at 85, and European gas futures, well, they are just down just a little bit. All right, let's get to some individual pre-market movers this Thursday morning now. We'll go over to London and Chloe Mele.
Good morning, Bonnie. Let's start with those big tech earnings. On the negative side, we have Meta coming out with a disappointing outlook that is sending those shares sinking. We also have Qualcomm also having an underwhelming outlook, which signals some weakness in that smartphone market. And then on the positive side, we have Microsoft coming out with very strong cloud revenue and driving those shares this morning. So a bit of a mixed picture there. Moving on to the food sector, we've got Starbucks and Chipotle up in the green this morning after some positive earnings from both and boosted guidance from Starbucks in particular. They have benefited from some new trendy items on their menu and some loyalty programs as well. And finally, let's go over to the cybersecurity sector, with Fortinet boosting its sales guidance, and that is driving the shares quite strongly this morning. We're up more than 10% for the cybersecurity firm.
Chloe Mele, thank you so much. She'll be back later in the hour. Also coming up this hour, we'll discuss the Fed's decision and also that news conference with Citi's Andrew Hollenhorst. We'll also break down tech earnings. Angelo Zeno of CFRA will join. Let's start, though, obviously, with the Fed Chair Warsh reiterating the commitment to tackle inflation.
Let me reiterate, there is no soft inflation target. There is no soft implicit target, not on this committee's watch. I don't believe that either part of our mandate is generally at war with the other part. Prices reacted in real time to incoming information, and the reduction in forward guidance may have been a factor. CapEx is preparing the ground for future growth. Nonetheless, the precise timing and magnitude of effects on the supply side remain hard to predict. The 5+ years of inflation above target cannot be cured in 9 weeks, or by a single month of modest price decreases. This Fed will not waver.
Joining us now is Bloomberg's Ben Ram. Ben, it's clear that markets were dumbfounded, even though they got technically what they were expecting, right, which was no hike. Is it fair to characterize this as an utter fail, which most market participants are today? Ed Yardeni basically saying, you know, what was Warsh thinking?
Absolutely. I think that the markets got wrong-footed Kevin Warsh for a change. I think that, the markets are kind of wondering who is the real Kevin Warsh in all this? Is he the one who talks hawkish like we just heard from him? The inflation, so there is no soft inflation target, and this committee won't tolerate an overshoot of inflation. But then when you go into the committee and actually vote on policy, he votes to hold rates. So who's the real Kevin Warsh? And that's the question that confronted the markets yesterday. And the market said, you know what, we don't know which way he's going to swing, and he's not taking action anytime soon from the looks of it. So we are going to demand a higher inflation risk premium to hold long-end treasuries, and they sent yields soaring.
What suddenly took away the market's faith, though, that he is going to fight inflation? I mean, he kept saying it. Was it the over-protesting, if you like? Or is it possible that markets may have overreacted?
No, I don't think that the markets overreacted here. The markets are sending out a very clear message. We do not care about your words. Words do not constitute action. It's what you do with the FOMC rate that matters. And you have, by the Fed's own projection, core PCE is going to be 3.3% this year, and economic growth is going to be above trend. So that calls for a more restrictive rate, not a rate of 3.625 in the mid-rate. So I think that the markets are sending out a very clear message, unlike the Fed, which is kind of talking hawkish but leaning dovish.
At the same time, though, Ben, if markets weren't expecting a hike yesterday, and they weren't, it was an outside chance that there would be one. What's to say that he won't hike next time, which would be exactly as markets anticipated before this move in the yield curve?
They may very well act the next time around, but the point is that it's the message and it's the signaling that you're giving to the market, and the markets are kind of thinking, hey, you've been talking hawkish all this while and you're not acting upon it. So it looks like as of today, the markets are not gaining conviction that the Fed is willing to act. And they're going to go by what they see so far, not what the Fed will do 6 months down the line, because by then it may be too late to stamp out inflation. We saw that happen in 2021, 2022. The Fed thought that inflation was going to be transitory, and we know that they got wrong-footed and they were found lacking in their response. And the markets fear the same thing now, and that is why you see the kind of reaction that we did yesterday.
And Goldman actually pointing out several dovish comments from Warsh, including downplaying AI-related price pressures, which we might have expected, but also connecting the rise in rates not to a market signal, but to the economic strength that we've been seeing. Is it possible, though, then, that Warsh was actually speaking to very different audiences here, that maybe he was sending out some signals to the administration, some signals to the market, some signals to his colleagues?
Yeah, I think it's entirely possible, and it's like the markets, and that's exactly the problem of the markets, right? They can't see a coherent message in all that he's sending out. Who is he trying to please? Is he trying to please Trump, or is he trying to talk hawkish and then lean dovish? So the markets are completely confused. And his communication in the press conference yesterday was all over the place. I'm sorry to say that, and that's why the markets are thinking, look, you know what? We as nominal bondholders need to have a coupon protection, and therefore we are going to tag on an inflation risk premium.
In terms of higher yields, then, who is most exposed globally? For whom is it a problem now?
Well, it's a problem for the BOJ as well as it is for the BOE. If you look at the 10-year bonds warning across the G4 economies, the ones that are suffering the most are the ones where the central banks are behind the curve. That is Japan, the Bank of England, and the Fed. And I think that we've got the BOE meeting later today. And unless the BOE sends a message that it is willing to stamp out the second round effects of inflation before it creeps up, I think the gilts will sell off too.
All right, Ben, thank you so much. It's going to be a big day in markets for reactions, and we thank you for your context. That's Bloomberg's Ben Ram. Stock futures higher, the Nasdaq 100 obviously into correction territory following the FOMC decision. We also got results from Microsoft. They reassured investors, however, of the returns on outsized AI spending. Let's bring in Bloomberg's Neil Campling for more. So Microsoft, a little bright spot. I guess it was always going to happen at some point, right? But we did get excellent results from many of the other companies that reported yesterday. What did you take away from the whole spate of reports?
Okay, so with Microsoft specifically, if we look at it, actually, it underperformed the other big tech companies this year into results. So it kind of sets you that there was quite low expectations in that respect. I think what stands out is that a number of things in Azure's growth, up 43% year on year, is kind of a validation of their CapEx spending itself on their platform. You know, they still managed to generate nearly $20 billion of free cash flow. So a very contrasting fortune to what we saw last week from Alphabet, for one example. Their operating expenses grew by 9.8%. So 10% OPEX growth is not too bad. So they are monetizing the investment. And that's, I think, where primarily investors are sort of relieved, if you like, in terms of there's some signs of fiscal discipline and some signs of good growth coming through from the market. You know, we've had here the fastest quarterly growth rate since 2022. So that's definitely a positive relative to some of the other big techs we've seen.
So that was Microsoft. Now, it turns out Kevin Warsh isn't really the only one with a credibility problem. Markets just are not buying Mark Zuckerberg's play on AI. You know, what's the problem with Meta? It absolutely dropped.
Yeah.
Disappointing quarterly revenue forecast, raised capex, and really there's nothing to show for it.
Yeah, well, in contrast to what we've just discussed with Microsoft, the OPEX at Meta grew 65% year on year. Free cash flow disappeared. There was very little free cash flow that was generated by the business. And the problem is that Zuckerberg on the call is giving us mixed messages because they haven't got the AI platform, but they're saying they're investing significantly in AI for a future potential platform. And then talking about the fact that they've got, you know, they need all the compute power they can possibly get, but they'd also consider renting some out to other players because of their high pricing that's being offered to them. The numbers don't really make a lot of sense in terms of what they're spending, what they're reporting, and then what the future direction is, because we don't really know what their AI position will be in the future. But they keep spending and the capex keeps increasing. And that, I think, is the real issue for Meta itself.
Yeah, well, on the semi-trade, right, and we're down 27% on the SOX index month to date. I want to ask you about Samsung because, once again, fantastic results. We got profit soaring 250-fold, Neil. Obviously, you know this, but in semis and memory, we had profit up 357% in terms of revenue growth this quarter. Yet the stock is down again 3%. What's the problem?
Yeah. So I think the problem is that we have, for many months now, talked about the supply-demand issues in memory, and that's clearly still the issue in terms of we just haven't got enough supply to meet demand. The problem is, though, that they, just like SK Hynix and Micron, are raising capex. So we know there is supply coming on stream, and investors are looking at things like token prices going lower, and that's a problem for the memory companies long term.
All right, Neil, thank you so much. That is Bloomberg's Neil Campling. Now to other top stories trending on the terminal this morning. Shell higher on an earnings beat. Second quarter profits soared to their highest since the start of the Ukraine war. The war in the Middle East boosted Shell's trading and refining businesses. Shell's CEO spoke to Bloomberg.
As we err towards producing more jet fuel to meet that season of demand, it does mean that you are reducing gasoline and diesel production. And what we are finding at the moment is both gasoline and diesel are at decadal lows in terms of inventories, which starts to put pressure on those price lines.
Stellantis misses second quarter profit estimates, competition from Chinese automakers, recall costs in North America, and weak pricing in Europe weighing on results. The stock is down 47% this year, making it the worst performing stock on the stock 600. Adidas shares falling the most on record. Heavy spending on World Cup marketing dented profits. Despite an earnings miss, Adidas nudged its sales outlook higher for the year. This is Bloomberg.
The global economic playbook is being rewritten and the levers of power are moving in real time.
To see where the world is headed, you have to look where the action is.
I'm Haslinda Amin in Singapore.
I'm Menika Doshi in Mumbai.
Welcome to Emerging the New Economy podcast.
Each month, we dive deep into how the world's most exciting rising economies are shaping the global future.
Join the conversation. Subscribe to Emerging on your favorite podcast platform today.
What is going to be the consequence for U.S. markets? We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything. It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more.
We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Tensions escalating in the Middle East, sending oil prices above $90 a barrel on Brent. The U.S. conducting a fresh round of attacks on Iran, keeping the prospects for a peace deal uncertain. Bloomberg's Abir Abu Omar joins us now from Dubai. So Iran got the response promised by President Trump overnight. Abir, what's been the fallout?
Good morning, Vani. Yeah, exactly what you just said. President Trump did threaten to strike Iran and give them a beating, he told Fox News yesterday. And then Iran today hitting back at Kuwait. This is the latest that we know. Just moments ago, Vani, we heard that a Chinese company in Kuwait was hit. One worker was killed there. I don't have a lot of details around that, but Iran also hitting Jordan in the early hours of the morning here in the Middle East. 5 missiles. Again, Jordan intercepting them, according to local media. And this follows a few days of calmness. If you were here in the Middle East, Vani, we did report how on Friday, last Friday, the U.S. all of a sudden stopped attacking Iran. Iran later on saying that it will suspend its own attacks, only for those to restart yesterday against countries in the region, U.S. military bases. President Trump making that threat yesterday, sticking true to it. Today, Central Command did start its latest heavy wave of attacks against Iran at 8 p.m. Eastern time, and that continued until the early hours of the morning. Now, Vani, this is all happening, a re-escalation in the region, quite dangerous. But something else that's quite dangerous is that we're now seeing new fronts opening up in this war. We're seeing movement by the proxies of Iran in the region, more so than previously. The Houthis in Yemen attacking the Red Sea, and then militia in Iraq attacking Saudi Arabia. And so a dangerous escalation and precedent in this war.
All right, Bloomberg's Abir Abu Omar in Dubai. Thank you so much for that update. Coming up, we're going to have a look at what else is making headlines in your front page news. This is Bloomberg.
My old mentor, Roger Staubach, who told me when I transitioned, football will never leave you, but you need to leave it.
Wow.
Everyone has a dream. And a lot of dreams are, you know, my dream is to play football and play professional football, and you get the dream comes true, but it is going to end. And the day it ends, the day before it ends, you're one of the best in the world. Great. The next day you wake up, that's gone. What are you great at? And the truth is nothing, right? I'm not great at anything else.
I talk about it all the time, Steve, is this whole idea of it's not from penthouse to penthouse. And what I mean by that is you played for 15, 20 years, and you're in the penthouse. That doesn't mean that you come to the business world and you're going to be in the penthouse. You don't start on the third floor or the lobby. You actually have to start in the basement.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo.
And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas.
Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine. Watch, listen, stream.
Every weekday, Bloomberg puts the spotlight on a different aspect of global finance. Flows, funds, and the forces shaping markets on ETF IQ. The future of money with Bloomberg Crypto. The players behind major transactions on Bloomberg Deals. Rates, risk, and the cost of capital on Bloomberg Real Yield. And personal finance, retirement, and wealth management on Bloomberg Money. A different topic every weekday, only on Bloomberg Television.
Time now for your front page news. And first up, the Financial Times is reporting the $20 billion hedge fund founded by former OpenAI employee Leopold Aschenbrenner is looking to raise fresh capital after suffering heavy losses during the recent AI rout. Makes a powerful reversal for the fund's situational awareness, which the FT says was up 439% on a net basis for the year as of the end of June. Next up, the Wall Street Journal is reporting on a roadblock for President Trump's nominations for Attorney General. A key committee vote to advance Todd Blanche for the AG role was postponed after two GOP senators warned they could vote against the pick unless the administration permanently kills off the $1.8 billion so-called anti-weaponization fund. And finally, the New York Times leading with Dr. Anthony Fauci invoking the fifth more than 100 times during a Senate Homeland Committee survey yesterday. The Times says Republicans, led by Senator Rand Paul, painted Dr. Fauci as a narcissist who was personally responsible for every COVID death or adverse vaccine reaction. Coming up, Andrew Hollenhorst of Citi on the Fed and Kevin Warsh's performance. This is Bloomberg.
Very famous dogs. You have the
300,000 that I could manufacture. It's a large piece, over 10 feet long, or 12 feet long, 10 feet high. But it turned out that the fabricator came back to me and said, you know, Jeff, I can't do it for 300,000. It's going to be 650,000. But eventually, then they raised the price again. And they finally brought it up to 1.6 million. And I told Eli that this is the reality of it. I showed him everything, and he ended up paying for the production cost.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
It's 5:30 a.m. in New York City, 10:30 a.m. in London. Good morning. I'm Bonnie Quinn with your Bloomberg Brief. Let's get you set up for the day. Credibility and question, long and Treasury yields spiking to 19-year highs following the Fed's rate decision and Kevin Warsh's news conference. Tech stocks looking to end 6 straight days of losses as Microsoft earnings impress. Meta's, though, not so much. And the U.S. striking Iran with a new wave of attacks, keeping the prospect for a peace deal hanging in the balance. Let's get to those markets, digesting the FOMC and that news conference that whipsawed particularly the bond market. We seem to see this reaction again in today's session. Look at that. You have the 2-year yield lower. We're at 426.24, down another basis point, and the 30-year yield higher by almost 2.5 basis points. It's this twist steepening that's happening. Now, it didn't happen on the way into the decision. It didn't happen right after the decision because the market got exactly what was it anticipating, with no hike and absolutely no change to the statement. It was after the news conference when markets became absolutely dumbfounded by what they were hearing. Cowen saying today the honeymoon period has ended with a bang for Fed Chair Warsh. Giordani saying Fed officials just won't listen to us, as in the bond vigilantes. Michael Froley at JP Morgan, his note is entitled simply, "That's incredible." We'll get to all of that in a moment with Andrew Hollenhorst of Citi. Let's look at equity index futures, though, because we might be breaking that streak for the NASDAQ 100 with futures pointed to gains there for that index, which is in technical correction. This primarily thanks to Microsoft at the moment, which might be a turnaround for the books. Most of the other stocks underperformed investor expectations, at least, if not earnings, yesterday. And then we got Samsung overnight. Again, massive increases across the board in all of the good metrics, and still that stock was lower in the Korean session. If we look at oil, we also have some pressure there. And of course, this is one of the things that's clouding the outlook. Brent crude has come back a little bit, but it's still just below $91 a barrel. New York crude almost at 85, and European gas futures, well, they're extending their decline, but still trading just below 60 euros per megawatt hour. Let's get to some individual market movers this morning now with Chloe Melley.
Good morning, Bonnie. It's a bit of a mixed picture for those big tech earnings this morning. So if we start with this flash of green in the middle of the screen with Microsoft raising, the shares rising this morning after the cloud growth came in ahead of expectations. So that was a bit of a bright spot. On the other hand, on a more negative side, we've got Meta and Qualcomm issuing some disappointing outlooks and seeing the shares down quite significantly in pre-market trading this morning. In the food sector, we have got two companies, Starbucks and Chipotle, having really benefited from their new loyalty programs and also having some very trendy new items on their menus. And so we are seeing that really drive the shares this morning after Starbucks boosted its guidance and Chipotle beat sales estimates as well. So a bit of a positive story there for that food sector. And finally, let's go over to cybersecurity with Fortinet boosting its sales guidance. And we are seeing that really drive the shares this morning, up almost 10%, with analysts mentioning that the firewall businesses were particularly strong. And so we're up quite strongly there as well for that company.
All right, Chloe, some green on the screen today. That is Chloe Melley there in London. Inflation fears gripping markets after the Fed decided to keep rates on hold.
Warsh was a little bit more dovish than people expected.
The bond market is really probably the main risk for this run on US, but also for the rest of the world.
New high since 07 on the long bond.
The market is trying to tell you that I think the direction of travel is going to be higher. It's more worried about inflation.
This is the market realizing that the first FOMC was him trying to establish credibility, trying to come across as hawkish, and now markets are just not buying it.
There is a bit of a credibility question. Market starting to question. If you look into the second half of the year, you do get seasonality on your side. You do get a methodological change to PCE measurement.
They will have to move at the next meeting.
I do think we do get rate hikes in September.
It cannot only be talk. You will eventually have to follow through.
Joining us now is Andrew Hollenhorst, Chief U.S. Economist at Citi. An incredible day, Andrew, you have to say. Now, given that you were going into this meeting not at all expecting a hike and still expecting cuts later in the year, are you going to be a little bit more lenient on Fed Chair Warsh?
You know, I think I will be, in the sense that there's a lot that we still need to learn here from the data. So I think it made a lot of sense for the Fed not to hike at this meeting. It would have been an odd meeting to hike at, given that since the June FOMC meeting, if you look at the data, and I think there hasn't been enough focus on the actual U.S. domestic data, we've had softer job growth and much cooler inflation, that inflation report for June. Now, Chair Warsh did say that inflation report was not the main issue that was driving their decision. One data point never is going to be. But as some of your previous guests noted, the seasonality is on your side. We should have softer inflation readings for the next several months. We do have a methodology change to core PCE in September that should see those numbers revised down. And this openness from Warsh, which is probably where I would agree most with his comments, maybe it's one of the things that I was most surprised that he said, is the idea that core PCE inflation is looking a little bit more like an outlier. That's really picked up. That looks like it's accelerating. That looks a lot more concerning. You look at other inflation metrics, core CPI most prominently among them, they really look like they've cooled relative to core PCE, or don't look as concerning as core PCE. So I think there were reasons for Warsh to be less hawkish here. Still, I am surprised at how dovish it was.
Yeah, even you are surprised, Andrew. And, you know, you have to ask yourself, there are two possibilities here, right? The bond market obviously was completely dumbfounded by what was transpiring throughout the news conference. And Chair Warsh himself said it himself. There's a performance element to this, right? You come out and you give it. He didn't have to give a news conference, but he gave one. So either the market overreacted, and I'm very reluctant to give the bond market or ascribe any kind of emotion to the bond market, right? Or the Fed chair was naive. Now, I also find it hard to believe that Kevin Warsh is this naive, but surely this is not the market outcome that he wanted.
I don't think that Kevin Warsh is naive. I think that we had priced a lot of hawkishness in ahead of this meeting. So it was almost going to be difficult for that hawkishness to be ratified without the Fed raising rates. And my expectation was that the Fed would stay on hold at this meeting. I think that was the base case for almost every economist. But there was a view in the market that Warsh was going to do something to surprise the markets, that either that could be a surprise rate hike at this meeting. And remember, we went into it pricing about 30% probability that the Fed would hike, or there would be some kind of signaling of a rate hike in September, which is hard to do if you're not providing forward guidance. So the fact that we got none of that, I think, was almost necessarily going to lead to a more dovish outcome at this meeting. And then the other is when you say very little, the market, people like myself and your viewers, are going to listen very, very carefully to everything that you do say. So it's not that Chair Warsh made lots and lots of dovish comments. It's that he made this dovish comment around inflation. He also talked about that the market has kind of done the work for us, that yields have moved higher in anticipation of the fact that the Fed might tighten interest rates, might tighten policy. If the market has done that work, maybe the Fed doesn't need to do that work. That's always a little bit dangerous logic, because, well, the market is doing that work because it thinks that you might be hawkish. So if you sound more dovish because of what the market has done, then you get a dovish response. So we really didn't hear that much from Chair Warsh, but the things he said were dovish. And when you don't say very much, that's what the market's going to react to.
Yeah, I mean, did he reveal himself, in fact, as a dove? I mean, as John Authers says today, the fall in the 2-year yields would suggest that indeed he did. And, in that case, we might actually be looking at cuts at some point.
I think that what we learned is we don't have this super hawkish Chair Warsh that's really going to be pushing for a hike even at this meeting. And again, ahead of the meeting, talking to investors, talking to a broad array of different people, there was at least a minority view out there that we really were going to see Chair Warsh push this committee to hike in a way that surprised the market. That'd be very different from prior Fed chairs. So just the fact that that didn't happen, that we got even a more balanced Chair Warsh, I think was dovish relative to market expectations. In terms of what his actual reaction function is, I think we still really don't know. There was a question that tried to pin him down on that, and he said, look, at the end of the day, if inflation is higher, we're going to be thinking more about tightening. If inflation is lower, we're going to be thinking more about engaging in looser monetary policy. And that's all I can tell you about the reaction function. So that is a very broad and general description of the reaction function. I think we still really don't know. But what we do know is that we don't have a Fed chair that's pushing for a near-term hike here. And that should, not only did we not get the hike in the month of July at the meeting yesterday, but I would question also, we're still pricing a lot in for September. This didn't necessarily sound like a Fed or a Fed chair that is looking to hike in September to me.
Yeah, and definitely that pricing is changing a little bit. We could be at an inflection point. It sounds like you're describing a Fed that's becoming more reactive as opposed to maybe forward-looking, Andrew. And is there a danger there? Could the economy be in trouble with this Fed if something isn't done before the end of the year? And are you still looking for cuts?
I still think that the Fed is going to end up cutting interest rates. That depends on two things. One is inflation slowing down. That we already saw in the report for June. And like I was saying, those numbers should continue to come in softer. Core CPI inflation, we think is going to be down at 2.3% year on year, 2.2% year on year in the next couple months. Those are just completely normal core CPI readings. They would raise no eyebrows. There's no reason you should have more restrictive policy. So that would be an argument, at least, to price out these hikes. In terms of pricing in cuts and the Fed actually delivering cuts, there you would have to see some concern on the labor market. Right now, there is zero concern on the labor market from Fed officials and really from markets because we've had the unemployment rate just stable at 4.2%. In my forecast, that unemployment rate is actually coming up over the remainder of the year. That's the seasonality that we've seen. That's the seasonal pattern that we've seen the last 2 years. That's had the Fed cutting the last two Septembers. So that's in our base case. So I think at the very least, the inflation data should mean pricing out these hikes and the Fed staying on hold. If we get the rise in the unemployment rate, then that's how we get to cuts.
All right, so no change in the base case, at least yet. Andrew, thank you so much for joining us this morning. Andrew Hollenhorst of Citi. Now, to other top stories trending on the terminal this morning. The US launched new strikes against Iran, hitting dozens of military targets. The US says they're in response to an attack on American forces in Jordan. The latest strikes mark an escalation in the conflict that's spreading across the Middle East. New menu items and revamped loyalty programs boosted Starbucks and Chipotle's second quarter performance. Both chains raised guidance after posting stronger than expected quarters. The results show diners are still willing to spend money at restaurants if the prices and flavors are right. Goldman Sachs is testing investor demand on a potential $5.4 billion debt offering to help finance a Blackstone-backed data center leased to Microsoft. The timing is still under discussion after a sell-off in AI-related debt raised borrowing costs and weakened investor demand. Come up, we'll take a closer look at the results from Microsoft and Meta, plus more earnings ahead. Angela Zeno is going to join us of CFRA. This is Bloomberg.
Technology is embedded in every aspect of our lives, and that revolution is playing out in real time. From finance to defense tech, AI to entertainment, from the road to the stars, Bloomberg is bringing you the stories of companies and people that are pushing tech to new frontiers and the politics reshaping global tech markets.
I'm Ed Ludlow, live in San Francisco, and this is Bloomberg Tech.
Every weekday, only on Bloomberg Television.
Historically, bubbles were characterized by a notion of if you build it, they will come. In the late 90s, when we were building out data networking equipment, people were putting huge amounts of fiber in the ground on the assumption that it would come. And economists like to go back for reasons that are unclear to me to the railroads. They were also, if you build it, they will come. What is unusual about AI right now is the builders are so far behind the demand, it's absurd. We have a backlog of more than $25 billion of demand. That there are none of us, not AMD, not NVIDIA, that can keep up with the demand that your employees are driving. That's, in a lot of ways, the opposite of a bubble. We are chasing. Our customers and their customers are moving at the speed of software, and we're moving at the speed of real estate, data centers. Right. And so we are behind.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Our investments in AI are accelerating every major part of our core business. They're improving the experience for people using our apps, driving better performance for advertisers, and helping our teams build new experiences and ship faster. Second, we are developing new personal agents that will be the foundation for our next wave of products and revenue lines in the months and years ahead.
Mark Zuckerberg defending Meta's AI spending on the company's earnings call, even as revenue forecasts disappoint. Angelo Zeno of CFRA writing, quote, "Despite the mixed Q2 results, we remain constructive given enticing valuation and new potential monetization streams from personal AI agents, business AI subscriptions, and API access to Muse models." Angelo Zeno joins us now. If that's the case, Angelo, why didn't Mark make the case better? It seems that investors just aren't buying it. The stock is down nearly 9% of the pre-market.
Yeah, so thanks for having me, Vani. And I would say, that's been the issue here with Zuckerberg, I'd say the last 2 quarters. You kind of look at Q1 earnings season, and similar to what we saw last night, is the fact that he just didn't tell the story good enough. I mean, when you kind of look at the initial reaction to the stock, it did sell off largely because of the light Q3 guidance, or fairly conservative Q3 guidance. But when you look at the top line, it is still growing at a pretty good pace, just decelerating on tougher comps. But as you kind of look here over the next couple of quarters, I think really what the market wanted to hear was a little bit more clarity in potentially that compute initiative that they've thrown out there. They've got a lot of compute capacity that they've obviously bought because of the higher CapEx spending. And in this environment, that's not necessarily a bad thing, because there's a lot of value in that compute. The problem is, again, he's not telling the story and putting numbers around what the revenue opportunity is around that. And in fact, when you kind of look at the messaging, it was very cloudy in nature. I think this is one of those things where you have to wait a couple of more quarters and give Meta the benefit of the doubt. But in an environment where there's just a lot of uncertainty out there, I think at this point investors are just looking elsewhere.
Yeah, I mean, on compute, it's clear Meta is receiving offers at a premium, but there's just not enough detail around it. Is it because Meta just doesn't know yet? Yeah. And like the rest of us, is sort of waiting to see what happens in this AI environment?
Yeah, I think they just don't know yet. I think they see 2 great opportunities. One being, hey, listen, we can instantly generate revenue similar to what the cloud players are doing right now. And that is, hey, listen, we're buying the compute capacity, and we'll sell it off to those that need it, like an Anthropic. But more importantly, for the longer term health of this company, if you can find ways to build intelligence on top of that compute capacity, there's more sustained higher higher margin, higher value type of revenue around it. And I think that's really what Zuckerberg would ideally like to use and maximize that compute capacity for. Again, though, from an investor perspective, it's going to take time to realize those benefits from a revenue perspective over the long term. And I think that's right now, what the street is struggling with, and why you've kind of seen the mixed messaging from Zuckerberg.
Let's move to Microsoft, which got rewarded for once, right, Angelo? Copilot growth, also, much better growth in Azure. Is this counteracting the narrative that perhaps, there won't be as much uptake from businesses and from individuals on AI? Is this sort of telling the world, look, it can be monetized?
Yeah, I think so. I mean, I think this was as good a quarter as you probably could have gotten out of Microsoft, right? I mean, you got the Azure numbers, great print, 43%, an acceleration into the second half of the year, 45% for the September quarter. Everybody wants to see that acceleration in cloud. You've seen it out of Alphabet. You're now seeing it from Microsoft, and you're probably going to see it tonight from Amazon in our view. And that does kind of tell you, hey, listen, enterprises are spending. They need a lot more compute capacity out there. If that capacity is being made available by Microsoft and others, then the enterprise space is going to spend on that capacity. And then when you kind of look at their productivity tools out there, specifically Copilot, among other offerings out there, there was some great numbers tied to that. And again, something that the street wanted to see. And again, it shows that the enterprise is willing to spend for these greater AI capabilities. So when we kind of think about Microsoft here, and I think the balance that Microsoft is striking here between the CapEx spend, making sure they're free cash flow positive, is something that investors like at this point in time. They're almost kind of the grown-ups in the room relative to some of the others out there.
Are these customers pretty sticky, Angelo? And does Microsoft have pricing power? Is there any chance that, a China offering could come and take some of the territory away?
I mean, they have some they've got significant pricing power. They're actually hiking prices in terms of their, enterprise offerings. So they're benefiting from a tailwind on that side of things. In terms of some of the models that they're rolling out here, we haven't seen much on that side of things. Obviously, they just launched 7 models. That's something where we expect them to kind of penetrate more and leverage more of their internal, products to those models. And I think that you'll get the benefits on cost from that perspective as well. But as far as kind of, the competitive pressures out there from China is concerned, I think that's something that, the entire ecosystem is going to have to deal with. And over time, from at least from a large language model perspective, that is a good thing, I'd say. But Microsoft, I think, is, they're more of a company at this point in time. They're going to continue to benefit from the volume-based side of things on Azure, while they'll continue to do what they do on the enterprise offerings. And given that they are kind of this enterprise king, more penetrated than just about anybody on the enterprise side, they clearly have a competitive advantage from their existing massive installed base.
All right, Angelo, thank you so much. 2 very different reactions to earnings last night, Angelo Zeno of CFRA. Coming up, we're going to get you set up for your trading day as markets digest the FOMC decision. This is Bloomberg.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
Good morning. Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
It's Bloomberg Money.
This is the Asia Trade.
This is Wall Street Week.
Welcome to Balance of Power.
You're watching Bloomberg Deals. Welcome to Bloomberg This Weekend.
This is Bloomberg Television.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Tyler Kendall in Geneva, Switzerland, and this is Bloomberg.
Today, the Bank of England makes its next interest rate decision, and investors will look to BOE Governor Andrew Bailey for signals on the rate path ahead.
Inflation is higher than we expected. Of course, now what we've got to do is get it back to 2%.
Join the opening trade team for live market reaction and analysis and on-the-ground coverage at the Bank of England. It all starts today at 12:30 p.m., only on Bloomberg.
This is Bloomberg Brief. I'm Bonnie Quinn in New York. Now a look at what's ahead today. Well, we have more earnings, $8 trillion worth of market cap, in fact. MasterCard, Hershey coming before the bell, and then two huge ones, Apple and Amazon, after the close. Plus, the Bank of England announces its rate decision. That's coming up at 7 a.m. Eastern Time. And then in terms of U.S. economic data, we get GDP, jobless claims, U.S. PCE. Those are all out at 8:30 a.m. Eastern. Let's take a look at some movers, because, of course, yesterday was the second biggest earnings day of the season, right? And Microsoft definitely outperformed, 8.5% higher. It even brought down its capex spending due to an accounting error, but it really pleased investors. Growth in Copilot and in other areas of the company like Azure. Now, Meta Platforms, not so much. Investors getting skeptical again about Mark Zuckerberg's comments. Apparently, these companies are going in different directions, but also moving higher. Fortinet. So obviously it boosted its revenue forecast and really satisfied in terms of earnings. Security companies doing well. Let's take a look at the macro environment, though. Now that investors have had a few hours to digest that news conference, we see that pricing hasn't changed, right? The bond market is still in the same reaction as we saw yesterday. So if you look at that 30-year yield, we're up another 3.5 basis points now, continuing to creep higher. Twist steepening for that curve after Kevin Warsh's credentials on inflation fighting may have been called into question just a little bit by some of the dovish comments that he made. We're keeping our eye on NASDAQ futures, which are reacting to some of the better earnings. The dollar also plummeted as that news conference was ongoing, gave back some of those declines, though. We have to watch international investors at the moment. Well, that's it for Bloomberg Brief. Surveillance is next.
Do you mind being called an ideological lunatic or a bunch of left-wing nut jobs?
You know, I've been called worse things than that.
You'd think she owned the place.
23andMe, I think, is so incredibly valuable. We're coming back.
It had that kind of detective story feel to it. You know, when you're hot on the trail of something, you know that it's very exciting.
What magazines were you reading as a kid?
I don't think I was reading magazines until I was in them.
You are on the cover of all of these.
Oh, and there's many, many more, but we just don't have time.
Why should people trust you?
I don't think anybody should trust any company or entity completely with any of this.
It's very uncomfortable. Artificial intelligence is this force that is far bigger than we are.
I want to build better businesses around these brands.
The shock will never wear off.
So you're a brother and sister running one of the most powerful companies in the world. When you argue, who wins?
No one. The way I could see AI being banned or blocked is if something really went wrong. And if something really went wrong, then maybe it deserves to be.
So is it paradise ahead or Gattaca?
Maybe somewhere in the middle.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Joanna Bersecci in El Ola, Saudi Arabia, and this is Bloomberg.
Today, our committee decided to vote by a 9-3 vote to maintain the target range for the federal funds rate.
Those dissents were not done in a vacuum. Many people on the board are leaning towards a rate hike.
I'm particularly glad with the fact that they've listed the 3 dissenters.
Having dissents is not unusual. That being said, there's very little to hang your hat on in the market.
If the data ends up coming in line with his side, this may all work out, but if not, this could end pretty poorly.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Thursday, questioning credibility. An evasive Fed chair testing the bond market's patience. Meta's Mark Zuckerberg struggling to defend massive spending. And the US and Iran failing to stop the conflict from spreading. Oil holding on to the 90s.
It seems like all the pillars that have been holding up this market are getting kicked out from under it. On one hand, you've got higher long-term rates following that Fed meeting. You have worries about CapEx spending and cash flow not keeping pace, actually turning negative for Alphabet and really going down to the lowest level since 2022 for Meta. And then you have oil fueling additional inflation fears, and you put this together, and it's a toxic brew for the morning.
Well, let's talk about a statement from this Federal Reserve. It was in the statement again at the very bottom, the last line. The committee will deliver price stability. This market is beginning to question the willingness to follow through.
This market is calling the Fed's bluff and saying, ultimately, if you're not willing to hike rates, you're not willing to give us a sense of why you're not hiking rates right now, and if you're going to talk around the issue and not give us a clear answer about absolutely anything, we're not going to believe that you actually are going to take action. You're trying to jawbone us, and you think that we're too stupid to fall for it. Guess what? We're going to call your bluff. The bond vigilantes are back out, and that's the reason why the yield curve steepened the most going back to April, before a Fed meeting going back to 2022 when they hiked by 50 basis points.
And he's in a really difficult position. Not only do we have, the first time in 10 years, 3 dissenters, and he has to come out and defend what their decision was, which I'm still confused about actually the communication about why they didn't hike, what his reaction was there to that. But on top of that, just moments after you have this decision, you have this press conference, the president once again says, well, it's not Kevin's fault. It's not his fault. He's fantastic. It's the board. It's political. He's going to be sandwiched now in between both these rival forces.
It's not the first time we've seen a central banker make a communication error. This was a mess of a news conference. We've seen something similar from Lagarde at the ECB in her early years. We saw something from Powell years ago in his first term. We're seeing the same thing again from Kevin Walsh. I think what is difficult about this moment is the backdrop. The backdrop for this communication mess is unforgiving. The amount of supply you're seeing in the Treasury market, the amount of supply that's coming from mega cap tech, the amount of supply you're seeing internationally, Germany, and elsewhere too. Brammer, that makes this moment very, very unforgiving, and they'll have to get a handle on it because the price of capital is going up and things are moving in the wrong direction.
Bond investors have leverage. And when bond investors have leverage, well, you want to be them because guess what? They will exact a pound of flesh, and that is what they're doing this morning. If you're not going to give them a sense that you truly are committed to price stability and keeping inflation expectations anchored, well, guess what? They are going to penalize you. And that is the reason why not only did you see people flee from the U.S. long-term bonds, but also the U.S. dollar, saying we're not sure that this central bank has what it takes to really get through what they're promising right now.
No one needs our opinion today, this morning. Just park all that. Just focus on the market reaction to Brammer's point. The front end rallied, the long end sold off, inflation expectations firmed up and the dollar weakened. That tells you everything you need to know about a rejection of this Federal Reserve, a rejection of them claiming they'll fight inflation.
And to Anne-Marie's point, the fact that President Trump came out and said Kevin Warsh is wonderful, he's doing a great job, it's the rest of the committee, didn't do anyone any favors. What it did was it undermined further any kind of credibility that this Fed could have taken hold of had they hiked or had they had a more hawkish proclamation. The more that people see Kevin Warsh and Donald Trump moving in tandem, the more they are going to see this Federal Reserve as fundamentally compromised.
Yeah, the optics of the last 24 hours really not great for this bond market. Equity futures doing better. We're bouncing back by a third of 1% on the S&P. Coming up this hour, we'll catch up with Barbara Reinhardt of Voya Investment Management as the bond market pushes back. Norman Rule of CSIS as the US launches a heavy wave of strikes against Iran. And Greg Moskowitz of Mizuho as Microsoft cloud growth impresses investors. That stock getting it done in the pre-market. We begin this hour with the bond market questioning Fed Chair Kevin Warsh's inflation-fighting credibility, sending 30-year bond yields to the highest level since 2007. Barbara Reinhardt of Voya Investment Management joins us now for more. Barbara, good morning.
Good morning.
What was your reaction to that yesterday afternoon?
Look, he's falling into the same trap that so many Fed Chair people fall into when they take the role. And it's a communication blunder. It's sending the wrong signals to the market. And this is what we were worried about with a new Fed chairperson coming in, is that equity markets are going to get nervous. You saw the same thing with Jerome Powell. There was an 18% correction within the S&P 500 when he said we're a long way from neutral, a very offhanded remark. And I think you do have a credibility issue at this point. So the Fed's going to need to either get inflation under control or the bond market's going to do it for it. And we do see on some of our forward-looking indicators that inflation should be rolling over. Income growth is starting to slow. Consumer spending is starting to slow. But the fact is it may not be fast enough to stop probably more equity market weakness as a result of bond yields climbing.
Lots of reaction coming from Wall Street. One of my favourite takes came from Aditya Bave of Bank of America, duffed and confused. And he said the following: we think the need to re-establish credibility increases the probability of a hike in September. Do you agree?
Well, I think the inflation data is going to come in a lot softer. So all of our forward inflation indicators are rolling over at this point. So the market may indeed do some of the Fed's work for it, which is what Warsh was confusing the markets about yesterday. I think this lack of forward guidance is coming at a particularly bad time. And I think that this kind of pulling back and relying on some of these task forces, while it's a great idea in theory, the execution of it seems a little bit murky at this point, which I think is also confusing the bond market.
Given some of the confusion and concerns around a lack of credibility that the Fed's going to follow through in anchoring inflation expectations, do you think that that puts the tech trade more at risk, considering that it's a higher duration asset increasingly as a result of its CapEx plans?
Well, I think you've got two things going on. So, number one, the tech trade is really as a result of the hyperscalers burning through their cash flow, not slowing down on their CapEx spending. Eventually, the memory shortage is going to get resolved with more memory. So there's this concern that you got this big cash flow burn with the tech stocks. You're not seeing the big productivity lifts from AI just yet, although we all use it in our day-to-day lives and are finding it to be incredibly helpful. I think that you've got this concern that they're burning through so much cash flow, and additionally, this equity supply that's hitting the market is really big, and the buybacks and the mergers are just beginning to offset it. This is the first time since 2000 in this year that you're going to see net equity issuance and net equity demand kind of coming out of it. So buybacks and also mergers really being even. So it's a lot to hit the tech trade at this point.
About a year ago, I was speaking with Howard Marks, and he said if he were going to get into the tech trade, even though he's typically a credit investor, he'd rather be in the equity than the credit because he's getting paid for the equity in terms of the potential upside.
Sure.
I wonder if that equation has flipped right now, whether potentially you're getting paid to be in the bond side of things and not necessarily on the equity side as a result of the dynamic, as a result of how high yields have gotten.
Well, I think there is some truth to that. However, you have to think about it this way. Credit spreads have just started to weaken really over the past 10 days. You're about 10 basis points wider on IG credit. But I think you have to do a lot of homework as a credit investor in these hyperscalers, off-balance sheet, data center-backed bonds that are being issued. You really need to find out whose balance sheet is being, decked against these interest payments. And that's going to be a really tricky one, even for the most astute of credit investors to look into.
So do you think something people want to stay away from for the remainder of the year?
Well, when we take a look at the internals of the market, look, the S&P 500 just slipped below its 50-day moving average. There's, quite a ways to go until it hits its 200-day. But the American Association of Individual Investors, it's 30% bulls, it's 42% bears. That could mean that you have a little bit of a counter trend rally. But there's also one thing that we're not talking about that's bugging the market, which is the midterm elections. Markets do not like uncertainty. Generally, those summers before the midterm elections can be very ugly. You don't necessarily need to get all the way to election day, but you probably need to get to maybe mid-October for oil prices to come down, for the inflation data to roll over, to really probably put in a more sustainable bottom.
It's not also just the midterm election. It's also the conflict in the Middle East. The market thought the president was going to take a diplomatic route, and right now we actually see more strikes, and it's spreading. Egypt's getting hit. You see attacks in the Black Sea and the Caspian. Is the market starting to pay more attention to this than they were, say, 2-3 weeks ago?
You'd have to, because of the price of oil, right? The price of oil is going to hit consumers' pockets through the transition mechanism of gasoline prices and other distillate products, jet fuel, all those types of things. You're even starting to see, I think, probably some fatigue, on behalf of many of the president's supporters, right, saying, we've had a lot of this, we've had enough of it at this point, and you need to start to focus back on domestic policies as well, because domestic policies will come knocking at the door sooner than you think.
Let's not do the midterms yet. It's still July. I just
See, when people start talking about midterms,
I'm not there.
I think, I'll take the rest of the year off. I'm going to midterms. I'll start talking about, October 1st.
Yes, actually, Labor Day is
That's
when the
what I
market
said
starts to really pay
yesterday. I
attention
said
to it.
I'd give you till September 7th.
End of September. All right.
Well, Monday is August, so you're certainly getting there. But look, you have the underlying strength of earnings. While, look, the market certainly
She's
feels...
trying to comfort us.
No. I'm just trying to give you some facts that you need to think about.
I'll take the therapy. Carry on, please.
Yes, that's right. I've turned from portfolio manager to therapist. So, look, you do have the underlying strength of the equity market. You've got the underlying strength of earnings. Sales growth is really off the charts at this point. And the beats are being rewarded, which is signs of a healthy market. But look, we haven't had a 10% correction in quite some time. Even the market downdraft that you had in late February into early March, that one wasn't a 10% correction. So it's not surprising to see some weakness, a lot of questions about the hyperscalers at this point. Those things need to get resolved, and the Fed is not helping.
Barbara, appreciate it.
Thank you for having me.
Thanks for being here. Thank you. Barbara Reinhardt there at Voya Investment Management. This market this morning is punishing indecisiveness. You see that the Federal Reserve punishing indecisiveness by selling the 30-year bond. Meta punishing the indecisiveness of Mark Zuckerberg on the call. And it is indecisive. It's confusing. What direction are they going in? Are they going to be a neo-cloud player? Are they going to use that capacity for themselves? We still don't really know. That stock is down by 9%. Indecisiveness is getting absolutely hammered in this market. This market right now is unforgiving.
There's too much money at stake right now for there to be such indecisiveness. You need clarity of vision, and if you don't have clarity of vision, people are going to say, ultimately, we don't believe you can succeed.
Futures this morning bouncing back up by 0.4 on the S&P with an update on news worldwide with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Good morning, John. President Donald Trump praising Fed Chair Kevin Warsh, calling him, quote, brilliant after the central bank held rate steady for a fifth straight meeting. Trump saying, I know he'd love to see lower rates, but he's got a political board and they want to keep them up. Microsoft shares rising in the pre-market. The company reporting fourth quarter results that beat analyst expectations. Its Azure cloud unit growing 43% at the fastest rate in 4 years, and revenue topping $100 billion for the first time. On the flip side, Meta shares falling in the pre-market. The Facebook and Instagram owner giving a disappointing quarterly revenue forecast. The company reporting its lowest free cash flow in years, a sign of ballooning expenses for AI. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. Thanks for the update. Up next on the programme, striking Iran once again.
We're going to be hitting them very hard. because it's our turn to hit them. They know it's coming. They're asking us not to do it, so it's our turn. And we'll see if we get there with an agreement.
Up next, we'll catch up with the former senior U.S. intelligence official Norman Rule. Live from New York City this morning. Good morning.
When news breaks,
a redhead across the Bloomberg terminal.
Bloomberg has you covered.
Trump's global tariffs are struck down by the U.S. Supreme Court.
For all the context and clarity you need.
There's going to be now tons of tariff headlines until midterm elections.
Hear it first on Bloomberg.
The trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
Let's talk about the significant risk transfers to find space in their balance sheet.
Hedging some of that risk.
You could look at it the other way. Obviously, this stuff is risk-weighted.
I would much rather be long than be short.
We're in a kind of sweet spot.
Very, very strong alignment.
3 revolutions in one.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Every trading day, only on Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Two tech stories in the pre-market. Microsoft gets it done. Stock is higher by 9%. Meta does not. Stock is down by 9%. Two very different themes in the pre-market for big tech. Later on, we'll hear from Apple, we'll hear from Amazon. In the market right now, equity futures with a bounce on the S&P 500, up just a little by 0.4% on the S&P 500. On the Nasdaq, entering correction territory, down 11% from the record high back in June. Up this morning by 0.75%, down for the last 5 or 6 days on the Nasdaq. Make it day 6 in yesterday's session. That's the longest run we've seen since October 2022.
There are a couple of issues here. On one hand, you've got the volatility coming from South Korea, questions about competition, questions about capex, challenges to that. And then you have this duration trade, the idea that a lot of the debt that some of these hyperscalers have been issuing has been disproportionately on the long end of the yield curve. All of a sudden, when you have 30-year yields at the highest levels going back to 2007, and you have people worried about inflation expectations, that's taking a chunk out of bondholders' pockets right now who invested in the capex story of these hyperscalers, and is going to crimp the ambitions to do more.
This market, this bond market, we bought 2s, we sold 30s, and sold 30s really, really hard. 2s out to 30s this morning look like this. The move continues. Yields down at the front end to about 426. Up at the long end to 523. When the Fed chair tells you continuously they'll do something about inflation, then doesn't, this market is going to push back. When the Fed chair tells you that inflation matters and then doesn't act, this market is going to push back. What was interesting yesterday about the dissents is that initially the dissents revealed a preference to hike. And then after the news conference, the dissents just revealed the resistance elsewhere to not do anything at all, led by the Fed chair himself, Kevin Walsh.
There was no understandable explanation as to why not move now, what they were waiting for, what kind of reaction function there is. A reaction function is distinct from the idea of telling you what you're going to do. I'm just going to say that. That seems to be the market's view. Ed Yardeni,
sure.
The grandfather or the father of bond vigilante, the expression, said, in effect, they are saying that if the Fed won't be vigilant about inflation, then they will maintain law and order in the economy, they being the bond market.
Look, It felt like a communication exercise for the last month. We know what that communication exercise was about. We'll talk cautiously, we'll get the market to tighten financial conditions, but we won't actually hike. The thing is, when you actually say the quiet part out loud, which is basically what Fed Chair Kevin Walsh did yesterday in the news conference, the market starts to think, hang on a minute, I'm not playing that game. Like, I'll play along with you a little bit, but I'm not going that far. Goodbye.
Nobody wants to be condescended to. And when somebody says to you, you know what, you're going to do this, and then we're going to all get to the great goal that we're all trying to get to, and just trust me, I'm not going to give you more information, but it's all going to be okay. The seventh grader in us starts to throw spitballs.
I know. Didn't it feel like that yesterday?
That's how it felt.
It felt like being spoken to like you were still a seventh grader.
But that's my point. Right? I think that there was a bit of a tantrum because people were saying, hold on a second, I'm throwing the football.
We're asking some big questions.
Yeah, it's like we've been asking them every day.
Is the balance sheet accommodative?
Exactly. Yeah.
Okay. Like,
what's the source of inflation?
You know?
Like, well, what is it?
Right.
A little bit.
Yeah, okay. Crude this morning looks like this, 91 on Brent. WTI around $84 a barrel this morning. Under surveillance this morning, striking Iran once again.
We're going to be hitting them very hard because it's our turn to hit them. They know it's coming. They're asking us not to do it, but, you know, they tried shooting. So we had 5 rockets shot going 8,500 miles an hour, and all 5 rockets were knocked down to the ground. But they nevertheless took a shot, so it's our turn. And we'll see if we get there with an agreement.
So here's the latest this morning. The US renewing attacks on Iran as the conflict in the Middle East spreads. Vessels in Egypt believed to be the subject of an attack for the first time. Bloomberg's Tyler Kendall joins us now from Washington. Hey, Tyler.
Hey, John, good morning. Well, we are seeing further disruptions beyond the Strait of Hormuz as 2 LNG tankers were hit off the coast of Egypt, which, as you mentioned, does mark the first time that we've seen such an attack in Egyptian waters since the conflict began. Now, no one has claimed responsibility for the attacks, though we do know that Saudi Arabia has been rerouting vessels to use Egypt's Mediterranean coast amid an ongoing threat from the Houthis when it comes to disrupting commercial traffic in the Red Sea. Now, at this point, we've gotten very little public indication that Iran is willing to let up its leverage when it comes to commercial shipping, though I will point out that within the last hour, we heard from Pakistan's foreign ministry, of course, a key mediator in this conflict, say that negotiations between the U.S. and Iran are, quote, ongoing, and that there is this big focus on reopening the Strait of Hormuz. New data out this morning does show that there has been at least a slight uptick in traffic, even amid this flare-up in fighting. Research from Kepler finding that 14 vessels transited through yesterday, up from the single digits that we saw last week. Though we have to say President Trump has really kept that escalation and the threat of further escalation on the table, with this latest attack just coming hours after he vowed to retaliate for Iran's surprise attack against U.S. forces earlier this week. Now, John, we did hear from a senior administration official who outlined that yesterday's overnight wave of attacks was larger in scope than previously believed, though it doesn't mark a resumption of full major combat operations.
Tyler Kendall with the latest in Washington. Tyler, thank you. More from Tyler in the next hour. Here's the take from the former senior U.S. intelligence official Norman Raw. He writes the following: diplomacy is not dead, but there is little evidence that it will succeed soon. Norman joins us now for more. Norman, sir, welcome back to the programme. What are the necessary conditions required to offer a sustainable diplomatic solution? What do we need to see happen here?
Good morning. We need to see Iran drop its maximalist demands. At present, Iran is demanding effective control of the Strait of Hormuz, which would give it a stranglehold on the economies of the Gulf countries, an ability to access or interrupt their fiber optic lines, and an ability to impose pain on the entire global economy. Until that changes, you're not going to see a substantial shift in the regional dynamic.
Norm, at the start of the conflict, the administration, as well as the Israeli military, was going after top brass of the Iranians. Right now, it continues to be from CENTCOM, military command centers, missiles and drone facilities, coastal surveillance and defensive sites. Do you think they're going to continue targeting these types of assets, or can we see it spread once again?
In the near term, the U.S. strategy appears to be consistent. Washington is dealing with this in a vertical approach. It's expanding attacks in Iran against targets that would degrade Iran's capability to strike the U.S. and shipping. Remember, just as we may have munitions restraints, so do the Iranians. At the same time, the goal of the U.S. is to shape the debate within Tehran to bring them to a diplomatic table. Going against energy, infrastructure might actually harden that debate. Now, the Iranian response is to work horizontally and to widen the geography as much as possible to bring international pain against the United States to cease these attacks.
Is there any evidence that that debate is actually happening in Tehran?
There is evidence of a debate, but there's no evidence that debate is moving in the direction that we might wish. Indeed, there are hardline actors who would contend that Iran needs to take an even tougher position against the international community and against the U.S. Because remember, if Iran controls the Strait of Hormuz, this is a vast amount of routine and regular money that would be largely difficult for the United States to constrain via sanctions. If, again, the system is approved, that it gives Iran fees. So Iran is going to aim for that target.
Norm, how much have the bases, the U.S. bases in the region, have been how much have they been compromised over the past couple of months of fighting?
Well, the U.S. has not maintained a large presence in the region per se, other than for training, air defense, and other activities related to that. Over the recent years, the United States has actually withdrawn a number of its elements to the United States. We manage wars from the United States and from the aircraft carriers in the region. Now, that's not to say these aren't important. There are partners there. We do have a military presence there. But for the large part, the war is conducted from the United States.
Norm, how much is the fact that Saudi Arabia has now entered this conflict open the door for other Arab partners?
Well, we're watching the gradual fading of red lines of Gulf countries to be involved directly in this conflict. Now, again, the conflict is spreading into a multi-theater war. And in addition to Gulf actors, we've had the Ukrainian strike on an Iranian ship in the Caspian. So what is happening is the red lines for other actors to strike back against Iran to demonstrate they're not going to be punching bags for Iranian weapons. That is gradually fading. And that trend will likely continue, although the Saudis and others will push for de-escalation and to try to keep the region calm.
Norm, it's always good to hear from you. Thank you, sir. The former senior U.S. intelligence official, Norman Rule, there on the backdrop in the Middle East right now. The conflict is spreading clearly. It's involving more countries. It's involving more military assets across the region. And it's not just the Middle East that's of concern. More so, really reasserting itself in the last, I would say, 2 months, is the situation in Russia. And crude product is something you'll hear more about a little bit later in the program.
Right. The Russians, first off, have an export ban because of this. You see the Ukrainians hitting vessels in the Black Sea, in the Caspian Sea. It is now a multi-front war, not just the Strait of Hormuz. We have to care about what's going on, as well as the Bab el-Mandeb Strait and the Red Sea. On top of that, reports overnight about Egypt and potentially this drone that hit vessels in Egypt. This is starting to metastasize. At the same time, reports yesterday, China is sending military hardware to Iran. This is becoming multi-country, multinational, and spreading geographically.
Paul Sankey of Sankey Research joining us in the next hour on crude and oil product. Up next on the program, let's talk tech. Greg Moskowitz of Mizuho on Microsoft's massive cloud growth. That stock is up by 9% in the pre-market.
Western countries, all of them are cutting funding to Africa. And some of these programs were supported by funding coming from Western countries, like for human resources, for testing, for transportation of samples. And suddenly, African countries have to think how to fund money and to cover this gap. But it takes some time. And I think the combination of all of these factors are fueling this mistrust that we see at community level. We value the support we got and we are still getting from the US. And we think that if we continue to work together, and there is no reason for the US not to work with Africa CDC, Africa CDC is the leader in terms of public health in Africa.
The global economic playbook is being rewritten and the levers of power are moving in real time.
To see where the world is headed, you have to look where the action is.
I'm Haslinda Amin in Singapore.
I'm Menika Doshi in Mumbai.
Welcome to Emerging the New Economy podcast.
Each month, we dive deep into how the world's most exciting rising economies are shaping the global future.
Join the conversation. Subscribe to Emerging on your favorite podcast platform today.
Equity futures bouncing back on the S&P, up by 0.5, on the Nasdaq up by 1%. 6-day slide on the Nasdaq 100, the longest since October 2022 for the semis, down for 5 consecutive days. That's the longest run so far this year. This is the bounce helped out by Microsoft. We'll talk about that name in just a moment. Microsoft getting it done. Meta did not. In the bond market, check this out. 2s, 10s and 30s. 2s got bought, 30s got sold. 2s this morning down again, yields lower to 426. 30s up 2 basis points to 522. That was one of the biggest Fed day steepenings we've seen, going all the way back to the 90s. Look at the curve. 2s out to 30s. This is how much steeper things are right now. That's on intraday. You take that chart back, let's say a couple of days or the last year or so, you'll see a major spike higher in just the last 24 hours, speaking to the questioning of the credibility of this institution.
Yeah, it was more than 8 basis points yesterday of steepening. It was the most going back to April of 2025. On a Fed day, it was the most going back to March of 2022 when they did that 50 basis point rate hike. And before that, it was taper tantrum day in 2013. So, yes, it is one of the biggest steepenings. And this one was led by the long end, of feeling that maybe this Fed was not as committed to anchoring Fed inflation expectations.
And Kevin Warsh coming out and telling the market to play the ball, not the referee. I love what Robert Armstrong of the FT had to say about that. He said it doesn't make any sense. The Federal Reserve is not the referee. You set interest rate policy. You are a player. What do you expect the market to do? And I think that's where it felt like he was almost talking down to financial market participants.
I almost feel sorry for Warsh this morning because he's going to take a beating from everyone from all different kind of directions. But you're just absolutely right. Neil Dutta said the same thing yesterday. To claim that the move between meetings was about the data and the market coming up with its own ideas about what was happening, when it was clearly responding to several speeches from hawkish Fed officials going into the quiet period. I don't know if he is misleading us, attempting to mislead us. I hope he's not, but come on. If you follow this market, you knew that didn't really stack up.
You're not a passive player here, to your point. You're an active one, and there's clearly a role that all the Fed officials who came out in the interim and talked about the potential to raise rates had a clear influence on why the market was pricing in a greater degree of rate hikes and a greater degree of hawkishness. So that didn't really ring true. A lot of it didn't really seem to make sense to markets, and so the only conclusion they could come to was this might have been either political or a belief that they could just jawbone the market into submission.
That's the new metric right now. It's the 30-year in the 520s. That is going to be put alongside every single Fed chair Kevin Warsh speech for the rest of this year. And it's going to be used to measure his inflation-fighting credentials for the rest of this year. That's it now. Everyone's going to talk about this.
There are two metrics. I think that it's that one and the idea of the 30-year and just what it does. And then it's the dollar. And if you do have the yield move going up, as Torsten Slok was saying, with the dollar weakening, that tells you all you need to know about credibility.
Which I've got to say is unfortunate for the Fed chair because there's so much else going on that's leading to high yields at the long end of the curve. But that's where we're at. That's the conversation. 520 something on 30s this morning. Counting it down to the open about 3 hours away. Let's get to your morning movers. Yahira has more. Hey, Yahira.
Hi, John. The contrast between Microsoft and Meta results is clear looking at this board as investors reward the company that is showing clearer returns on AI spending, and that is clearly Microsoft. As it said that its cloud revenue, its cloud unit rose at its fastest pace in 4 years, and its CFO indicated that Microsoft would hold the line when it comes to any new capital spending. But at Meta, Mark Zuckerberg showed a more muddied picture, and that was a problem there. A lot of analysts wanted to hear more about this cloud computing opportunity, but they did not get that. Instead, Meta delivering slower, softer revenue growth and a dramatic decline in free cash flow. Turning to the chip sector and getting a gauge on the smartphone market as well, with Qualcomm, shares are falling 5.4% after it delivered a disappointing forecast due to problems we've heard about repeatedly, component shortages and higher costs, which have been weighing on the entire smartphone market. But of course, it's a problem when that is your biggest business by far. And we end on a check on the consumer with Starbucks and Chipotle both delivering a beat and a raise. Shares are up more than 6%. The results suggesting the consumer is not pulling back across the board. They are willing to spend if you give them something that they want. Both companies, Starbucks and Chipotle, said that new menu items is what got customers through the door. John?
Yahira, thank you. Appreciate it. I looked at those two names in the pre-market earlier on this morning, thought the same thing. You look at the rest of the economy right now, away from tech. Look at the consumer stories. They've held up pretty well through the week.
To me, this is actually the story. The idea that tech has had a lot of drama spurred by how much shares have gone up. But when you look at the other companies, and just to be clear, so far about half of the S&P 500 has reported earnings with earnings growth of something like 28%. I mean, it's been absolutely astronomical in terms of the gains. You start looking at this and you start saying maybe there's a reason for the optimism that people feel.
Tech scare, not a growth scare. We've said that repeatedly, at least not yet. On our radar this morning, the US striking dozens of Iranian targets, responding to attacks on American forces in Jordan. The conflict spreading across the region after unclaimed attacks on vessels at an Egyptian port. Elsewhere, a tale of two hyperscalers. Microsoft shares rising after posting its fastest quarterly growth in 4 years, with cloud revenue rising more than 40%. Meta shares plunging following a disappointing forecast and reporting its lowest free cash flow in years. And finally, the Fed chair, Kevin Walsh, calling on markets to do the work.
Participants are learning to play the ball, not the referee. Markets can be a very good source of information. So they're gauging themselves how restrictive the Treasury curve should be. Even while at some level we haven't done much in 42 days, the markets have done quite a bit. They are working in concert to keep us on our toes.
Markets have done even more in the last 24 hours, pushing 30-year yields to 19-year highs. And I just wonder how much of a good source of information that might be for the Fed chair waking up to this.
I was thinking the same thing, that essentially Fed Chair Kevin Walsh went to the market and said, show us what you got. And the market said, well, here you go. The highest 30-year yield going back to 2007, massive yield curve steepening. How do you like them yields? And this is the question. How does he respond? Does that, to Torsten Slok's point yesterday, sort of ensure that there's going to be a rate hike that much more in September to offset some of the tightening that we've seen?
Bank of America questioning the same thing. It's going to come down to the data between now and then. They're going to need some soft prints to bail them out of that communication problem in the last 24 hours.
If you don't get it, you're only going to get ongoing steepening, which you're seeing today, and you're going to get a weaker dollar. And until you get some Fed rhetoric that can give more explanations that are somewhat understandable, this market is just going to keep on going in the direction it is.
At least he's kind of Jackson Hole. You saw that commitment to a news conference at every meeting, a Jackson Hole speech too.
Yeah,
right.
I mean, but you know,
blank page at the moment. But
I'm not sure how many people were happy with the commitment to every news conference, every meeting for the rest of this year after that performance. But
especially because he said that he'd have something to say, and then one person said, "What was it that you just said?" And he said, "You know, what was it that you just accomplished?" And he's like, "Well, you know."
He had easy reasons, though. We had good CPI. He could say there's a geopolitical conflict that's pushing up oil that we need to see how it's going to be resolved. He had reasons to really lean on, and just decided not to.
You know, the most important line from this Fed meeting was made before this Fed meeting even took place, and it came from Chris Waller, the Fed governor, in that speech, when he said, sternly staring at inflation until it melts before our withering gaze is not an option. I actually thought it was the most powerful line we've had in Fed speak for the last several months. And that was the line we were all thinking of in the news conference as Kevin Walsh was saying nothing. and indicating they wouldn't do anything anytime soon. That's what we were all thinking of. The words of Governor Chris Waller.
Yeah, I loved Neil Dutta's comment, which is evidently staring at inflation with a withering gaze is an option, because essentially that's what just happened.
The 30-year in the 520s. Let's turn back to the tech story, a better story from Microsoft, the tech heavyweight delivering a better-than-expected report with cloud compute revenue topping $100 billion. Greg Moskowitz of Mizuho maintaining his outperform rating and raising his price target to 510. Greg joins us now for more. Greg, welcome, sir. It's good to get some time with you. I'm sure it's a busy morning following a busy afternoon for you and the team. The stock is up in the pre-market, up quite nicely. What did Microsoft manage to do yesterday that Alphabet struggled to do a week before?
Well, thanks so much for having me. It's always good to be here. It really comes down to Azure. Everything begins with Azure when it comes to Microsoft, and they had guided to 39 to 40% year-over-year revenue growth. The investors were looking for 40 to 41. I would say 41% at the most. They delivered 43. This is the most significant upside that we have seen in quite a few quarters from Microsoft. And then what's also very important to note is that as it relates to Q1 guidance for the September quarter, the street was at 40 to 41%. They guided to 45% constant currency growth, just a massive beat. And I will also say that there's been an impression among many investors for at least a few months now that Microsoft has sort of lost its mojo when it comes to Azure. They've seen the massive acceleration at Google Cloud. They've seen AWS accelerate. They've seen some other developments, competitively speaking. And I think Microsoft resoundingly showed last night that they remain very strongly positioned in Azure, and certainly they projected a lot of confidence as well. And so that effectively, to me, is why we're seeing this move today.
How much of the move is also attributed to the fact that CapEx spend and the plans for the upcoming year were lower than people had expected? Only $175 billion versus the expectation of $190 billion.
Right. So it's a good question, Lisa. The only clarification I would have there is it's not quite apples to apples. They've made an accounting change in that they've taken their data centers and their office buildings, which used to be amortized over a 15-year period, that's now being amortized over 25 years. And so they had previously guided to $190 billion of CapEx for calendar 2026. They said that amount of spend is unchanged, but based on the accounting change, it actually goes down to $175 billion. So effectively about a 10% difference in terms of reported CapEx in year one as a result of this change, but overall, no alteration, so to speak, in the trajectory for 2026 CapEx.
How much is the tell of this earnings season free cash flow? Alphabet really punished after their first free cash flow negative quarter as far back as the data goes. And then you had Meta also with free cash flow coming in at the lowest level going back to 2022, while Microsoft actually had a pretty decent free cash flow number that came in. Is that the true tell right now in terms of market performance?
Yeah, I will say, broadly speaking, there is absolutely increased attention on the ROI of all of these investments. This, very large increase in CapEx that we've seen across a number of key players in this space. And so, yes, there's increased scrutiny on the free cash flow that will be generated. Now, I will say Microsoft did not provide explicit guidance for fiscal 26 CapEx. So we know the first couple of quarters, roughly speaking. We don't know the back half of the year. Microsoft did say, though, that free cash flow will still grow in fiscal 27, no matter what. So that provides a little bit of a guardrail, if you will. But again, still some uncertainty. And I think it's reflective of the fact that there's just extremely strong demand for AI workloads at this time. I think everybody knows that. And these companies are all racing to fulfill or service as much of this demand as they can. But naturally, there's a great amount of scrutiny, understandably so, on the returns from these investments.
I know you're really focused on Azure. Where are Microsoft now in the race in terms of maybe catching up to AWS?
So certainly AWS remains the largest in terms of cloud compute oriented revenue. Microsoft does continue to grow faster, and we're really impressed with kind of what we saw this quarter. And one other thing that I will note as well, which doesn't always get as much attention as perhaps it should, But this, 4 points of acceleration that they just showed in the June period, 43% growth versus 39% in March, is also coming versus a compare that is 4 points tougher. And so it's really unusual for a business this size to show that kind of acceleration against a comp that is so much more difficult. So again, really underscoring some very good momentum for Azure right now.
Greg, appreciate your time. I know it's a busy one. Greg Moskowitz there of Mizuho on Microsoft. Much better numbers from them. Microsoft, a real standout performer for the Mag 7. We will hear from Apple and Amazon after the close. Let's get you an update on news worldwide with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John. Thank you. Poland's Prime Minister Donald Tusk saying an object that crashed near its border with Ukraine was a Russian missile. Tusk says the incident took place at around 3:40 a.m. local time during an intense Russian attack targeting Ukraine. Wildfires in Europe now forcing evacuations of the island of Crete. Cooler weather is helping firefighters gain control of blazes in parts of Spain and France. In eastern England, a large wildfire has broken out near a nuclear power plant as hot, dry conditions grip the UK. And Shell reporting second quarter earnings that beat analyst estimates. The British oil company saying its profit more than doubled from a year ago as it benefits from the increase in oil and gas prices. And that is your Bloomberg Brief, John.
Hey, Vonnie, thank you. Appreciate it. Up next on the programme, the bond market showing up to play.
It was a real family fight. That's the better way to get policy right. That's our North Star. Market participants are learning to play the ball, not the referee.
Up next, Francis Donald of RBC.
Just wanted to say, Primer is back. We've been scouring the frontiers of science and technology to help explain the difference between the next gold rush and whatever this thing is. And in season 2, we're upping the stakes. More danger.
Now that is some high-grade uranium mineralization.
We used to have a stable climate on this Earth. Right now, we do not.
More science.
We're pushing the envelope of technology in multiple directions. Software, hardware, chemistry, physics.
The cable is like very cold.
And more CEOs that can nail the photo shoot.
Hundreds and hundreds of billions of dollars are at stake.
While the problems are economic, the solutions are too.
And yes, we will be talking about AI.
There is a lot of humanoid hype out there.
But our future doesn't run on hype. It runs on innovation. Watch season 2 on all these lovely channels.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more.
We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Here's the bounce in stocks this morning, up by 0.5 on the S&P, on the Nasdaq following a 6-day slide. The Nasdaq 100 higher by 1%. In the bond market, want to do something slightly different. Let's talk about the yield curve. 2s are rallying, yields are down a basis point. 30s are selling off, yields are up 2 to 522. That was the story yesterday. The moves were much larger than that. And the front page of every financial newspaper this morning, every Wall Street note you can think of, is all about the same thing. The question to follow through. Are they willing to follow through at the Federal Reserve and do something about above target inflation? And we're questioning the credibility of this institution. I get it. I understand why those questions are there. We're all asking them. There's an additional question I think we should spend a little bit more time on. The preferred tool to address the inflation if they do follow through. There was just a hint of that from the Fed chair yesterday in this quote. If inflation continues to be elevated through the forecast period, interest rates could well be part of that solution. And then he gave a little bit of a nod to the balance sheet. Now, if you believe that's a revealed preference, then the bond market's doing exactly what it should do. Yields down at the front end, up at the long end. And I wonder how much more we'll be discussing that over the summer.
If this is another tool, that means they could potentially reduce their balance sheet further, not buy as many of the long-term treasuries, and thus it would make sense to see yields creep higher on the long end.
Let's do something different. Let's talk about the bond market and what's happening here instead of just, I could do this all morning.
I know, I think it's great.
Right, but we'll do something different.
Talk about BS, the balance sheet.
Right, that kind of BS. You really are hurt by yesterday, aren't you?
Wow, Lisa's face
it was just, you could feel it.
Wow,
you could feel it.
Something else.
Well, let's just move on.
Bramo was just not happy. Don't talk down to Lisa.
Nope.
Just don't talk down to Bramo.
Maybe I just wasn't understanding.
Maybe, yeah, maybe. Under surveillance this morning, the bond market showing up to play.
It was a real family fight. That's the better way to get policy right. That's our North Star. If inflation continues to be elevated through the forecast period, interest rates could well be part of that solution. Market participants are learning to play the ball, not the referee.
So here's the latest this morning. The bond market questioning Fed Chair Kevin Warsh's commitment to the fight against inflation, pushing 30-year bond yields to the highest level since 2007. Francis Dollar of RBC writing, Warsh is going to have to spend the next few meetings addressing why he remains so committed to addressing inflation by keeping monetary policy on hold. Francis joins us now for more. Francis, good morning.
Good morning.
Did you react the same way Lisa did to that news conference yesterday?
I had many reactions, but so too did the market. And it occurred to me as I was watching the 10-year, the 30-year move that we were all effectively going through the 7 stages of grief. There was shock at the communication style. There was some denial from the press corps. What do you mean we're not going to get forward guidance? Some real anger at the long end of the curve. Where we're not just yet is that reconstructing how we're going to think about the Fed and full-on acceptance that we are not going to get a Powell or Yellen or Bernanke-style Fed with the Warsh Fed. And the one line that I clued into is a line that everyone has been quoting, but maybe focus on the wrong word. There was the line from Warsh, the markets are learning how to play the ball, not the referee, which I love as an economist because the ball is the economic data. But I clued into the word learning. He's indicating he understands, and we should all understand, this is a transitional moment. We may not have a full picture of what this new framework is, and so there will be some volatility as we adjust to it. Is it a permanent volatility, or is it a adjustment phase?
You think this is part of the process?
Well, it's part of a process of moving from one style to another style. And now the next iteration of that is, can we really wean ourselves off and focus on the econ data ahead? So we've got a lot of econ data just today that could be very informative about the path of inflation ahead. As opposed to looking backwards at where the data has been, we're going to have to start getting much better, much stronger, much more reactive to the future path and all of the data that goes into it.
At the same time, the rise yesterday in the 30-year yield wasn't driven by inflation expectations. That was driven by real yields. And you could see the real yield at the highest level going back to 2008. It was driven by a dollar that normally strengthens when you get higher yields. In fact, it weakened. This did seem to go to a sense that this Fed was less determined to keep inflation under control. Do you think that's the wrong takeaway about what it means to have this new communication style, this new Federal Reserve?
Well, what occurred to me over the time is, while we're very concerned about inflation and lots of reasons why, there's breadth, there's a lot of longer-term inflationary pressures in play, there is a reason to stay on hold when you have a core PCE that will print at 3.3%. And it is that, well, a lot of the drivers of inflation are supply side and not particularly rate sensitive. So there was an argument to be made here, and could have been made, update. We are on hold because we are assessing whether rate policy reactions is the right tool to address this inflation, which is hurting consumers. That would have been a pretty easy off-ramp that wasn't used this time. Maybe we'll see it in future communications.
So if you're past the 7 stages of grief, do you think that this market is mispricing some of what we heard yesterday? Do you think that the anger at the 30-year is misplaced and that you'd be buying that?
I'm feeling some relief and validation from the markets that we're now cluing in a little bit more to some of the upside risks here. We've had some complacency when it comes to inflation. Now, Fed Chair Warsh, of course, talked about 5 years of inflation above. It's 5 years, 4 months of inflation above 2%. But there is 39% of the CPI basket is running above 3% right now, including just about everything that Americans buy regularly. Food, electricity, rent, God, coffee prices are a real issue, child care. All of these things that Americans buy are really problematically high, and consumers are feeling that pressure, particularly at the lower end. So acknowledgement that this is a problem in markets and by the central bank is what frustrated me last year under the Powell Fed that we're now starting to see a reconciliation of.
What do you make for the rest of the year then? September, certainly live?
All meetings are live, and that's the intention, of course, of where we're moving forward. But if we're correct and inflation is going to stay sticky, the odds of rate hikes are going to need to climb. And if we don't get rate hikes, well, then we'll get other forms of market responses to that. The question is, does this actually rectify what's happening underlying inflation? Because, you know, the conflict in the Middle East, which is broadening, we've seen headlines just this morning, AI development somewhat rate sensitive, but not fully. That super high income consumer that's holding up this consumer ship, they may actually get wealthier off of higher interest rates coming through, and tariffs are back in play. This doesn't seem to be headline news at all, but we have new Section 301 tariffs that should have been the end of tariff pressure in Q2 that are coming back online. So are these higher rates in the market going to actually impact the inflation ahead? This is another form of reconciliation we have to address.
Just to pick up on one thing you said, high yields might lead to more spending at the upper end of the K.
Well, we're just thinking differently about the consumer than we might have in the past.
I'm open to that.
When you have, you know, there's a huge Venn diagram overlap between our high income, very wealthy consumer and the demographic attached to it. So if they actually are more, they have more concentration in high yield or any yielding investments, then you could actually see a wealth impact from that as well. Of course, it's offset by other elements, but this is not the same consumer that we had 10 years ago, and their reaction function to stock market volatility or bond market volatility, it looks different. At the end of the day, though, you want a house, you're not feeling great today about that rise in the 30-year. You hold debt, you're not feeling great about some of those market rises there. So we just have to think in a way that's more fragmented with the consumer than just one profile for all.
Therapy Thursday. Appreciate it. Thank you. Needed it after yesterday, to be honest with you. Francis Donald of RBC. I can think of one person that needed it more than I did. You know, and they might be sitting around this table.
Okay,
right
you
now.
know, I'm going to take a deep breath, and I'm going to be an open mind that, you know, maybe we're all just looking at it wrong.
We're going to see a different Bramo in the next hour.
I think so. I've been slapped down.
I've got my doubts.
I now
Who
have
slapped
therapy.
you down? No one slapped you down.
I feel humbled. Maybe I just don't
by who?
understand correctly. I don't, just it.
Bramo. Do you? Everyone loves that.
Yeah.
All right. Up next, Max Kandler of HSBC, Paul Sankey of Sankey Research, Nick Jones of BNP, plus the St. Louis Fed president, the former Jim Bullard. That's next. This is Bloomberg.
Every weekday, Bloomberg puts a spotlight on a different aspect of global finance. Flows, funds, and the forces shaping markets on ETF IQ. The future of money with Bloomberg Crypto. The players behind major transactions on Bloomberg Deals. Rates, risk, and the cost of capital on Bloomberg Real Yield. And personal finance, retirement, and wealth management on Bloomberg Money. A different topic every weekday, only on Bloomberg Television.
World's most powerful investors don't ring a bell. They quietly reshape entire industries. This is the money shaping the world. The Dealmaker playbook, where power and billions of dollars change hands every day. From private equity and credit to venture capital and M&A, we bring you the inside scoop on the biggest deals and debates, plus exclusive conversations with finance's ultimate insiders. Great scoop on this. You've been reporting about an activist investor coming up and trying to shake things up. What's the latest?
We've been hearing that there was going to be an activist at some point. The question was who?
There is a convergence of technology and national security.
The United States is a big country. We're playing in the Northeast. That's an economy as big as the United Kingdom.
This is a really interesting space to watch. We're expecting more consolidation.
As this is Bloomberg Deals at Bloomberg Invest, I want to talk about the broader deal and M&A environment.
This is a moment in time. We'll see how long we're here. It's far too early to call.
There is an underinvestment in what's going on in private markets because everyone's looking for additional AI cloud capacity, and it's very tough to build.
Everybody wants to get things going, and the IPO market is just one symptom of that. It is an early indicator of what we're going to see in the M&A market.
Let's go to Scarlett Fu, who's taking a closer look at drone companies. With ongoing conflicts in the Middle East and Ukraine, there's renewed investor appetite for new names in the space.
Excellent reporting. I'm Danny Berger, and this is Bloomberg Deals. Every week, only on Bloomberg Television.
Technology is embedded in every aspect of our lives, and that revolution is playing out in real time. From finance to defense tech, AI to entertainment, from the road to the stars, Bloomberg is bringing you the stories of companies and people that are pushing tech to new frontiers and the politics reshaping global tech markets. I'm Ed Ludlow, live in San Francisco, and this is Bloomberg Tech. Every weekday, only on Bloomberg Television.
What is going to be the consequence for U.S. markets?
We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. markets close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Still in an environment where tech is contributing the lion's share of earnings.
The markets can't go up without tech going up.
The bar is just being set too high.
We're going to remain in a choppy market for tech stocks.
It's just time to take a deep breath and own the best names in the sectors.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the second hour of Bloomberg Surveillance starts right now, and your scores, the price action looks like this. Futures positive by 0.5 on the S&P, bouncing back on the Nasdaq following a 6-day slide up 1 full percentage point. In the bond market, 2s, 10s and 30s questioning the credibility of this Federal Reserve. Yields down at the front end by another basis point, up at the long end by another 3, 5.23 on 30s.
Yeah, this is a move that's getting a lot of people's attention. Highest 30-year yield going back to 2007, highest real yields going back to 2008. And how much is this really pushing back against the Fed, saying the Fed's watching the market saying, well, you've got an inflation problem and you need to get policy under control. Look, I'm breathing. I'm touching grass.
Take a deep breath,
I'm taking a walk. Because ultimately, this story has yet to be written, and we'll have to wait to see what the Fed comes out.
It's a process. We're working through it, all right?
Maybe it's 7 stages of grief.
Where are we? Not at acceptance yet. Are we getting closer?
It's a long week.
OK. Got some symmetry for you. Yesterday at the Federal Reserve, a hold and 3 dissents. This morning at the Bank of England, a hold, and I see 3 dissents. Let's get to that. With more, Lizzie Burden is outside the Bank of England, and she can break it down. Hey, Lizzie.
Well, John, much like the Federal Reserve last night, it's a hawkish hold from the Bank of England, a 6-3 split. That's more hawkish than was expected. Catherine Mann joining Chief Economist Hugh Pill and external member Megan Green in dissenting for a quarter-point hike. Mann that this hike was needed for credibility, but she couldn't persuade the rest of the committee. For now, the data gives them cover. Excuse the police car just going past. The data gives them cover to stand pat. We did, of course, have inflation coming in below the BOE's expectations in June at 2.6%. And the reason that they want to wait for clarity is not just the geopolitical uncertainty, but also the fiscal uncertainty around Andy Burnham. Do we think that maybe he'll go for some more borrowing when it comes to the autumn budget down the track? But, of course, the exposure to international energy markets, the big factor here. Just interesting in terms of the guidance, it's unchanged, but they say there isn't evidence evidence of second-round effects yet, but they're split in terms of what the likelihood of second-round effects would be down the track. And they're saying as well that they have various scenarios of what inflation could look like in the future. In the mild scenario, it peaks at 3% in Q4 2026. In the adverse scenario, it peaks at 4.5% in the second quarter of 2027. So a range again, as we have seen in previous times, rather than a central forecast with variance around it. So it's interesting given that as well, we've had so many swings in the oil price. These projections are perhaps a bit mouldy on arrival, John, but just looking at the market reaction, the pound is up 0.2%, which is pretty much where we found it before the decision. So now we're looking ahead to the press conference with Andrew Bailey later on today. European viewers, by the way, can be watching it on Bloomberg TV with the opening trade team's analysis. And I'll be there as well. We'll have it on the terminal, Bloomberg.com and YouTube for other regions as well.
Lizzie, get in the office. Get away from the sounds of the City of London. Lizzie Burden there with the latest. Unchanged, 3 dissents. Very similar to what we saw yesterday at the Federal Reserve. I would say the difference is probably going to be Governor Bailey versus Chair Walsh. I think the outcome of that news conference might be slightly different.
It also is different because the expectations were lower. People weren't expecting that degree of dissents, although in the U.S. they weren't expecting 3 dissents either. I will say that's where you see it in the pound. The fact that the pound held steady, strengthened a little bit after the decision was released, and that gives you a sense of how the international markets are viewing this.
Let's get to the view on Wall Street this morning. All talk, no action. Fed Chair Kevin Walsh's indecisiveness leaving the bond market questioning the Fed's credibility. Max Kettner of HSBC writing the Fed narrative has moved from a bias to ease to a willingness to hike. The decision not to hike has therefore prompted some modest recalibration of rate expectations. Max joins us now for more. Max, welcome and good morning. How modest are those moves in that yield curve?
Yeah, I think yesterday, I'll try to perhaps to do a little bit of a better job in answering questions in the next 10 minutes than what we've had yesterday, although I don't think the bar is particularly high. Look, I think when you look at the yield curve move yesterday, that's been basically the bond market voting with their feet. But I think one of the things that we also need to bear in mind that particularly in the last couple of days, positioning particularly from fast money really was moving towards, OK, they might be actually doing a hike. And if not a hike, then he's going to sound very, very hawkish, really to hammer down that message around credibility that he's managed to manifest really during his first press conference in the June meeting, right? And now we've got the complete opposite. If you look at the yield curve move, you just look at 2s, 5s, 10s, 30s, you look at that, the reaction after the June meeting, you look at that after yesterday, it's the exact opposite move. So I was a bit puzzled yesterday. Why, what's the incentive of doing that? What's the incentive of dodging every sort of question around the Fed's hawkishness? To me, that is, slightly up for grabs, that question.
Max, yesterday everything got sold. Equities got sold. The long end of the bond market got sold. The dollar got sold. The Fed's credibility got sold. Max, what's more instructive for risk? Is it the move at the front end of the curve or the longer end of the curve?
No, I think it's more the longer end. So if the longer end really starts to be properly unhinged, both 10s and 30s, I think that will be an issue for equities and for credit, for EM assets, really for everything from FX to credit to equities. Because the issue is, I've talked about this here in this program for months already, is that we've been ignoring what we call that danger zone, right? That danger zone, the level of yield on the long end that normally triggers really a risk-off reaction across all the asset classes, whether it's risk-on or risk-off assets, right? So it also includes things like gold, for example. That's what we've seen yesterday. We have been able to ignore that so far because the earnings picture has been so strong. And that yet again is the case now with the Q2 reporting season. Once again, we have these broad-based earnings surprises. But of course, if the bond market, and particularly the long end, starts being unhinged and the volatility there is too high, that drags probably volatility in rates across the curve higher, and that puts a dent on valuations, not only on PEs, but really across the asset class spectrum.
Before we got earnings, Max, you were on the edge of getting a little more bearish. Not getting bearish, but just not getting as bullish. Then you reversed that after we got a number of these earnings. They came out so well, and the responses, at least from Microsoft, have been positive. Does anything change with your call based on the reaction that we've seen in the long end of the yield curve?
No, so I would give two answers to that. Number one, from an asset class and from an asset allocation perspective, no, not at all. If you look at things like equities over treasuries, so you look at the relative performance between those two, you would not think that in the last 2 months there's been such mayhem in parts of the equity market. So the equity market overall is doing fine, right? If you guys were to look at charts like the equal weighted S&P or look at equal weighted global indices, look at things like the topics, look at things like European stock markets, right? The stock 600. There's nothing to see. We're pretty much at or very close to the all-time highs. It's literally just tech and just semis where we've seen that weakness. And that brings me to the second answer. Now, going forward, the question is that tech weakness, that semi weakness, is that going to drag us down? Is that going to drag beta down across the risk asset spectrum? Or are we done and are we going to rotate back into tech? Are we done with that broadening trend that we've been on for the best part really of the last 4 weeks? Is that done in the next couple of weeks? Or is that going to now manifest itself into broader risk off in August? I think that's the question now.
Max, the broadening out trade that people were talking about earlier this year included not just the United States and the non-tech names, but the rest of the world. And I just wonder how much you're doubling down on the rest of the world aspect, especially given the greater degree of volatility around U.S. policy.
Yeah, absolutely. So we are still overweight and quite a lot overweight in Japan and particularly in Europe. So when we were closing at the start of July, our overweight in emerging market equities, simply because we were obviously not foreseeing how big that drawdown would be in Asian memory names. But we were uncomfortable with that pretty high volatility and with those wild swings already at the end of June and the first week of July, hence why we've taken off emerging market equities in particular and put that into Europe and into Japan. Now, if you look at things like Europe, in fact, European equities, they're pretty much the same line as the equal weighted S&P. So I don't think, Lisa, right, I don't think it's rotating out of the US. It's more about, are we going to buy the equal weight? Are we going to buy the rest of the S&P? Or are we going to rotate back into tech and semis? For me, we're not quite there yet. We're not quite at the level where I want to say the broadening is done. I don't want to buy the other half of the S&P, the non-tech and AI S&P, that stuff that we bought in the last 4 weeks. I want to go back into tech and semis. I think the technicals are not just quite there yet, but I think that is just a matter really of weeks. It's not something we're like, well, at some point in the next couple of months, given how strong that drawdown has been, particularly also in the global momentum names, I think that is a matter of weeks, if not days, until we can really switch there around. The one thing that I would say is it's definitely not, in our view, something where global risk and global risk assets, equities, credit, high beta effects is going to drag down by that momentum sell-off. We've seen such a big sell-off already. You know, that means going forward, you're going to have to create a big catastrophe scenario. You're going to have to see an even bigger drawdown now going forward for that to spill over into a broader risk-off.
So, Max, bullish kinda. Is that a decent summary of where you're at right now?
Yeah, absolutely. I think I would say max bullish, but it depends what you buy, right? It's not just like, well, I'm just going to buy tech and I'll sleep. No, we were buying the wings of the world, right, up until a month ago. We were buying Asia and we're buying the US, and particularly the tech names. For us now, it's still really max bullish, but it's the broad-based one. It's the second earnings season in a row where not only in the US, but also globally, people have once again been going on about how high the bar to beat is for earnings, and they've been once again underestimating how strong and how broad-based the earnings impulse and the earnings recovery really is.
Max, good to see you, buddy. As always, Max Kentner there of HSBC on this Federal Reserve, on this earnings story. And Lisa, you said it at the start of the week. I was saying repeatedly the week begins on Wednesday. We have these massive events coming up, and you were talking about the earnings elsewhere, and you were absolutely right. The earnings elsewhere have been pretty tremendous.
Yeah, I'm long a triple frapped, half decaf, half calf, 2%
with a Coca-Cola,
Frappuccino with a Coke. I mean, that's essentially where
Fired
we're
up.
at. Well, no, it's just the idea of Starbucks, the fact that they just need to figure out how to get enough food to cater to people who want to pay a lot of money for all this food. I mean, it just gives you a sense of how strong the economy is.
How much caffeine did you need yesterday? Or something stiffer after the news conference,
yeah,
right?
You need a lot of caffeine for that.
I need to just get used to a style. You know, I don't know what he was trying to accomplish. I actually, if I could ask one question this morning and get a candid answer, I would say, are you happy with the reaction in markets? Because if he was, and I guess we'll get the answer to
Is it by design?
Is this by design, or is this, you know, a communication error that you can
We should just start having whatever TK's having in the news conference.
I think I might have to.
Right? Just get through it. So much easier. Let's get you an update on news worldwide this morning with your Bloomberg Brief. Let's get to Vonnie Quinn. Hey, Vonnie.
Hey, John. Thank you. The Bank of England mirroring the Fed, announcing it's holding rates steady with 3 dissenters calling for a hike. The committee saying they stand ready to act to stop high inflation from lingering. Moonshot AI securing a $35 billion valuation. Sources telling us here at Bloomberg that's far more than the Beijing-based startup was aiming for. The company now seeking funding at a valuation of $50 billion. It's aiming for an IPO in Hong Kong as early as this year. And a blowout quarter for Samsung, South Korea's largest company, posting a 250-fold surge in chip profits, driven by demand for high bandwidth memory and storage. Samsung echoing comments from SK Hynix, saying it doesn't expect a let-up in the speed of AI development and data center construction. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. Thank you very much. Up next on the programme, Iran, back under fire.
We're going to be hitting them very hard because it's our turn to hit them. They know it's coming. They're asking us not to do it. So it's our turn. And we'll see if we get there with an agreement.
Well, Sankey Research up next, live from New York City this morning. Good morning.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo. And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington. Let's start overseas.
Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine. Watch, listen, stream. Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance. After the close, coming up a little bit later, we'll get earnings from the likes of Apple and Amazon. Looking forward to that. Equity futures on the S&P 500, positive by 0.5 on the S&P, on the Nasdaq, up by 1.2 on the Russell, up by 0.4 in the bond market. Some pushback against this Fed chair. 30-year yields are higher by 2 basis points, 522. You know, I keep saying that, and I keep wondering afterwards, is it pushback? Is this ultimately what he wants? To your point, Bramo, is it by design?
You know, I would argue not really, because you don't want to see the dollar fall and yields go up. That is a toxic brew for any central banker, especially given the fact that it isn't necessarily coming from inflation expectations going up. So this raises a question fundamentally about Fed credibility and whether this market is going to inject an ounce of pain into this Fed's discussion.
The Fed's credibility got repriced in the last 24 hours. It got sold. In the commodity market, Brent and WTI shaping up as follows. Brent holding on to the 90s at $90.30. Under surveillance this morning. Iran back under fire.
We're going to be hitting them very hard because it's our turn to hit them. They know it's coming. They're asking us not to do it, but you know, they tried shooting. So we had 5 rocket shots going 8,500 miles an hour, and all 5 rockets were knocked down to the ground. but they nevertheless took a shot. So it's our turn. And we'll see if we get there with an agreement.
So here's the latest this morning. The US retaliating against Iran, failing to stop the conflict from spreading as Tehran strikes American and Arab targets across the Middle East. Bloomberg's Tyler Kendall has the latest. Hey, Tyler.
Hey, John, good morning. Well, Iran's retaliation to the U.S.'s retaliation is hitting across the region, and disruptions to commercial shipping are extending beyond the Strait of Hormuz. Overnight, 2 LNG tankers were hit off the coast of Egypt, and while no one has claimed responsibility for that attack, there has been this heightened focus on Egypt's Mediterranean coast, as Saudi Arabia has been rerouting ships there in a bid to avoid the threat posed by the Houthis in the Red Sea. At this point, there's been very little public indication that Iran is willing to let up its leverage when it comes to commercial shipping. And we saw this new data show, though, that there is this slight uptick when it comes to traffic in the Strait of Hormuz. Research from Kepler saying that 14 ships transited through in both directions yesterday, up from single digits last week. But importantly, almost all of these vessels are using that Iranian-approved corridor. Now, importantly, we did have the U.S. Energy Secretary Christopher Wright on Balance of Power last night, who told us that on average we are seeing 13 million barrels per day leave the Persian Gulf over this past week. He says that's about 2/3 of the pre-war flows. But importantly, John, the Energy Secretary went on to say that half of those supplies are moving through the Strait of Hormuz and the other half are going through bypass pipelines.
Tyler Kendall with the latest down in Washington. Tyler, thank you. So the broadening conflict across the Middle East pushing crude and refined product prices higher. The Shell CEO delivering a new warning on cost and supply.
As we err towards producing more jet fuel to meet that season of demand, it does mean that you are reducing gasoline and diesel production. And what we are finding at the moment is both gasoline and diesel are at decadal lows in terms of inventories, which starts to put pressure on those price lines.
Well, Sankey Research writing, we have been super bullish on refining and think there is a major crisis here. We argue people are looking at the wrong oil price. Crude is not the issue. Gasoline, distillate and jet are. Paul joins us now for more. Paul, good morning. How small, how thin is the cushion? How bad are things?
Well, it's just that the refiners here, for example, refiners are running at 96% utilisation.
How unusual is that, to run at 96%?
That's where we want them, and it's not unusual. I mean, for example, in Mexico, that would be 50%, you know, but it's an amazing performance, and it does raise the risk around refining, because obviously when they're running that hard, hurricane season coming up, El Nino, we went through a couple of heat waves, and that causes issues. So I'm worried that there may be more problems. But the big idea is that basically wholesale gasoline is $140 a barrel. Brent is at 90, and that margin is absolutely massive in terms of profitability. As I say, it's a margin, not a price, the $70 refining margin. And that's telling you that the tightness is in the refining system. So there's plenty, more or less plenty of crude, a lot of it driven by China's behavior and by the SPR, which is another big turning point, by the way, because when we run out of SPR, which should happen around September, that'll massively change the dynamics of the WTI market here in the US, and it'll be very bullish.
When it comes to the products, which is most vulnerable right now?
Well, jet fuel sort of sits above distillate as the hardest to make, and the industry's done an amazing job of raising their yield and really addressing the jet fuel crisis. And the reason they do that, it's the highest margin product. So jet fuel has actually not been the problem that we anticipated, basically because we didn't realize the refining industry could generate so much more jet fuel than as they've been able to. The tightness at the moment, which is interesting, is the area that's normally not that tight, which is in gasoline, and that's where we're watching the inventories go way below the bottom of the range. And that's basically because they're pushing so much into jet and diesel that you're actually sucking down the biggest inventory, which is gasoline. And then, of course, as I said, you're drawing down the SPR very rapidly as well.
But on the SPR, Energy Secretary Chris Wright says it's a, quote, long way from operational minimum. You think there's an issue coming in September?
Well, that's depending on the rate that weekly it's being pulled down. But the refiners now find it a great deal because they're basically taking physical barrels. They're not paying for them, and they owe physical barrels in the future. And as you know, pay back more barrels, but in the future, which is a much lower, something of a lower price. So the refiners want the crude. There's a big debate that hasn't really been addressed by the DOE of where the bottom of the SPR lies. They put out a note about Cushing, which is a different thing. Cushing is metal tanks above ground. The SPR is a salt cavern that you hollow out by dissolving the salt. Every time you take it down and then push it back up, you push water underneath and you dissolve more of the cavern. So there's actually a technical question. Is the cavern getting bigger? How low can it go? Is all basically not being addressed. other than, Chris Wright's, frankly, has a very high reputation in the oil industry. But as an energy secretary, he's said some things that haven't turned out to be entirely true, particularly regarding the Straits of Hormuz. So I'm not sure that, what he says about the SPR is really definitive, frankly. We just don't know when we're going to have to stop downloading it, basically.
So the SPR is like a bag of popcorn where half of it's air and you open it up and you don't realize until you finally get in there?
Oh, okay, yeah. I mean, it's going to get really convoluted here.
No, okay, hold on a second.
No, it's a salt cavern with oil in
it. In all seriousness, I am wondering how much credence you put to the barrels that are still going through the Strait of Hormuz and potentially through pipelines, actually making it through, which has been a huge offset to some of the drawdowns that people were expecting.
Yeah, I mean, my latest research, which I haven't published yet, actually, but it's on the UAE, because the UAE is actually exporting more oil now than it was before the crisis started, and that's been one of the most stunning dramas here. And I'd add that, the front lines in this conflict are shifting. If you just look overnight, what you've seen here is US and Saudi basically fighting Iraq versus Saudi. UAE seems to be at peace now. They've made some kind of peace with the Iranians. There's no issues in Abu Dhabi at the moment. And of course, Israel, Lebanon is quiet. And then the other big front, which is going crazy, is Russia, Ukraine. That one is absolutely out of control. So the conflict has shifted quite dramatically, as any war would. And, I think the biggest one is that actually oil is coming out through the Hormuz. So, for example, UAE has been transshipping quite successfully. So what they're doing is using smaller, more discreet tankers, zip around the strait, and then load bigger tankers, to export actually more oil than they were before the crisis.
Do you think that we need to be paying more attention to what's happening with Russia and Ukraine, and that's going to take more barrels off than a lot of people are expecting?
Well, there's no question that this one of the stunning aspects of this whole World War III, because I always say if you're worried about World War III, you're in it, has been the emergence of Ukraine as a superpower, as a drone superpower. That you wouldn't have thought. Now that Ukraine is very popular in the Middle East, they're doing arms deals down in the Middle East. But what I will say is they're trashing Russia. And I don't know how much longer Russia can handle this. It's getting intolerable for the Russian people, I'm sure.
Paul, it's good to see you. Appreciate it. Thanks. You. Everything's personal with Bramo. Did you go to the movies recently? Did you get done over on a bag of popcorn? Is that what happened?
She went to see the Odyssey.
Oh, it was a bag of popcorn. No, it's just like a bag of popcorn or like a box of cereal when you open it up and it's like...
I would be scared of you at the movies right now. Like, you'd be throwing that bag of popcorn at me.
It's been a long week.
Right?
Tomatoes. Sleep is an important thing.
Kevin, avoid the movies, all right? Don't bump into Bramo. Not now. Paul, thank you, sir. It's good to see you.
Pleasure,
thank you very much. Futures right now on the S&P positive by 0.6 on the S&P 500. In just a moment, we'll catch up with Nick Jones of BNP. He's cutting his price target on Meta. Many others have as well, on the back of some disappointing results. That stock is getting absolutely hammered. The stock is down by about 9% so far in the pre-market. The hits keep coming for the Fed chair. So dovish, it's hawkish. That just came from Bank of America. That ultimately it's going to make them need to hike rates to get back some credibility, and maybe as soon as September.
Yeah, I did get pushback saying that actually it's not that the Fed is losing credibility, it's that the market, to the point that Francis Donald was making, is waking up to the reality that inflation is going to be higher for longer, and rates should be too.
The reality is yields are higher again at the long end of the curve through 520. Up next, we'll get you some morning movers as well. ARM and Qualcomm sliding on a smartphone slowdown. good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
It's Bloomberg Money.
This is the Asia Trade.
This is Wall Street Week.
Welcome to Balance of Power.
You're watching Bloomberg Deals. Welcome to Bloomberg This Weekend.
This is Bloomberg Television.
Bringing you the latest geopolitical news whenever and wherever it happens. I'm David Gura on the Salar de Uyuni in Bolivia, and this is Bloomberg.
Trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
Let's talk about the significant risk transfers to find space in their balance sheet.
Hedging some of that risk.
You could look at it the other way. Obviously, this stuff is risk-weighted.
I would much rather be long than be short.
We're in a kind of sweet spot. Very, very strong alignment. 3 revolutions in one.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Every trading day, only on Bloomberg.
The cash opened 2 hours away. Equity futures bouncing back. We're up by 0.6 on the S&P, higher by 1.3 on the Nasdaq. Thank you, Microsoft. That stock flying at the pre-market. We'll get to that story in just a moment. It's been a difficult moment, though. A difficult week for the Nasdaq. The Nasdaq 100 sliding for 6 consecutive days. Haven't seen a run like that since late 22, October to be precise of that year. And the semis have had a difficult run as well. We had a guest on the programme talking about rewarding good news. The fact of the matter is, for the chip players, we haven't rewarded good news. We really haven't. And Samsung has been another example of that. Intel one more, SK Hynix another. We've seen it across the board, across that sector.
There's skepticism about the overall story, how long the hyperscalers can keep spending endless amounts of cash, given that this cash is increasingly coming from skeptical investors, and how long memory chip makers can continue with 80+% margins, because ultimately, when you have margins that, as Jason Thomas of Carlyle said, are too good, that invites competition. And that's what you're seeing coming from China.
Maybe the most bearish thing that came for the spending story yesterday came from the Fed news conference. The price of capital, the cost of borrowing is going up. Check it out. 30-year yields higher by 2 basis points this morning through 520, the highest since 2007. There is a lot of competition for capital out there, Bramo, and we're seeing some higher rates.
Yeah, a significantly higher proportion of investment-grade tech-related issuance so far this year has been 10 or longer, 10-plus years in duration. That really points to how the long end of the yield curve selling off affects these tech players. There is so much debt being sold that when you get yields at this level, you have to wonder if it starts to constrain the ambitions of some of these hyperscalers. And ultimately, we may see that over the next week.
Not yet. And that's what's interesting. They've not responded to it yet, but you do sense increasing indecisiveness over at Meta. Which direction is that company going to go in? The pressure keeps ramping up.
So Meta narrowed its full-year forecast for CapEx to actually the higher range, $130 to $145 billion. And they've gotten punished for their lack of decisiveness. Microsoft actually lowered theirs, and I understand it's a bit of an accounting issue, but at the same time, that's what's getting rewarded right now in markets.
Brent crude looks like this morning. Brent and WTI. Brent holding onto the 90s through much of this morning, just about right now. It's down by 0.75%. WTI as well, 83 on WTI crude, 83.60. It's difficult to say things are getting better in the Middle East. Probably easier to say things are getting worse.
They're getting worse. The president said he's going to hit them very hard. And to be honest, that's exactly what the United States did. Yesterday, CENTCOM came out with a statement talking about the facilities they are going after, trying to make sure they can degrade Iran's capability to stop vessels from going to the Strait of Hormuz. But now that is really just one choke point everyone's talking about. This conflict is expanding. It is going to Egypt. It is going to the Red Sea and the Bab el-Mandeb Strait. And as we just heard from Paul Sankey, a number of individuals, you have to also remember there is still a conflict going on in Russia and Ukraine continuously shows their ability to hit Russia deep in their territory, go after refineries, as well as their issues in the Black Sea and the Caspian Sea.
Oil still elevated so far this morning. As we count you down to the cash open, some 2 hours away, let's get you some single names, some morning movers. Yahira has more. Hey, Yahira.
Hi, John. We are seeing a big divergence in Microsoft and Meta shares this morning as investors reward the company where you can clearly see a return on all that AI spending, and that is Microsoft, where its cloud revenue growth rose at its fastest pace in 4 years, while at Meta, it painted a more muddied picture. A lot of analysts wanted to hear more about that cloud computing opportunity, but they did not get that from CEO Mark Zuckerberg. As you said, it just feels like there's a lot of indecisiveness there. Instead, Meta delivered softer than expected revenue guidance and a dramatic fall in free cash flow. Turning to the smartphone market, that is weaker. We are seeing ARM Holdings negative, but Qualcomm falling 5.4%. Both companies said that Qualcomm issued a disappointing forecast pointing to component shortages and higher cost issues we've heard about before, while ARM said that weakness in smartphones is starting to weaken its royalty growth. Both companies, however, are seeing strong demand when it comes to supplying data centers, but that is not yet big enough to offset the weakness that we're seeing in the smartphone market. And we end on a company that just reported earnings, and that is Norwegian. Shares falling 7.25% after it cut several of its annual forecast metrics. The company says that bookings for the next 12 months are lower than expected, pointing to softer demand, the conflict in the Middle East, plus its own company-specific challenges. But even if you admit it, you won't get a pass, John.
Yahara, I'm not trying to go. I'm not trying to go. The stock is down by 7% at the pre-market.
Norwegian Cruise Lines has those like sort of fjord cruises that I think,
That's
smaller
like
ones.
maybe the one exception.
Yeah, so I got you.
You're paying? Maybe the one exception.
Or the popcorn.
Just for the popcorn. Okay, not for the cruise. On our radar this morning, the US launching fresh strikes against Iran in response to attacks on American troops in Jordan. The conflict spreading across the region. Vessels in Egypt believed to be the subject of an attack for the first time. Elsewhere, it's the busiest day of earnings season, headlined by reports from Apple and Amazon. The tech giants set to offer the next test for the AI trade, both mega-cap companies reporting after the closing bell. And finally, the president lumping in Fed Chair Kevin Warsh and a call for lower rates.
He's fantastic. He's a brilliant guy, smart. I know he'd love to see lower interest rates, but he's got a board, and it's a political board, and they want to keep rates up. But we fight through rates.
The timing of that statement was not very well timed. Let's put it that way. For the bond market sell-off that was materializing at the time, it came right at the end of that news conference with Kevin Warsh, and it made the optics, the backdrop for his evasiveness in that news conference look a lot worse.
It just sort of underscored the dovishness of his lack of responses to a lot of questions in terms of Kevin Warsh in particular. Here's the issue. Was this at all coordinated, or is this just fueling conspiracy theories that's going to force the hand of Fed Chair Kevin Warsh to be more hawkish at the September meeting and push back against what we're seeing in markets?
The timing was unfortunate for Kevin Warsh because it just feels like a pile-on. He's getting pulled in one direction by the dissents and the hawks on the committee. At the same time, the president's saying he's fantastic, and the president is saying, the president has sat down with him and interviewed him, I know he wants to see lower rates. I was expecting a phone call into the Fed show yesterday. I was watching, and all of a sudden...
Oh, you were ready to dial in?
All of a sudden, the president is starting to weigh in on everything. The one thing I would say, though, is that anytime you ask the president about rates, for years, they should always be lower.
I'm pretty sure you've got my number. You could have dialed in at any point you wanted, OK? Are you buying that she actually wanted to dial in yesterday?
She definitely did not.
Of course not.
President Trump is a real estate guy. Real estate wants rates lower. I don't know that he's going to be happy with the long end yield going up to the degree that it is.
No way. This is going to create...
problematic for the housing market.
Exactly.
Besson, over at the Treasury, very quiet. And we said yesterday on the programme, if he was looking at the response in this bond market, I'm not sure he'd be too pleased about this. And it's just going to put even more emphasis on them needing to issue at the front end of the curve. And then you start to think where this is going, which is why I keep going back to the yield curve story. We could spend some more time on this later on in the programme. This move is consistent. I'm not saying it's because, but it's consistent with the idea that they put less emphasis on the policy rate and more emphasis on the balance sheet. You would see front-end yields come down and long-end yields go up. Whether that's going to happen, I don't know, but he gave a subtle hint to that in the news conference, and let's see if he gives that some more time later this year.
Yeah, can you peg rates at, say, 3.5% in the United States, issue all your debt at the front of the yield curve, have 3.5% of your overall base interest costs, term out any kind of long-term debt, and deal with the consequences that is likely to result from both the dollar, the long end of the yield curve, and potentially inflation?
Precisely. It's consistent with the move in the yield curve. It's consistent with the move in the US dollar. Let's see how this turns in the months to come. Let's turn back to the tech earnings story. Meta falling in the pre-market as investors digest a disappointing revenue guide. The company also boosting the low end of its capex forecast as it continues to ramp up AI spending plans. Nick Jones of BNP Paribas cutting his price target on Meta by $100 to $855, writing the lack of clear near-term returns on investments in combination with the potential need for incremental capital will likely weigh on Meta's multiple. Nick joins us now for more. Nick, welcome to the programme. We've seen the capital markets push back, the equity market push back on Mark Zuckerberg's plans before. And he is willing to make pivots, and we saw that with the year of efficiency in 2023. Nick, how close do you think we are to that moment for this company, for this stock?
After the earnings call last night, it doesn't seem like we're very close based on the tone of the CEO and CFO. I think right now, what investors are often missing with Meta's story here is they have one thing that a lot of the other AI competitors don't have, is they have profitable distribution through all of their applications. So these investments to them, I think, are critical. We've seen Sora launch and then, get shuttered. We saw OpenClaw. There's been new social media sites launch throughout this kind of AI trade over the last several years. I think for Meta, they see a real opportunity to drive investment here. So we don't think kind of EPS numbers are really going to move much on earnings. On the other hand, free cash flow estimates are likely going negative for the next couple of years, and they may need to raise some money to kind of fund from here. But overall, we actually think the strategy makes sense. We brought our price target down really to reflect sentiment. We still see pretty significant upside, but kind of as you alluded, the market really wants to start seeing some returns here.
So, Nick, as you know, it's an unforgiving backdrop right now. You said the strategy makes sense. Just makes me wonder why he's being so indecisive about what they'll do with their capacity, whether they'll sell it or use it internally. That indecisiveness, to some degree, is being punished this morning. I'm not saying it's the whole story, but it's part of it. What kind of decision ultimately do you think they'll make on that?
I think eventually they'll launch a cloud offering or some sort of neo cloud offering. The theme of the call last night was really balancing near-term opportunity versus long-term opportunity. And they kept, I think they said 2 or 3 or 4 times on the call that near-term compute is more valuable than long-term compute, meaning they might have some opportunistic deals to be made to monetize any excess compute they would have. But ultimately, the message remained the same. They intend to build compute that they want to use over time to improve the product on their platform.
What does Meta want to be when it grows up? I mean, we're talking about the metaverse. Now we're talking about cloud computing. We're talking about frontier models in addition to the core business of social media and advertising.
Yeah, I think AI is actually one of these new technologies that really enhance Meta's platform. So what do you really get from AI? You get much richer, deeper, and longer context windows. Who would benefit from deeper, richer, longer context windows? Well, that's advertisers. They have this huge user base that's engaging more and more with the platform, as reported last night. So this should allow them to serve the right ad to the right person at the right time. This should allow them to get deeper into social commerce, better content recommendations to keep folks on the platform longer and longer. So I actually think this technology may be somewhat different than kind of the metaverse initiative is better positioned to enhance the platform.
That's not sexy right now. And we heard that with Mark Zuckerberg. The idea of talking about catering to advertisers isn't sort of the hot thing, which is coming up with frontier models and being able to provide cloud computing and being able to change the world in all of these, high AGI types of scenarios. Do you think that Mark Zuckerberg will be happy with just being a really good advertising tool?
I don't think so. They also talked a lot about launching more enterprise solutions to enable workflows. I think increasingly they're going to enable SMB kind of agentic workflows, enterprise agentic workflows. A lot of the folks who use the platform for advertising, they have back-end CRM systems, they have internal workflows, they maybe need to process returns. There's a lot of things that could benefit from more technology through whether it's WhatsApp, Instagram, Facebook, on the platform that I think can broaden their revenue streams.
Nick, it's good to catch up. We appreciate it. Nick Jones there of BNP Paribas on this stock as they cut their price target and others do as well. That stock is down 25% from the highs of last year, from last August to be precise. It's down another 9 so far this morning. There is a profitable business in there. There's a big engine that churns out a lot of money, which is what Nick is getting at. At some point, it becomes a screaming buy. Right, at some point. And we saw that a few years ago. When they went into that year of efficiency, things started to change for that company, that stock, specifically really quickly. I don't know how close we are to that moment, but you need a heck of a lot more decisiveness than what we've seen in the past few days.
The last time free cash flow was lower than where it was in this past quarter was in that year of efficiencies in 2022. After that, free cash flow bounced back up.
Yep.
If, as Nick Jones predicts, you're going to get negative free cash flow for a couple of years, will this market tolerate the ambitions at the same time that they're coming at the expense of that cash-producing machine?
Certainly not tolerating it right now. The stock is down again in the pre-market by 9%. Let's give you an update on news worldwide this morning with your Bloomberg Brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John. Thank you. The Senate committee considering Todd Blanche for Attorney General abruptly called off its confirmation vote last night. 2 Republican senators are still holding out support. One holdout, Tom Tillis of North Carolina, wants Blanche to meet with Jeffrey Epstein's victims first. The Pentagon awarding major defense contracts to boost weapons stockpiles. Lockheed Martin winning a $59 billion deal to sharply expand Patriot missile production. General Dynamics and Huntington Ingalls securing contracts worth close to $76 billion for nuclear submarines and upgrading shipyard infrastructure. Jersey Mike's preparing for its trading debut. The company and some of its shareholders raising $1 billion in an IPO that priced at the midpoint of its marketed range. Shares pricing at $23 each and giving the company a market value of $7.3 billion based on the outstanding shares listed in the filings. That's your Bloomberg Brief. John.
Hey, Vonnie, thank you. More from Vonnie in about 30 minutes' time. Up next on the programme, questioning the North Star.
It was a real family fight. That's the better way to get policy right. That's our North Star. Market participants are learning to play the ball, not the referee.
Up next, we'll catch up with the former St. Louis Fed President, Jim Bullard, live from New York City. You're watching Bloomberg Surveillance.
My old mentor, Roger Staubach, who told me when I transitioned, football will never leave you, but you need to leave it.
Wow.
Everyone has a dream. And a lot of dreams are, you know, my dream is to play football and play professional football, and you get the dream comes true, but it is going to end. And the day it ends, the day before it ends, you're one of the best in the world. Great. The next day you wake up, that's gone. What are you great at? And the truth is, nothing, right? I'm not great at anything else.
I talk about it all the time, Steve, is this whole idea of it's not from penthouse to penthouse. And what I mean by that is you played for 15, 20 years and you're in the penthouse. That doesn't mean that you come to the business world and you're going to be in the penthouse. Now, you don't start on the 3rd floor or the lobby. You actually have to start in the basement.
The global economic playbook is being rewritten and the levers of power are moving in real time.
To see where the world is headed, you have to look where the action is.
I'm Haslinda Amin in Singapore.
I'm Menika Doshi in Mumbai.
Welcome to Emerging the New Economy podcast.
Each month, we dive deep into how the world's most exciting rising economies are shaping the global future.
Join the conversation. Subscribe to Emerging on your favorite podcast platform today.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at Japan's Akasaka Palace in Tokyo, and this is Bloomberg.
We're a long way from neutral. We're not here to close spreads. And then yesterday's performance in that news conference. He's not the first, he won't be the last. A new central banker struggling to communicate with a market that doesn't quite understand how to translate who this guy is, what he stands for, and what his preferences are. Right now, equity futures are bouncing back from losses yesterday, up by 0.6% on the S&P, on the Nasdaq 100 up by 1.4%. In the bond market, yields higher at the long end of the curve. 30s down, yields higher by a single basis point, 521. On 30s this morning.
Yeah, still at the highest levels going back to 2007. A real pushback. And ultimately, I think you're asking the right question. Is this by design, or is this going to be a closing the spreads type of moment as we get some of the rhetoric from other Fed officials? Is this the new policy of anchoring the front end of the yield curve and allowing the long end of the yield curve to do the dirty work? Or is this potentially something that is going to cause a reversal in policy?
I don't see him rushing to schedule an interview anytime soon. Let's put it that way. I do think that the others on the committee will come out swinging in the next couple of weeks. Only because of one thing in that news conference that stood out to me, and we talked about it briefly yesterday. I'm open to these ideas, a new way of communication. I think it will take time to internalize. Let's give it a chance. All of that stuff. But the tone was patronizing. When he started to talk about the big things, the big ideas they needed to discuss, as if we haven't discussed them or debated them for much of the last 5 years. If I was sitting on that committee, I would have been offended yesterday. And I've been looking for that in the tone, in the communication of these officials in the weeks to come.
People are smart, both on the committee and in markets. People are incredibly smart, sophisticated, and have been analyzing these questions for a long time. There's a family fight in markets about exactly how to interpret all of this. And I think it's wonderful to actually be open to that. But to talk around issues as though you're actually saying something is a triggering event.
Under surveillance this morning, it was triggering for Bramo. We're questioning the North Star.
It was a real family fight. That's the better way to get policy right. That's our North Star. If inflation continues to be elevated through the forecast period, interest rates could well be part of that solution. Market participants are learning to play the ball, not the referee.
So here's the latest. 30-year bond yields rising to the highest levels since 2007 as investors challenge the Fed's credibility, fearing Chair Kevin Walsh won't temper inflation fast enough. The former St. Louis Fed President Jim Bullard joins us now for more. Jim, for once, I imagine you were happy you were on the inside and you were sitting on the outside. What was your view of how that news conference went down yesterday?
Well, unfortunately, I thought it was a little bit rocky. It's probably not unanticipated, given that Chair Walsh is new in the role. This is his second press conference. But I thought, the sell-off with the higher yields in the 30-year are kind of nerve-wracking for a central banker. Dollar depreciation on the announcement. I think he needed to do more to create optionality in September, and he didn't do very much of that. He emphasized the inflation target and that you weren't backing off the inflation target, gave a little bit of a hint that, the measurement, might be a factor there. I don't think that was helpful. You might as well explain what the main arguments were around the table, because the members are going to go out and tell you what they are thinking, and basically what they're thinking is there are 2 more inflation reports to come, and we want to see those inflation reports before we get going on any kind of hiking campaign. So you might as well at least acknowledge, the contours of the argument. I understand he doesn't want to give forward guidance, but it's a work in progress, and he's very accomplished, I think, in many ways. But markets obviously didn't like this.
A work in progress implies there is some intent here. There is an objective. Jim, what do you think it is? What is the intent? What's the objective?
Well, I think he says what he means. I would characterize interest rate policy in the U.S. as being partly the Fed and partly the market. And he feels like it's become 90% Fed and 10% market. He wants that back to dial that back to 50% or something like that. And so that you can't drive either side to zero. Both sides have a role to play, but he feels like it's been too much Fed, not enough market, and maybe he's erring in the other direction now. But I think we'll get to a good equilibrium eventually.
Do you think, Jim, that there's a difference between forward guidance and a reaction function?
I do. I think, and we're struggling, I think, to know what he means when he says he doesn't want to give forward guidance. If you look at a Taylor rule or something like a Taylor rule, that tells you what the Fed would do in every single state of the world. And so that's forward guidance in some sense. But I think what he means is like the chair would come out at a press conference and say, hey, it's highly likely we're going to move in September, or it's highly unlikely we're going to move in September. That sort of forward guidance, I think, is what he wants to get away from. That might be warranted, especially when you want to have optionality to see how developments proceed.
The reason why I asked Jim is because he seemed to say that we're conflating the two and that people are asking for a reaction function when actually all they're looking for is some sort of forward guidance. And I just wonder what you make of the way he answered questions or didn't answer questions. I mean, do you think that this was deliberate, or do you think that there is a larger idea that the market isn't understanding?
Yeah, well, is it deliberate? Well, I'm sure he thought very carefully about how he wanted to handle things. And I guess one thing that stood out to me is that he didn't want to bring up, okay, there are 2 inflation reports before the next meeting, because I think he was feeling like that would create too much data dependence and too much focus on that. But that's really the story here is, can the committee count on inflation coming down, especially coming down, core PCE inflation coming down below 3% and being on track to go to 2%? Or are they going to have to get on a tightening campaign to make sure that that happens? So, the data is going to be important over the next couple of months.
Jim, do you think that performance makes it more likely they'll hike in September?
Well, he steadfastly stayed away from that. I think I would have preferred that he say, we're ready to move, under certain circumstances, and we're definitely willing to move. Instead, he only talked about the inflation target itself without saying that we're ready to take action. Markets didn't like that. And they actually, the 2-year yield went down. And so now markets are less sure that the committee will actually follow through and try to drive inflation back to 2%. So I think it is a bit of erosion of credibility. I think it can all be managed, but unfortunately, it was a little bit rocky.
Yeah, it wasn't a great performance, let's put it that way. Jim, thank you, buddy. As always, the former St. Louis Fed President Jim Bullard there on the performance of Kevin Walsh in that news conference just yesterday. Up next, we'll catch up with Matt Miskin of John Hancock, Walter Piecyk of Lightshed Partners, Mike Gapon of Morgan Stanley, Kelly Kowalski of Mass Mutual. The third hour of Bloomberg Surveillance is just around the corner.
Today, Wayfair sees immense potential in brick-and-mortar stores.
When we got into physical retail, our view was that, even if the market continued to grow for e-commerce, probably a large chunk of the market in the space would stay offline.
Kate Gulliver showed me around Wayfair's new 150,000 square foot Atlanta flagship store.
When customers who have seen us online come into the store, they're generally a bit surprised by actually the breadth of what we offer. Often if you're going online, maybe you're looking for something particular. But when you come into the store, you walk in, you see, the market square, you see all these pillows, you see the decorative accents. So what we're seeing actually is that in store, we do really well in some categories that online are, less a percentage of the total.
How does technology help in kind of making it seamless online to store?
I think
and vice versa.
The biggest thing is for the customer on the front end, that she can be in the store, that she can actually shop here, go back home, complete that purchase. And if you look at these sort of price tags and everything, they're all these digital tags. That's because they're the exact same prices they are online. So you're not going to be surprised that you saw something in the store and then you decided to purchase it online, that it's somehow different and that the offering is different. It's actually very consistent, but when she's here, she can have her app open and everything that she's doing here can be very similar to what she's doing at home. And I think that consistency is quite important.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Historically, bubbles were characterized by a notion of if you build it, they will come. In the late 90s, when we were building out data networking equipment, people were putting huge amounts of fiber in the ground on the assumption that it would come. And economists like to go back for reasons that are unclear to me to the railroads. They were also, if you build it, they will come. What is unusual about AI right now is the builders are so far behind the demand, it's absurd. We have a backlog of more than $25 billion of demand. That there are none of us, not AMD, not NVIDIA, that can keep up with the demand that your employees are driving. That's, in a lot of ways, the opposite of a bubble. We are chasing. Our customers and their customers are moving at the speed of software, and we're moving at the speed of real estate, data centers, right? And so we are behind.
Every weekday, Bloomberg puts the spotlight on a different aspect of global finance. Flows, funds, and the forces shaping markets on ETF IQ. The future of money with Bloomberg Crypto. The players behind major transactions on Bloomberg Deals. Rates, risk, and the cost of capital on Bloomberg Real Yield. And personal finance, retirement, and wealth management on Bloomberg Money. A different topic every weekday, only on Bloomberg Television.
Get your fixed income fix. Watch Bloomberg Real Yield around the world, right here on Bloomberg. Context changes everything.
Today, our committee decided to vote by a 9-3 vote to maintain the target range for the federal funds rate.
Those dissents were not done in a vacuum. Many people on the board are leaning towards a rate hike.
I'm particularly glad with the fact that they've listed the 3 dissenters.
Having dissents is not unusual. That being said, there's very little to hang your hat on in the market.
If the data ends up coming in line with the side, this may all work out, but if not, this could end pretty poorly.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
He's got good suits. He's got great suit game. No?
He does.
Everyone's been so mean.
He's got great hair. He's got
great game.
The president's right. He has great hair. He's got great hair.
He looks slick.
He has a great resume.
Looks the part.
He does.
Just doesn't say much.
You know, look, maybe he'll come out and he'll reverse course. And maybe he said everything he needs to say.
We're going to be nice at this hour.
I think so.
Now, we're going to try. Just 60 minutes, Bramwell. You can do it.
I think
I reckon.
I will.
I reckon you can. Live from New York City this morning. Good morning to you all. For our audience worldwide, the third hour of Bloomberg Surveillance starts right now. Your price action looks like this. Equities bouncing back from yesterday's losses. A 6-day slide on the Nasdaq. We're higher this morning by 1.3%. Microsoft, a big part of that. The stock is up by 9% in the pre-market. Going into earnings a little bit later. In the bond market, 2s, 10s and 30s. We said yesterday on the Fed special, will this move stick? It sticks and some. Yields down 2 basis points at the front end, 425 on 2s, 30s up just a little bit. We're holding on to 520 on 30s this morning. Coming up a little bit later, look out for this, more earnings on Wall Street, more Mag 7 names. You're going to hear from Apple, you will hear from Amazon. We see a big divide in the pre-market between the Metas and the Microsofts of this world. Where will Amazon and Apple fit in?
Yeah, Amazon's going to be more in line potentially with Microsoft and Alphabet in terms of direct comps. Apple, I actually think might be the most interesting one because it stands out as the anti-AI trade. They didn't do the huge capex that the other hyperscalers, the other tech companies did, and they're getting rewarded for that. And can they deliver some of the actual tangible consumer goods, especially with higher prices for the component parts?
Well, I think that's what's going to be interesting, too, where they see component prices going, and are they going to have to tap into potentially, at least in the Chinese market, maybe some other Asian markets, buying Chinese component parts because memory chips are just too expensive to keep prices down when it comes to things like iPhones and tablets. Those two names in focus a little bit later on this afternoon. This tenor in focus right now, this maturity, it's the 30-year. The yield just about unchanged on the session, around 520. It's the highest level we've seen going back to 2007. And people in this bond market, by people I mean Lisa, fired up this morning on the performance of Kevin Walsh in that news conference. You're not alone. You've got a lot of company, I have to say.
Well, okay. First of all, I think that we're all very open to a new approach from the Fed and the idea of the sort of financial repression of the post-financial crisis not necessarily being the path forward. The issue for a lot of people is they don't have an understanding of what will force the Fed's hand to hike rates at a time where inflation has been above target for 5+ years. And that, I think, 5+ years. And that's the reason why you're seeing some pushback, because it's not clear why they didn't hike. It's not clear why they would hike. And a lot of people are wondering whether this is just someone who's talking a big game and not going to actually act.
And John, you brought up a great point. What does the Treasury Secretary think of this and this performance? I went back to some remarks he said just after Kevin Warsh was sworn in. Quote, "We're going to get back to basics in terms of accountability and credibility." The market is not saying that that was basics of credibility and accountability. Also, I'm not saying whether it's the causation or the correlation, but rates peaked the day before Chair Warsh was sworn in. He cannot be too happy with this performance.
I agree with you, Anne-Marie, and it's working out what the strategy is. I think for many people on Wall Street, I'm thinking of Jim Caron of Morgan Stanley earlier this week talking about the strategy of Warsh, and it kind of made sense. It was fairly intuitive. You introduce some hawkishness to the front end of the yield curve. It helps you to cap rates at the longer end of the yield curve. You basically build up your inflation-fighting credibility credentials. That made sense to me. It's like we unwound that completely in just a full 180. In the bond market yesterday, we started to question the hawkishness at the front end of the curve and then started to question the inflation credibility at the long end of the curve. And now this can go somewhere else. And it's the next phase of the conversation I think is risky. I'm not saying we're going there, but I'm saying the moves today are consistent with it. And this is what I mean. If the market begins to believe we have a Fed chair that's not willing to fight inflation with rates but wants to do it with the balance sheet, and wants to accommodate more issuance at the front end of the curve coming from the Treasury, you'll see more of what we've seen in the last 24 hours. And what do I mean by that? You'll see yields come down at the front end, you'll see yields go up at the long end, and you'll see the dollar weaken. And that's entirely consistent with the price action of the last 24 hours. I'm not saying that's the reason for why we've seen that price action in the last 24 hours. I'm just saying there's a risk that the narrative starts to go to that place if they don't push back quickly enough.
Let the fireworks begin. We get Fed commentary, I'm sure, in speeches over the next couple of weeks. And then do we hear from Treasury Secretary Scott Bessent? Not only that, but we're also going to be hearing from Kevin Warsh, Jackson Hole. And right now it's a blank sheet. Maybe it's getting filled up this morning. Coming up, we'll catch up with Matt Miskin of John Hancock, with markets whipsawed by the Fed and mega cap tech. Walt Piecyk of Lightshed Partners looking ahead to results from Apple. Mike Gapin of Morgan Stanley breaking down the latest read on inflation and the labour market. We begin this hour with stocks bouncing back and bond yields at near 2-decade highs. Matt Miskin of John Hancock writing, the bond market is flashing a bear steepening as the more tempered hawkishness did not appease the bond vigilantes. Matt joins us now for more. Matt, good morning. Good to see you.
Good morning. Thanks for having me.
Bonds on sale. Are you a buyer?
Yeah, we're starting to look at it. You know, I mean, we're looking at 5% now on the aggregate bond index. We're looking at about 6% on corporates. High yield is back to 8%. If I can do 5 to 8%, look, yield is destiny at the end of the day. And there's a lot of volatility. There's a lot of uncertainty. I don't know where inflation's going. I don't know, especially after yesterday, I don't know what the Fed's going to do in September. But what I do know is if you can get 5 to 6% per year for the next 5 to 10 years,
you should take it.
It's not bad. And we've got what's called real yield, John. It's been a while. This real yield after the inflation deduction is actually pretty compelling. I'm not trying to say step into the 30-year. I get it. It almost looked like yesterday that they cut because of that steepening. Because I think what also happened was you had right before the meeting this, oh my God, they might actually surprise hike. So the 2-year yield rose and it flattened. And then that just kind of came off in the meeting. But look, yesterday, the 30-year going out like that, if it's your second day at the office, you come home and it's like, how was your day? Well, the 30-year blew out. That would not be my best. That would not be how I'd want to come home. But I think that's how
If you're interested in bonds here or close to getting interested to buy, what are you less interested in buying? What becomes a sell?
Well, here's the thing. If yields keep going, and this is the whole concept of let the bond market do monetary policy, it's going to work until it doesn't. And I think in your first or your second meeting, or how many weeks, he kept saying how many weeks exactly am I here? But, you can get away with that. At the next meeting, I don't think he can get away with that. If yields rise too much, it's going to break something. And, the liquidity is going to be pulled back. And companies need liquidity right now. You've got the AI theme that's just absorbing so much capital. You're going to hear more companies say, I need CapEx, I need issue equity, issue debt. And so if rates back up too much, and the consumer's okay, but it is not great. So if you're saying we're going to raise borrowing costs, we're going to let the bond market do the work for us, it's trial and error. And if it backs up too much, then all of a sudden something snaps, and then all of a sudden there's a liquidity event and yields tumble. So you want to make sure you're getting that. I think looking opportunistically in it. We've got a mild credit bias. We're not overweight, high yield. We've got a little bit, but just play it, I'd say middle of the curve or a little shorter than the middle of the curve, a little bit of credit, and just get paid income while you wait.
Does this introduce a lot more volatility and potentially spread widening to credit? Because right now, not only do you have questions about what higher yields will do to the overall economy, but also volatility just inherently in the Treasury is not a good thing for risk assets and spread.
I totally agree. I think that it can, yeah. I mean, and so you've got this uncertainty on top of uncertainty. And look, they're going to be looking at the economy. Spreads are 288 basis points as of today. They're off the lows. I mean, we're looking at oil prices. We still got, earnings season we got to get through. And we've got, more, we've got GDP. I think that's kind of lagged. But, I think the spreads are going to look at the economy more so than the Fed. But it does make longer duration credit that much more risky. I think the shorter end or even the intermediate, you're going to be okay. But that longer duration credit, yeah, that's a risky spot.
At what point will that constrain the spending ambitions of hyperscalers?
Right now, we are getting two massive forces colliding. So we've got these hyperscalers that are like, we need debt, we need equity, we need capital. And then you've got the Fed, well, before yesterday at least, saying we're tightening. And we've got the bond market tightening. So you've got these two forces colliding, and it's happening here at the end of the year. So I think that it can incrementally already weigh on something. You're seeing them report like last week, and the stock sells off. That is a warning signal to them saying, look, you don't have a blank checkbook anymore. That's getting taken away from you. You're going to eventually have to put your spending under control. And it's like these earnings reports, negative free cash flow, positive earnings. Like earnings are opinion, cash flow is fact. And right now, the cash flow is negative.
So what do you do in this environment? At the same time, oil is going up because of a massive geopolitical problem that the diplomatic route doesn't seem to be the one that this administration is going to take.
It's going to be tough. And look, I don't think they should make policy decisions based on oil because you can easily make a policy mistake. 1 second you could feel like, all right, higher oil, inflation, and then the next day there's a headline and oil prices come down and then you feel like you're off sides. That being said, oil prices are higher. Supply has come offline significantly. Like, I can't even believe where oil prices are given where we were, over the last year. We're up not that much. And we've had 20% of the global supply still basically constrained. We've released all this strategic petroleum reserve, and we're running, we can't do that forever. And because there hasn't been any more meaningful, change to that narrative, I think that's going to keep elevated oil prices, and it's going to keep the Fed in a tough position to eventually probably have to do something. But again, I don't think they should move just on that. If the economy can hold up okay, that's probably when they actually go. And
the price of energy is going up. The cost of capital is too. The good news, look at these earnings from the likes of MasterCard. EPS coming in at $5, a little north than that, the estimate $4.77. The backdrop for the economy right now, this is the good news, that this economy is still okay. Based on these numbers we see from the big companies in corporate America, they're still churning out fantastic earnings.
We've seen that from one consumer company after another. All the card companies have been beating expectations. MasterCard, just the latest. I mean, every single metric increased, including cross-border volumes and net revenue. This goes to the question of how long can you see a sell-off in hyperscalers before the wealth effect takes down some of this consumer spending? In other words, at what point does the weakness that we're seeing right now act as a leading indicator of what is to come, particularly at the high end of the income sphere?
That stock up by 3% so far in the pre-market. Matt, it's good to see you. Thank you, buddy. Matt Maskinev, John Hancock there, weighing in on this Federal Reserve and what it means for this bond market. Close to buy. Not 30s, but interested in the rest of the curve.
There were two T-shirts I'd like to make. Yield is destiny. I thought that was fantastic.
You wrote down the quotes.
And the other one, earnings are opinion, cash flow is fact. I think that both of those could be really good mugs or T-shirts.
You wear that at the weekend. That would be very on-brand, Bramo.
I would. I actually think I should.
Yield is destiny.
I think that's fantastic.
OK, if you see Lisa walking through Central Park or something, yield is destiny. Let's give an update on news elsewhere this morning. Bloomberg Brief. Vonnie Quinn has that and more. Hey, Vonnie.
Hey, John. Thank you. The U.S. hitting dozens of targets in Iran in a 2-hour operation following through on President Trump's threat that they were going to, quote, get a beating. The conflict spreading across the Middle East with unclaimed attacks on vessels at an Egyptian port as well. Poland's Prime Minister Donald Tusk says an object that crashed near its border with Ukraine was a Russian missile. Poland says the incident took place at around 3:40 a.m. local time during an intense Russian attack targeting Ukraine. President Donald Trump praising Fed Chair Kevin Warsh, calling him brilliant after the central bank held rates steady for a fifth straight meeting. Trump saying, I know he'd love to see lower interest rates, but he's got a political board and they want to keep rates up. That's your Bloomberg Brief. John.
Bonnie, thank you. Thank you very much. Up next, the Morning Calls Plus. Walt Piecyk of Lightshed Partners saying Apple will have a hard time keeping up its recent growth. That conversation up next. Live from New York City this morning. Good morning.
When news breaks,
a redhead across the Bloomberg terminal.
Bloomberg has you covered.
Trump's global tariffs are struck down by the U.S. Supreme Court.
For all the context and clarity you need.
There's going to be now tons of tariff headlines until midterm elections.
Hear it first on Bloomberg.
Technology is embedded in every aspect of our lives, and that revolution is playing out in real time. From finance to defense tech, AI to entertainment, from the road to the stars. Bloomberg is bringing you the stories of companies and people that are pushing tech to new frontiers and the politics reshaping global tech markets. I'm Ed Ludlow, live in San Francisco, and this is Bloomberg Tech.
Every weekday, only on Bloomberg Television.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Broadly speaking, there is absolutely increased attention on the ROI of all of these investments. This, very large increase in CapEx that we've seen across a number of key players in this space. And so, yes, there's increased scrutiny on the free cash flow that will be generated.
That was Greg Moskowitz there of Mizuho weighing in on Microsoft. Microsoft putting up some decent numbers in the pre-market. The stock doing quite nicely. Equity futures on the S&P 500 shaping up as follows. Positive by 0.7. On the Nasdaq 100 up by 1.5. On the Russell this morning, positive by 0.7. That's the bounce back in equities after yesterday's losses. In the bond market, just about holding on to that 520 level on 30s. You're starting to come in just a little bit. The good news, I guess, this morning is that we're not continuing to see this bond market sell off, because that would be pretty bad to see this 30-year become even more untethered than it was in the last 24 hours.
We saw a massive move yesterday. It's sticking, but at least it's not continuing to accelerate in this session. Real key question going forward, how much does some of the message from yesterday, or the lack of message, get walked back with a little bit more of a definitive guide into what they're going to do in September?
Let's talk about what's happening elsewhere. Let's talk about one name in particular, Meta. Here are your morning calls. First up, Citi, cutting its price target, citing elevated spending and lower free cash flow. Your second call from Piper Sandler, lowering its price target, noting lack of clarity in its near-term compute monetization plan. And finally, Wells Fargo slashing its price target, citing broad uncertainty on the hyperscaler investment cycle. That name is getting hammered It's down by 10%. Let's stick with big tech. A fresh test ahead with results from Apple and Amazon due after the closing bell. Investors looking for the payoff from massive AI spending. Bloomberg's Ed Ludlow joins us now for more. Ed, good morning, buddy. And I guess that's what makes Apple different. They are different.
Yeah.
They're the standout in the Mag 7. They have not joined in the mega cap spending.
They're almost like the AI safety trade, right? Because they're insulated from the capex story. They have very different problems of their own, largely centered in higher component costs, memory. But the market has really cheered them. Now they need to justify the premium. And of course, this is Tim Cook's final earnings call and release as CEO before he goes up to executive chair on September 1st and John Ternus takes over. But the street is expecting growth, 16% on the top line. A strong showing in services could be interesting. And then their full-year capex, for what it's worth, just over $12 billion, which compare and contrast with Amazon is very much in line with the story of earnings season so far. We know how much Amazon's going to spend, $200 billion. And the thing is, it's highly analogous with Microsoft and Alphabet, Google Cloud, right? AWS, its core cloud unit, is expected to grow 31% year on year. That is real pace, bigger pace than they've seen in a long time. It's all the extra stuff, and that was kind of the lesson learned from Microsoft and from Meta last night. Other tangible data points that AI is getting traction for them. Key numbers, revenue, $197 billion. AWS will be $41 billion of that. But of course, it's the operating income cash cow. And so there is a high bar here. There is a burden of proof on Amazon, particularly to talk past capex if they give a number. Just a reflection that last night was quite tense because you waited on Microsoft and Meta to give that capex guide for the coming 12 months, and then nothing came. And so the market was like, OK, let's play with what we've got.
Ed, looking forward to the programme later on this morning. Bloomberg Tech a few hours away. Ed, thank you. Walt Piecyk of Lightshed Partners writing, it will be hard for Apple to replicate the growth the past year. Now investors are rewarding them for lack of capex and lack of AI. Walt joins us now for more. Well, welcome to the programme. It is strange that what was once a weakness is now considered a strength. Do you consider it a strength?
It's crazy. I mean, you can hear Ed talk about being the AI safety trade for a company that doesn't really have AI is kind of stunning. And I know there's been people talking that I have the developers mode software. I'm using the new Siri. It's better. Sure. It's not like great. It's still like not doing the stuff that they promised years ago. But right now we're in the middle of a good growth cycle. Remember, John, these cycles kind of come and go, right? The last time we had double-digit growth, particularly in iPhones, was 2021. And then prior to that, 2018, then 2015, then 2012. And all of those years in between, you had some cyclicality. Now, they can do stuff to try and juice that growth, price increases, $2,500 phones. I don't know if the operators are going to support that with the subsidies that are perhaps required to get the type of volumes that you need. So I think when you look at consensus, a lot of times, John, sell-side analysts basically, mark to market their stock prices because it goes up. The research director says you still have a buy, either move your price target up or downgrade. So they take the numbers up and take the numbers up. The reason the stock's going up, as you guys already mentioned, was probably more about this overall AI trade. So as a result, these forward numbers are starting to get a little ahead of themselves. Where I could be wrong. China's huge. They love the foldable phone. That grows and sustains growth for another year. But I think given where the valuation is on this, given where the trends have been in terms of money flows into it, because this quote unquote safety AI trade, it's just getting a little bit more risky to own here.
So with that in mind, what are you looking for later on this afternoon that might validate? What would be the metric that you would point to that you're expecting to validate the ultimate concerns you have?
I don't think there is anything because we're still in this upgrade cycle. There could be, if anything, maybe some, if people start anticipating the next phone, you see a rollover in growth. The operators have already reported, right? We know the upgrade rates have started to decline already. So there could be some flow through on this. So, but again, easy comps from last year, flow through of we're in this kind of cyclical trend right now. I'm not sure there's any real signal going into the September quarter, which only has a couple of weeks of new product launch sales. For them to change, I think, the already very bullish outlook in terms of growth. And remember, John, China also is like a big contributor to the growth the last couple of quarters.
Which also leads to a question of component prices and how much they're looking to potentially tap the Chinese memory chip companies for new parts. Do you expect any kind of announcement or tell on this call about that?
I mean, I'm sure they'll indicate that. Well, they've already increased price, right? They've shown that it's they quote necessary to increase these prices in order to maintain margin to generate tens of billions of dollars of free cash flow. So I think there'll probably be more support that yes, the investors will see price increases to match the component increases. What we just don't know is how that may ultimately impact unit demand overall. I mean, people are able to and have shown that they can hold on to their iPhones for a very long period of time. These are very good products, and I don't think anything other than it being foldable, anything functionally new that would drive some out of cycle, super cycle that exists right now.
Do you think at the higher end and the more expensive phones, there is a greater emphasis being placed by consumers on AI capabilities or a lesser one in terms of it being more of a vanity piece?
I don't think there's any focus on AI, and I think the reason is we haven't truly gotten to the power of agentic. Some of the stuff where your emails are summarized or how it helps your photos, obviously Android has those things sooner. It hasn't changed market share, quite the opposite. Apple continues to do well with market share. So I don't think we've gotten to the point where AI is delivering the functionality to your phone that is making the difference on why you would A, upgrade your existing iPhone to get whatever AI features that they're offering, or B, switch to Android, who may offer some of that. Now, again, we'll see. AI is changing very quickly, right? 6 months ago, like Apple was thought of like not the AI winner. Now they're quote unquote the AI winner. So we'll see what 6 months or 9 months looks like, if AI continues to advance in competing products.
Well, it's good to see you. Thanks for dropping by, as always. Walt Piecyk there of Lightshed Partners. To Walt's point, stock is up by something like 16% so far this month, just because they're not spending money. We're focused on what they're not doing. At some point, we have to focus on what they are doing, right?
Well, and they've actually been doing better because of some upgrades and because of certain cyclical reasons that Walt was laying out. How long that can continue, I keep going back to, what is it? Earnings are opinion and cash flow is fact, and that kind of is going to have to be what we see.
And yield is destiny.
Yield is destiny.
I like yield is destiny too.
I think that's fantastic.
You should make that t-shirt.
I really would enjoy that because it's true.
Okay.
It's like that is where we're going.
There's some branded merch here, don't we?
I think
make some mugs.
Yes, yield is destiny is a perfect surveillance.
Right, you want that?
Oh yeah, I think
Okay.
that's. Please, let's make
it's
it
all
happen.
yours. All right, I'll make it happen for you. Apple down in the pre-market by 0.6. Anne-Marie doesn't want it.
Why?
No, you're not impressed.
I like my Yankees and Knicks mugs.
Okay, we're not going to take that away from you. All right, they're not playing well at the moment, are they?
The Mets are.
Just sort of bury that mug out of shame.
No.
Like, put it away. When does Boone go?
I'm a forever fan.
When does Boone?
That's a great
right?
question.
Yeah, there you go. From New York City this morning, good morning. You're watching Bloomberg TV.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg. Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg.
The opening bounce about 60 minutes away. Equity futures are positive by 0.6 on the S&P, bouncing back on the Nasdaq by 1.4, and the Russell higher by 0.55%, bouncing back from a pretty tremendous day of losses. Everything down, really. 30-year got sold, equities got sold, tech got hammered, the dollar weakened. Wasn't a good picture for the Fed chair yesterday.
No, it was every single pillar of this market was getting kicked out from under it. On one hand, you had questions about the CapEx cycle and just how tolerant this market would be to financing the hopes and dreams of hyperscalers. You had a Fed that came out and was perceived as being more dovish, or at least not giving any kind of feasible explanation for anything. And suddenly you had a massive sell-off in the long end of the yield curve, and oil prices were rising in a reignition of what was happening in the Middle East. Essentially, everything was going wrong, and right now, hard to see what can rectify it.
Something going right. The data's pretty decent. Let's get into that data. Mike McKee has more. Good morning, Mike.
I hate to disagree with you this early in the morning, John, but the numbers aren't really all that good this morning. We haven't had a lot of numbers like this in a while, and they are backward looking because it's first quarter or second quarter GDP. You got to go back to April, May, and June. Comes in at 1.5%. That's after a 2.1% rise in the first quarter, and it's below the 2% that was anticipated. Now, personal consumption was higher for the quarter, 3.2%, than in the first quarter, 0.5%. But it started off strong in the first quarter and then was revised down. The latest numbers on income and spending, which go into this second quarter report, are from June. Income's up just 0.2 after 0.7 the prior month. Personal spending up 0.3. It was up 0.9 in the month of May. So when you average that out, it's still not a good number in terms of the consumer, and we'll have to see whether or not that continues to be revised. The PCE price index, everybody's been kind of waiting on that, although they can figure it out. Down 0.1% as forecast. It was up 0.5% in the month of May. On a year-over-year basis, that leaves us at 3.7%. That's down from 4.1%. The core PCE number is at an increase of 0.1%, much lower than the 0.3 we had in May. And a year-over-year basis, we fall from 3.4 to 3.3%. And finally, jobless claims. Now, there's one that's good news, John. 197,000. That's up from a revised 188. Remember, last week was the lowest since 1969. So we don't have that historical comparison, but we do have a very low jobless claims rate. Continuing claims, 1,782,000, and that is down from 1,789,000. So all in all, the economy does appear to have slowed in the second quarter. The labor market seems okay, but you have to question, where is the consumer going at this point?
Mike, thank you, I think. I was looking at the claims data. Mike, you know that. Mike McKee with the data. Thank you very much. 197, right? Continuing claims, not as bad as expected either. Labour market backdrop, still pretty decent.
Yeah, and this is the reason why you're seeing all of the consumer discretionary names do really well and perform with earnings that have continued to exceed expectations. There is this tension, between how long this is going to continue and whether wage gains are going to allow people to absorb some of the inflationary backdrop. for the foreseeable future.
Mike Gapin fired up. You ready for this? Mike Gapin of Morgan Stanley joins us now for more. Mike, good morning. Good to see you.
Good morning.
Your thoughts, not on the data, on the news conference, the performance of the Federal Reserve in the last 24 hours.
Well, I would say if my conversations with clients are representative, I think investors largely found it disappointing, and I think they were confused, and I think some came away thinking that he was overconfident. So I do believe that there are mixed reviews on the performance overall. I think markets went into it thinking maybe there's a chance we're going to get a hawkish reaction function that would establish inflation-fighting credibility, and I think it walked out not quite sure what it had, and in lieu of that, and not knowing, priced in an outcome that suggests there's a higher bar to rate hike. So I don't know if I'd call it dovish. I think we thought we might get something going in. We didn't get that. I'm not sure we know what we have coming out.
I found it confusing.
Yeah.
I don't think I was alone. I'm open-minded enough to wonder whether there is a bigger picture here, trying to work out what that bigger picture is. What do you think the intention is here, the ultimate objective for this Fed chair? What's he guiding us towards? What's the process about?
Well, at least in the narrow sense of what should we expect from press conferences and communications, it's clear. He's not going to say a lot. And what I would suggest is that means there's a vacuum. So if the Fed is not communicating, it will leave a vacuum. And that hole is going to get filled by something else. It'll get filled by market views, our views, other sets of views. They may be right, they may be wrong, but what he's saying is that's fine, and don't look to me to course correct that. So I think he is intentionally trying to say less, and we'll see whether or not he can do that over time.
Do you think that this means he needs to do more? Do you think this increases the chance of a rate hike in September?
Not necessarily. I ultimately think it will be dependent on the data. There's also 18 other people on the committee who I think have kind of a more, say, conventional reaction function around this. So I do think the incoming data matters. We do think inflation will be behaving more in the second half of the year. So I'm not convinced they have to. But what I think markets wanted to hear were conditions under which they would. So the decision to not hike yesterday was not a surprise. But where I think the confusion is just essentially, well, why didn't you? And under what conditions might you? And so that's where, that doesn't mean he has to come back later and do it. I think the data will ultimately drive
Can I jump in,
that story.
Mike?
Yeah.
The confusion for me was when he was asked, why didn't they raise rates? Why did you keep rates unchanged? And he said, well, I don't think rates have remained unchanged. And then he pointed to what the market had done.
Right.
That's where it started to get confusing for me. Are you outsourcing monetary policy to financial markets? And then markets started to think, well, OK, they're not going to hike.
Right.
So I'm going to take all that back.
Yeah, look, my biggest disagreement in all this is his analogy of we want the market to play the ball, not the referee. The Fed is not the referee in this. The referee sets the rules, enforces the rules, is an impartial arbiter, and the referee doesn't care who wins the game. The Fed cares who wins the game. The Fed has goals and objectives in this. The Fed is a player on the field. The rest of the market cannot play the ball without knowing how the Fed might play the ball. So I think it's the wrong analogy. I don't think it's credible to say the market is telling us what it thinks about the data and the economy without thinking about how we think about the economy. So that's where I would strongly disagree on that stance.
To build on what John was saying, some of the interpretations from yesterday was that the Fed's lack of action in saying they're going to outsource it to the market was a Fed that didn't want to hike rates and was going to use any excuse not to hike rates just in order to appease potentially somebody in particular. I'm just wondering, do you think that the credibility of the Federal Reserve was deeply undermined yesterday?
I think Fed credibility took a hit yesterday. It doesn't mean it's not recoverable. I just think in the outcome of the meeting was we're not sure what you're doing. So yes, I thought you might be credible in this direction. I got a different message. I do think credibility suffered a bit. It's not permanent. But to your question on intent, again, if you don't fill a gap with your view, other views will go in it. Whether they're right or wrong, we'll ultimately see.
How do you think they recover? What does that look like? Do they need the data to come their way? Does that involve a series of speeches? Do they now need to hike even more in September? How do they recover from that?
Well, I think one is, yes, you get clarity from the data that make it clear what you're supposed to do. And in this case, it's either you stay where you are or you raise rates later this year. We think the data will conform. We think the Fed's on hold for the rest of the year. So the data would validate what yesterday was, let's call it a confusing signal of patience. He may ultimately be validated by the data. If the data is clear in the other direction, then I would expect a Fed that was unanimous in June, that was 9-3 in July, will move in the direction of hikes later this year.
How interest rate sensitive is this economy at this point? I'm talking about the long end of the yield curve. If yields remain at 5.21% on the 30-year, will that materially slow a U.S. economy that otherwise has momentum?
Yes, but I think why I'm hesitating is there's one side of the economy that's really not interest rate sensitive, and that's generally the AI story. The view is 50 basis points here or there. It's not a yield sensitive decision. But mortgage rates went up yesterday, right? So the non-AI part of the economy, which is already somewhat modest, you saw the GDP data, the consumer is a little bit modest, right? That depresses non-AI activity. So one of the challenges for the Fed is where the resilience is coming from and where some of the upside risk to inflation is coming from or downside risk to the labor market is not really interest rate sensitive right now. So yes on net, but you're weighing on the parts of the economy that are already soft because you can't necessarily counter the other side of the policy with a 25 to 50 basis point change in front end rates.
So let's talk about the other tools. Can we finish on the balance sheet? He was asked a question about monetary policy, and he said if inflation continues to be elevated through the forecast period, interest rates could well be part of the solution. Is balance sheet an option here?
Yes. So the forecast period in this case is the 3-year horizon of the projections, assuming that those are still valid. So yes, what I think he's saying is interest rates are not potentially the only part of the solution. So I do think he is trying to interject some potential role for the balance sheet. Whether the data in the economy allow that to materialize, we'll see. But yes, I do think he was not giving a nod to potential balance sheet actions.
How is that going to work? Do we have to wait for a task force to complete? How quickly do you think the rest of the committee could get on board with the idea that, yes, inflation's above target, but no, that's not the right tool. We need to look beyond just interest rates?
Middle of 2027?
You'd have to wait that long.
Task force apparently won't complete its work until the end of this year. 3 to 6 months to debate the options. Unlikely that the economy will allow that to proceed.
Mike Gapen of Morgan Stanley. Mike, thank you.
Appreciate
it. Very diplomatic. Appreciate some diplomacy this morning. Bramo's been so fired up for the last 3 hours. Well, just trying to rein Bramo in, just losing it.
Well, you know, I don't often have such a clear sense of exactly how things are shaking out, but particularly that press conference, when there are a lot of words and you're like, I'm not understanding this, putting them together. I understand English, but the words put together don't really make sense. It's a frustrating feeling.
I'm not so frustrated anymore. I've kind of chilled a little bit. I think the market has as well. I'm trying to work out a bunch of things, though, that I still don't really understand the answers to. I go back to initially we thought that the Fed chair was trying to introduce some hawkishness into the front end of the curve. Kind of made sense. That's why 2-year yields started to come up. And then when he started talking about outsourcing monetary policy to financial markets, the market just looked at the bond curve and just said, OK, we've been pushing on the wrong side of the curve here. Forget front end rates. We'll tighten things up on the long end, especially when he's sort of open to using balance sheet and not so open to doing anything with actual interest rates. And that's where the debate's going to go from here through the summer. I also thought it was really weird the way he talked about Jackson Hole. Once he said, I'm only going to talk when I've got something to say, you can't say I've agreed to talk and the page is blank, right? That doesn't really add up either.
This is what I mean about saying a lot of words that don't really make sense. I mean, the whole idea that forward guidance and reaction function, he was saying, are two sides of the same thing, and that you guys are just essentially asking me for forward guidance, and people said, no, we're asking for the reaction function and exactly what's the model that you're using. The idea that you're talking about, that it's an input in terms of what the market does. Okay, then does that mean you're market dependent? No, it's one input of all the input. So what are we talking about here, which is the reason why the sort of cyclical experience was somewhat dizzying.
It was very circular, wasn't it? It was just round and round and round and round. We called it a 3-part act yesterday, and I think it's important to keep going back to that. The statement's one, the news conference is the other. The third piece of this act is all the Fed speak you will get in the next few weeks, and I just think that's going to be so important. How offended were they? They're human beings. I thought some of that news conference was patronising. We've talked about that repeatedly in the last 24 hours. Does that change the tone they'd already got? I could sense some snark from some Fed speakers, I won't name them, going into the quiet period before this news conference even started. How much are we going to see of that in the next month?
Yeah, ultimately, that's going to set the tone. I mean, could you see a situation where Kevin Warsh is in the minority and the Fed votes to hike rates? Is that something that potentially is on the docket?
Something to watch for. Let's give you an update on news worldwide with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John. Thank you. Recapping all the data we just got. Second quarter GDP coming in at 1.5%, missing estimates and lower than the 2.1% rise in the first quarter. Meanwhile, PCE falling 0.1% last month on the back of lower gasoline prices. Jobless claims also costing 197,000 initial claims filed last week, slightly lower than estimates calling for 200,000. Continuing claims coming in at 1.78 million, also below expectations. Jersey Mike's is preparing for its trading debut. The company and some of its shareholders raising $1 billion in an IPO that priced at the midpoint of its marketed range. Shares pricing at $23 apiece and giving the company a market value of $7.3 billion based on the outstanding shares listed in the filings. And that's your Bloomberg Brief. John.
Vonnie, thank you. Thanks for this morning. Up next, we'll catch up with Kelly Kowalski of Mass Mutual, saying even a jumbo rate hike won't bring inflation down to the Fed's target. Plus, Yahira has your morning movers. Microsoft leading the rally this morning in tech. Meta disappointing. Amazon and Apple up next.
Western countries, all of them are cutting funding to Africa. And some of these programs were supported by funding coming from Western countries, like for human resources, for testing, for transportation of samples. And suddenly, African countries have to think how to fund money and to cover this gap. But it takes some time. And I think the combination of all of these factors are fueling this mistrust that we see at community level. We value the support we got and we are still getting from the US. And we think that if we continue to work together, and there is no reason for the US not to work with Africa CDC, Africa CDC is the leader in terms of public health in Africa.
What is going to be the consequence for U.S. markets?
We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
The Fed is not the referee in this. The referee sets the rules, enforces the rules, is an impartial arbiter. And the referee doesn't care who wins the game. The Fed cares who wins the game. The Fed has goals and objectives in this. The Fed is a player on the field. The rest of the market cannot play the ball without knowing how the Fed might play the ball.
Mike Apin of Morgan Stanley weighing in on this Federal Reserve led by a new Fed chair, Kevin Warsh, in his second news conference that was a little bit rocky, according to the former St. Louis Fed President Jim Bullard, and many others with much stronger words to describe the last 24 hours. Equity futures right now in the S&P 500 firmer by 0.6. The market doing better. The Nasdaq higher by 1.6%. The opening bell about 42 minutes away with some morning movers. Just ahead of your cash open, Yahara has more. Hey, Yahara.
Hi, John. The difference between Microsoft and Meta is clear as day, as you can see, as investors reward the company that's showing a clear return on investment from all of its AI spending. And that is, of course, Microsoft revenue in its cloud unit rose at its fastest pace in 4 years, while at Meta, it forecasts softer revenue growth and a dramatic decline in free cash flow. And I added Amazon to this board since, as you can see, shares are up 3% ahead of earnings later today, with investors hoping that Microsoft's strong cloud growth will translate into strength at AWS. We turn to MasterCard. Shares are up 3% in the pre-market after it gave us another strong read on the U.S. consumer. After Starbucks and Chipotle also helped to lift optimism, the payments company delivered an earnings beat driven by strong transactions volume. We've heard similar messages from Visa and MasterCard in the past 2 weeks. And we end on Crocs. Shares are plunging 12%, but the problem here is not the consumer not buying its products. It's high expectations because the company beat on earnings, sales expectations, and even raised its full-year guidance. But after shares rallied 56% this year, investors are focusing on some small blemishes, but it's just another example of this market leaving companies with little room for error. John?
Crocs and cruises. I just can't. Yahara, thank you.
Crocs, cruises, and Coke.
I just can't.
Drink a Coke on a cruise.
With Crocs.
With your Crocs.
Wearing Crocs. Is that what you need?
I think so.
That kind of
Crocs
break?
are awful.
That sounds
Please
like a
don't
nightmare
ever
to me.
wear Crocs, Lisa.
Sounds like an absolute nightmare.
I used to have Crocs.
I think you still do, secretly.
You think that I'm a Crocs kind of gal?
I think so.
You know,
potentially.
Go ahead.
Potentially.
You have
There's
to be of a
nothing wrong
certain
with
age
it.
where they're only acceptable. Like my nephews like them, they call them fast shoes because they're in and out of the house, like they play in the
that's cute.
backyard. That's it. After 9 years old, no.
I'm still
There you go. Brownow's a child at heart. Nothing
We're
wrong
all
with
children
that.
at heart.
Aren't we just?
Yes.
Okay, let's talk about bonds, right?
Please.
Your 30-year bond yield hitting its highest level since 2007 as investors raise major questions over the Fed's ability to bring prices back under control. Kelly Kowalski of MassMutual writing a 25 or even 50 basis point hike won't single-handedly return inflation to 2%, but it could reinforce the Fed's credibility and help keep longer-term yields anchored. Kelly joins us now for more. Kelly, good morning.
Good morning.
Do you think they need to hike in September now?
I think this has become a lot more about credibility than actually bringing inflation down. If you look at what we saw going into the meeting, you had a decoupling in inflation expectations and oil prices. You had real rates rising. Why were real rates rising? They can rise for a number of reasons. Fiscal deterioration. Also, the market doesn't know the new rules of the game of this Fed, and I don't think we got that yesterday, which was part of the reason for the sell-off in the long end.
Do you think you can retain credibility just through speaking?
The market is telling us that's not going to happen. And it's interesting, right? Because during Warsh's first press conference, he said, we don't want the markets to listen to the Fed effectively. We want to listen to the markets. And it reminds me of the Spider-Man meme where it's like they're pointing at each other and it's kind of like who's directing who. And it feels like we're sort of in that paradigm right now.
At what point do you say that ultimately they've got to course correct? That ultimately the Fed has to come out and either hike rates or do some jawboning that's actually effective that brings long-term rates in and gives you actually a buying opportunity? I mean, at what point as an investor do you look past this perhaps communication error?
Well, I think a lot of it does depend on the data we get between now and September, right? We've got a couple more inflation reports. We've got a couple more job reports. But I think if we continue to see this sell-off in the long end, we see the 10-year, for example, breach that uncomfortable point, you know, approaching 4 3/4 to 5%. That's going to turn a lot of heads.
Do you think that at this point there is a threshold at which they have to hike, or else the market is going to see that much more of a yield curve steepening and that much more of a dollar weakening?
It's hard to really draw, I think, a line in the sand. And look at the market this morning. I mean, even sort of with the pressure on, long-dated yields, the market's been anchoring to positive, results for Microsoft, and futures are up. So I think from where we are right now, there probably needs to be more pain. You probably need to see inflation expectations also creep up more, because that's one of their key arguments, right, is inflation expectations remain anchored. So I think you'd have to see that as well.
When it comes to earnings, we just heard from another guest who said, when it comes to earnings, you have the fact that when it comes to CapEx, that's potentially what you want to see in terms of, what was it, facts? Something is facts, yield is destiny.
Thanks.
We had Microsoft come out and Meta, very different stock story. What are you expecting for the remainder? We have Amazon today.
I think what the focus is going to be on the cloud revenue, the cloud backlog, and the CapEx forecast, right? I think, we were very excited to see Microsoft's results. They kept CapEx in check. The cloud backlog grew. And if you look at the backlog between Alphabet and Microsoft, it's over $1 trillion. So the demand is there for these companies. I think the market just needs to see that delicate balance between the demand, the CapEx, and the monetization. And what Microsoft did was they really struck it on the monetization, both with the Azure revenue as well as the Copilot adoption.
And the communication. I think communication has been such an issue, not just for these companies, but for central banks too. It's kind of defined the week, going back to Alphabet. For tech earnings, indecisiveness has hurt you. For central banks, indecisiveness has hurt you.
Especially when there's so much at stake. When inflation's been running hot, and when CapEx is running hot, and when cash flow is running low, suddenly communication and the direction of travel matters a whole lot.
Kelly, it's good to see you. All I can see now is that, Spider-Man meme. That's all I can see. Kelly Kowalski there of MassMutual on this Federal Reserve, looking at the market, looking at a Federal Reserve that's confused, very confused in the last 24 hours.
Yeah, the player ref experience
didn't work, right?
It just didn't work. And I think that is the key point that a lot of people are taking away. You can't observe bond markets in a vacuum. You can't observe markets in a vacuum. It's like the Heisenberg principle. I believe that's the one where it's like when you examine something, you're actually influencing the experience. And that's essentially what you're seeing right now. A lot of people said the market was responding to what Fed officials were saying. This isn't necessarily some sort of clear crystal ball.
You're a player.
Exactly.
Right, that was Gapen's point. You're a player on the field. Now, I get that he doesn't want to be and is trying to remove himself from it, but that's introducing some volatility to this market.
You're not a referee if you set interest rates. You are a player. So it doesn't make sense. And maybe it would have been better if he just didn't do the press conference in the end.
But he's going to be doing press conferences for the rest of this year. So
yay.
You wanted them. I was ready to get rid of them. You wanted them.
You're blaming me. Innings.
You wanted them too.
I like watching.
Both wanted this.
Because I like watching them.
And you'll enjoy it. Every one of them. From New York City, thank you for choosing Bloomberg
Shut
TV.
It down.
This was Bloomberg Surveillance.
Trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
Let's talk about the significant risk transfers to find space in their balance sheet.
Hedging some of that risk.
You could look at it the other way. Obviously, this stuff is risk-weighted.
I would much rather be long than be short.
We're in a kind of sweet spot. Very, very strong alignment.
3 revolutions in one.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Every trading day, only on Bloomberg.
Very famous dogs you have, they look like balloon kind of figures to some extent. How do you make those?
In the case around 300,000 that I could manufacture. It's a large piece, over 10 feet long, or 12 feet long, 10 feet high. But it turned out that the fabricator came back to me and said, you know, Jim, I can't do it for 300,000. It's going to be 650,000. But eventually, then they raised the price again. And they finally brought it up to 1.6 million. And I told Eli that this is the reality of it. I showed him everything, and he ended up paying for the production costs.
Oh, hello there. Just wanted to say, Primer is back. We've been scouring the frontiers of science and technology to help explain the difference between the next gold rush and whatever this thing is. And in season 2, we're upping the stakes. More danger.
Now that is some high-grade uranium mineralization.
We used to have a stable climate on this Earth. Right now, we do not.
More science.
We're pushing the envelope of technology in multiple directions. Software, hardware, chemistry, physics.
The cable is, like, very cold.
And more CEOs that can nail the photo shoot.
Hundreds and hundreds of billions of dollars are at stake.
While the problems are economic, the solutions are too.
And yes, we will be talking about AI.
There is a lot of humanoid hype out there.
But our future doesn't run on hype. It runs on innovation. Watch season 2 on all these lovely channels.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Tyler Kendall in Geneva, Switzerland, and this is Bloomberg.
We rally after the Warsh and Zuckerberg pushback. 30 minutes until the start of your cash equity trade. I'm Danny Berger.
And I'm David Gura. Bloomberg Open Interest starts right now.
Coming up, Microsoft soars, Meta struggles, Apple and Amazon take the spotlight next.
Long bond yields climb around the world on concern that the Fed will fail to rein in inflation.
And Brent hovers near $90 a barrel as the U.S. launches new strikes against Iran.
Some stocks to watch this morning. Microsoft rallying after earnings signaled that its AI investments are starting to generate returns. Its cloud computing paying off. On the flip side, we talked about soaring, suffering. Meta delivering a disappointing quarterly revenue forecast, reporting the lowest free cash flow in years. And Qualcomm, that chip maker, giving a weak outlook, citing component shortages and rising costs, difficulties, Danny, with its supply chain.
We are in the midst of the busy earnings season. That's tech on one side. I'm looking at some of the consumer names this morning, David. Starbucks and Chipotle. They both raised their guidance after stronger than expected quarters, both of them rallying. Chipotle by 8.25%, largely thanks to trendy new items on their menu and revamped loyalty programs. Also on the consumer side, MasterCard reporting a 21% profit surge. They're expanding beyond its traditional payment networks.
Well, I want to turn back to the Fed now, if we could. Chair Kevin Warsh reiterating the Fed's commitment to tackling inflation.
Let me reiterate, there is no soft inflation target. There is no soft implicit target, not on this committee's watch. I don't believe that either part of our mandate is generally at war with the other part. Prices reacted in real time to incoming information, and the reduction in forward guidance may have been a factor. CapEx is preparing the ground for future growth. Nonetheless, the precise timing and magnitude of effects on the supply side remain hard to predict. The 5+ years of inflation above target cannot be cured in 9 weeks or by a single month of modest price decreases. This Fed will not waver.
Investors evidently struggling to understand what all of that meant. They're dumping 30-year treasuries after those comments from the Fed chair, sending the yield to a 19-year high. Well, fresh data this morning showed the U.S. economy grew at a weaker than expected pace, while the Fed's preferred inflation gauge cooled in the month of June. Joining us now is Michael McKee, Bloomberg's international economics and policy correspondent. Maybe we can dissect some of that language there in just a minute, Mike, but let's start with the GDP figures and what you took away from those numbers that we got this morning.
Well, the interesting thing about GDP is it was certainly weaker than expected, but a lot of that was in government and inventories. Consumer spending held up for the quarter. Now, the question is, where are consumers going from here? Because the numbers for consumer spending, the June number, was much weaker than what we saw for May. May was up 0.9, consumer spending up only 0.3 in June. So are consumers falling off? Disposable personal income down, and the savings rate has fallen significantly, 2.7% in June from 4.4% in January, and even higher in 2025. So that's the, I think, worrying figures in there. The PCE numbers for inflation were as expected, basically. We knew that they were going to be down because of energy prices falling, and in the month of June we saw weaker PPI and CPI, so no surprise there, but I'd keep an eye on what consumers are going to be doing going forward.
Well, when it comes to Chairman Warsh, I mean, why give forward guidance when you can instead talk in circles? It's something ironic that he comes out and says, look, the markets are finally playing the ball, not the referee. They're reacting to the data, not to us. And then as he's speaking, we get the biggest market reaction since April of last year, with 30-year yields reaching their highest in decades. How is the market interpreting this? Is this just a loss of confidence and credibility with this Fed?
I think so. You know, when he said that, I thought of you immediately, because Danny is a big soccer fan.
That is true.
And that was a World Cup reference, but I think a lot of people have made this point that the Fed is not the referee. The Fed is a player in the game. And that's one reason the markets are disappointed, because the monetary policy works through the markets. And you look here at what's happened in terms of the Fed hike rate bets. They dropped when the Fed yesterday basically said we're not doing anything today, and then they've come back down again for the 2-year, but and for September. But the numbers for beyond that, right now we're pricing in a full rate hike for October. And the point I wanted to make about that chart, by the way, is that it is cumulative. So the reason it dropped was because the July numbers fell out of it. There's a 65% chance. There was a 65% chance that the Fed would raise rates in September, and that's still the case.
Yeah, I mean, the Fed literally sets short-term rates. So in that way, it's like it's the striker almost, like it is scoring goals. It is making a difference. Mike, thank you so much for joining us.
So Kevin Warsh needs to wear number 10 on his back.
He does. Wow, really deep knowledge, Mike. I like that. He does need a number 10. Thank you so much, Bloomberg's Michael McKee. And we're going to get more on this morning's economic data and that Fed presser with White House National Economic Council Director Kevin Hassett in about 10 minutes time. Did you know that most like the star players wear 10?
Why is that?
I'm trying to remember exactly. There is some sort of lore that like the best players have 10. So when you're the best on your country's team, you try to get a 10.
Get the 10.
Get a 10 on your jersey.
Get one from Mr. McKee, maybe.
Yeah. I think he is the best player on our team. All right, let's turn now to tech. Microsoft soaring on strong cloud growth while Meta slides as CEO Mark Zuckerberg defends the company's AI spending.
Our investments in AI are accelerating every major part of our core business. They're improving the experience for people using our apps, driving better performance for advertisers, and helping our teams build new experiences and ship faster. Second, we are developing new personal agents that will be the foundation for our next wave of products and revenue lines in the months and years ahead.
Joining us now is Bloomberg Tech host Ed Ludlow. Ed, what did Meta get wrong that Microsoft got right?
Well, not necessarily getting it wrong, but they try to defend the transition to AI, which is a departure from the core business model of social media. And the story to this point has been, well, how is AI going to improve that core business? Now, basically what Meta is pitching is monetizing the infrastructure that they've invested in through cloud services, and not as simple as renting out GPU capacity, not as simple as just being literally a cloud player, but offering a pretty wide range of enterprise AI services on top of it. And there's like not that much line of sight to that. So that's a summary of what Mark Zuckerberg said. And, in an extension of that clip, he basically defended saying, like, we see this going in a good direction. The CapEx math was important. They lowered the bottom end of the range for the year to $130 billion, and the ceiling still $145 billion. But one part of that 9% drop is that, Susan Lee, the CFO, said, we're not going to say anything about 2027 CapEx. And so, that's the formula still for this earnings season. Growth in the quarter gone was good, 28% on the top line, but in the outlook for the current fiscal third, it just was tepid. It was in line to below consensus, and it wasn't good enough.
Ed, let me do something really shameless here, and that is steal a question from Lisa Abramowitz when she asked on Surveillance this morning, which is, what does Meta want to be when it grows up? And so we've lived through the name change and the emphasis on the metaverse, and here we are now with this giant AI spend. Is that at all clear from Mark Zuckerberg and his team, sort of where this company is in a year or 5 years from now?
I thought you were going to ask me why Playmakers were number 10. This is the issue, right, is that when you cover Meta from a sort of technology beat perspective, a lot of the CapEx story to this point was very closely tied to what they were doing internally. That's a really big story. So like to Wall Street, they're like, okay, capital expenditures is the investment. What's the ROI on the other side? But the companies have always said, we need this capacity for the work we're doing internally. There is not sort of a linear or direct line to revenue growth in the existing businesses. When Meta grows up, it wants to be a quasi or hybrid frontier lab and still have its existing social media businesses and have a hardware business, the modus operandi by which people engage with their AI in the smart glasses realm. That's a really good point that you've made, David, because they're trying to tell all those stories at once, while guiding like the direction of travel for CapEx is to make the most of that infrastructure that's being built.
So what then is the story that Microsoft told that the market is rewarding this morning?
Yeah, much easier. Cloud growth is excellent. 43% on Microsoft Azure. Its fastest pace of growth since 2022. But it's so much easier to compare and contrast Microsoft with Alphabet and maybe with Amazon tonight, in that Microsoft said, okay, this was our top line growth on cloud. And here are some other data points. So Copilot had 30 million installed seats. Let me check that. 30 million paid users at the end of the quarter. That's an add of 10 million from the March quarter. So they're showing tangible evidence that the net result of their AI investment is getting traction in the real world.
All right, Ed, thank you so much for joining us. Bloomberg Tech host Ed Ludlow, and don't miss Ed's interview with Qualcomm CEO, 11:40 a.m. New York time. By the way, Matt Maley of Miller Tabak writes in to say that Pele wore number 10.
Okay, all right.
And then since then, all the other top players have.
I see. They just want to emulate him.
Yeah, just to set
I would
the
as well.
record
That's
straight.
good.
Yeah, I agree. Let's bring in Anastasia Amoroso, Chief Investment Strategist at Partners Group. Not on soccer, I promise. Look, it feels like some of the key pillars of this market have gone missing. Oil isn't as cheap as it once was with the reignition of the war. We're questioning this Fed, and longer-term rates have become unmoored. And now this question around AI and the return is really coming home to roost. Does this make you any less bullish on this market to have these three key pillars come under question?
I mean, I think, yes, investors should question all of those things. And I guess on the margin, it does make us more cautious on the public markets. You know, first of all, on the price of oil, look, we don't know where this ultimately shakes out, 2 or 3 months down the road. And I think investors are still assuming that some sort of Strait of Hormuz reopening will still be the end result. And so for that reason, I think we're largely discounting the price of oil. So I probably don't see that as the biggest headwind to equities right now. The second thing on rates, it's interesting because what Fed Chair Warsh said is, I think he's happy for the bond markets to do the heavy lifting. And so if the bond markets are doing that, that's certainly going to spill over to equity valuations. And so, yes, on the margin, that does really kind of deter the S&P from perhaps having a greater breakout that it would have had otherwise. And then the last point on AI, I guess that's probably the biggest risk to the market in my mind right now, because, look, 50% of the S&P exposure in some sort of way is related to AI, hyperscalers, semiconductors, and so forth. And, part of why the trade has come under pressure is rates, but the other part is there's just more competition in terms of models. And Ed talked about the frontier models, but it's not just the leading open AIs and Anthropics of the world, but it's more and more China-based models. It's more and more just open source models. And so if all of a sudden, if your best customers perhaps are not seeing as much use of tokens, what does this mean for the demand for semiconductors? What if we don't need the highest, sort of quality semiconductors? What if we can do more with less? And so that really, I think, what investors are starting to question. And, to the extent that plays out, I think that does pressure the overall market.
There was a time when we were kind of frustrated with the Magnificent Seven as kind of a definition for all of these living under that umbrella wasn't working out as well as I think it was intended at the beginning. And I wonder if we're kind of going through the same thing with hyperscalers now, that there isn't kind of a unifying theme through a lot of these different companies, and maybe Microsoft and Meta kind of illustrate that.
I think one unifying theme is CapEx.
Yeah.
There's a lot of CapEx that all these companies are clearly deploying right now and putting in the ground. But I think what you're seeing is this bifurcation, and the case in point, Meta versus Microsoft, very different story, because one was able to show the monetization, one was able to show the trajectory of cloud revenue growth, and the other, sort of as you were pointing out, still struggling to find that path. And look, for hyperscalers, I think at the moment they might be in this precarious phase where, yes, credit spreads are widening because free cash flow is falling. But what's happening right now is there's a timing mismatch. You have to put a lot of this CapEx into the ground, and then the payoff is likely to come a few years down the road. Again, Microsoft seems to be on that trajectory, but I'm actually optimistic on hyperscalers, let's say 1 or 2 years down the road, because if that scenario I talked about earlier plays out, if we actually need perhaps less advanced semiconductors or pricing is lower, CapEx will decline for these hyperscalers.
All right, Anastasia, you're going to stick around with us. That's Anastasia Amoroso of Partners Group. Up next, Kevin Hassett from the White House National Economic Council.
Thousands of American Marines are heading to the Middle East.
Greece will not participate.
There's a very good chance we're going to end up in a deal.
He's looking at putting boots on the ground.
This is going to be a short-term excursion.
Trust Bloomberg for on-the-ground coverage.
Things are not de-intensifying.
A lot of fear here in Europe. Ukraine is being left out in the cold.
Up-to-the-minute reporting.
The Fujin report has been hit.
Missiles have struck the U.S. Embassy.
And the analysis you need.
The United States military has shown its might. Now it's time to please calm down.
Nobody covers geopolitics like Bloomberg.
Power Players is back to take a look under the hood of the business of Formula One.
Hi, I'm here to see Pierre Gasly.
Welcome to my workplace.
Do you feel pressure?
Massive pressure.
Ferrari is the best example that we can be very proud of the past to look after the future.
From the iconic brand setting the standard.
Oh boy.
Can you imagine Ferrari without racing?
No, and I say no, no, no.
To the newcomers forging ahead.
I grew up my whole life racing against the boys.
This global phenomenon continues to chart new territory.
This was a tennis court 8 days ago.
I can't even believe that. And the speed of the business has never moved faster.
My career might stop, but I'll still be driving something.
Yeah. Probably very fast.
Yeah.
This is so exciting!
This season, we're along for the ride.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at Japan's Akasaka Palace in Tokyo, and this is Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
It's Bloomberg Money.
This is the Asia Trade.
This is Wall Street Week.
Welcome to Balance of Power.
You're watching Bloomberg Deals.
Welcome to Bloomberg This Weekend. This is Bloomberg Television.
Welcome to our global TV and radio audiences. I'm Danny Berger alongside David Gura. Data showing the U.S. economy grew at a weaker than expected pace, while the Fed's preferred inflation gauge cooled in June. Let's bring in White House National Economic Council Director Kevin Hassett. Kevin, we can talk about the state of this economy in just a moment, but I want to begin with what you discussed yesterday. Yesterday, before this Fed decision, saying that you have full confidence in Chair Kevin Warsh. Now it is a market that is rethought, that is losing confidence with long-term yields pushing at their highest in more than 2 decades. And at the same time, economists giving counsel that they don't think that they are fully confident in this Fed either. Director Hassett, do you still have full confidence in Fed Chair Warsh?
Of course. And there's a natural transition time where a new leader comes in and tries to get the House in order. I think that, that there were 3 dissensions or 3 dissents, but that happened to Jay Powell in the past as well. The dissents all came from regional Fed presidents, not from the actual governors. And so it sounds like he's got his house in Washington in order. And we'll look forward to seeing how it's going forward. But I think that his job just got a little bit easier if you looked at the PCE data that just came out, which was actually a top line of negative, which is very unusual. Core dropped a lot. And so I think the inflation numbers have continued to head in the direction that we saw with the previous CPI number, which is an objective of the Fed, is to get those numbers down.
And we heard from him after the last CPI report not to look at one set of data discretely. But picking up on what Danny was asking about just a moment ago, there does seem to be some concern here that there is no clear reaction function at this time, no clear analytical framework from this Fed. Is that a concern to you? Is it something that you think that the Fed sure has to work to remedy here in meetings ahead?
Well, again, I think that the Fed's old political reaction function was based on outmoded science regarding the Phillips curve, and if you get a little bit of growth, then you got to hike rates. But that model assumes that the growth is coming from demand-side factors, and I think what Kevin Warsh has done is he's brought in a brain trust of some of the smartest people on earth to help rethink what's, given all the science we've had on what happens when there's supply versus demand shocks, what should the Fed be doing? And it's a lot different than what the Fed staff has been advising people to do over the last few years. And so I would say we're going to have a new, improved, and much better reaction function, and that's happening relatively quickly because Kevin's put some of the smartest people who've been working on this their whole career, like Karen Dinan at Harvard, to help him think about how to do that.
He might have his house in order, as you say, Director Hassett, but again, it's a market that is not in order. It is a long end yield, the 30-year yield, which yesterday closed at its highest since 2007 at 520. Are you concerned that this is a Fed chair that does not have control of these markets? Because, Director Hassett, that makes your life much harder. It makes this economy and consumers who want to buy a house, it makes their life much harder and you as you look at the cost of servicing debt.
Look, the bottom line is that Kevin Warsh was there before. He's an incredibly experienced guy. He's well respected and well liked by his colleagues, even the Democrats up on the board. And he'll do what the data say he should do, and he'll be independent. And the fact is that the data right now are taking the pressure off the Fed. And I think that the markets will get around to seeing that. Maybe they need another couple of prints like the one we saw today from PCE. But we should also talk about the GDP numbers today a little bit, because I think that they've been miscovered quite a bit. The fact is that final sales were up almost 4%. We had a big boom in consumption, a big boom in investment. We even had big positive housing numbers, and those were offset in the bottom line because the capital spending that we're doing is imported capital goods, which so you subtract imports from that, and then also because of technical changes in the price of oil, they revalued the oil inventories, and that's subtracted from GDP as well. So I think that the final sales number of 3.9 is really what I would say is the signal. So it's not a half full glass of GDP, it's a full glass.
Full glass of GDP. I want to pick up on something you said. You've known Kevin Warsh for an awful long time through Republican policy circles and certainly your time at the Hoover Institution. And I'm curious, I think an open question here is Kevin Warsh a hawk or a dove? What would your answer to that question be?
I think he's a realist, but he's really serious about getting inflation back to its target. That's his job. He's a very, very pragmatic person who understands the responsibility of the Fed is a dual mandate. And the part of the mandate that's been out of control recently is inflation. And most of that was not the Fed's fault. Most of that happened, or at least not directly, because remember what happened was that right after Joe Biden took office, we had this massive stimulus, even though the COVID episode had mostly ended. And that massive stimulus was like a helicopter drop of cash into the economy. The thing is that the Fed was in denial that would cause inflation for almost a year, and that's how inflation got out of control. But the stimulus that actually caused the inflation was the reckless spending by Joe Biden. And, I can promise you that this administration is not going to do anything like that.
I mean, again, Director Hassett, I would point out that we've had a lot of stimulus from this administration as well, be it COVID checks themselves or what we've seen in the One Big Beautiful Bill. Even so, it is a president who yesterday echoed what you're saying, his confidence in Chair Hassett, but at the same time said that it's a difficult task because this is a Federal Reserve who is political. Director Hassett, who is political at the Fed? Would you view the 3 dissents, as we saw, in favor of a hike? Were those political votes by those FOMC members?
Well, I can't climb inside the heads of those folks, but as you know, before Kevin came into the Fed, that many times even, on this network, I talked about the sort of befuddling movements of the Fed. So Joe Biden is stimulating the economy like crazy, and the Fed's saying it's transitory supply disruption, when obviously, I had interviews in May of that year where I said it looks like inflation is going to be around 7% because of the big chunk of demand that was being thrown into the economy by the Bidens. The Fed ignored that. They didn't really start tightening until Jay Powell was reappointed as Fed chair. And then they cut rates sharply right before the election in order to help Kamala Harris. When President Trump, in contrast, was elected, then even before he was inaugurated in the first term, the Fed started hiking rates in that December. And so that the patterns of their movements have been very, very suspicious. And so I don't want to speak to specific people, but those patterns are very suspicious. And I think that that's the kind of thing that's going to end now with Kevin Warsh.
Again, Director Hassett, I just have to push back against this. It's a Fed that cut rates since Trump's been in office. So I don't see how that is necessarily suspicious. I don't want to rehash the conversation we had last time, but that pattern's not there, as you say. Sure, they cut before Trump came into office, but it's a Fed that eased rates with Trump as president.
Look, the pattern I described is not in dispute. And, I think that what's going to happen going forward is that the Fed will be responsive to the economic data and be independent, because Kevin is going to be there and he's going to manage the people who would try not to be independent. And so I'm very, very bullish about the prospects of the Fed policy moving forward in the proper direction, the nonpartisan and independent direction.
I'm struck by how much we're talking about the Biden administration and looking back, and perhaps we can look forward here in the minutes that we have left. There's a war going on in the Middle East. There's still war in Ukraine. And we have an administration now for which you work that's imposed these new tariffs under Section 301. What do you say to American consumers who acknowledge the fact that the inflation level is higher than the Fed's target and are worried that those two inflationary issues could make inflation more troublesome, more nettlesome, or even go higher here in the months ahead?
Well, I think that if you look at the positive prints we've had for CPI and PCE, you can see that energy is just a small part of the inflation story. So we've seen drug prices come down because of Trump RX. We've seen our deregulatory efforts lower prices for just about everything. We've seen the great work of Brooke Rollins and the Ag Department help food prices get under control. The only thing everybody was talking about when we first got here was egg prices. Egg prices are at an almost all-time low because we've done a much better job managing the avian flu than the previous administration. And so I think the price pressure is easing all around, and energy prices have for sure blipped up again for a while. But I think that if you look at futures markets, they expect that to recover relatively quickly, and that's our hope as well.
Well, why isn't that what we heard from Chair Warsh? She talked about that inflation still being an issue. They're committed to 2%, said that they're watching it. Kevin Warsh did. Director Hassett, it doesn't sound like a Federal Reserve or a chair that's on the same note as you are.
No, I disagree. I said things are heading in the right direction, and that's reassuring for the Fed. And I think that he's saying that he still has work to do. And saying you have work to do and things are heading in the right direction, they're not contrasts at all.
Kevin Hassett, let me pull an audible here. You wrote a book in 2002 called Bubbleology. And as you look at the AI sectors we've been doing over the course of the morning, are there warning signs that you see that we could be in bubble territory here?
You know, the difference, I first no. And the difference between the dot-com boom of the 90s and what we're seeing now with AI is that the AI companies are actually making money. So remember back then we had insane valuations for firms that had yet to make any money at all. And so you can wonder, well, are they ever going to make money? Pets.com, are they ever going to make money? You know, it turns out the model of taking dog food to your house has worked pretty well for Amazon. But back then, you know, the early firms that were doing that, you know, they all went out of business. And so it ended up being that there was enthusiasm about the internet that in the long run was good enthusiasm, but it created a lot of failure, business failure. Here we've got like a few companies that have this remarkable investment that's increasing the productivity of firms all across the country, and they're charging their customers for the service in the terms of billions and billions of dollars. And so when you see real money and real success and real productivity growth and so on, then there's a rational explanation for why the increase in value is happening. Now, whether it goes too high or too low, that's something the market will figure out. But it's much harder to have a rational expectation for why things are going up when you don't see the money.
All right, Director Hassett, we really appreciate your time this morning, as we always do. Thank you for joining us. White House National Economic Council Director Kevin Hassett, thank you. Still with us around the desk is Anastasia Amoroso of Partners Group. Anastasia, Kevin Hassett there saying that he still fully has confidence in this Fed chair. What was your read after a Fed decision where, again, even though he said that markets were listening to the data, not the Fed, it was a huge reaction, a very, very big steepening from this bond market post that presser.
And I know one way to interpret that is to say, well, maybe the markets have lost confidence in this Fed, but actually there's two things that he said why the long-term yields may be rising. And one is because growth is actually pulling in the right direction. And I do actually agree with the assessment that growth based on this GDP print, I mean, the consumption is strong, CapEx is strong. So I do agree that if growth is going to be greater, then that warrants a higher real interest rate. And then the other side, of course, is inflation expectations. And I think that's where we have to be a little bit careful because five-year inflation swap, for example, moved lower post the first FOMC meeting that he chaired, and now it moved a little bit higher. So I think that's the undesired market direction. But look, I would give him time. I think he is playing for time, and I think he's going to run out of that time when it comes to the next meeting. But if you think about the next 6 weeks, you know, we're going to get 2 more inflation prints. And if the trend does continue that we saw in June, then maybe that gives him cover to not actually hike interest rates. I also do think that he actually revealed the reaction function as a central banker. He said, as a central banker, if you're not worried about the labor market, and we do think it's stable today, if inflation is going up, you raise interest rates. If inflation is going down, you lower them. So if he sees inflation go down in the next couple of months, perhaps that doesn't actually pave the way for rate hikes.
I have about a minute left, but Kevin Hassett, mentioned the task forces that Kevin Warsh has convened here, and one of them has to do with inflation and looking at inflation. So as we look at the PCE read today, there could be a world in a few months' time in which that isn't the Fed's preferred gauge for inflation again. How does that change your perspective or the way that you look at inflation, knowing that it might not be the one that they're going to use here in the future?
You know, look, clearly this has been the yardstick for a long time, the official one. But at the same time, unofficial, I think all of us as a market community have been looking at a range of metrics. And this has been a conversation for a long time that if you look at real-time, real-world inflation data, it might be showing something different versus what we have in the backwards-looking data. In case in point, one of the biggest reasons why inflation is still above 3% in the case of, core PCs, because of housing. If you look at the owner equivalence rent, they're running above 3%, but is that the reality today? Because if you look at Zillow, if you look at CoStar, those rent increases are running -1 to +1%. So is it possible that once we adjust for the real-time data, that real inflation actually comes down? So I would not be surprised if we started to have those conversations in the fall. And look, looks like there's going to be a flurry of activity from the Fed in the fall.
Yes, there is. Hey, Anastasia, stick with us. Let's first get through this market open and some earnings conversations as well. The S&P and NASDAQ rebounding this morning. It is thanks to Microsoft. Without this, we might be looking at a very different picture after that sell-off, a correction for the NASDAQ after Chair Warsh, and again, disappointment from Meta, but Microsoft outweighing it. Down at the New York Stock Exchange, we have Charlie Morrison and the rest of the team at Jersey Mike's. They're IPOing today. And come on, Danny DeVito, the real star. Put him in the middle of the Jersey Mike shot, I say. I will be down at the New York Stock Exchange at around 2:40 p.m. today to interview the CEO of Jersey Mike's as their company starts to trade. We have a boxing group here. There's some merger going on. Look, I don't like stereotypes, but, like, come on. This guy looks like such a boxer. Like, he's from the north somewhere in England. Maybe, I'm sure. He's probably not. I'm probably going to need to, like, dig myself out of this hole. But, yeah, it's a merger of a boxing promotion company ringing the bell at the NASDAQ, which is pretty cool.
It's very cool. I want to look at just a handful of the movers we've been watching over the course of this morning. Of course, this contrast is the most evident one, that between Microsoft and Meta, both of which reported earnings yesterday. We see Microsoft here up more than 11% this morning on news that its cloud computing here has yielded results in a way that it hasn't for other companies. Case in point, Meta Platforms. And we had Mark Zuckerberg yesterday defending his company's strategy going forward here. But markets clearly thinking that that's lacking, not getting enough meat on the bone from Mark Zuckerberg. That's for what Meta's plans are as we see this enormous capex from that company. And then lastly, just pointing to Qualcomm here, down almost 5% this morning. Qualcomm, of course, the chip maker used in so many smartphones across around the world, I should say. It's suffering here from supply chain issues. We see it down about 4.4%, Danny.
Some other earnings results that we're also watching this morning. MasterCard, they reported a 21% surge as the company expands beyond traditional payment network services. Chipotle and Starbucks, both of them raised their guidance after stronger than expected quarters, thanks to trendy new menu items and and revamped loyalty programs. All those stocks up across the board. But let's dive deeper into Starbucks. Romaine Bostick, co-host of The Close, is joining us this morning alongside the CEO of Starbucks, Brian Niccol. Romaine.
That's right. Brian Niccol joining us right now, fresh off of last night's earnings report, 7.9% comp growth. Brian, obviously the street likes what they hear, but I do need to get a little bit more color as to exactly where that is coming from. Transactions, 4.2%. That's foot traffic, Brian. Is that just favorable comps, or are you truly getting more people into the store?
Yeah, no, great to be here. And look, the reality is what's terrific to see is the growth is coming from more customers coming into Starbucks more often. And, you know, that's just a foundational strength. And the good news is we're seeing it across all income groups and really all age groups. So just really terrific strength moving through our stores.
With regards to the tickets as well, that was also up about 3.5% in the most recent quarter. So it's a function of both foot traffic coming into the store, but also people spending more. Are they buying more? Are these add-ons? What gets that ticket price up to that 3.5% jump?
Yeah, so what you're referring there is we're seeing people add more food, so a higher attach rate. And then what we're also seeing is people modifying more of their drinks with things like our cold foam, adding an espresso shot. So it really is terrific to see people using our menu to get them the customized experience that they want out of their drink, and then also attaching what is really some terrific food to go along with their beverage.
Do you have any concerns about maintaining this momentum? And I don't necessarily mean that from an operational perspective. We just got a GDP report for the second quarter, backwards looking, much lighter than what folks had been looking for. Consumer spending holding up right now, but you've referenced in the past that you had seen some strain, at least amongst the lower income consumers. Are you concerned that some of that weakness might be spreading beyond just the lower income folks?
You know, actually, we're seeing strength across all income groups at Starbucks. And, you know, what we continue to see is when we give people a great experience, they come back more often. And when we do it consistently, they really reward us with their business. And so, you know, we've not seen the customer move back as it relates to Starbucks. They've been really resilient. We're very optimistic about where we're headed. You know, we exited the quarter with really strong performance, and we're excited about how we're heading into our fourth quarter, and we're really optimistic about the plans we have for 2027. So, you know, look, we're just getting started. It's great to see the strength across all of these customer, you know, demographics, and we're confident we're going to continue to have success with them.
Well, let's talk about 2027. Obviously, we've seen the revenue numbers, at least I say the sales numbers start to come up a little bit. There's still some concerns about whether we could see more meaningful profitability. How much of the lag between those two is tied to the revamp of the stores? I mean, you've done 1,000 so far for this fiscal year. I think you're, still guiding towards 1,500 for the next fiscal year. There's a huge cost attached to that, right?
Well, you know, look, I think the thing that we've done here is we were really smart about what we spent on these uplifts and the implications on the store. So, you know, we can do these things for roughly $150,000. We do not close the store at all, so operations continue to perform. And then the experience that our partners have, because now they've got a new, really great looking coffee house, and that what our customers have results in, you know, frankly, more transactions. So it's been a great program. We'll continue to push the program forward. We're going to accelerate it into 2027 because we know when we create a great coffee house and we have that great partner / barista to customer experience, we're rewarded with more business. And, you know, it's not a big investment, but it's a meaningful investment, and then it gets us great results.
Is there any way you can share with me what the difference in comp sales is for a revamped store relative to the stores that haven't been uplifted?
You know, we haven't shared that publicly, but what I can tell you is we see a move in a positive direction as it relates to transactions. And because of what we're seeing, we are accelerating the program.
I think the last time we talked with regards to transactions, you talked a lot about improving the in-store experience by also improving the speed of which those orders get out the door, whether it's in the cafe or in the drive-through. I know there was some color on the conference call about some of the time that you shaved off of that. We're talking seconds here, but it seems like those seconds matter to you. How much progress have you made?
Yeah, look, this is one where I'm really excited because we set out right from the go that we wanted to improve the speed that our customers experience and then do it consistently. And kind of behind that is really this drive towards more throughput. And we've seen just that. So we've got better throughput in the mornings. We also have better throughput in the afternoons. And frankly, as a result, all day long, our transactions are up throughout the day. And when you kind of pull that back, yes, customers are loving the experience, but our partners are doing a great job of being staffed as a team, deployed correctly, and then consistently executing the Green Apron service model, which then results in better speed at the drive-thru, better speed in the cafe, more on-time and mobile order pickup, and frankly, pretty good speed in the delivery channel as well. So it is having the effect that we would want, where in totality, the Starbucks business now, I think, is providing people the great experience that they want at the speed that people need based on the occasion where they're visiting us.
Is there any conflict, though, with getting that number down in terms of the time down and this idea of these add-ons and other things that I would assume would complicate the process for the baristas just a bit?
Yeah, look, we're very intentional. So everything that we do, we have an eye towards what is the implication on our ability for our customers to get the product, the food that they want in the speed terms that they desire. And we also have a really close eye to make sure that our partners are set up to be able to provide the customization, the drink, the craft, the way that they would want to do it themselves. And so, that is part of our development process, and that's part of the rigor that we go through to make sure before it gets to the store, it's been vetted such that we know we can still deliver on the great experience at the speed that our customers expect.
You've introduced a lot of new products. I know you even talked on the conference call about a s'mores drink, not necessarily my bag, but I can understand why some folks might like it here.
Have you tried it? You need to
not
try
yet,
it.
Not yet. I have tried the orange cream, and it is good here. But, and look, I mean, probably the s'mores drink isn't targeted towards my demographic. I mean, you've clearly gone after the younger demographic with the Gen Z, the pink drinks, the s'mores, et cetera here. But with these types of drinks, the complexity that maybe adds to the process, but also this idea, if these aren't going to be permanent menu items, just sort of limited time offers, do you run into sort of some issue in terms of sort of how you forecast out comp sales growth if s'mores might be gone in, whenever, a few weeks or whatever?
Yeah, look, I think the menu innovation that comes out as like limited time offers versus the menu innovation that ends up being permanent on our menu, they serve two different purposes. And yes, we're able to forecast this with accuracy. I mean, as a result, I think you saw in the release, our supply chain, we're 99% of the time in stock with the items that people want. And I think if you look at our beverages, it's almost close to 100%. So we are able to forecast correctly, supply it correctly, and then most importantly, we build it in such a way that our partners are able to do it consistently and give people the experience that they want. And as you mentioned, like the orange cream cold foam that's going on, the cold brew. I mean, look, the good news is, yes, it's orange cream, but it's exactly the same way that we always do cold brew. It's exactly the same way that we always do cold foam. So the consistency, the standardization of the builds so that people can get to the quality experience that they want at the speed that we know they desire is really important to the work that we do on this.
What's the best-selling product out there right now?
I mean, look, we still are selling, right now, our ice shaken espresso is a huge popular drink. Our Americano is a very popular drink. Obviously, the iced caramel macchiato is one of our top drinks. Matcha lattes is a top drink. So the good news is it's not just one item. We actually have the breadth that I think really resonates with people's palates.
I do have to ask you, Brian, about a report that Bloomberg had about 3 weeks ago, citing internal documents, that you were actually looking to replace some of your in-house software tools, particularly those made by Microsoft and IBM. Your chief technology officer has talked a lot about how he can maybe get some of those software costs down. Any credence to that report?
Yeah, look, I think you would expect us to be looking with a critical eye towards any product that we use and whether or not we're getting the best cost proposition, and also are we getting the best outcomes from that proposition. And that's basically what we're doing here is we've got some great partners, but at the same token, we need to make sure that we are getting the best output for the best pricing. And I think, as probably everybody's doing with the advent of AI, it gives you an opportunity to rethink what we're doing and how we're doing it. And, that's literally the exercise that we're going through. And I think you would expect that from all organizations to have the cost discipline tied to making sure that you're getting the right outcomes that you want.
Well, that cost discipline is obviously also increased the amount of cash you have on hand. At the same time, your debt obligations are down. Where's that cash going to go? Is that next dollar going to go to buybacks? Is it going to go to acquisitions? Is it just going to go back into the stores?
So the good news is for us, as the business continues to recover, the balance sheet gets stronger and stronger. It gives us terrific opportunities to invest in growth. Obviously, some of that growth is going to be the store remodels and then obviously building new stores. And then we'll look around to figure out what is the right next growth vehicle for us. Buybacks may be part of it. Obviously, we've got a dividend that has always been there. So we're always thinking through what is the best way to deploy that cash so that we get growth in the business and get a great return for our shareholders and all of our partners.
Hey, Brian, appreciate it, but I need you to do one last thing for me and settle a debate that my niece wanted me to ask you. When officially does pumpkin spice season start?
It's coming. Get ready. We're not too far away, so I'm anxious for it as well.
All right, Brian, really appreciate you taking time for us. Brian Nichol there, CEO over at Starbucks. Danny?
I think the answer is it's like Christmas. It comes earlier every single year.
I just assume Starbucks, they just have this cabal. They just meet in closed-door rooms and decide when it's time to finally unleash the pumpkin spice.
Now is the time. I love this. This is the best conspiracy I've heard. Romaine, thank you so much for bringing us that excellent interview. That's Bloomberg's Romaine Bostick with Starbucks CEO Brian Nichol. Thank you all both so much. Anastasia Amoroso of Partners Group is still with us. Pumpkin spice and s'mores and all. The consumer is willing to pay up, I guess, for really sweet, sugary drinks that maybe are not Romaine's bag. But you have those earnings and contrast it with P&G still struggling, not being able to get consumers to pay up for labeled products. What is your read on the consumer thus far this earnings season?
Look, the read on the consumer is that the consumer continues to spend. The consumer continues to have the means to spend. And like we just heard the CEO of Starbucks say, is the consumer across all categories is actually boosting their spending to varying degrees, certainly higher at the top end, lower at the low end. But I think that's sort of the norm. What I would say, if you look at the performance of the consumer discretionary index, it sort of hasn't gone anywhere this year. But underneath, you have a lot of winners, you have a lot of losers. And when I think about our business, when I think our private equity portfolio and the consumer companies that we have, we actually kind of do cater to this K-shaped recovery. On the one hand, we may have a Breitling brand portfolio company that clearly caters to the ultra luxury segment. And on the other hand, we've invested in the cat food business. And fun fact, there's 75 million cats in the United States, and apparently that number is greater than the number of dogs. As you know, in New York, for example, it's pretty hard to have space to host a dog. So, so the cat food business has been growing very nicely for us. And so I think the point is that, if you lean into certain themes within the consumer, if you follow certain trends, I think that's really the way to approach investing in that segment versus just expecting the overall index to perform.
Let me dovetail what you just said with what we heard from Kevin Hassan, what we saw in the data this morning. And I'm curious sort of how long you see the resilience of the consumer lasting. I brought up with him the fact that this war is ongoing. Energy prices are higher. There are new tariffs in place, and we have midterms coming up here. There are a lot of factors here that I think could, if not lead to uncertainty for the consumer, be a real drag on them as well.
One reassuring thing that I heard from Chair Warsh yesterday is that he's not trying to bring down aggregate demand. And, that was sort of the concern going into the press conference, because if you're trying to bring down inflation, probably the best way to do that is to raise interest rates and bring down demand. But the fact that he's not doing that, that's quite reassuring. So that tells me that maybe we can continue to have the unemployment rate around 4.3%. We can continue to have wage growth at around 3.5%. If you think about it, that's not a bad place to be. If inflation is running at 3.5%, hopefully getting lower, that means in real terms, consumers still have spending power that they can allocate. So I actually think that's the tailwind that we have. And the tax cuts are still working their way through the system. And as long as we have strength in corporate spending, CapEx spending, which we do have, as long as we have record corporate margins, which we also have for the S&P 500 companies, I think all of that fuels kind of the strength of the consumer as well.
Anastasia, we're going to have to end it there. Thank you so much for spending this morning with us. Really appreciate your time. Anastasia Amoroso of Partners Group. Let's get a check on your equity market about 15 minutes into your trading day. And it really is Microsoft that's lifting up this overall index. We're now trading higher by 1% after falling yesterday on some of these tech and AI nerves and what we heard from the Fed. Microsoft itself is adding 50 points to the S&P 500, which itself is up 79 points. Rallying 15%. Just a huge move for such a large cap company. Micron and all of the other chip stocks doing well in today's trade too. Amazon, they'll report earnings after the bell today, rallying ahead of that. Apple, though, is down ahead of their earnings. They've had a good run. They just barely kissed $5 trillion in market cap, now trading back below that, dropping 2%. But the real drag on this index is Meta, down 9% after some confusion over just exactly what Mark Zuckerberg wants to do with their AI business. Are they becoming a neo cloud? Are they using that capacity for themselves? Overall, that's translating into a market where tech is up because of Microsoft, because of how the chip players are moving this morning. If we look at the various sectors, communication services, though, that will be at the bottom because Meta sits in this category. I feel like we need to redo sectors again, just given how these hyperscalers have changed. Consumer discretionary, industrials, those are doing well. Staples, healthcare, so it's a real kind of like safety trade that is unwinding that we saw yesterday. So it's full risk on this morning, David.
All right, coming up here, we'll speak with analyst Michael Nathanson as Meta investors look for clearer signs that its AI bets are indeed paying off. This is Bloomberg Open Interest.
Hello there. Just wanted to say, Primer is back. We've been scouring the frontiers of science and technology to help explain the difference between the next gold rush and whatever this thing is. And in season 2, we're upping the stakes. More danger.
Now that is some high-grade uranium mineralization.
We used to have a stable climate on this Earth. Right now, we do not.
More science.
We're pushing the envelope of technology in multiple directions. Software, hardware, chemistry, physics.
The cable is like very cold.
And more CEOs that can nail the photo shoot.
Hundreds and hundreds of billions of dollars are at stake.
While the problems are economic, the solutions are too.
And yes, we will be talking about AI.
There is a lot of humanoid hype out there.
But our future doesn't run on hype. It runs on innovation. Watch season 2 on all these lovely channels.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo. And I'm Christina Raffini. We're tracking breaking news today from Wall Street to Washington. Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
Bringing you up-to-the-minute space news whenever and wherever it happens. I'm Ed Ludlow at NASA's Kennedy Space Center in Florida, and this is Bloomberg.
What is going to be the consequence for U.S. markets?
We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
At 9:30 a.m., the market tells you what it's really thinking.
We beat the drum to the opening bell.
With deep analysis of the forces driving the price action.
Focusing investors on what really matters.
Where the money flows, which markets are changing.
Conversations with players shaping the narrative.
Innovative growth companies gravitate to NASDAQ.
It's not just like, let's buy the Mag 7 or AI. That's a really compelling story.
This is where your trading day begins.
And this is Open Interest.
Only on Bloomberg.
Meta is slipping after a softer outlook and higher spending forecast. Analysts say investors still want proof that the company's massive AI investments are paying off. MoffettNathanson's Michael Nathanson lowered his price target on the stock, saying investors need proof points that Meta AI investments are working. And he joins us now. Michael, great to have you with us. Going through your note this morning, there's a point that you make, which I want you to reiterate here. That is, this goes beyond a company or a chief executive having a failure to communicate or some communications issues. This is more deeply rooted than that.
Yes, it is. People have been saying, look, this is just fixed by a good conference call or maybe a podcast. The issue is as you move into these new businesses that are not tied to your core ad-supported businesses, you're facing new competition. You've no history of success here. So you need to give us proof points, evidence that these bets are showing some signs of returns, right? It's so early in the process. But I just think, look, we're in a strange place where we're all relying on the company to allocate capital really, really well without getting any data points back of how the roadmap is moving in terms of ROIC basis.
So Zuckerberg can't just don a new chain or a new haircut and solve this problem for the market, because the market is punishing them for not having that clear message. Michael, I mean, was there any takeaway you got from what direction Meta is going in? Are they going to be a neo-cloud player? Are they going to use the capacity for themselves? Did you get any sense what the direction of travel is for them?
Yeah, good question. It was reported heading into the quarter that they were approached by Anthropic, I think, to do a $10 billion deal over a couple of years. They acknowledged on the call that they've been receiving offers for their compute, and they may, depending on the offers, depending on their own internal use, accept some of those bids. It was very vague, right? And the point is, in 26 and 27, they're still capacity constrained, but they're saying in the out years, maybe they become more aggressive in their build out and use some of their compute power for third parties, right? So they didn't go all the way to say we're going to be a hyperscaler, but they opened the door to say that if we can't use the compute ourselves, we will rent it out. Now, the question I asked in the callback with the CFO is, look, at some point, the bottlenecks of compute will probably ease and everyone's going to overbuild. And then at that point of overbuilding, the idea of getting these premium rents for compute may fall apart, right? We've seen this in other types of markets. So the problem we have is we have to wait to 28 to see really what the CapEx is going to look like to power this new hyperscaler model. And then we'll see what demand looks like, right? So it's put, no pun intended, a cloud over the story, because you have to wait for the more details of CapEx spend and then some evidence of what they're going to do on the hyperscaler side.
Some opacity there. I want to turn to history if I could, and I wonder what lessons we can learn from the last time Mark Zuckerberg took the company on an errand in the wilderness like this. So we saw him go all in on the metaverse, legless virtual bodies and all. And we saw the market reaction to that, the skepticism that was inherent there at the beginning. Can we take any lessons from that? Is that a playbook that's useful here this time around as he gets into AI?
Yeah, so I've maintained a buy on the stock, and I knew this was going to be rocking. I kind of kicked myself for not being a little bit more cautious. But here's what I've learned, right? In 2022, there were two things going on. There was the metaverse, and there was a shift from Instagram and Facebook's stories to Reels, short form video, which they were looking at TikTok as a model. If you go back to 2022, the stock bottomed out at $100 a share. And people had real doubts about can they convert to more of a TikTok model. And they did really, really well. At the same time, the metaverse has not paid dividends. But this stock in 2022 was on sale. People were so negative. And it was a 7-bagger from 2022 to 2024. So what I've learned is, look, these guys build great products. Zuckerberg does have an amazing track record of figuring things out. And we have to be a little more patient, but it's not a great feeling to kind of fly blind and wait for some data points from them to prove that this is working, right? But that's why we kept the buy on, because we kept the buy on 2022. That was the right call, way back
Hey,
when.
Michael, I hate to rush you, but we only have about 45 seconds here. You're willing to be patient, but is this market, considering what's different this time, is they've already made a mistake in those years past and having to do a pivot for 2022? Will the market be less patient this time around?
Yeah, it's a great question. The metaverse is hanging over us too, because if people feel like they've turned a blind eye to the metaverse spending, so I think some of the grace they've had in the past has worn out. So that's a really great question, and that's why the stock is trading below 17 times earnings next year.
All right, Michael, thank you so much for joining us this morning. Michael Nathanson of MoffettNathanson. Coming up in hour 2 of Open Interest, Joanne Feeney of Advisors Capital. As markets digest those big tech earnings, Derek Wood of TD Cowen reacts to Microsoft results, and the CEO of Kendra Scott joins us about AI adoption in the jewelry industry. He'll tell us what exactly that means. All of that coming up in hour 2.
As an exchange, what can you do to make it more attractive to be a publicly traded company?
Talk to our customers. We spend a lot of time with our listed companies, listening to their concerns, particularly the offices of the CFO, head of IR, listening to their pain points, general counsels as well, and then act as an advocacy group for those companies to really focus on structured reform to allow a company to tell their story in the most efficient way possible and reward them for the good disclosures that they are making in the market.
Is there any sort of financial innovation that you could drive to get more companies to list? Tokenization has come up.
Well, we did announce our tokenization initiative earlier this year. We already built the technology, we've already done a variety of proof of concepts. It allows for instantaneous settlement, 24/7 trading. It importantly allows for the rights associated with a share to move into that electronic form, but is going to be a platform that runs in parallel to our more traditional exchanges.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Joanna Bersecci in El Ola, Saudi Arabia, and this is Bloomberg.
From ABC News, I'm Sherry Preston. A new gauge of the prices we're paying, in part because of the war. The inflation gauge favored by the Fed shows prices 3.7% higher in June than they were a year ago. Here's ABC's Elizabeth Schulze.
We are seeing oil prices spike again as the war escalates. The national average for a gallon of gas now $4.08. That's back where it was in June before the ceasefire was announced. A year ago, about $1 lower than this. And a new estimate this morning from Moody's Analytics shows that the typical American household has now spent an extra $672 in gas, diesel, home heating, and jet fuel expenses combined since the start of the Iran war.
The nation's economy growing from April to June at an annual rate of just 1.5%. However, stocks are bouncing back this morning after the Dow had its worst day in more than a year on Wednesday. Overnight, U.S. forces striking again, and Iran aiming at bases housing U.S. troops as the relative lull in fighting appears over. ABC's Rachel Scott is at the White House.
Israeli Prime Minister Benjamin Netanyahu, who launched this war with the U.S., issuing this warning in an interview with our Lindsay Davis.
If Iran does strike Israel, how will you respond?
I think they'll make a terrible mistake and will respond very, very forcefully.
Netanyahu has also been less optimistic than President Trump that a deal with Iran could ultimately be reached.
Republican Senator John Cornyn saying on his way into the Capitol today he's no closer to getting confirmation that the $1.8 billion anti-weaponization fund and protections for the Trump family from audits set up by the IRS will be scrapped. He says he needs that before he will vote to confirm Todd Blanche as the next Attorney General. Actor George Clooney now says he and his family were among the hundreds of thousands of people who had to evacuate in France ahead of raging wildfires. Dow's up 370. This is ABC News. The family of Nolan Wells, the teenager who died after a night with friends at a barrier island off Mississippi on the 4th of July, is sued.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney.
How do you think the Fed is looking at tariffs, the uncertainty of tariffs?
Let's take a look at the sectors and how they performed.
A lot of investors getting whipsawed every day by news events.
Breaking market headlines and corporate news from across the globe.
Could we see a market disruption, a market event?
Are people just too exuberant out there?
You see some so-called low-quality stocks driving this short-term rally.
Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio, Originals, and the Bloomberg Business app.
Good Thursday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. We are streaming live on YouTube, streaming live on Bloomberg.com as well. Markets rebounding today after yesterday's sell-off with the Fed announcement. Coming up here, Anurag Rana is going to break it down, some of these tech earnings. He's a senior tech analyst at Bloomberg Intelligence. We'll talk to him about Microsoft, and we got a lot of other earnings coming out there. We had Amazon and Apple after the close today. Tyler Kendall, Bloomberg News Washington correspondent, will get the latest out of the Mideast. Nancy Tengler, CEO and CIO of Laffer Tengler Investments, will join us to give her thoughts on the market. And then a good one, David Kirkpatrick, founder of Techomedy. He's the expert on all things Meta. Meta selling off today while Microsoft's trading higher, giving that the divergent view of AI. So a lot coming up here today. Scarlett Fu and Paul Sweeney, and this is the Bloomberg Intelligence Program. Bloomberg Radio is introducing a new feature exclusively for Bloomberg.com subscribers and terminal clients. Participate in our wall-to-wall coverage of earnings today at 4 p.m. Eastern by submitting questions for our analysts and experts to answer live on air. Subscribers can go to Bloomberg.com/AskRadio to send in questions. Then listen on Bloomberg Radio and watch on Bloomberg Originals and YouTube at 4 p.m. Eastern. So some new stuff coming up, some cool questions coming in. It's all good. You can participate. Right now, let's kick this whole thing off with John Tucker and a Bloomberg Business Flash.
All right, Paul and Scarlett, this Bloomberg Business Flash brought to you by IBKR. Trade, election, climate, and economic outcomes with IBKR prediction markets right alongside your stocks and options. Earn interest in your position and receive $1 per contract if you're right. Learn more at ibkr.com/predictions. Well, as you said, Paul, after yesterday's Fed fright sell-off, major stock averages higher right now. And, yeah, information technology, the best performing of the major industry groups in the S&P 500. And the semiconductor stocks getting a lift. Lam Research, for example, that's actually the best performing stock in the S&P 500 right now. It's up 22%. The semiconductor index, the SOX, up over 7%. Microsoft earnings, it looks like they got the memo on AI spending fears. That stock 15% higher. Mark Zuckerberg at Meta may not have gotten the memo. Meta is now down 9%. And if you've been asleep at the wheel, Amanda Agati at PNC says, yeah, the big theme for tech earnings should be pretty clear by now.
Investors really want to see an acceleration in revenue growth, and companies hold the line on CapEx. This idea that AI CapEx is going to continue to outpace return on invested capital, or however you want to describe it in terms of the metric, is just something that investors are really getting paranoid about.
S&P 500, 90 points higher, up 1.2%, 7406 on the index. The Dow, up 326 points. That's a rise of 0.6%, 51,914 there. NASDAQ 100 up 772 points. That's a rise of 2.8%. Let me do yields after they popped higher from Kevin Warsh yesterday. The twos down right now 4 basis points, 422. The tens down a basis point, 466. 30-year up a basis point, 521. Can I just sit on the beach, read my books, collect 5.2% interest? Maybe.
Might go up even more.
Silicon Valley back on top as America's luxury housing market. The AI wealth and, the IPOs sending median home prices. Let's pick on Atherton, up 20%.
Town. Awesome.
$10 million in the first half. This is the average. You got to be kidding me. The median home price, $10 million in the first half.
There are big houses out there, John.
Well, oh yeah, okay. So it's the most expensive zip code now, ahead of Fisher Island on Miami.
Yeah.
So, yikes.
Palo Alto's right there. Beautiful. You can get into the city.
What's the mortgage? What's a 6% mortgage on $10 million house?
It's a jumbo mortgage.
Yes. We check the markets all day long right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Scarlett and Paul.
All right, John. Thank you so much. Appreciate that. Scarlett Fu and Paul Sweeney live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. Stocks are higher, as John was reporting, particularly the NASDAQ. Let's take a look at some stock movers out there. We can do that with Judy LaGrue. She's a reporter for Bloomberg News, joining us here in studio. Judy, what are you looking at?
Good morning, Paul. First, looking at Meta, ticker META, the stock is tumbling as much as 10%. It is on track for its worst day since last October, and it's on its 11th day of a losing streak that has not been matched since 2012. Wow. So this is coming after Facebook's parent company gave a revenue forecast that was disappointing to investors, but it also reported the lowest free cash flow in 4 years. The company raised the low end of its full year forecast for both CapEx and total expenses, adding to concerns about whether or not spending on AI will translate into better growth. Mm-hmm. Yep. And so, Evercore analysts specifically were noting the lack of clarity on CapEx spending. And we're seeing, again, sort of the tale of two cities here. We're getting a lot of really positive feedback, of course, with Microsoft and how it's really been able to take its cloud revenue and really increase it without taking its CapEx too high. But then Meta, on the other hand, it's really signaling ballooning AI expenses. So looking at that.
Yeah, it's an interesting comparison, Microsoft and Meta, and the messaging around that. We're going to have Anurag Ron in just a moment. He'll break it down for us from Bloomberg Intelligence. What's next?
Sure. Teladoc, ticker TDOC. The healthcare company's shares are slumping as much as 27% today, which puts it on track to reach its worst day in over 4 years. So this is the virtual health care provider that's behind the service BetterHelp. And analysts at Truist said that investor expectations were centered around signs of stabilization for BetterHelp, but instead the company meaningfully reduced its revenue outlook for the BetterHelp segment as the decline in U.S. cash pay business accelerated faster than anticipated. So Truist analysts are really noting that insurance growth for BetterHelp is not yet sufficient to offset the accelerating deterioration in cash pay the business is receiving.
All right. Last stock that you're watching, Judy?
Sure. Chipotle, which is right down the street from us, ticker CMG. The Mexican restaurant operator is rallying as much as 14%. It's on track for its best day since April 2023. This is coming after the restaurant chain reported comparable sales for the second quarter that beat analyst estimates. The company also boosted its annual guidance after bringing back its popular honey chicken. Has anyone here had it?
No, but I am a huge Chipotle fan. But I go, I'm
Sounds like Judy's like offering to go get lunch.
I mean,
3rd Avenue, 63rd Street. I mean, I'm just saying.
Maybe I'll bring it
Matt
in.
Miller is famous for that, for just doing a food run and bringing stuff in.
Oh, that's nice.
But I don't know where Matt Miller is today.
Matt Miller's on paternity leave, so it's going to be a while before he brings in food for us.
All right.
We miss you, Matt.
Oh, yes.
Very good. All right, Judy, thank you so much. Appreciate that. Judy LeGroux giving us the breakdown on some of the stocks on the move today. And for more conversations like this, subscribe to our Stock Movers Reports. Listen for 5-minute audio reports on the biggest winners and losers in the stock market. Subscribe to Stock Movers on Apple Podcasts, Spotify, or anywhere you listen. Big moves in the stocks, as Judy was just mentioning, some of those tech names. Microsoft, okay.
Meta, not okay.
So much. So let's go to Anurag Rana, Senior Tech Analyst for Bloomberg Intelligence. Anurag, let's start with Microsoft here. Why is the stock up so much today?
I think it was down, I think, 40% over the last 12 or so months because of, just rising fears of CapEx and not translating into cloud growth. And I think that's a lot of that is what's driving this big rebound today.
But what's different between what Microsoft telegraphed and what Alphabet telegraphed? Because cloud growth was visible at Alphabet as well, but investors punished the stock.
I think it's, as I said, one of the most important factors is the relative valuation. Second thing is this, on an incremental basis, Azure growth was not improving as much as what we saw that Google is showing. Now, we did see modest improvement in Azure relative growth rate, and it's going to actually get even better next quarter. So I think everybody is saying that finally Azure growth is picking up, and at the same time they are being a little more responsible with their free cash flow. I think that probably is one factor that most people are not talking about, is even next year, next 12 months after they've spent all this money, they will still be free cash flow positive. So they are better managing this entire, you could say, blow up or build up than some of the other vendors that are out there.
So what do you think Meta has to do here, Anurag? I guess it's not enough to say, hey, our advertising business is doing even better because of some of the AI investments we made. What do you think they need to do here realistically?
They have thrown out a couple of things, such as, figuring out when they have those models and some, you could perhaps make some money off of it, but I am not even sure how much you can do that. The second option they're saying is, well, maybe we'll get into the cloud business and compete with some of the other ones. Now, over there, it's not going to be easy because now you're, trying to compete with somebody who's been established for decades. So I think you find themselves in a very, very rough place when you're spending, hundreds of billions, and you have to figure out how to show that ROI. So the big question for them, everybody is asking. In fact, that was the question so much on the call yesterday about the discussion around ROI.
When it comes to CapEx, I just look at what Microsoft has done. There was a time when the CFO had pulled back on CapEx for a little bit, and that raised concerns. This time around, in the quarter that just passed, CapEx increased 70% to $41 billion in the quarter. Analysts had anticipated $42 billion, just coming in $1 billion lower than what analysts had expected. Is that something that Microsoft, kind of massaged, and investors see that and like it?
I think it was not just that. I mean, we have been calling for Microsoft to be a little more responsible for CapEx for the last several months. One of the things they did was they're basically saying going forward, they're going to be using, you could say, renting capacity a little bit more than building it themselves. And second, they also, increase the depreciation of that. So eventually what's going to happen is, just on the surface, that actual big number for the next 12 months is going to look smaller than what it is. But what it does is it helps your free cash flow. And that's something investors are watching very carefully.
So is Microsoft the stock out of the doghouse now? I kind of felt like it was in the doghouse.
It was in the doghouse, absolutely. As I said, I mean, the multiple compression has been so much. I've never believed it that, for a company growing this much, you could, basically completely get them out of the, you could say, run here. But, there are reasons to be careful when it comes to Microsoft also. I mean, everything is good. But the cautionary tale is that they don't have their own chips that are being sold at that, continuous rate as what we are seeing what's happening with Google and Amazon. Now, they have their own chips, but not at that same acceptance rate as the others. So I think that's really what they need to show also over the next 12 to 24 months, that customers are going after their own chips, because that actually helps reduce the CapEx quite a bit. Because right now, what are you doing? You're just going to NVIDIA and buying their GPUs and selling them back.
All right, Anurag Rana, thank you so much. Our senior tech analyst for Bloomberg Intelligence, joining us from Chicago. And to your point, Paul, Microsoft down 13% over the past 12 months, Meta down 23%, Alphabet up 69%. And of course, today that's flipped with Microsoft, the best performer, up 14.5% among the Mag 7 names.
Just amazing. So we'll keep on top of that. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker, the Bloomberg Newsroom, with this Bloomberg Business Flash. So yeah, investors are buying the dip today. The chip makers rebounding. Let's go through some of the chippers. Lam Research, SanDisk, CoreWeave, Western Digital, all leaders right now in the broader market. And of course, you're talking to Anurag about Microsoft. Right now, those shares up 14.3%. The cloud unit grew at the fastest clip in 4 years. And also forecast AI spending that's not necessarily going to break the bank there. Those gains, of course, overshadowed by the slide in Meta Platforms. They had the disappointing quarterly revenue forecast, and the spend also a concern on the capex on AI. Shares there, they are down 9.3%. And of course, investors' attention going to turn to the results from Apple and Amazon. Right now, S&P 500 up 88 points, a rise of 1.2%. 7404 on the index. The Dow Jones Industrial Average is up 337 points, a rise of about 0.7%. The Nasdaq 100, 828 points higher. This is a 3% rise for the Nasdaq 100. And in the yield space, the 2-year is down 5 basis points right now, 421. The long bond at 5.2%. Pretty much unchanged right now. Jersey Mike subs. The initial public offering drawing about 15 times the orders for the shares available. This is according to our sources. And they rang the opening bell for the New York Stock Exchange. It was Danny DeVito and Eli Manning.
Yeah.
Somewhere in my house, I have an autographed framed picture of Eli Manning.
Oh, boy, that's big.
Now it's relegated to like a back shelf somewhere.
Yes, exactly.
One day, maybe it'll be worth some money. But
Exactly.
anyway, we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Paul and Scarlett.
John Tucker, thank you so much. We appreciate that. Scarlett Fu and Paul Sweeney live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. Geopolitics, we're right back on the front and center here. The U.S. and Iran exchange airstrikes as fighting in the 5-month war flared up once again, with hostilities now spreading across the Middle East. Let's get the latest reporting. We can do that with Tyler Kendall, Bloomberg Washington correspondent. She is down there in D.C. Tyler, what's the feeling here? Is there a big push for peace coming from the White House, from Congress, anywhere, or are we just kind of in this, I guess, stalemate here?
Paul, it feels like we're in a cycle of retaliation and strikes, though at the same time, this White House has repeatedly maintained that they would prefer diplomacy be pursued as the top option. But then we got new updates and headlines this morning after the latest wave of U.S. strikes in retaliation for the Iranian strikes against U.S. forces earlier this week. Iranian state media now reporting that this morning the IRGC targeted additional U.S. forces in both Kuwait and Bahrain. And as you mentioned, we're seeing the potential that the conflict could spread even wider as commercial shipping disruptions continue to extend beyond the Strait of Hormuz. Notably, overnight, we saw 2 LNG tankers hit off the Egyptian coast, marking the first such attacks in Egyptian waters since the conflict began back in February. Now, nobody's claimed responsibility for that particular attack, but there had been this heightened focus on the Egyptian Mediterranean coast, considering that we know that there had been heightened focus on Saudi Arabia trying to reroute shipping over there in a bid to avoid the threat from the Houthis in the Red Sea. So it feels like we are continuing to escalate further and further. But I will say that the White House, while some pretty tough rhetoric from President Trump, he has also said that we are repeatedly close to getting Iran back to the negotiating table. We just haven't seen that publicly quite yet.
I'm glad you mentioned the Egyptian waters in Saudi Arabia, because it definitely feels like this conflict is widening out. It's broadening out. Saudi Arabia, Iraq, Egypt, they all are involved in one way or another now. Are they playing a part, if any, in this supposed peace process, the diplomacy that the president says he wants to pursue?
Well, Scarlett, we heard from at least one regional mediator earlier today. That is Pakistan's foreign ministry, who, of course, has been absolutely key in the ongoing discussions. And the ministry said that there are talks happening behind the scenes between U.S. and Iran negotiators, though he didn't give us any further information beyond that, and that those talks are focused on reopening shipping in the Strait of Hormuz, because we know that that is the #1 obstacle at this point, before we can even talk about what those potential talks would look like on curbs to Iran's nuclear program. We do know, as you mentioned, Saudi Arabia and Iraq. Saudi Arabia now getting a little bit more involved in the conflict than previously before, as U.S. and Saudi forces did team up earlier this week to hit what they say were Iranian-backed proxy sites in Iraq. So it's definitely something to watch as regional partners get more entangled into this conflict, and it continues to drag on now as we enter into the 6th month.
Tyler, are there any scheduled negotiations that we should be aware of, or is there really nothing happening at the peace table at the moment?
Well, beyond the comments that we got from Pakistan's foreign ministry, Paul, we don't really have much insight into what the dialogue looks like behind closed doors. Before the recent uptick in fighting that we saw this week, we had heard from the U.S. ambassador to the United Nations, Mike Waltz, say last week that talks were happening at both that more nuanced technical level as well as at the leadership level, seeming to imply that the negotiations were actively happening during that lull in the fighting after that nearly 14 days of consecutive strikes. But since this resumption of strikes, today was really the first confirmation that we had that some sort of dialogue is happening. President Trump did tell reporters earlier this week that Iran was the one that requested the pause in the fighting, but then again, Iran was the one that restarted those attacks during that surprise strike on the U.S. base in Jordan earlier this week. So it's really difficult to pin down exactly where we stand in the diplomatic process, even as the White House says that's the option they would like to pursue without taking further escalation off the table.
All right, Tyler, thank you so much. Tyler Kendall, Bloomberg News Washington correspondent, joining us from the White House. That buzzing sound you heard in the background, I believe it was the lawnmowers over there at the White House.
Yeah.
So
No, I think that was a DeWalt drill, 22 volt.
Oh, okay. Thank you.
That's all right.
Mr. Home Improvement.
Well, maybe they're tearing something down. That's
actually there's a lot of construction going on, so that's a really good point.
Yep.
All right, let's move on now to our next investor who's joining us, Nancy Tengler, a friend of the show, CEO and CIO of Laffer Tengler Investments. Nancy, you just heard from Tyler what's going on in terms of the geopolitics. We know we had this landmark Fed meeting yesterday, which left reporters confused and to some extent the bond market confused as well. And then we have earnings, which are not as confusing, with Meta sinking and Microsoft rallying. From where you sit, what drives the long-term investors' take the most, the long-term investors' view of these three factors?
Well, Scarlett, you raised all the right points, and thanks so much for having me. Earnings are what matter at the end of the day. Geopolitical shock is, of course, a thing and difficult to navigate, but eventually the market becomes numb. And I think we're getting there again, where, I picked up a Wall Street Journal from a week ago, and it was like, we're in a ceasefire. And I thought, geez, I think we've had two since then. So as an investor, I'm going to be focused on the things that drive stock prices, and that is earnings. On the Fed, I'll just say this, having managed money through the Alan Greenspan years, we lived in a perpetual state of confusion, because when he did speak, we had no idea what he was talking about. He was intentionally obscure.
Right.
I think Kevin Warsh is shooting for that. It's going to take the market a bit of time to sort through it and make the adjustment. But the earnings that came out, and it's not just Microsoft, it's Lam Research, Starbucks and Chipotle showed the consumer is still alive. And then we got Quanta Services this morning, which shows data center build out is not dead. And I think that is all of those are important aspects of what has been what investors have been skeptical about and what has been hurting stock prices, especially the growthier names in recent weeks.
And just last night, Nancy, we had Meta and Microsoft report, and boy, their stocks are taking diametrically opposed reactions this morning.
Right.
What does that say about the AI trade in the marketplace these days?
I think, Paul, it says you have to be able to demonstrate that you can monetize the CapEx spend. Where investors are concerned, we do not own Meta. We do own Microsoft. I've been pretty vocal about being out of Meta for a long time, because it's basically an advertising company. And so to sort of float this idea that they're going to lease or, rent out additional capacity, I mean, that's fine, but it doesn't go to strategy and long-term sustainable, growth drivers. So I think what you want to look for in this environment are the companies that are able to monetize. We're in an arms race. We know that. I think Microsoft's flat CapEx, which was reported as a decline, but it was really an accounting adjustment to the useful life of a data center, 15 years to now 25. I think the market was relieved by that. Personally, I think if you're going to compete, you got to spend money. And so I haven't been as alarmed as the market has by the CapEx spend, but you've got to demonstrate you can monetize it.
What we've seen as well with the S&P 500 kind of just bumping along is a stalling out in the big caps, and especially in some of the AI names as well. Small and mid cap growth stocks are getting a little bit of a turn in the spotlight here. How do you think about whether big tech growth, big cap growth is out of the picture? I mean, is it a temporary thing? Is it a 6 month, 1 year kind of thing?
I think it's temporary, Scarlett. I mean, I don't know. I wouldn't say 6 months to a year. I'd say a couple months. I think, we get these movements of regression to the mean in the market. We get corrections every 12 months. This feels like that, because without the earnings growth from technology, the market multiple goes up dramatically. And so I think that the story, at least for us, has been in the 90s, 95 to 99, you saw 60% cumulative earnings growth, but 220% stock price outperformance. This last 5 years, we've seen it's been kind of in equilibrium. So the market multiple hasn't really expanded. And I think you need to see that continue for some period of time before the rest of the market can take over. And I'm not convinced the rest of the market can ever take over. So we have an overweight in some of our strategies to technology, a market weight in others. We have been broadening out overweight in industrials and consumer discretionary over the last couple of years. And that's important to do, but I don't think you can win without technology in your portfolio.
In that case, are data centers evil?
Are they evil?
Yes.
So I'm going to take the other side of that one, Paul. I know it's going to be really unpopular. A parish in Louisiana paid teachers $55,000. This was a Wall Street Journal story, not mine. $55,000 in bonuses, which was more than they make annually, thanks to data center revenues. Loudoun County property taxes have gone down 28%. Energy costs have gone up, but 16%. So I think there's a balance, and the companies are getting very smart about reusing water, which is a big deal in Arizona, where I spent half my life, where we don't have a lot of water and we got a lot of stuff going in, data centers, foundries. So I think they're getting smarter about that. And then the whole power generation aspect of it. I think we're going to find in a couple of years that we aren't talking about this anymore.
All right, Nancy, thank you so much. Nancy Tengler, she is, of course, CEO and CIO of Laffer Tengler Investments, joining us with her take on the markets. It's really notable, Paul, how much the Russell 2000 has beat the S&P 500 just in the past year.
Yeah.
Up 32%, 33% total return. The S&P up almost 18% during that same time.
Yeah, that's the broadening out the trade that a lot of people have been calling for, and a lot of people feel like that's a healthy metric for the market. So we'll keep an eye on that. The S&P up 90 points here, 1.25%. So not nice rebound today. This is good.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker, the Bloomberg Newsroom, with this Bloomberg Business Flash. So the semiconductor stocks, some of the best performing shares as dip buyers jump in. Lam Research, best performing stock in the S&P 500. They delivered positive results. Shares of Lam right now up close to 22%. And Oracle gaining more than 8%, saying it had expanded a partnership with Google Cloud to bring Gemini artificial intelligence tools to its business customers. Right now, communications services, that's actually the worst performing major industry group in the S&P 500. We have the S&P 500 up 97 points right now, up 1.3%, 7413 on the index. The Dow Jones Industrial Average up 340 points, a rise of about 0.7%, and the Nasdaq 100 up 905 points, a rise of 3.3%. The Philadelphia Stock Exchange Semiconductor Index, that is up 8.8%. How's that for a little volatility? Meantime, Matt Miskin at Manulife says, you know what? Bonds are getting his attention.
If you can get 5 to 6% per year for the next 5 to 10 years, it's not bad. And we've got what's called real yield, John. It's been a while. This real yield after the inflation deduction is actually pretty compelling.
Let me give you the long bond quote, 30-year. Well, it's unchanged in terms of basis points right now, 5.2%. You know what? Employers are put in a weird position these days. They're not just scanning resumes, but they're using biometric devices and trying to identify.
What, scanning my eyes?
Yeah, all sorts of things. They're trying to verify applicants' identities. Biometric scans of their faces, actually. That includes your eyeballs.
Wait, to make sure that I'm the person, the person doing the interview?
Let me do the story, and then you can ask all these annoying questions.
Okay, I'm raising my hand in the background.
So they're scrutinizing email histories, even examining the outlets behind them in Zoom interviews. They're concerned about applicants using stolen or fabricated identities to try and boost their chances of getting a job. So there's one example. They uncovered a candidate using deepfakes to impersonate somebody else during a video meeting. In one case, a recruiter interviewed one person only to have somebody entirely different show up on the first day of work. Pretty much how I got my job here. We check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Scarlett and Paul.
All right. Thank you for that, John Tucker. Looking at the markets right now, we have green on the screen in terms of equities, with the NASDAQ leading the way up 2.5%. Within the NASDAQ, one of the big decliners is Meta, although its losses have been moderating, I guess is the way to put it. It's down less than it was before. Meta currently down 9% right now. Investors not liking what they're hearing. So let's bring in David Kirkpatrick, founder of Techonomy, also wrote the book on the company formerly known as Facebook. His book was The Facebook Effect, the inside story of the company that is connecting the world. And David, you point out that Meta disappointing investors, not meeting financial expectations, even marginally, is a major change because Mark Zuckerberg has run this company to consistently and relentlessly top investor estimates. What do you think is going on there?
Well, thanks so much for having me, Scarlett and Paul. We are in an extremely precarious time for any of these tech giants with the scale of capital investment that they're throwing towards AI these days. And the precariousness of the moment is compounded in the case of Meta because, among other things, they're being sued right and left for many things, but especially for harming the mental health of teenagers. I mean, it was interesting that among the one analysis of these results yesterday was that if they hadn't set aside $2.4 billion for legal contingencies, they would have made their earnings number, which they missed. So that's $2.4 billion for most companies would be a really serious problem that you're expecting to pay that kind of money out because of legal settlements. For a company with $60 billion in profits annually, that's not so huge. But it just goes to underscore the complexity of this company's position in society and business. So that they continue to say they're going to spend 130 to 145 billion on capital expenditures for data centers this year. So, wow. That's all I can say.
Yeah, David, it was interesting last night for investors, the compare and contrast of Microsoft with their results and the stock trading up dramatically today, 14, 15%, and yet Meta down about 9%. What is Meta's AI strategy, do you think?
Oh, that's a great question. And I think a lot of analysts on the call with Zuckerberg yesterday would have liked to have gotten an answer for that. I mean, for example, recently Bloomberg broke the news that they were considering renting out data center capacity to other companies like possibly Anthropic or OpenAI, which they haven't yet done. And he didn't say anything about it on the earnings call yesterday. If they did, that would be a good way of monetizing these extraordinary capital expenditures. So far, Zuckerberg keeps making funny noises about, hey, we probably have enough uses for this capacity ourselves. That wasn't a clear answer. They have begun charging money for a lot of things they never charged for before. So you can now pay $50 a month and get access to a human if you have a problem with your Instagram. If you don't pay $50 a month, good luck on that. But the answer is, I don't think they fully know, because I think they're waiting to see how the whole industry settles out. But I do think that Zuckerberg published a very strident and optimistic op-ed in the Wall Street Journal this week, talking about he believes personal superintelligence is going to be the transformative force in the world, and people have to have individual access to that, and big companies can be gatekeepers into that sort of capability. So if you read between all these lines, I think their strategy is they want to more or less compete head-to-head with companies like OpenAI and Anthropic by using advertising to subsidize the offering of free AI services that they believe ultimately will go to individuals all over the world to enhance their lives. That's a long-term statement, but I think that would be a summary of how Zuckerberg thinks about it.
And does Zuckerberg and Meta have the track record for that? I mean, it does selling ads very well, but does it do other things just as well?
No. In fact, it has never done anything well aside from sell ads. It's never had a growing business of any size that really wasn't ad-based. I mean, they had $60.5 billion in revenue, and $59.3 billion of that was advertising this quarter. So, but ads can be used to pay for a lot of things. And I think that's what I was trying to say before, that, we've seen OpenAI, for example, talk about how we're going to try to become an ad company. They can do that, and they're already doing it a tiny bit. But really, that's a really hard transition for a company like that to make. It is the easiest thing. Zuckerberg and Meta are in some ways, the world's best advertising-based company. And as they grow in other areas, if they can continue to use that core competence, it could be a tremendous asset in expanding out in the AI arena. Right now, they're just using AI to make the ads more seductive and their services more addictive. And I mentioned when I sent you a note earlier, I think it's highly ironic that they're being sued for making young people's lives worse because of the addictivity of their services. And yet what they're spending all their AI money on right now is making their services, in effect, more addictive. So they're paying all this money to make their services do more of what they're being sued for in some weirdly ironic way.
David, thank you so much for joining us. Really appreciate it. David Kirkpatrick, founder of Techomedy, joining us here. I mean, just look at the CapEx for Meta. Over the last 3-4 years, it's kind of 30 billion to 35 billion. This year, 136 billion. Next year, 184 billion. And I think investors are just saying, is this quintupling of your CapEx just to support your advertising business? Are we going to get a return on invested capital on that?
Yeah, and what is that going to look like, right?
There's got to be something else out there that you're spending all this money on. You don't have a cloud computing business per se, so it's just, like Azure does, like Amazon does. So that's, I think, what we're seeing.
It's got to go somewhere.
Yeah, it's got to go somewhere. So anyway, that stock is down today. We'll have more coming up. This is Bloomberg.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio.
Tom Keene, Alexis Christophers, Paul Sweeney live here in our Bloomberg Interactive Broker Studio. We're streaming live on YouTube. JMKE, that is the ticker for the new IPO. Jersey Mike subs priced the deal last night at $23 a share. I think that's somewhere kind of in the range there. And it's set to start trading today. Let's see what's going on with that stock and kind of what the pipeline's looking like. We can do that with Anthony Hughes, Bloomberg's equity capital markets reporter. So how did the pricing go last night? And how was it relative to the range and all that stuff?
Yeah, well, the Jersey Mike's IPO priced at the midpoint, which was $23, and it's indicated to open around that level. I think there was a lot of valuation debate, and the price range that was marketed with the price range of 21 to 25. So it was that wide range sort of implies that there was going to be a bit of a debate about how much this company was worth, and it actually was marketed at a premium to some of the comps, including Wingstop, and some people thought that was a little bit generous. You've got a situation here where this is a company that was bought by Blackstone in early 2025, and they're already looking to take it public and crystallize some gains. And they also took out a dividend prior to the company going public, which was about $500 million.
That's smart.
So Blackstone doesn't do badly out of this process, even though on the face of it, it looks like the IPO valuation is not too much higher than the price at which they paid for it.
Clever. You mentioned that Blackstone is going to crystallize some of its gains, not all of its gains, right? It's still holding on to a stake.
Yeah, it's still going to be a major shareholder. So obviously, when sponsor-backed companies go public, the investors like to see that the sponsors don't cash out entirely, and they generally are okay with sponsors selling some of the shares if in certain situations. I mean, ideally, most IPOs would be all primary, not too much secondary. As we've discussed before, this company is a franchise-based business. It doesn't have a huge amount of need for capital. So in some ways, this IPO is driven by Blackstone's priorities. But the company is growing well, and it's got big expansion plans in the UK, looking to build, to open a 300 odd stores in the UK, wow, which is a big part of the growth.
Man, that would. I'm just trying to think. Every block in London has the Pret a Manger. Every block. Put a Jersey Mike's next to that. Oh my God, they're gonna freak out. All right, so here in my IPOs, no primary sellers, none, not allowed. Blackstone's a little bit different. I probably can't push them around too much back in the day.
No, so I think they call the shots more than
sell some
others.
Stock. I guess they're going to. Mike Halen's out with the research from Bloomberg Intelligence. He's saying it's a premium multiple to the comps, but their same store sales are running faster than some of the comps as well. So maybe that's worth it here. How important is this to Blackstone? I mean, to get a good open trading here today, because there's such a monster account out there in the marketplace.
Yeah, well, Blackstone has said that this is the year of the IPO, which has been true to an extent. I mean, they have taken a company called Liftoff Mobile public already this year, and also they took public their own data center investment vehicle. But they had several portfolio companies which have filed to go public and haven't yet gone public and seem to have been delayed. A company called Encore and another one called Entrada. And, they're looking to take some other companies public. But, obviously private equity firms are looking to get some realizations under their belt in what's been a bit of a tough period. And some of these IPO plans and monetization plans for a lot of these portfolio companies have been deferred in this environment in the last year or two. So, it is important for Blackstone to have a good outcome here. I think the issue here is that the IPO market as a whole is tough post SpaceX, and this is indicated to open pretty flat. I mean, it may be that people don't have a lot of patience here if this doesn't come out of the blocks good, and it's always a possibility that it can trade down. A lot of recent IPOs have traded down, and it's been pretty disappointing.
And you talk about recent IPOs, there's also been like food and beverage retailer IPOs that have not done particularly well. I mean, on the one hand, Jersey Mike is not a tech name, so you can just steer clear of the whole AI narrative, but peers in its space haven't necessarily had great debuts.
Yeah, I mean, the consumer sector as a whole has been underperforming the S&P 500 this year, which is quite ironic given that, the bankers are looking to move away from the AI adjacent IPOs here a bit and offer something a bit different to the investors. But, there's a big question mark as to whether consumer IPOs really are going to do well in this environment. But, I think investors are looking for something a little different, and this company is growing growing well within its space, and it has some good numbers looking out for the next year or two. I think the problem with a lot of these sorts of consumer IPOs is they're doing well at the moment. How are they going to do in 2 or 3 years' time? It might be a little bit of a different environment. But this IPO was pretty well supported. It was 15 times oversubscribed, and 20% of the orders got zeroed out, which on the face of it sounds really positive. But we did hear separately there was a fair bit of hedge fund interest in it, and less sort of excitement from the long only side. So you have to take that into account. That there is a bit of nervousness about how this will actually perform.
All right, very good. We'll see. It's kind of indicating around 23, right where it was priced. So we'll see if it opens up. Usually around noonish, I guess. I don't know. Anthony Hughes, thanks so much for joining us. Anthony Hughes, Bloomberg U.S. Equity Capital Markets reporter. For our listeners in the U.S., a reminder, you can listen to us via satellite radio on Sirius XM Channel 121. Access the world's only global audio business network, coast to coast, 24 hours a day. Bloomberg Radio on Sirius XM Channel 121 is presented by Golden Crest Metals. Stay tuned for the latest market news and industry research. The next hour of Bloomberg Intelligence starts in just a moment. Looking at the trading in the market here today, we are trying to claw back some of those losses from yesterday. The S&P is up 72 points. That's about 1%, and the Nasdaq's up 545 points.
But you see the bond market extending the action from yesterday.
Exactly. I mean, the bond market's telling you, the 30-year Treasury's up another basis point, 5.21%, while the short end, the 2 years, down 4.5 basis points. So
yeah, I mean, people still digesting what Kevin Warsh said, or in most instances didn't say at yesterday's news conference.
Yeah, a lot of frustration from some folks out there, but that might be the new way.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney.
How do you think the Fed is looking at tariffs, the uncertainty of tariffs?
Let's take a look at the sectors and how they performed.
A lot of investors getting whipsawed every day by news events.
Breaking market headlines and corporate news from across the globe.
Could we see a market disruption, a market event?
Are people just too exuberant out there?
You see some so-called low-quality stocks driving this short-term rally.
Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio, Originals, and the Bloomberg Business app.
Good Thursday morning from the Bloomberg Interactive Broker Studio in Midtown Manhattan. This is Bloomberg Intelligence with Paul Sweeney, Scarlett Fu, and John Tucker. We've got a lot to get to in the second hour of the program. We're streaming live on YouTube. We're going to talk to Ira Jersey, our chief U.S. interest rate strategist, on the moves in the bond market after Kevin Warsh's second time helming the FOMC meeting. There's a big spike in the 30-year yield yesterday, and it has extended into today. Mark Gurman is our managing editor for Global Consumer Tech. There's a small company named Apple reporting earnings after the closing bell, and he will give us what he'll be looking for in those results. Eric Balchunas, our senior ETF analyst for Bloomberg Intelligence, has an alternative for you if you want to steer away from the AI trade. He says you can go look for an alternative in the trash. He'll explain all of that. And Shiv Verma, the CFO of Robinhood, will be joining us in studio to give us his analysis on Robinhood's latest quarter. Just a reminder that Bloomberg Radio is introducing a new feature exclusively for our .com subscribers and terminal clients. You can participate in our wall-to-wall coverage of earnings. And today at 4 p.m., for instance, we've got a bunch of companies reporting by submitting questions for our analysts and experts to answer live on air. Subscribers can go to bloomberg.com/askradio to send in questions, then listen on Bloomberg Radio and watch on Bloomberg Originals and YouTube at 4 p.m. Eastern. Reminder that Apple will be reporting at 4:30 p.m. this afternoon. All right, let's head over now to John Tucker for a roundup of the latest business news.
All right, and there's a rebound in one of the best performing stocks in the S&P 500 after their earnings results. Lamb up close to 22% right now. You mentioned it, Scarlett, with all the recent worry over AI spending, they kind of look like geniuses at Apple. But the iPhone maker's earnings after the close could remind investors of some of the hurdles that it still faces. Apple shares have been on a roll, 15% rise just in the month of July, 22% overall this year. Oil and gas companies also set for a blockbuster earnings season, helped by energy prices. Energy companies estimated to report a 129% jump in second quarter earnings from a year ago. This is according to all the data compiled by Bloomberg Intelligence. Meantime, Barbara Reinhardt at Voya Investments says the higher bond yields, they're going to eventually weigh on stocks.
We do see on some of our forward-looking indicators that inflation should be rolling over. Income growth is starting to slow. Consumer spending is starting to slow. But the fact is it may not be fast enough to stop probably more equity market weakness as a result of bond yields climbing.
Okay, the long bond will do that. Up almost 2 basis points right now, 521. Dow Jones Industrial Average up 160 points. That's up 0.3%. The S&P 500 up 69 points, up close to 1%. The Nasdaq 100 up 766 points. Now that is a rise of 2.8%. So the days of stumbling across a cheap seat on the airlines, that may be over. Airlines have long relied on analysts to devise the pricing rules, so they increase fares by 20% once a flight is a quarter full. Now, thanks to AI, that's letting carriers change seat prices more quickly.
Dynamically.
So, yeah, they're weighing a bunch of variables in real time, squeezing more revenue out of every flight.
I know. Big sigh.
Yeah, anyway, we check the markets and other stuff right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash, Scarlett Ball.
That other stuff is such a bummer.
It is. I don't know. I'm only flying if people pay me to fly. That's the new
Did you know that he's a United
million mile
flyer?
No, I only get reminded of that every other second.
Every time there's an airline story, we come back to it. John, thank you so much. We appreciate that. Scarlett Fu, Paul Sweeney live here in our Bloomberg Interactive Broker Studio in New York City, streaming live on YouTube and Bloomberg.com as well. So John is just reporting. We got some green on the screen after yesterday's pretty dramatic sell-off here. Let's take a look at some of the stocks on the move today. We can do that with Judy LeGroux. She's a reporter for Bloomberg News. Judy, what do you got for us today?
Sure. It's generally a really big day for earnings today. We've got about $8 trillion in earnings for the S&P 500 coming out today alone. So much to talk about. I will start with Yum Brands, ticker YUM. Shares are trading higher as much as 9.4% on the day, and it is on track for its best day in 18 months. And this is coming because of news about Taco Bell. The business is starting to recover from the Cyclospora parasite outbreak linked to tainted lettuce. And Taco Bell's quarter-to-date comparable sales are down 2%, which was certainly better than the market expected, and it has improved over the last 10 days. One thing I thought was interesting is that Taco Bell is the fastest growing brand in the company's portfolio. So this is a company portfolio that includes KFC and soon to be sold Pizza Hut. CFRA analysts called Taco Bell, quote, the most important segment in the business post Pizza Hut, and that acceleration in comp sales is the key positive surprise in this quarter for the company. So space to watch.
We have
Space to watch.
Right on Lexington Avenue between.
Yes.
It's
another eatery near us.
Boom.
Yeah.
Yep.
All right.
Recently.
Outside of earnings, there is some M&A on this Thursday.
That's right. Market Access Holdings, ticker MKTX. The shares of the company are soaring as much as 30%, and that puts it on track to reach its highest intraday jump in nearly 18 years. This is October 2008. The stock year to date, though, is down 10%, and this is coming as a result of M&A activity. The parent company of the New York Stock Exchange, Intercontinental Exchange, agreed to buy Market Access Holdings for about $6 billion in cash. So this is adding to one of the world's biggest sort of trading platforms. We're adding a fixed income exchange, and particularly around corporate bonds. So definitely a space to watch with respect to the M&A activity. Intercontinental Exchange itself, ticker ICE, is down about 1%. So not much movement there.
All right. Carvana.
Carvana, ticker CVNA, shares are falling as much as 15%. It's on track for its biggest intraday drop since January and its worst day since last April. The shares are down about 29% year to date, and we're continuing to watch Carvana. We've been talking about it on the show today. The full year forecast had a midpoint below analyst estimates, and William Blair analysts called the wide range of profit growth forecasting as particularly complexing. I think that a lot of analysts are really just trying to figure out, like, what the deal with Carvana is. The stock is quite volatile. The company is sort of really not giving very clear signals to the market about its revenue and its profitability. So watching that space as well.
All right, Judy, thank you so much. Judy LaGrue is Bloomberg News reporter here with our Stocks on the Move. And for more conversations like this, be sure to subscribe to our Stock Movers Reports, 5-minute audio reports on the biggest winners and losers in the stock market. It's available on Apple Podcasts, Spotify, or anywhere you listen. Some big news. A redhead, as we like to call it here at Bloomberg. UEFA members have agreed to boycott the World Cup. This is massive.
What does that mean?
Well, they're going to not participate in the World Cup if FIFA, which is the governing body of global soccer, proceeds with this plan to sell a stake in its media and commercial businesses. It's a nonprofit FIFA, but it's going to spin off this arm to monetize, the media rights that it has, and the World Cup and other events that it hosts.
Okay.
And some investors, like Jared Kushner's brother, Josh Kushner.
Oh boy.
So he's got ties to the Trump family, invest in a stake. And where our reporting has shown that Thrivent, which is run by Josh Kushner, is one of the interested parties.
Interesting. All right, there you go.
So, UEFA members are obviously the European football body, and FIFA is the global soccer body.
Boy, look at you.
I did a lot of reading on this because it's so interesting. It's like a big family fight.
We learn something every day, don't we, John?
All right. Well,
but FIFA's not interested in making money.
No, FIFA's very interested in making money.
Yeah, well,
our next guest might be able to help on this.
Yes. Ira Jersey knows a thing or two about soccer. He also knows a thing or two about family fights, speaking of which, because we had this Fed meeting yesterday where officials voted 9-3 to hold rates unchanged. And during the press conference, Fed Chair Kevin Warsh insisted that this decision to leave rates unchanged was not a sign of inertia at the central bank.
Let me reiterate, there is no soft inflation target. There is no soft implicit target, not on this committee's watch. CapEx is preparing the ground for future growth. Nonetheless, the precise timing and magnitude of effects on the supply side remain hard to predict. I asked for a good family fight and I got one. I heard a lot of commonality on the questions. Were there different leans on the answers? You bet there was. In the high mountain air in Jackson, Wyoming, I'd like to also frame the big questions. There is a tendency, especially with the proliferation of meetings and press conferences, to get caught up in the myopic.
Kevin Warsh there, the Fed chair, speaking yesterday. All right, let's bring in Ira Jersey. He is our chief interest rate strategist here at Bloomberg Intelligence. Ira, the bond market reacted pretty dramatically to what happened yesterday. You had the 2-year yield falling, the 30-year yield spiking, and those trends continuing today. Warsh has said he wants to get an unfiltered message from the markets. What is the message that the markets are sending?
That the market doesn't know how to react to this. And I think that that's one of the biggest fallacies in what Kevin Warsh is trying to do, because it's very circular logic here, where he says, look, we don't want to give forward guidance, and we're not even going to give our reaction function, like what we'll do if certain things happen. And because of that, the market has to adjust. So the first thing that you saw, like you noted, the long end sold off pretty dramatically, and that will probably continue to be a little bit of a theme. We could see higher yields, particularly in that 30-year part of the curve. I think in large part because the market has to put in risk premia because it doesn't know what the Fed's going to do in the next 4 to 8 years, however long he happens to be in office. Now, the front end rallied mainly because there were people who thought that the Fed might have hiked yesterday, and in fact, there was about a 30% chance going in of an interest rate increase. So that front end rally was all basically academic and just saying, okay, they didn't hike this time, we have to rally the front end. Let's see what they're going to do in September.
And Ira, we got some pretty tame-ish inflation data today with core PCE. Maybe the Fed can just sit on their hands here. I don't know. What do you think?
Yeah, well, our call has been that they would do nothing, that they would basically be on hold for the rest of this year. It's not impossible that the Federal Reserve does something, but if this data continues on trend in July and August, and we wind up seeing a continued moderation of inflation, then the likelihood that they are on hold in September goes up very dramatically, and I suspect that will ultimately be the issue. I think also the other thing to consider here, Paul, is that, Kevin Warsh has focused very much on inflation during his talk. But when you listen to other members of the Fed and when you just consider who they are and what they've said in the past, they will take the dual mandate into account. So you can't completely discount the jobs numbers and only focus on those inflation data. So keep that in mind too. And of course, we do get another data print next week that could wind up moving the market pretty dramatically in the wage and jobs data.
Okay, Ira, before we let you go, we need to lean on your soccer football expertise. The UEFA members agreeing to boycott the World Cup if FIFA proceeds with plans to sell a stake in its media and commercial businesses. This is groundbreaking, isn't it?
Yeah, it's really interesting. There's been this growing pressure between UEFA and FIFA over time. Things like the Club World Cup, for example, because UEFA's worried that something like a FIFA tournament like the Club World Cup could eat into their cash cow, which is the Champions League, which is the tournament that all of the best clubs from all around Europe play in. And that's really where UEFA makes their money and where a lot of their clubs make their money. So I think UEFA is just worried that they'll be marginalized because they have their own tournament, right? So this all started in part when FIFA suggested maybe we'll go to a World Cup every 2 years instead of every 4, and UEFA really pushed back against that as well. So, but this is major, right? Like, we've never seen a whole confederation boycott a tournament. I mean, that's pretty impressive.
All right. Ira Jersey does the interest rate thing. He does the soccer thing. He
can cover it all.
But we only pay him one salary, though. So we kind of get, we work him twice as hard.
We get buy one, get one free.
Yeah, we get some good value from Ira. Ira Jersey, Bloomberg Intelligence Chief U.S. Interest Rate Strategist. Lots of earnings after the close tonight. Our good friends at Apple are reporting, and boy, the stock's been trading really well. And maybe let's just take it slow on this whole AI thing. Maybe that's paying off here. They're not out there spending the gobs of money that a lot of these other companies are. Mark Gurman joins us, Bloomberg News managing editor for Global Consumer Tech. Joins us here in studio. Is usually based out there in Los Angeles. Mark, what do you think the expectation is? What do you think the company wants to convey tonight on their earnings call?
Well, this is going to be Tim Cook's final earnings call.
Really?
This is going to be his final earnings call. Yeah.
Wow.
We are going to be getting earnings results for his final full quarter in charge.
Okay.
The transition happens
Very cool.
2/3 of the way in through the fourth quarter, which obviously we're already in.
Okay.
Right? Runs through September. So today you're going to hear a lot about probably Cook legacy, Cook looking forward to Turnus taking over as CEO, them presenting this continuity message, talk about how they're going to continue to run the company financially and operationally the same under the new CEO. So essentially trying to use this as a sort of a jumping off board for this transition, but also to talk about how this is happening at an extremely opportune time. Obviously, they just were floating around a $5 trillion market cap.
Yep.
They launched this new Apple Upgrade subscription service, which I think is a blockbuster, and it's going to transform the company and enable its next multi-trillion dollars worth of growth on their market cap. And so they're going to have a lot of praises to sing. They're going to demonstrate a lot of stability. The one knock that you're going to hear on this call is obviously about the memory shortage. They just raised pricing, so that will be the one headwind we hear about. But in terms of the Wall Street numbers, I'd be shocked if they didn't meet the expectations.
No, they're very good about making sure they do just that, Mark. Since this is Tim Cook's last earnings call and earnings meeting with everyone, are they going to hold off on making any announcements, or are they going to try to squeeze something in so that John Turnus starts off with a brand new clean slate, or will John Turnus try to announce new things when he does take over the earnings call next quarter?
Are you talking about products?
Yeah, products or any kind of announcement, really.
So this is all timed for Turnus. He's taking over September 1st. They're going to hold their next product announcement about a week and a half after that. And so he'll be there. He'll do the whole thing. He'll introduce the first foldable iPhone, introduce some new Apple Watches, perhaps a new home device. So this is going to be a pretty significant product announcement series of launches for them that Turnus will be at the forefront of. And that's all about a month away.
30 seconds. Just explain what the subscription product is that you're talking about that could be a game changer? Explain what that is.
So it's a new program. It's called Apple Upgrade, and it's like leasing a car.
Ooh.
Instead of buying the phone outright or an iPad, Mac, Apple Watch, and other Apple devices, instead of financing it, so paying off the cost over payments, it's a lease. So for a phone, for example, $35 a month for an iPhone 17 Pro Max, you pay the $35 a month in perpetuity, and you continue to get new versions of that phone model every year.
But you never own it.
You never own it. And if you want to own it, you have to pay it off, just like with the car. The lease payments are not the car's total cost broken up. It's obviously a percentage of what the car's value is, and then you buy off the car when you want to keep it, or you can trade it in for a new model. But the difference with the car lease payment, there's no drive off with the Apple product. There's no money down. So I think it's a great program. Financially, you're probably better off buying it outright and then selling the phone whenever it's time to buy a new one. But most people are not going to do that. So for 99.99% of people, this is going to be a big hit. And it's the biggest change to how Apple sells products ever.
Right. And you wonder whether they're going to extend this to other products in the Apple universe as well.
Wow.
Mark Gurman, thank you so much. Mark Gurman is our managing editor for Global Consumer Tech. He will be all over Apple's earnings later on today when they announce at 4:30 p.m. Eastern Time. Let's go back to the big headline that we were just talking about. UEFA members, and this is, of course, a European body that governs football, has agreed to boycott the World Cup. There's a lot of conditions here. So I want to bring in Randall Williams. He is our Global Business of Sports reporter here in New York. Randall, they had threatened to do this, to boycott the World Cup, and this is if FIFA moves ahead with spinning off this commercial and media rights arm, the way that the PGA Tour has done with its businesses. Just walk us through how significant this is.
It's huge. So you think about the members of UEFA. It is the world champion, Spain. It is one of the final four, three of the final four, now that I think about it. It is England, it is France, it is Croatia, it is Portugal, where Cristiano Ronaldo plays. And so a lot of these superpowers in the global business of football and the global sport of football are saying, you do this and we're out. That strips the World Cup of a lot of its popularity. And I do think that in the matches that I went to, they have a different culture than what we see in South America that is more tribal in nature. And so I think it's huge. It is a very, very big deal that UEFA is saying no, absolutely not. Now, the next question is, what is CONCACAF going to do? And CONCACAF is over North America, Central America, and the Caribbean. But this is a huge deal.
So how radical is it for FIFA to propose selling a stake in itself?
It's huge. I mean, look, with the PGA Tour and Live Golf comparison, the PGA Tour had to right some things, and Live Golf was exploiting some of maybe the flaws previously in the PGA Tour. Now the PGA Tour is righting its wrong. A lot of the players are happy. There haven't been that many complaints on FIFA's side in terms of how this tournament went. There are European nations who weren't happy with it expanding to 48, but now they're talking about going to 64. What does that mean for those superpowered countries? Is that they play more smaller teams and the group stages get larger, which, you know, of course will grow the money, but is growing the money that way, the way that it's supposed to happen? I'm not so sure. And that's what UEFA is looking at this and saying, if we're going to grow the business of soccer and the business of football, then we need to do it the right way. And this is not the right way.
So the feud is escalating. FIFA must have anticipated this. I mean, I can't imagine that they didn't think UEFA was going to blow up in fury over this. What are you looking for in terms of response from FIFA, how they navigate this?
Well, I would say UEFA and FIFA's relationship has long been strained. They have always been going back and forth, and this was the last straw for UEFA. And so at this point, what I'm watching next is to see what Gianni Infantino does. Like, of course, JP Morgan, who is running this deal with Thrive Capital and Kushner, of course, they are the recipients of this. They're the ones who are giving money. And so this is on FIFA and Gianni to try to get this thing across the finish line. But if you're superpowers, if England, France, Spain, Portugal, Croatia, and so many of them don't participate in the World Cup, is anybody going to watch? Is that money that you're spending that you could potentially be spending? If they say we don't want it, okay, like now what? Is you're going to do a World Cup with a lot smaller nations? I just don't think that that would be successful.
Wow, interesting. All right, this is what I would call a developing story.
Yeah, a major developing story, especially considering, like you said, 3 out of the 4 countries that made it to the finals were part of UEFA. So
the thought is that this money would be spent to develop programs, but is this the right way to do it? How many conversations did JP Morgan and FIFA have with other suitors? Did they go to private equity? Did they have, billionaires who were interested in this? Right. I'm not so sure. It looks like Bloomberg reported a couple days ago, or maybe this morning, that this was already agreed to, or we were talking about it long before the World Cup begins, and that's a problem because for UEFA. So.
All right, Randall, thank you so much. Appreciate short notice. Randall Williams coming in. He covers the business of sport here, and this is all about the business of sport. Right now, let's get a little bit of a radio check here. We can do that with John Tucker and a Bloomberg Business Flash.
All right, just power through this real quick. A day after entering a technical crash in the NASDAQ 100, adding about 2.8%. Investors saw what looked like some bargains, so they jumped in. Semiconductor stocks in particular benefiting. The semiconductor index, the SOX, up close to 8%. Microsoft surging 14% on the strong cloud growth. Some relief, they're not going to break the bank. Also with AI investments, S&P 500 up 61 points. The Dow up 141 points. The NASDAQ 100 up 718 points. And we check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Paul and Scarlett.
All right. Thank you so much, John Tucker. When we talk about the AI trade, there's been a less excitement about it of late. Lots of questions, lots of questioning over whether all this investment is going to be worth it in the end. Today, it's kind of paying off. Meta's decline notwithstanding. You have the NASDAQ up more than 2%. But everyone's looking for a way to hedge perhaps the AI narrative or, alternatives. Eric Balchunas is our senior ETF analyst here at Bloomberg Intelligence, and he and his team have come up with an antidote to the AI trade. And Eric, you have a report that you published where you say the AI antidote can be found in the trash. Literally. You're talking about buying garbage collectors, companies that deal in waste management. Walk us through what you found.
Yeah, on the team, every time there's a really bad day with the glamour stocks like the Qs and DRAM and AI, we'll joke about how, hey, waste management is up. And so I looked into the numbers. We were just, found it amusing for a couple months. And I looked into the numbers, and this is shocking. Waste management has a negative 66 correlation to DRAM, which is, again, the heart of the memory chip trade over the past 4 months. That is more inversely correlated than treasuries, any other stock, first of all, and also gold and even the VIX. So like today, where DRAM did have a great day, it's up 13%. Waste management's down 4%. So it works on the negative too. But I will say that it's kind of poetic maybe that the opposite of these AI dreams is that you still have to pick up the garbage.
Do we have any reason? Is there a fundamental reason why this is there?
No, I just think that when there's a bad AI day, there's algos that rotate, and they generally go by value stocks, industrials, and staples. Staples has a pretty good inverse correlation as well, not quite what the garbage stocks are. But what's interesting, if you look at the industrial sector of which these garbage stocks are in, that's about a flat correlation, which is pretty good. I mean, it's a diversifier, but it's nowhere near negative 66. And then we look at the halo stocks, which is a trade of other sort of, goods and services that you kind of have to have. And the garbage collectors are in that ETF too. But again, the halo ETF is about flat. So these particular garbage companies just have, I think, a special ability to be the actual polar opposite of SK Hynix, basically.
Okay, when you talk about DRAM, the ETF that basically has packaged all the memory chip makers, you're really talking about 3 companies specifically, SK Hynix, Samsung Electronics, and Micron, because they're the big players. Is there an equivalent ETF for the garbage collectors?
No, there used to be one. It was way ahead of its time from Global X called the Waste Management ETF. WSTE was the ticker. Came out in 2011, closed in 2012. So it was like, I mean, talk about being way ahead of your time. But we have this thing called the Lazarus list, where issuers will dig up an old liquidated idea and try it again. We'll work with airlines. Jets was the 3rd attempt at airlines. Maybe someone will try this one. I will say, for anybody out there, this is a 4-month correlation study, and it's based on DRAM, not the general market. However, garbage collectors are still a good diversifier from the general market, but they're not as inversely correlated. They just have a special inverse correlation to this memory chip trade. And I wanted to point that out because bonds have just not done that well. In the past couple months, And the past couple times we've checked, bonds kind of go down with stocks. So people are definitely searching for something.
All right, good stuff. Eric, fantastic reporting and digging around by your team. Eric Balchunas, our senior ETF analyst, with the report that the best AI mania hedge, perhaps, Paul, may just end up being to buy garbage collectors.
There you go. I couldn't have figured that out for the life of me. All right, let's switch gears, get back to the market here. Again, the S&P is up 60 points. The NASDAQ up 490 points, 2%. And the NASDAQ 100 is up 2.6%. So a little bit of a rebound for the tech names. More on the earnings fronts. Robinhood, the digital wealth management firm, reported some numbers that beat estimates. Stock trading down a little bit today. Not to worry. We have the Chief Financial Officer of Robinhood in our studios, Shiv Verma, CFO of Robinhood. Shiv, talk to us about your quarter that you guys reported. What was the message to the street these days about Robinhood?
Yeah, thanks for having me. So first, record quarter. It was our best quarter ever in terms of net deposits. Customers trust us with $22 billion of their hard-earned assets. Really incredible to see. Second, it flowed the financial profile. Record revenue, $1.3 billion, up 32% year over year. So not just on the asset side, but also the revenue. And third, we are launching a ton of new products. We just hit 13 businesses with $100 million of ARR. We added 2 new ones this year, our web product called Robinhood Legend and the credit card. So across the board, really great engagement from customers and translating to financial profile.
One of your existing businesses, crypto, is not doing as well, and it's partly because of the price action that we've seen in Bitcoin and the other digital coins overall. The crypto revenues beat, but they were down about 38% year over year, and weaker volumes may be an issue going forward. What turns that around?
Yeah, so it's a great question. First, we are long-term bullish on crypto. We believe in the asset class. We believe it's here to stay. What are we focusing on? The infrastructure layer. And so a couple things that we announced this quarter, the Robinhood chain, fastest chain ever to hit 100 million transactions. We also launched the Robinhood Earn product. You can lend your crypto out on stablecoin and get 7%. So the asset class and the coins, it's great for customers. You want to provide access. It'll ebb and flow. I've been there 8 years. I've seen probably 4 different crypto winters. But if you invest in the technology and you invest in the infrastructure, we believe that's here to stay. And the Robinhood chain was a great example of that.
Shiv, what's a typical, or who is a typical Robinhood investor? Maybe how has that changed?
Yeah, great question. So who is our median customer today?
Okay.
They tend to be 35 years old. They tend to be married, tend to be educated, extra discretionary income relative to the US, widely distributed across the US, not just a coastal product, 1 to 2 kids, or a cat or a dog. That is our prototypical customer. What they're doing is, as they're getting wealthier, they're using Robinhood for more and more of their products. So we announced Robinhood Banking last year, just hit 3 billion deposits, growing really, really nicely. Our customers also say to us, hey, I bank with Robinhood. Even before we were a bank, that's how they thought about it. And so as they're getting wealthier, they want the same products everyone wants. Retirement assets, those are now up above 35 billion. They want ETFs. We just launched custodial accounts. I have a young daughter. She has an account on Robinhood. Trump accounts. We're now supporting all of the children. And so when I joined 8 years ago, the average age was around 27 or 28. We are growing with our customers. They're getting more wealthy. They're asking for more products. And so we always start with what do our customers want, and then we build it for them. And as you do that, you start to see them consolidate more of their wealth.
Okay, so that median customer you were just describing, what is their interest level towards prediction markets? And you know, when I ask about this, I'm curious beyond sports, the World Cup. You know, what is their interest in trading futures contracts or these event contracts on, I don't know, GDP, the Fed, inflation, something other than sports?
Yeah, so we just announced yesterday that we now have 2 million customers have used event contracts. Smaller relative to our $28 million customer base, but that was 1.5 million customers just a few weeks ago, so growing really nicely. We are seeing customers use it for a wide variety of things. So you mentioned economics. Yesterday was Fed Day. You tend to see a lot of contracts around interest rates. When there's a cultural moment, so whether it was the World Cup, Taylor Swift's wedding, things of those natures, you tend to do it there. Elections are really popular, so we're starting to see a lot, not just for the midterms, but also the primaries. We think we are at the beginning of a prediction market super cycle, that this could actually be bigger than the equities market. The fun part is use cases are coming up out of the woodwork. So an example I've shared before is last winter, we saw a lot of customers trading weather contracts. We were trying to figure out what they were doing. They were hedging their flights. They were waiting for delays, and they thought there'd be another way. We also saw that in a certain state, they were using it during hurricane season. They were supplementing their home insurance. Now, customers weren't explicitly saying, I'm buying insurance, but that they were starting to use. So there are so many different use cases. There's no doubt sports has found product market fit. But if you look overseas, actually the majority of contracts are non-sports. And it tends to be cultural moments, lifestyle, things of that nature. What we're really excited for, how do we make our brokerage product better? Say, for example, you have a view on Apple. You can buy the equity, you can buy a derivative, or in time, you should be able to buy an event contract. Will Apple beat earnings? How many iPhones were they shipped? That's where we think it's going. And so again, sports is a great use case, but there are a lot of other areas that we're starting to see.
How is AI, agentic trading, how is that impacting your business?
So we're at the forefront of it. We believe in AI. And so our agentic products, we just announced it about 100,000 customers. It's really early. This first wave was for customers who are AI native. So you have to plug into your MCP and you have to do your own LLM, such as Codex or Claude Code. Even with that, we still had 100,000 customers just sign up. Where we're going is we're going to make it more native in the app. What does an agent actually do? All it does, it abstracts away a pain point. Let's say you're a customer and you have a view. I want to buy energy stocks. Okay, can you help me do research on that? Great, here's a list of things you could do. Now, can you help me actually execute the trade? That's the next step. And so we're not building agents just for the sake of agents. It's how do you solve customer pain points? So we started with the really techno-native. Now we're going to make it native in the app. And then going forward, we have some really fun things that we're cooking. I don't want to front run the product side, but we think across all of our products, not just brokerage, payments, banking, credit card, et cetera. There's a lot of things you could do.
I'm glad that you mentioned the Trump accounts, and I just want to circle back to that momentarily because you said that this is something you're focused on, bring in customer retention, of course. Analysts see this as a driver of future growth. What's the timeline for a meaningful contribution from the Trump accounts rollout?
Yeah, so it just started in early July, and the uptick has been phenomenal. So some numbers we shared yesterday, over 7 million children have already signed up, and about $1.5 billion of contributions have already been made. So in the first 3 to 4 weeks of being live, that is phenomenal. We are getting inbounds on so many different use cases. So employers, for example, Robinhood said we will match any of our employees. Many other employers have come out and said that, so we're building that. Donors, Michael Dell and Susan Dell have said they're going to make a big donation, so we're building that. We think this will be one of the most powerful ways to help children grow their wealth. The U.S. stock market, as you guys well know, is the greatest creator of human wealth in history. Getting customers to start early is so impactful.
Shiv, thank you so much. A pleasure to see you in our studio. Shiv Verma is the Chief Financial Officer of Robinhood. On the company's latest results, you look at the stock right now, Paul, down about 3.25% at $86.94 a share.
Yep, 25 buys, 6 holds, 1 sell. So the street likes the story, at least at this point. Pretty good story.
All right, much more coming up. This is Bloomberg Intelligence on Bloomberg Radio.